What if the most valuable lessons about money, business, and life were all combined into one book, straight from the mind of the world's greatest investor? Wisdom Beyond Your Wisdom is a hand-picked collection of quotes and timeless advice from Warren Buffett, the legendary chairman and CEO of Berkshire Hathaway. Often called the Oracle of Omaha, Buffett didn't just build a fortune, he built a legacy. From humble beginnings in the 1950s to transforming a struggling textile company into a global powerhouse worth over $600 billion, Buffett's journey has been nothing short of extraordinary. But what makes him truly remarkable isn't just his net worth, it's his unmatched ability to simplify complex financial truths into everyday wisdom. His insights have guided entrepreneurs, investors, and curious minds on the path to financial clarity and long-term success. In this book, endorsed by Buffett himself, you'll discover the quotes people have read over and over again, words that have shaped fortunes, inspired discipline, and sparked better thinking. Are you ready to see the world through Warren Buffett's eyes? Open these pages and get ready to change the way you think about money forever. Someone's sitting in the shade today because someone planted a tree a long time ago. Explanation? This quote by Warren Buffett highlights the importance of long-term planning and investment. Just like a tree takes years to grow before providing shade, success and security in life come from decisions and efforts made in the past. Whether it's financial investment, education, or personal growth, the benefits of wise actions accumulate over time. For example, if you start saving and investing early, you'll have financial security in the future. Similarly, if you develop good habits and skills today, you'll reap the rewards later in life. Moral: 1. Think long-term. Success comes from consistent efforts over time. 2. Make wise decisions today. Your future depends on the choices you make now. 3. Patience pays off. Good things take time to grow and bear fruit. 4. Help future generations. Your efforts today can benefit others in the future. 5. Small steps lead to big results. Even small investments of time or money can lead to great rewards over time. Opportunities abound in America. Understanding and teaching. This quote emphasizes that America is full of chances for growth, success, and prosperity. It means that individuals who are willing to work hard, take risks, and make smart decisions can find numerous opportunities in various fields, such as business, education, and innovation. The country offers a strong economy, access to resources, and a culture that encourages ambition and entrepreneurship. Moral: 1. Hard work leads to success. The more effort you put in, the greater your chances of success. 2. Seize opportunities. Recognize and act on the chances available to you. 3. Innovation and ambition are rewarded. Those who think creatively and take initiative can achieve great things. 4. America values determination. Persistence and dedication can help overcome obstacles. 5. Anyone can succeed. Regardless of background, opportunities exist for those willing to chase them. In the business world, the rearview mirror is always clearer than the windshield. Explanation. This quote by Warren Buffett means that it is much easier to analyze past events and understand what went right or wrong than to predict the future. In business and investing, looking back at historical data and trends gives clarity, but making decisions about the future is uncertain and challenging. For example, after a financial crisis, everyone can analyze and see the mistakes that led to it. However, predicting the next crisis before it happens is much more difficult. Investors and business leaders must make decisions based on incomplete information about the future, making the windshield future unclear compared to the rearview mirror past. Moral lessons. 1. Learn from the past. Use historical insights to avoid repeating mistakes. 2. Be cautious about predictions. The future is uncertain, so always prepare for different possibilities. 3. Make informed decisions. While past trends help, always consider present and future risks before acting. 4. Adaptability is key. Since the future is unclear, being flexible and adaptable is crucial in business and investing. The resilient march of American business, a lesson for investors. Once upon a time, in a small town, there was an old investor named Henry who had seen the stock market rise and fall countless times. He would often sit on his porch, watching the sunset, while young investors gathered around him to hear his wisdom. One day, a nervous young man named James approached him. "Henry," he said, "I keep hearing about market crashes, recessions, and economic downturns. How can I possibly invest when everything seems so uncertain?" Henry chuckled, taking a sip of his tea. "Ah, James, let me tell you a secret. American business has always faced challenges, wars, depressions, financial crises, but it has always bounced back stronger." He leaned forward. "Take the Dow Jones Industrial Average, for example. It started at 66 in the early 1900s and soared to 11,497 by the end of the century. That's a jaw-dropping 17,320% increase. And guess what? This happened despite 4 costly wars, the Great Depression, and multiple recessions. Investors who stayed the course not only saw their stocks rise, but also received dividends along the way." James raised an eyebrow. So you're saying setbacks are normal?" "Absolutely," Henry nodded. "Short-term declines are just part of the game. But over time, the stock market rewards those who have patience and faith in the power of American enterprise." James smiled, feeling a newfound confidence. "As long as I focus on strong businesses and think long-term, I'll be fine." Henry patted his shoulder. "Exactly. Investing isn't about avoiding storms. It's about knowing the sun will shine again. Risk comes from not knowing what you are doing. Understanding and explanation." This quote by Warren Buffett emphasizes that risk is not an inherent part of investing or any endeavor. It arises when a person lacks knowledge or experience. If someone invests in stocks without understanding the business, market trends, or financial principles, they are exposing themselves to unnecessary risk. However, if one takes the time to study, analyze, and make informed decisions, the risk is significantly reduced. For example, if you drive a car without knowing how to operate it, you are at high risk of an accident. But if you learn driving skills, understand road signs, and practice, the risk decreases. Similarly, in investing or business, thorough research and understanding minimize risk. Moral lessons. 1. Knowledge is the key to reducing risk. 2. Educate yourself before making important decisions. 3. Blind decisions lead to unnecessary dangers. 4. Preparation and research create confidence and security. 5. Success favors those who know what they are doing. The power of staying in the game. Why timing the market is a mistake. Investing is a long-term game, and when the fundamentals are strong, it's crucial to stay committed rather than jump in and out based on short-term predictions. Charlie Munger and Warren Buffett firmly believed that trying to time the market, whether by relying on expert forecasts, economic cycles, or even superstitions, is a costly mistake. The stock market naturally fluctuates, but history shows that staying invested yields better results than trying to guess the perfect entry and exit points. Those who attempt to dance in and out of the market often miss the best days, significantly impacting their long-term returns. The risks of being out of the market. While some investors fear the risks of being in the market, Buffett and Munger highlight an even greater risk, being out of it. The market tends to rise over time, and missing just a few key rallies can drastically reduce an investor's overall gains. Instead of trying to predict short-term movements, it's wiser to stay invested and allow the power of compounding to work in your favor. Our experience with newly minted MBAs has not been that great. It's difficult to teach a new dog old tricks. Understanding and teaching explanation. This quote suggests that fresh MBA graduates, despite their academic knowledge, often struggle to adapt to traditional, time-tested business principles. Many MBA programs emphasize modern theories, complex financial models, and aggressive strategies, whereas seasoned investors like Warren Buffett prioritize simplicity, patience, and value-based investing. The phrase, "it's difficult to teach a new dog old tricks," humorously flips the common saying, indicating that younger professionals may resist proven traditional methods in favor of what they've recently learned. Moral lessons. 1. Practical knowledge is key. Real-world business and investing require experience beyond what textbooks teach. 2. Value traditional wisdom. Time-tested principles often outperform overly complex strategies. 3. Adaptability matters. Learning should be a continuous process, blending both new and old insights. 4. Experience over theory. Theoretical knowledge must be tested against real-world situations for true mastery. Look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. Understanding and explanation. This quote by Warren Buffett highlights the importance of embracing market fluctuations instead of fearing them. The stock market moves up and down due to various factors, such as investor emotions, economic news, or company performance. Instead of panicking during downturns or blindly following the crowd during upswings, smart investors use these fluctuations to their advantage. When the market is irrational, either overly optimistic or pessimistic, opportunities arise. If prices drop due to panic, a wise investor can buy quality stocks at a discount. Similarly, when prices are excessively high due to hype, one can sell overvalued stocks for a profit. Moral and key takeaways. 1. Market volatility is an opportunity, not a threat. 2. Avoid emotional investing, stay rational. Buy undervalued stocks during market panic. 4. Sell overpriced stocks during market euphoria. 5. Think independently instead of following the crowd. 6. Long-term perspective leads to success in investing. The company you keep. Once upon a time, in a small town, there were 2 childhood friends, Sam and Jack. They grew up together, playing, studying, and dreaming about their future. However, as they grew older, their paths started to diverge. Sam found himself in the company of hard-working and ambitious people who constantly pushed each other to improve. They discussed ideas, read books, and learned new skills. Over time, Sam developed a strong work ethic and became a successful entrepreneur. On the other hand, Jack fell into the wrong crowd, people who spent their time gossiping, making excuses, and avoiding responsibility. Slowly, he lost interest in his goals, and his dreams faded away. Years later, at a school reunion, Sam and Jack met again. Sam was thriving, while Jack regretted the choices he had made. He realized that the friends he had surrounded himself with had shaped his destiny. The moral of the story: you will move in the direction of the people you associate with. Choose your friends wisely. Surround yourself with those who inspire, challenge, and uplift you. They will help shape your future for the better. To swim a fast 100 meters, it's better to swim with the tide than to work on your stroke. Understanding and teaching explanation. This quote emphasizes the power of external factors in achieving success. Instead of solely focusing on personal improvement, like refining your swimming technique, it is often more effective to align yourself with favorable conditions, such as swimming with the tide. In a broader sense, this means that working smart is just as important, if not more, than working hard. Whether in business, investing, or life, identifying trends, opportunities, and external forces that can propel you forward will often yield better results than isolated self-improvement. For example, in investing, instead of trying to pick average stocks and constantly tweaking your strategy, it's wiser to invest in strong businesses that are already benefiting from economic trends. In business, choosing a growing industry can be more beneficial than just improving your skills in a stagnant one. Moral key takeaways. 1. Work smart, not just hard. 2. Leverage external advantages to maximize success. 3. Align with trends and favorable conditions. 4. Efficiency often beats effort alone. 5. Recognizing opportunities can be more valuable than just skill enhancement. Wall Street is the only place that people ride to in a Rolls-Royce to get advice from those who take the subway. Understanding and teaching. This quote, often attributed to Warren Buffett, highlights the irony of the financial world. Wealthy investors, who have already made significant money, often seek financial advice from analysts, brokers, and fund managers who may not be as financially successful themselves. It points out that having theoretical knowledge about investments does not necessarily mean that a person has achieved great wealth through investing. It also suggests that experience and wisdom in investing are more valuable than simply working on Wall Street. Just because someone works in finance does not mean they are personally wealthy or make the best financial decisions. True financial success comes from practical experience, patience, and sound investment strategies rather than just giving advice. Moral lessons. 1. Wealth does not always equal financial wisdom. Just because someone is rich does not mean they make all their financial decisions wisely. 2. Theoretical knowledge versus practical success. Many financial advisors have knowledge but may not have built personal wealth themselves. 3. Do your own research. Instead of blindly following expert advice, understand investments and develop your own strategy. 4. Experience matters more than titles. Real success in investing comes from long-term experience and proven strategies, not just a Wall Street job. 5. Be cautious with financial advice. Always verify the credibility of those giving financial guidance. I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. Understanding and teaching explanation. This quote by Warren Buffett highlights the philosophy of long-term investing. He is not focused on short-term price movements or trying to make quick profits. Instead, he chooses stocks based on their fundamental strength and potential for long-term growth. Imagine buying a business, not just a stock. If you were to purchase a shop, you wouldn't check its value daily or sell it within a few weeks just because the price fluctuated. Instead, you would evaluate whether the shop is profitable, well-managed, and capable of thriving for years. Similarly, Buffett invests in companies he believes will grow and generate wealth over time, regardless of short-term market conditions. By assuming that the stock market could close for 5 years, he emphasizes the importance of patience and confidence in the businesses he invests in. If an investor follows this mindset, they are less likely to panic during market crashes and more likely to reap significant rewards in the long run. Key takeaways. 1. Think like a business owner, not a stock trader. Buy stocks with the mindset of owning a company for years, not for quick profits. 2. Ignore short-term market fluctuations. A strong company remains valuable even if the stock market temporarily shuts down. 3. Invest in fundamentally strong businesses. Choose companies that can survive and grow for years, not just those performing well temporarily. 4. Patience is key. Long-term investing generates wealth far better than frequent buying and selling. 5. Confidence over speculation. Invest only if you're confident that the company will still be valuable even after 5 years. Buy companies with strong histories of profitability and with a dominant business franchise. Understanding and teaching explanation. This quote emphasizes the importance of investing in businesses that have a proven track record of making profits and hold a strong market position. 1. Strong histories of profitability. A company that has consistently earned profits over many years demonstrates financial strength, stability, and good management. Such companies can withstand economic downturns and continue growing over time. Past profitability often indicates a well-run business with competitive advantages. 2. Dominant business franchise. A dominant business franchise means the company has a strong brand, customer loyalty, and competitive edge. It could be a market leader, have unique product services, or possess pricing power. Businesses like Apple, Google, or Coca-Cola dominate their industries due to strong branding and customer trust. Moral key takeaways. Invest in companies that have a long-term record of profitability. Look for businesses with a strong competitive position and brand strength. Such companies tend to provide stability, growth, and long-term wealth creation. Rule number 1, never lose money. Rule number 2, don't forget number 1. Understanding and teaching. This quote, famously stated by Warren Buffett, highlights the importance of capital preservation in investing. At first glance, it may seem overly simplistic, but it carries deep wisdom. 1. Avoiding losses is crucial. If you lose money, it takes much more effort to recover. For example, a 50% loss requires a 100% gain just to break even. This is why Buffett emphasizes not losing money in the first place. Number 2, risk management matters. Intelligent investors do not chase risky opportunities blindly. Instead, they analyze investments carefully, ensuring they have a margin of safety to avoid significant losses. 3. Long-term mindset. Buffett's rule isn't about never experiencing short-term dips, but about making decisions that protect wealth over time. Successful investors prioritize sustainable gains rather than gambling on high-risk returns. Moral lessons, key takeaways. Capital preservation is key. Protecting your investment should be the first priority. Smart decisions reduce risk. Do thorough research before investing. Losses are hard to recover. A small mistake can take a long time to fix. Think long-term. Short-term risks should not compromise long-term success. Remember the basics. Many investors fail because they ignore this fundamental principle. By following these two simple yet profound rules, one can build lasting wealth while avoiding costly mistakes. The investor's perspective. Buying a business, not just a stock, a store down the street, or a stock on the market. One day, a man named Robert was walking down the street when he noticed a local bookstore for sale. He loved books and thought about buying the store, but before making a decision, he knew he needed to understand everything about it. How much does it earn, he wondered. What are its expenses? Who are its customers? Does it have a strong reputation? And most importantly, is it worth the price? Robert wouldn't just buy the store because he liked books. He wanted to ensure it was a solid business investment. Now, what if instead of a bookstore, Robert was looking at a stock? Wouldn't the same questions apply? The Walt Disney example. In 1966, Walt Disney's stock was trading at $53 per share. To many, it didn't seem particularly cheap, but if you thought of it as buying the entire company, something remarkable appeared. The whole company could be purchased for $80 million. Now, consider what came with that purchase. Classic films like Snow White and Swiss Family Robinson were already generating revenue, even though they had been written off the books. Disneyland, an asset with tremendous value and growth potential. And most importantly, Walt Disney himself, a visionary genius, was still leading the company. To a thoughtful investor, this wasn't just a stock purchase. It was an opportunity to own a piece of an extraordinary business with real, tangible assets and a brilliant leader. Moral of the story. When investing in a stock, think of it as buying an entire business. Would you be comfortable owning the whole company at that price? If not, reconsider your investment. Important points to remember. 1. Think like an owner. Approach stocks as if you were buying the whole business, not just a piece of paper. 2. Evaluate assets and earnings. Understand the true value of what you're buying, including hidden or underappreciated assets. 3. Look for great leadership. A strong company with visionary leadership is a powerful combination. 4. Don't be fooled by the price. A stock might seem expensive or cheap, but what matters is its true value compared to its market price. 5. Invest in what you understand. If you wouldn't buy the whole business because you don't understand it, don't buy the stock either. Would you buy a local store without understanding its business? If not, why treat stocks any differently? You don't want a capital market that functions perfectly if you're in my business. People continue to do foolish things no matter what the regulation is, and they always will. Understanding and teaching explanation. This quote suggests that in the world of investing, the market doesn't need to be perfectly efficient for smart investors to succeed. If every investor made perfectly rational decisions, there would be no opportunity to gain an advantage. However, human nature ensures that mistakes, emotional decisions, and irrational behaviors will always be present, regardless of regulations. Even with strict laws and rules in place, people still act on fear, greed, speculation, and overconfidence. These mistakes create opportunities for those who understand the principles of value investing and market psychology. Successful investors thrive because they can recognize and capitalize on the missteps of others. Think of it like a chess game. If your opponent always played the best move, you could never win. Similarly, in the stock market, it's the irrational actions of others that create opportunities for those who stay disciplined and patient. Moral and key takeaways. 1. Markets are never fully efficient. Human behavior ensures inefficiencies exist. 2. Regulations can't prevent bad decisions. People will always act emotionally, despite rules. 3. Opportunities come from mistakes. Smart investors profit by recognizing and acting on market inefficiencies. 4. Stay rational when others aren't. The key to success is maintaining discipline when others act foolishly. 5. Learn from others' errors. Instead of following the herd, study their mistakes and position yourself wisely. We went from a wooded land to an incredible absolute abundance of riches because the United States has had a system that can unleash human potential. Never bet against what humans can accomplish if they're operating in the right soil, and we have the right soil. Understanding and teaching explanation. The quote emphasizes the transformation of the United States from a land covered in forests to one of immense prosperity. This was not a result of sheer luck, but due to the system in place that allowed human potential to thrive. The right soil metaphor represents an environment that nurtures innovation, entrepreneurship, and hard work. When people are given freedom, opportunities, and resources in a supportive system, they can achieve incredible feats. The United States economic and political framework has historically provided such an environment, making it a fertile ground for human ambition and creativity. The lesson here is that success is largely dependent on the conditions in which people operate. Moral lessons. 1. Right environment matters. Just as plants grow best in fertile soil, people thrive in systems that support innovation and ambition. 2. Never underestimate human potential. When given the right opportunities, humans can achieve extraordinary things. 3. Freedom and opportunity drive growth. Societies that encourage entrepreneurship, investment, and hard work tend to prosper. 4. A good system unlocks success. The right policies, governance, and culture create conditions where people can maximize their potential. 5. Progress comes from vision and execution. Transformations happen when individuals and societies effectively utilize their environment. If you don't know jewelry, know the jeweler. Explanation, understanding, and teaching way. This quote emphasizes the importance of trust and expertise when dealing with something you don't fully understand. If you lack knowledge about jewelry, the best way to ensure you make a good decision is to rely on a trustworthy jeweler who does. It highlights the value of relationships, credibility, and experience. Imagine you want to buy a diamond ring but don't know how to judge its quality. Instead of trying to learn everything about diamonds overnight, you should find a jeweler with a strong reputation who can guide you honestly. The same principle applies in many areas of life, whether it's investing, business, or even personal development. When you lack expertise in a field, surround yourself with reliable experts who do. Moral, point-wise. 1. Trust the experts. If you lack knowledge, rely on those with proven experience. 2. Build relationships. Having a trustworthy advisor is more valuable than trying to learn everything yourself. 3. Reputation matters. Choose mentors, partners, or professionals wisely. 4. Leverage knowledge. Instead of reinventing the wheel, use existing expertise to make informed decisions. 5. Apply in every aspect. This lesson is relevant not just in jewelry, but in business, finance, and life decisions. You only find out who is swimming naked when the tide goes out. Understanding and teaching explanation. Imagine a beach where people are happily swimming in the ocean. As long as the water level is high, you can't tell who is wearing proper swimwear and who isn't. But when the tide recedes, those without clothes are suddenly exposed. This quote, famously said by Warren Buffett, is a metaphor for financial markets, business, and life in general. During good times, when the tide is high, weaknesses remain hidden. However, when challenges arise, when the tide goes out, those who are unprepared, reckless, or overconfident get exposed. For example, in investing, when the stock market is booming, even bad companies may appear successful. But during a downturn, only fundamentally strong companies survive, while weak ones collapse. In business, a company may seem profitable when money is easy to borrow. However, During a financial crisis, those with poor financial management face bankruptcy. In life, a person may appear wealthy by living on credit, but when they lose their income, their financial instability is revealed. Moral lessons. 1. Tough times reveal true strength. Only when challenges arise do we see who is truly prepared. 2. Preparation is key. Always build strong foundations, whether in investing, business, or personal life. 3. Don't be fooled by good times. Just because things are going well doesn't mean weaknesses don't exist. 4. Manage risks wisely. Avoid overconfidence and ensure you have a safety net for difficult times. 5. Long-term stability matters. Those who focus on sustainability will survive downturns and thrive in the long run. Quote, I made my first investment at age 11. I was wasting my life up until then. Understanding and teaching. This quote is from Warren Buffett, one of the greatest investors of all time. It reflects his deep belief in starting early when it comes to investing and financial growth. At just 11 years old, Buffett made his first stock market investment, which set the foundation for his lifelong success. The second part of the quote, I was wasting my life up until then, is not meant to be taken literally. Instead, it humorously emphasizes how valuable time is in investing. Buffett sees every moment before he started investing as a lost opportunity for growth. Buffett's words teach us an important lesson. The earlier you start learning about money, investments, and wealth building, the greater your potential for long-term success. Moral of the quote. 1. Start early. The sooner you begin investing, the more time your money has to grow through compounding. 2. Time is valuable. Every moment you delay learning about finances is a missed opportunity. 3. Invest in knowledge. Before investing money, invest in learning about smart financial decisions. 4. Mindset matters. Treat time as an asset and focus on long-term financial goals. 5. Action over waiting. Even small investments made early can yield significant returns over time. Over the years, a number of smart people have learned the hard way that a long string of impressive numbers multiplied by a single zero equals 0. Understanding and teaching explanation. Imagine you're building a successful business, making great investments, or excelling in any field. You accumulate achievements, profits, and progress, each represented by a number. But if one critical factor in the equation fails, be it poor risk management, a single bad decision, or an unforeseen disaster, it can bring everything crashing down. For example, consider an investor who has made brilliant stock picks for years but fails to diversify. If one unexpected market crash wipes out their entire portfolio, all previous gains become irrelevant, just like multiplying by 0. This concept applies to various areas of life. A company with outstanding revenue but mismanages cash flow can go bankrupt. A student who excels in all subjects but fails in one crucial exam might not graduate. A sports team with top players but lacks teamwork can still lose. The lesson is simple. One critical weakness, if ignored, can nullify all strengths. Moral lessons, point-wise. 1. Success is fragile. One fatal mistake can wipe out years of progress. 2. Risk management is essential. Always prepare for worst-case scenarios. 3. No weak links. A single overlooked flaw can ruin everything. 4. Balance is key. Strength in one area doesn't compensate for failure in another. 5. Pay attention to details. Sometimes small things make the biggest impact. I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. Explanation. Understanding and teaching style. Imagine you are trying to cross a river. You see 2 options, a long jump that requires immense skill and risk, or a series of small stepping stones that get you across with ease. This quote by Warren Buffett teaches us to focus on simpler, high-probability opportunities rather than making things unnecessarily difficult. In investing, business, or life, many people believe success requires tackling the hardest challenges. However, the smartest approach is often to find easy, repeatable wins that accumulate over time. Instead of trying to double your money overnight, look for consistent, low-risk opportunities that steadily grow your wealth. Moral, key takeaways. 1. Focus on simplicity. Choose paths that are easier to execute with high chances of success. 2. Avoid unnecessary risk. Don't take on difficult challenges just to prove something. Opt for safer, smarter moves. 3. Consistency matters more than complexity. Small, steady gains over time lead to great success. 4. Look for opportunities within your skill set. Work within areas where you have an advantage rather than forcing yourself into difficult situations. 5. Success is about smart decisions, not harder work. Being strategic is more important than exerting more effort on tough tasks. Overall, we've done better by avoiding dragons than by slaying them. Understanding and teaching explanation. This quote suggests that in life, business, and investing, avoiding unnecessary risks is often more beneficial than confronting them head-on. Instead of seeking out dangerous challenges, dragons, to prove our strength, it's often wiser to sidestep them entirely. For example, in investing, rather than trying to take down a risky, overhyped stock, the dragon, in hopes of huge returns, it's often smarter to focus on stable, well-researched investments that minimize risk. Similarly, in leadership, avoiding toxic conflicts is often more effective than engaging in unnecessary battles. It's a lesson in prudence, choosing battles wisely rather than fighting every challenge that appears. Moral of the quote: 1. Risk management is key. Avoiding unnecessary dangers leads to long-term success. 2. Not every battle is worth fighting. Choose wisely where to invest your time and energy. 3. Preservation often beats aggression. Stability and longevity matter more than short-term victories. 4. Wisdom is in knowing what to avoid. Success often comes from evading bad decisions, not just making good ones. Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. Understanding and teaching. Imagine you're sailing in a boat that keeps leaking water. You tirelessly patch one hole only for another to appear. No matter how hard you work, you're constantly struggling just to stay afloat. Now compare this to a real-life situation, whether in business, relationships, or personal growth. If you find yourself stuck in a failing situation, constantly trying to fix small issues while the core problem remains, you're wasting your energy. Instead of repeatedly patching a broken system, it's often smarter to find a completely new approach, a new boat that doesn't require constant repairs. Warren Buffett, who said this quote, often applies it in investing. Instead of trying to fix a fundamentally weak business, he prefers to invest in a stronger, more reliable one. The same principle applies to careers, friendships, and strategies. If something is fundamentally flawed, sometimes the best move is to walk away and start fresh. Key takeaways. 1. Recognize when a situation is beyond repair. Don't waste effort on something fundamentally broken. 2. Work smart, not just hard. Shifting to a better opportunity is often more productive than endless small fixes. 3. Be willing to let go. Sometimes success comes from knowing when to move on rather than stubbornly holding on. 4. Apply the principle to all aspects of life. Business, relationships, and personal growth all require knowing when to switch paths. 5. Long-term thinking wins. Choose sustainable, strong foundations instead of constantly fixing weak ones. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Understanding and teaching explanation. This quote by Warren Buffett emphasizes the importance of quality over price when investing in stocks. Imagine you're shopping for a car. Would you rather buy a top-quality, reliable car at a reasonable price or a mediocre car at a super cheap price? The first option ensures long-term satisfaction, while the second might bring frequent issues and higher costs in the future. Similarly, in investing, a wonderful company has a strong brand and loyal customer base, consistent earnings growth and solid financials, competent leadership, a competitive advantage, something that makes it hard for others to compete. If such a company is available at a fair price, it's a great investment because over time it will continue to grow in value. On the other hand, a fair company might be available at a bargain price, but it may lack long-term growth potential, struggle with management issues, or face tough competition. Over time, even if you bought it cheaply, its value might not increase significantly. Moral key takeaways. 1. Prioritize quality over cheapness. A great company will grow over time, even if bought at a fair price. 2. Look for long-term value. Short-term cheap deals may not always be profitable in the long run. 3. Financial strength matters. Choose companies with strong fundamentals rather than just low prices. 4. Think like an owner. Invest in businesses you'd want to own forever, not just stocks for quick gains. 5. Avoid value traps. Cheap stock isn't necessarily a good deal if the company lacks strong growth potential. People who buy stocks for non-value reasons are likely to sell for non-value reasons. Their presence in the picture will accentuate erratic price swings unrelated to underlying business developments. Understanding and teaching explanation. This quote highlights the impact of irrational market participants on stock prices. Many investors buy stocks based on hype, emotions, or short-term trends rather than the actual value of the company. These non-value reasons include social media buzz, FOMO, fear of missing out, or speculative predictions. Since they didn't buy the stock based on its true worth, they are more likely to sell based on similar emotional triggers, panic, rumors, or temporary price drops, rather than any real change in the company's fundamentals. This behavior leads to unpredictable and exaggerated price swings, making the stock market appear more volatile than it actually is. However, these fluctuations are not linked to the company's actual performance, revenue, or long-term potential. In contrast, value investors focus on a company's financial health, competitive position, and future earnings potential. They are less affected by temporary price movements and instead base their decisions on solid research. Moral key takeaways. 1. Invest based on value, not hype. Make decisions based on a company's fundamentals rather than market noise. 2. Emotional trading leads to volatility. Buying and selling based on fear or excitement distorts stock prices. 3. Short-term price swings don't reflect business reality. Stocks can move unpredictably due to non-value traders, but long-term value remains key. 4. Stay patient and rational. Avoid reacting to price swings and focus on the company's real worth. 5. Be wary of the crowd. If many people are investing for non-value reasons, price movements may be misleading. With enough insider information and $1 million, you can go broke in a year. Understanding and explanation. This quote highlights a crucial reality of investing. Having access to insider information and a large sum of money does not guarantee success. In fact, it can lead to financial ruin if used recklessly. Imagine a person who believes that secret market tips will make them rich. They start investing based on rumors or privileged information, assuming that every tip is a golden opportunity. However, the stock market is unpredictable, and even insider knowledge can be misleading or outdated. If the investor lacks proper risk management, emotional control, and fundamental understanding of market trends, they may make poor decisions, buying high, selling low, or over-leveraging their capital. This is why many wealthy but uninformed investors lose everything quickly. They chase quick profits without understanding market fundamentals, the value of patience, or the importance of sound decision-making. Moral and lessons. 1. Knowledge without wisdom is dangerous. Simply having information is not enough. Understanding and proper execution are key. 2. Risk management is crucial. Even with a lot of money, reckless investments can lead to losses. 3. The market is unpredictable. No one, not even insiders, can predict movements with certainty. 4. Discipline matters more than quick tips. Long-term success comes from careful planning, not chasing rumors. 5. Wealth without strategy is temporary. Money alone does not make one a successful investor. Experience, patience, and skill do. The Tale of Two Investors, the Wisdom of Simplicity. Once upon a time, in the bustling city of New York, two friends, Mark and James, set out on their journey to build wealth through investing. Mark was ambitious and eager to beat the market. He spent hours every day studying charts, analyzing trends, and listening to stock tips. Every few weeks, he bought and sold stocks, convinced that he could predict the next big move. James, on the other hand, took a different approach. He remembered his grandfather's words. If you're not a professional, don't try to play the professional's game. Instead, own a piece of the market and let time do the work for you. Following this wisdom, James simply bought a low-cost index fund that tracked the overall stock market. He didn't try to time the market or chase hot stocks. Instead, he consistently invested a fixed amount every month, whether the market was up or down. The market's reality check. As the years passed, Mark's journey was full of excitement and stress. He had some big wins, but also painful losses. He often bought stocks at high prices, only to watch them drop. Trying to recover, he sold in panic, only to see the same stocks soar later. James, however, stayed the course. He understood that trying to buy at the perfect price was nearly impossible. Instead, he focused on avoiding the wrong price by steadily investing over time. While others panicked during downturns, he kept buying, knowing that the market historically grows in the long run. The final outcome. After 20 years, Mark reviewed his results. Despite all his efforts, he barely matched the market's returns. The stress, time, and trading fees had eaten into his gains. James, however, smiled at his portfolio. His index fund had grown significantly, compounding quietly over the years. Without stress, without guesswork, and without picking individual stocks, he had built a solid financial future. Moral of the story: simplicity wins. If you're not going to be an active investor, and very few should, then index funds are the best option. Time in the market beats timing the market. Instead of trying to buy at the perfect price, focus on avoiding the wrong price by investing consistently over time. Own a piece of the economy. A low-cost index fund ensures that you participate in overall market growth without taking unnecessary risks. Patience and discipline are key. The best investors are not those who chase returns, but those who stay invested and let compounding work for them. Invest wisely, stay patient, and let the market work for you. A truly great business must have an enduring moat that protects excellent returns on invested capital. Business history is filled with Roman candles, companies whose moats prove illusory and were soon crossed. Explanation: understanding and teaching way. In business, a moat refers to a company's long-term competitive advantage, which helps it maintain profitability and keep competitors at bay. Just like a medieval castle needed a moat to protect itself from invaders, a strong business needs a moat to safeguard its profits and market position. Some businesses may appear successful in the short term, but if their competitive advantage is weak, their profits quickly decline as rivals catch up. These companies are compared to Roman candles, fireworks that burn brightly but fizzle out just as fast. They lack a sustainable moat, making them vulnerable to competition. Moral key takeaways. 1. A strong business must have a lasting competitive advantage to maintain high returns. 2. Short-term success without a sustainable moat is risky, as competitors will erode its position. 3. Look for businesses with real, durable moats like strong brandings, network effects, or cost advantages. 4. Avoid investing in businesses that shine temporarily but lack long-term protection. Startups are not our game. Many of Berkshire Hathaway's largest holdings are well over a century old. American Express, Wells Fargo, Procter & Gamble, and Coca-Cola were started in 1850, 1852, 1837, and 1886, respectively. Understanding and teaching explanation. Warren Buffett and Berkshire Hathaway focus on investing in well-established, time-tested businesses rather than startups. The reason behind this is simple. Startups come with high risks, unproven business models, and uncertain futures. On the other hand, companies like American Express, Wells Fargo, Procter & Gamble, and Coca-Cola have survived economic downturns, technological shifts, and market competition for over a century. Buffett believes that businesses with strong brand value, stable cash flow, and a proven track record provide better long-term returns than speculative investments in new companies. This strategy is about minimizing risk while ensuring steady growth. Imagine you had to choose between investing in a centuries-old tree with deep roots or a newly planted sapling. The old tree has survived storms and seasons, proving its strength, while the sapling still faces the uncertainty of survival. That's the difference between investing in established businesses and startups. Moral key takeaways. 1. Invest in businesses with a proven track record. Stability and longevity matter. 2. Avoid unnecessary risks. Startups are unpredictable. Established firms offer security. 3. Look for strong brands and steady cash flow. These are signs of a company's ability to endure. 4. Time is a test of business strength. Companies that last for over a century likely have solid foundations. 5. Wealth is built on certainty, not speculation. Wise investors choose proven success over potential hype. You only have to do a very few things right in your life, so long as you don't do too many things wrong. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, highlights a fundamental principle of success, both in life and investing. It suggests that achieving success does not require constant perfection or a long list of achievements. Instead, it is about making a few key right decisions while avoiding major mistakes. Think of life as a game of chess. You don't need to make every perfect move, but as long as you avoid blunders that cost you the game, you stay in the competition. Similarly, in investing, choosing a few great investments and avoiding disastrous losses often leads to long-term wealth. For example, if a person saves and invests wisely in just a few strong assets, they can build financial stability. However, if they make reckless decisions, such as excessive debt, impulsive investments, or ignoring risk, those mistakes can wipe out years of progress. Moral lessons. 1. Focus on key decisions. A few smart choices in life, like career, investments, and relationships, can create long-term success. 2. Avoid major mistakes. Preventing big errors is often more important than seeking perfection. 3. Consistency matters more than quantity. Success is about making a few right moves consistently, rather than chasing too many opportunities. 4. Risk management is key. In life and investing, managing risks wisely prevents setbacks. 5. Long-term thinking leads to success. Making thoughtful decisions and avoiding impulsive mistakes ensures stability and growth. When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. This quote, often attributed to Warren Buffett, highlights the importance of long-term investing in high-quality businesses. It suggests that if you invest in fundamentally strong companies led by exceptional management, you should ideally never sell those investments. Imagine you own a business that consistently grows, generates profits, and is run by trustworthy leaders. Selling such a business just for short-term gains would be like cutting down a tree that bears fruit every year. Instead, by holding on to it, you allow compounding to work its magic, increasing wealth over time. Buffett's philosophy revolves around patience and quality. Instead of frequently trading stocks, he emphasizes buying and holding shares of great companies that continue to grow in value. Moral lessons, key takeaways. 1. Invest in quality. Choose businesses with strong fundamentals and capable leadership. 2. Think long-term. Wealth is built over decades, not days. 3. Trust in compounding. The longer you hold, the greater the rewards. 4. Avoid unnecessary trading. Frequent buying and selling erodes profits. 5. Stay patient and disciplined. Short-term market fluctuations shouldn't shake your confidence in good businesses. Berkshire's ownership interest in all 4 companies, Coca-Cola, American Express, IBM, and Wells Fargo, is likely to increase in the future. Mae West had it right. Too much of a good thing can be wonderful. Understanding and teaching explanation. Warren Buffett, through Berkshire Hathaway, has always followed a strategy of investing in strong, well-established businesses with long-term potential. This quote highlights that Berkshire's stakes in companies like Coca-Cola, American Express, IBM, and Wells Fargo will likely increase over time. The reasoning behind this is simple. If a company is fundamentally strong, has a durable competitive advantage, and generates consistent profits, owning more of it is beneficial. Just like Mae West's humorous take on life, where having too much of a good thing can bring great joy, Buffett applies the same logic to investing. Instead of diversifying into countless businesses, Berkshire focuses on a few high-quality companies and increases its ownership when opportunities arise. This approach ensures stable returns and leverages the power of compounding wealth over time. Moral: key takeaways. 1. Concentration over diversification. Instead of spreading investments too thin, focus on high-quality businesses. 2. Long-term growth matters. Investing in strong companies and holding them for decades leads to wealth creation. 3. Quality over quantity. More ownership in a great company is better than a little in many weak ones. 4. Compounding works best with winners. Increasing ownership in successful companies maximizes returns. 5. Confidence in investments. If you truly believe in a company's future, don't hesitate to invest more in it. This quote aligns perfectly with Buffett's philosophy. If something is great, having more of it is even better. Quote, the business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. Explanation: understanding and teaching way. Many business schools and corporate environments tend to emphasize complex strategies, sophisticated models, and intricate financial structures. They often teach that success comes from mastering these complicated frameworks. However, in real-world business and investing, the most effective strategies are often simple. For example, legendary investors like Warren Buffett follow straightforward principles. Buy great companies at fair prices. Focus on long-term value rather than short-term speculation. Stick to businesses you understand. Despite their simplicity, these principles have led to massive success, proving that effectiveness often lies in clarity and discipline rather than complexity. Moral: point-wise. 1. Simplicity leads to effectiveness. Clear and straightforward strategies work better than overcomplicated ones. 2. Complexity is often unnecessary. Many people complicate things to appear more intelligent, but it doesn't always lead to success. 3. Real-world success favors clarity. Practical decisions based on simple, strong principles outperform theoretical complexity. 4. Focus on fundamentals. Whether in business or investing, mastering the basics and applying them consistently yields better results. 5. Avoid complexity for its own sake. Choose efficiency over complexity. The simplest solution is often the best. I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. Understanding and teaching explanation. This quote, famously attributed to Warren Buffett, is a powerful principle in investing and wealth building. Let's break it down. 1. I will tell you how to become rich. This suggests that wealth creation is not a mystery. There are clear principles that, if followed, can lead to success. 2. Close the doors. This implies focusing on your own strategy without distractions. Avoid the noise of public opinion and market hype. Make independent, well-researched decisions rather than blindly following the crowd. 3. Be fearful when others are greedy. When the market is booming and everyone is rushing to invest, prices often become overinflated. This is the time to be cautious. Overconfidence in the market can lead to bubbles, and investing at peak prices can be risky. Instead of getting caught in the hype, consider whether assets are overpriced. 4. Be greedy when others are fearful. When the market crashes or there is widespread panic, many people sell their investments at low prices due to fear. This is often the best time to buy because great assets are available at a discount. Historically, market downturns have always been followed by recoveries, meaning those who buy during crises often see high returns later. Moral: key takeaways. 1. Avoid herd mentality. Don't blindly follow what the majority is doing. Think independently. 2. Patience pays off. Wealth is built by making strategic decisions, not by reacting emotionally. 3. Buy low, sell high. Fearful markets present opportunities for long-term investors. 4. Market cycles are natural. Ups and downs are part of investing. Use them to your advantage. 5. Stay rational, not emotional. Greed and fear drive market fluctuations, but a disciplined investor remains logical. This principle applies beyond investing. It can be used in business, career moves, and even life decisions. Quote, if you buy things you do not need, soon you will have to sell things you need. Understanding and teaching explanation. This quote highlights the consequences of impulsive spending. When we purchase unnecessary items, we deplete our financial resources. Over time, if we face a financial crisis, we may be forced to sell valuable or essential assets just to survive. For example, imagine someone earning a stable income but frequently buying luxury items, expensive gadgets, or unnecessary fashion trends. If an emergency arises, such as a job loss or a medical crisis, they might struggle to cover essential costs like rent, food, or healthcare. In such cases, they may be forced to sell their car, house, or other important possessions to manage expenses. This principle applies not just to individuals, but also to businesses and nations. Poor financial planning and overspending on non-essential things can lead to economic hardship, forcing people to sacrifice things they once considered essential. Moral lessons. 1. Prioritize needs over wants. Spend wisely and focus on what is necessary before indulging in luxuries. 2. Financial discipline. Develop a habit of saving and budgeting to avoid financial troubles. 3. Think long-term. Before making a purchase, consider whether it will truly add value to your life in the long run. 4. Avoid debt for non-essentials. Borrowing money for unnecessary things can lead to bigger financial struggles later. 5. Protect your future stability. Smart spending today ensures that you won't have to part with essential assets in the future. Like Wayne Gretzky says, go where the puck is going, not where it is. Understanding and teaching explanation. Wayne Gretzky, one of the greatest hockey players of all time, said this to highlight the importance of anticipation and forward thinking. Instead of chasing the puck where it is currently, a smart player predicts where it will be and moves accordingly. This idea applies beyond hockey. It's a powerful lesson for business, investing, career growth, and life decisions. If you only focus on the present, you'll always be reacting rather than proactively positioning yourself for success. For example, investing. Don't just look at what's booming now, analyze future trends and invest accordingly. Business. Successful entrepreneurs don't build for today, they innovate for what customers will need tomorrow. Career. Learning current skills is good, but mastering future demand skills makes you irreplaceable. Moral lessons in points. 1. Think ahead. Success comes from anticipating future trends, not reacting to the present. 2. Be proactive. Don't wait for opportunities. Position yourself to seize them before they arrive. 3. Adaptability is key. The world changes quickly. Staying ahead requires constant learning and adjustment. 4. Strategic vision wins. Whether in sports, investing, or business, the best players succeed by seeing the bigger picture. 5. Preparation leads to success. Those who prepare for the future will always have an advantage over those who only focus on the present. Quote, long ago, Ben Graham taught me that price is what you pay, value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Understanding and teaching explanation. This quote by Warren Buffett emphasizes a fundamental principle of value investing. Ben Graham, his mentor, distinguished between price and value, two concepts that are often confused. Price is simply the amount you pay for something. It is the visible cost, the number on the price tag. Value is what you actually receive in return. It represents the true worth of an item, whether it's a product or an investment. Buffett uses a simple analogy. Whether you're buying socks or stocks, the best strategy is to purchase high-quality goods when their prices are lower than their intrinsic worth. This is the essence of value investing, identifying great businesses and buying them at a discount rather than chasing temporary market trends. For example, if a high-quality stock, a company with strong fundamentals, is temporarily undervalued due to market fluctuations, it becomes an attractive investment opportunity, just like buying a premium product during a sale. Moral and key takeaways. 1. Focus on value, not just price. A low price doesn't always mean a good deal. Assess the true worth of what you're buying. 2. Buy quality at a discount. Whether in shopping or investing, the best purchases are high-quality items at reduced prices. 3. Patience pays off. Waiting for the right moment to buy can lead to better long-term gains. 4. Avoid speculation. Just because something is cheap doesn't mean it's valuable. Research before investing. 5. Think like an investor, not a gambler. Making decisions based on value rather than hype leads to financial success. Before looking at new investments, we consider adding to old ones. If a business is attractive enough to buy once, it may well pay to repeat the process. Understanding and teaching. This quote emphasizes a fundamental investment principle. Instead of constantly searching for new opportunities, first evaluate whether your existing investments still offer strong potential. If a business was worth buying once and continues to perform well, reinvesting in it can often be a smarter move than chasing new, untested opportunities. Consider it like a well-performing restaurant you enjoy dining at. If the food, service, and experience remain excellent, why take the risk of trying an unfamiliar place when you can simply return and have another great meal? Similarly, in investing, before seeking a new stock or asset, analyze whether your existing investments still have room for growth. If they remain fundamentally strong and undervalued, doubling down could yield better returns than venturing into unknown territory. Moral and key takeaways. 1. Strengthen what works. Before looking for new investments, assess whether your current ones are still valuable and can be expanded. 2. Trust proven success. If an investment was worth buying once and remains strong, reinvesting in it may be a smart choice. 3. Avoid unnecessary risks. New investments come with uncertainty. Reinvesting in familiar, high-quality assets can be a safer and more profitable approach. 4. Long-term vision. Successful investing is about compounding good decisions, not constantly chasing new ones. 5. Quality over quantity. A few solid investments can outperform a portfolio filled with untested opportunities. Americans are in a cycle of fear, which leads to people not wanting to spend and not wanting to make investments, and that leads to more fear. We'll break out of it. It takes time. Understanding and explanation. This quote highlights how fear can create a self-reinforcing cycle in the economy. When people feel uncertain or afraid, whether due to economic downturns, recessions, or crises, they become cautious. They cut back on spending and avoid investments, which in turn slows down economic activity. When businesses make less money due to lower consumer spending, they may cut jobs, reduce wages, or shut down, which further deepens fear and hesitation. However, the quote also conveys hope. Economic cycles are not permanent. Though fear-driven downturns take time to recover from, history has shown that economies eventually bounce back as confidence is restored and people begin spending and investing again. Moral and key takeaways. 1. Fear creates a negative cycle. When people hesitate to spend or invest, the economy slows down, leading to more fear. 2. Confidence is key. Economic recovery depends on regaining confidence and trust in the market. 3. Patience is necessary. Recovering from economic fear takes time, but history shows that economies do rebound. 4. Opportunities exist in uncertain times. Smart investors understand that downturns often present the best opportunities for future growth. 5. Economic cycles are natural. Just like downturns happen, so do recoveries. Staying calm and making informed decisions is crucial. The curious case of the falling prices. A lesson from the Buffett household. It was a typical evening in the Buffett household. The aroma of freshly grilled hamburgers filled the air, and Warren Buffett sat at the dinner table, ready to indulge in one of his favorite meals. His children, knowing their father's love for a good burger, laughed as he enthusiastically unwrapped his sandwich. "Dad, what would you do if hamburgers became cheaper?" One of them asked playfully. Buffett's eyes twinkled. "Oh, we'd throw a party. The cheaper they get, the more we can enjoy." The family chuckled, but then Buffett leaned forward, his tone turning more serious. "You know, it's funny," he said. "People are thrilled when the price of something they love drops, whether it's hamburgers, cars, or gadgets. But when it comes to stocks, they react the opposite way." His children looked at him, intrigued. "Imagine you're buying hamburgers for the rest of your life," he continued. "Wouldn't you be happy if their price went down so you could buy more?" Of course! But when stocks go down, people panic instead of celebrating. It's the one thing I've never understood. Why do people fear falling stocks? Buffett's simple analogy revealed a profound truth. If you're an investor planning to buy stocks for years to come, a market drop is like a discount sale on something you are already planning to buy. Yet, most people react with fear instead of excitement. The reason? Emotion. Unlike hamburgers, stocks have a price tag that fluctuates every second, triggering fear when values drop. Instead of seeing an opportunity, many focus on short-term losses, forgetting that lower prices mean better deals for future gains. The moral of the story: if you're a long-term investor, market downturns should make you happy, not scared. Just like Buffett rejoices when hamburgers get cheaper, you should embrace lower stock prices as a chance to buy quality investments at a discount. Key takeaways. Lower prices equals more value. When the price of something you love drops, you should be happy. Stocks are no different. Emotions drive bad decisions. Fear causes people to sell low and buy high, which is the opposite of what smart investors do. Think like a buyer, not a seller. If you're investing for the long term, cheaper stocks mean better future returns. Next time the market takes a dive, ask yourself, would I react the same way if it were hamburgers? If the answer is no, you've just learned a lesson from Warren Buffett. Only buy something you'd be perfectly happy to hold if the market shut down for 10 years. Understanding and explanation. This quote by Warren Buffett emphasizes the importance of long-term investing. It suggests that before purchasing any stock or asset, you should evaluate whether you truly believe in its value and potential, even if you couldn't sell it for an extended period. Imagine if the stock market suddenly stopped functioning for a decade. Would you still feel confident in your investment? If the answer is yes, it means you've chosen a fundamentally strong investment, one that isn't based on short-term speculation or market trends, but on genuine business value. To apply this principle, think like a business owner, not a trader. When you buy a stock, you're essentially buying a piece of a company. Choose businesses you believe in. Assess the company's fundamentals. Is the company financially strong? Does it have a competitive edge? Can it survive and grow over 10 years? Ignore market noise. Don't be swayed by daily price fluctuations or short-term news. Focus on long-term potential. Patience is key. The best investors allow time for their investments to grow rather than constantly chasing quick profits. Moral key takeaways. 1. Invest for the long term, not for short-term gains. 2. Choose quality businesses that can endure and thrive. Avoid emotional decisions based on market fluctuations. 4. Think like an owner, not just a stock buyer. 5. Patience and conviction lead to wealth creation. The stock market is a non-called strike game. You don't have to swing at everything. You can wait for your pitch. The problem when you're a money manager is that your fans keep yelling, "Swing, you bum!" Understanding and teaching explanation. Investing in the stock market is like playing baseball, but with a key difference. In baseball, if you don't swing at a pitch within the strike zone, the umpire calls a strike against you. However, in the stock market, there is no such penalty for waiting. You can be patient, analyzing opportunities and only taking action when the perfect pitch investment opportunity comes your way. However, professional money managers face additional pressure. Their clients, just like impatient fans in a baseball stadium, expect constant action. They want to see their money being actively invested, even when there are no good opportunities. This can lead to bad decisions, as managers may feel compelled to swing at subpar investments just to satisfy expectations. A great investor, like a great batter, ignores the pressure and waits for the right pitch, the one that offers the best chance of success. Moral and key takeaways. 1. Patience is power. You don't have to invest in every opportunity. Wait for the right one. 2. No forced decisions. The stock market doesn't penalize you for not making a move, so choose wisely. 3. Avoid external pressure. Just because others are pushing you to act doesn't mean you should. 4. Quality over quantity. A few well-chosen investments are better than many bad ones. 5. Discipline leads to success. Stick to your strategy and don't be influenced by short-term noise. You are lucky in life if you have the right heroes. I advise all of you, to the extent you can, to pick out a few good heroes. Understanding and teaching explanation. This quote highlights the importance of having role models or heroes in life. Heroes are not just people we admire, they shape our values, decisions, and aspirations. The right heroes can inspire us to become better individuals by setting examples of wisdom, integrity, and success. For example, if you look up to a person known for their honesty, you are more likely to develop honesty in your own life. Similarly, if you admire someone for their resilience, you will learn to overcome challenges with determination. The key is to choose heroes wisely, people who truly embody the qualities you want to cultivate. Warren Buffett, the legendary investor, often speaks about the importance of surrounding oneself with people of strong character. If you admire ethical, hard-working, and intelligent individuals, you will naturally absorb those qualities over time. Moral lessons. Key takeaways. 1. Heroes influence your life. The people you admire shape your thoughts, actions, and future. 2. Choose wisely. Not all successful people are good role models. Pick heroes based on values, not just achievements. 3. Learn from the best. Observe how your heroes think, act, and make decisions. Apply their wisdom in your own life. 4. Surround yourself with great people. Your environment plays a crucial role in personal growth. Choose friends and mentors carefully. 5. Aspire to be someone's hero. As you grow, aim to be a role model for others, inspiring them with your integrity and success. When investing, pessimism is your friend, euphoria the enemy. Explanation. Understanding and teaching way. Imagine you're at an auction and you see a beautiful painting. When everyone is excited and bidding aggressively, the price skyrockets. This is euphoria in the market. Investors get caught up in optimism, pushing stock prices beyond their true value. Buying at this stage is risky because prices are inflated and a correction may follow. Now, imagine the opposite. Nobody is interested, and the painting is selling for a fraction of its worth because people are afraid or skeptical. This is pessimism in the market. Fear drives prices lower than they should be, creating an opportunity for smart investors to buy undervalued assets. Great investors understand this principle. When people are overly pessimistic, stocks become cheap, presenting a buying opportunity. When euphoria takes over, prices are inflated, signaling a time to be cautious. Moral key takeaways. 1. Fear creates opportunity. Market pessimism often results in undervalued assets, making it a good time to buy. 2. Greed leads to overvaluation. Euphoria drives prices too high, making it risky to invest. 3. Successful investors go against the crowd, buy when others are fearful, and sell when others are greedy. 4. Emotions distort market value. Rationality, not emotion, should guide investment decisions. The 5. Patience is key. Recognizing cycles and waiting for the right moment is crucial for long-term success. The long game, why patience wins in investing. The farmer's lesson. A long time ago in a small Midwestern town lived an old farmer named Henry. He had spent decades tending to his fields, growing wheat and corn, and observing the cycles of nature. One day, a young investor named Jake visited him. Jake had been obsessively checking his stock portfolio, buying and selling based on the latest headlines, yet he was constantly stressed and losing money. Henry noticed Jake's frustration and decided to teach him a lesson. He took him to his vast fields and pointed at the crops. "Do you see these plants?" Henry asked. "Yes," Jake replied. "But what does that have to do with the stock market?" Henry smiled. "Tell me, do you think these crops grow taller every day? Do they rise in a straight line?" "No," Jake admitted. "Some days it rains, some days it's dry, some seasons are better than others." "Exactly," Henry said. "The American economy is like this field. It grows over time, but not every day, every month, or every year. Some seasons are rough, but over the decades, the harvest always comes." Jake nodded, but he still looked unsure. "But I keep hearing about recessions and market crashes. What if I lose everything?" Henry chuckled. "The only way to ruin a good farm is by making foolish decisions, like overpaying for bad land or digging up your crops too soon. In investing, the only way to truly lose is by paying high fees or trying to outguess the market. Patience and discipline always win in the long run. The moral of the story: investing, like farming, is a long-term game. The American economy, like a well-tended field, continues to grow over time, even if there are bad seasons along the way. Those who stay patient and avoid unnecessary risks will reap the rewards. Key takeaways. 1. The economy grows over time. It won't go up every day, but productivity increases, making it a long-term positive-sum game. 2. Don't panic over short-term moves. The market has ups and downs, but historical trends show long-term growth. 3. Avoid unnecessary losses. High fees and trying to outsmart the market are the biggest risks to investors. 4. Patience and discipline pay off. The best investors understand that wealth builds over decades, not days. Just like Henry's farm, a wise investor trusts the seasons and lets time do its work. The ability to say no is a tremendous advantage for an investor. Understanding and teaching. Investing is not just about finding the right opportunities, it's equally about avoiding the wrong ones. Many investors fall into the trap of chasing every potential deal, fearing they might miss out, FOMO. However, successful investors understand that patience and selectivity are key to long-term success. Saying no allows an investor to avoid risky or unclear investments, maintain discipline and stick to a well-researched strategy, preserve capital for truly valuable opportunities. Warren Buffett often emphasizes the importance of a too-hard pile, where he discards investments that don't meet his strict criteria. This selective approach prevents emotional decision-making and ensures that each investment aligns with long-term goals. Moral. Key takeaways. 1. Discipline is power. Saying no keeps you focused on quality investments. 2. Avoid emotional investing. Not every opportunity is worth pursuing. 3. Patience leads to better gains. The best investments come with time. 4. Capital protection matters. Avoiding bad investments is as important as making good ones. 5. A clear strategy wins. A well-defined approach ensures consistency and success. It's been an ideal period for investors. A climate of fear is their best friend. Those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance. In the end, what counts in investing is what you pay for a business through the purchase of a small piece of it in the stock market and what that business earns in the succeeding decade or two. Understanding and teaching explanation. Investing is often misunderstood by many, especially those who let emotions and media influence their decisions. The quote emphasizes that the best opportunities arise during times of fear and uncertainty. When markets are in turmoil, stock prices drop, creating a golden chance for patient investors to buy valuable businesses at a discount. However, many people wait for positive news or reassuring words from commentators before they invest. This approach is flawed because by the time the market sentiment turns optimistic, prices have already surged. Essentially, they end up paying a high price just to feel comfortable. What truly matters in investing is not market noise, but two fundamental things. 1. What you pay for the business, valuation at purchase. 2. How much the business earns in the long run. By focusing on these principles rather than short-term fears, investors can make sound, profitable decisions over decades. Moral and key takeaways. 1. Fear creates opportunity. The best investment periods often occur during widespread pessimism. 2. Ignore media hype. Following market commentators blindly can lead to costly mistakes. 3. Price matters. Your returns depend on the price you pay when buying a stock. 4. Long-term business performance is key. A stock's true value is determined by how much its business earns over time. 5. Patience rewards investors. Short-term market fluctuations don't matter. Focus on long-term growth. By keeping emotions in check and investing based on value rather than sentiment, investors can build wealth successfully. Tax-paying investors will realize a far, far greater sum from a single investment that compounds internally at a given rate than from a succession of investments compounding at the same rate. Understanding and explanation. Imagine you have two choices for investing your money. 1. Option A, single compounding investment. You invest in one solid asset that grows at a steady rate over time without selling and reinvesting. This allows your returns to compound without interruption. Up to Option B, successive investments. You frequently buy and sell investments, each time reinvesting the proceeds into a new opportunity that grows at the same rate. However, every time you sell, you have to pay taxes, which reduces the amount available for reinvestment. While both investments may technically grow at the same rate before taxes, the key difference is that Option B faces tax friction. Every time you sell, a portion of your profits is taken as tax, leaving you with a smaller base to reinvest. This means that over the long run, Option A, continuous compounding without tax interruptions, will significantly outperform Option B because your capital remains intact and keeps compounding on itself. Think of it like rolling a snowball. If you keep rolling it without stopping, it accumulates more snow and grows exponentially. If you stop frequently to remove some snow, like paying taxes, the snowball never reaches its full potential. Moral, key takeaways. 1. Tax efficiency is crucial for long-term wealth creation. 2. Uninterrupted compounding leads to significantly greater returns. 3. Frequent buying and selling can erode gains due to taxation. 4. Long-term investing in strong assets is often superior to constant reinvestment. 5. Minimizing unnecessary taxes and fees can maximize overall wealth. Quote, the investor today does not profit from yesterday's growth. Understanding and explanation. This quote by Warren Buffett emphasizes that past success in the stock market does not guarantee future profits. Many investors make the mistake of assuming that just because a stock or market sector performed well in the past, it will continue to do so. However, stock prices reflect expectations for the future, not just past performance. For example, if a company's stock price has already surged due to strong earnings, an investor who buys in late may not see the same level of returns as those who invested earlier. The market constantly adjusts to new information, and yesterday's success may already be priced into today's stock values. Instead of chasing past winners, smart investors focus on future potential, evaluating factors like innovation, competitive advantage, and growth prospects. Moral and key takeaways. 1. Past performance is not a guarantee of future results. 2. Markets are forward-looking. Focus on future growth, not past success. 3. Don't chase stocks just because they performed well before. Analyze fundamentals and future potential before investing. 5. Successful investing requires looking ahead, not backward. A thought for my fellow CEOs. Of course, the immediate future is uncertain. America has faced the unknown since 1776. It's just that sometimes people focus on the myriad of uncertainties that always exist, while at other times they ignore them, usually because the recent past has been uneventful. Understanding and teaching explanation. Uncertainty is nothing new. It has been a part of America's journey since its founding in 1776. Every era has faced challenges, unknowns, and risks. However, human nature causes us to shift between two extremes. 1. When things are stable, we become complacent. If recent times have been smooth, people tend to overlook potential risks, assuming the future will follow the same pattern. 2. When uncertainty rises, fear takes over. During turbulent times, people fixate on the unknown, often exaggerating risks and making decisions based on fear rather than logic. For CEOs and leaders, this means they must develop a steady mindset, acknowledging uncertainty without being paralyzed by it. Success comes from recognizing that uncertainty is always present and navigating it with rational decision-making rather than emotional reactions. Moral and key takeaways. 1. Uncertainty is constant. It has always been part of history and always will be. 2. Perspective shapes reactions. Fear and complacency both stem from how we perceive uncertainty. 3. Avoid extremes. Overconfidence in stability and excessive fear in uncertainty are both harmful. 4. Great leaders stay balanced. They neither ignore risks nor panic. They make informed decisions. 5. History proves resilience. America and businesses have survived and thrived despite uncertainties. A strong leader understands that while the future is unpredictable, thoughtful and rational decisions will always create opportunities. If you own See's Candy and you look in the mirror and say, "Mirror, mirror on the wall, how much do I charge for candy this fall?" and it says more, that's a good business. Explanation. This quote, famously attributed to Warren Buffett, highlights the concept of pricing power in business. See's Candy, a well-loved chocolate brand, has a strong customer base and a loyal following. Because people love its products and associate them with quality, they are willing to pay more each year without hesitation. The key idea is that a truly great business doesn't have to struggle with pricing decisions. If demand remains strong, even when prices rise, it indicates that the company has a competitive advantage, whether through brand loyalty, product uniqueness, or customer attachment. For example, if a company has to cut prices just to maintain sales, it might be in a weak position. But if a company can raise prices and customers still keep buying, it means it holds real pricing power, one of the strongest signs of a great business. Moral, key takeaways. 1. Pricing power is a sign of a strong business. A great company can raise prices without losing customers. 2. Brand loyalty matters. If customers love the brand, they will accept higher prices. 3. Competitive advantage is key. Unique products or strong emotional connections make businesses resilient. 4. Avoid price wars. Strong businesses don't need to compete by lowering prices. They create value that customers willingly pay for. 5. Invest in companies with pricing power. As an investor, look for businesses that can raise prices over time without losing demand. Quote, "Time is the friend of the wonderful company, the enemy of the mediocre." Explanation. This quote, often attributed to Warren Buffett, highlights the power of time in business and investing. A great company with strong fundamentals, innovation, and good management will grow in value over the years. The longer you hold on to such a company, the more it rewards you. On the other hand, a mediocre company, one that lacks competitive advantages, operates inefficiently, or struggles with leadership, will decline over time. No matter how much time it gets, its weaknesses will eventually be exposed, making it a poor investment. For investors, this means that picking quality businesses and holding them for the long term is a key strategy. Instead of chasing short-term gains, focus on companies that can sustain growth and profitability over decades. Moral lessons. 1. Quality matters more than quantity. Investing in a few excellent businesses is better than spreading money across many weak ones. 2. Time rewards strong businesses. The longer a great company operates, the more value it creates. 3. Weak businesses cannot survive forever. Mediocre companies may seem stable for a while, but they will eventually struggle. 4. Patience is key in investing. Long-term thinking leads to wealth creation, while short-term thinking often leads to losses. 5. Your initial investment decisions determine your future success or failure. Quote, "If a business does well, the stock eventually follows." Understanding and explanation. This quote, often attributed to Warren Buffett, emphasizes the fundamental connection between a company's performance and its stock price. Imagine you own a bakery. If your bakery consistently sells delicious products, attracts more customers, and increases profits, its value naturally rises. Over time, if your bakery were a publicly traded company, investors would notice its strong performance and be willing to pay more for its stock. Similarly, in the stock market, short-term fluctuations can be influenced by emotions, news, or market trends. But in the long run, a company's true value is determined by its earnings, growth, and overall business success. A well-managed, profitable company will eventually see its stock price reflect its performance. Moral and key takeaways. 1. Focus on business strength. A strong company with growing profits and sound management will eventually be rewarded in the stock market. 2. Long-term investing matters. Short-term stock prices can be volatile, but in the long run, good businesses drive stock value. 3. Avoid speculation. Investing in hype or short-term trends without considering a company's real business can be risky. 4. Patience is key. Investors should have a long-term perspective and trust that fundamentally strong businesses will appreciate in value over time. Earnings drive stock prices. The primary factor behind a stock's success is the company's ability to generate consistent profits. In stocks, we expect every commitment to work out well because we concentrate on conservatively financed businesses with strong competitive strengths run by able and honest people. If we buy into these companies at sensible prices, losses should be rare. Understanding and explanation. Investing in stocks is not about gambling or taking wild risks. Instead, the key to successful investing lies in selecting the right businesses with solid foundations. This quote highlights the essential principles of smart investing. 1. Conservatively financed businesses. These are companies with strong balance sheets, low debt, and sufficient cash flow to weather economic downturns. Financial stability ensures the company can survive tough times without relying heavily on external borrowing. 2. Strong competitive strengths. A business should have a unique advantage, such as brand power, technological edge, or cost efficiency, that makes it difficult for competitors to take market share. Companies with a moat, economic protection, are more likely to sustain profitability over the long term. 3. Run by able and honest people. Leadership plays a crucial role in a company's success. Honest and competent management ensures ethical decision-making, proper capital allocation, and steady growth. 4. Buying at sensible prices. Even the best businesses can be poor investments if bought at an overvalued price. Investors should aim for fair or undervalued prices to minimize risk and maximize long-term returns. By following these principles, losses become rare because investments are based on strong business fundamentals rather than speculation. Moral and key takeaways. Choose financially stable companies. Avoid businesses burdened by excessive debt. Look for companies with a competitive advantage. A strong moat ensures long-term success. Trustworthy and skilled leadership matters. A company is only as good as the people running it. Valuation is key. Buying even the best company at the wrong price can lead to losses. Smart investing reduces risk. By focusing on these factors, losses become rare and returns become more predictable. Never invest in a business you can't understand. Understanding and teaching. This quote, famously attributed to Warren Buffett, highlights a fundamental rule of investing. Knowledge is power. If you don't understand how a business makes money, what drives its growth, or what risks it faces, you're exposing yourself to unnecessary financial danger. Imagine you're given a golden opportunity to invest in a cutting-edge tech company developing quantum computing solutions. It sounds revolutionary, but if you don't understand how quantum computing works, how the company plans to generate revenue, or what challenges it faces, how can you confidently judge its future success? Many investors get trapped by the hype of new trends, cryptocurrencies, biotech startups, artificial intelligence, etc., without fully grasping the underlying business model. If you invest blindly, you're gambling, not investing. Buffett himself sticks to businesses that have clear and predictable cash flows, like Coca-Cola and insurance companies, because he understands them deeply. This allows him to make rational decisions based on facts, not speculation. Moral, key takeaways. 1. Knowledge is your best defense. Only invest in businesses whose financials, operations, and risks you can clearly understand. 2. Avoid FOMO, fear of missing out. Just because a business is trendy doesn't mean it's a good investment for you. 3. Simplicity wins. If a company's business model is too complex, it's best to stay away. 4. Do your homework. Research and analyze before making investment decisions. 5. Speculation is risky. Investing without understanding is no different from gambling. You should invest in a business that even a fool can run, because someday a fool will. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, highlights the importance of investing in companies of strong, simple, and sustainable business models. The reasoning behind this is straightforward. Management teams change over time, and not every leader will be brilliant. If a business requires an exceptional leader to succeed, it is vulnerable to failure when that leader is replaced by someone less capable. Imagine a company like Coca-Cola. Even if the CEO is not a genius, the business has such a strong brand, distribution network, and demand that it continues to thrive. On the other hand, if a company is too complex and requires extraordinary leadership to stay afloat, it becomes a risky investment. A great business should have the following qualities. Strong brand or market position. The company dominates its industry or has loyal customers. Simple and predictable operations. The business model is easy to understand and difficult to disrupt. Consistent profitability. It generates steady profits regardless of management changes. Competitive advantage. It has strong barriers to entry, such as patents, customer loyalty, or economies of scale. Harsh moral of the quote. Key takeaways. 1. Invest in simple, strong businesses. Avoid companies that rely solely on exceptional leadership. 2. A great company should run itself. Even with average management, the business should continue to thrive. 3. Management changes are inevitable. The business model should be robust enough to withstand bad leadership. 4. Look for lasting competitive advantages. Invest in companies with strong brands, loyal customers, or unique assets. 5. Avoid overly complex businesses. If a company is too difficult to understand, it may be too risky to invest in. Much success can be attributed to inactivity. Most investors cannot resist the temptation to constantly buy and sell. Teaching. This quote emphasizes the power of patience in investing. Many investors believe they need to frequently buy and sell stocks to maximize returns, but in reality, constant trading often leads to unnecessary losses, increased transaction costs, and emotional decision-making. Successful investors recognize that wealth is built over time by holding strong investments and allowing them to grow. Imagine planting a tree. If you keep digging it up to check the roots or moving it to different spots, it will never grow properly. Similarly, in investing, frequent actions often do more harm than good. Instead, patience, discipline, and trust in long-term strategies usually lead to better results. Moral key takeaways. 1. Patience is key. Wealth grows over time, not through constant trading. 2. Avoid emotional investing. Reacting to market ups and downs often leads to poor decisions. 3. Minimize unnecessary trades. More trades mean more costs and higher risks. 4. Long-term strategies win. Successful investors focus on holding quality assets rather than chasing quick profits. 5. Let compounding work. The longer you stay invested, the more your wealth grows. Though the path has not been smooth, our economic system has worked extraordinarily well over time. It has unleashed human potential as no other system has, and it will continue to do so. America's best days lie ahead. Understanding and teaching explanation. This quote highlights the resilience and effectiveness of the economic system in America. It acknowledges that progress is never without challenges. There have been ups and downs, crises, and recoveries. However, over the long run, the system has proven to be remarkably successful. The key strength of this system is its ability to unleash human potential, meaning it provides opportunities for innovation, entrepreneurship, and growth. No other system in history has been as successful in encouraging individuals to create, build, and prosper. The quote also expresses optimism about the future. Despite economic fluctuations, new advancements, technologies, and businesses will continue to emerge, driving progress. History has shown that while short-term struggles are inevitable, long-term growth remains strong. Moral and key takeaways. 1. Progress is not always smooth, but resilience leads to long-term success. 2. A strong economic system creates opportunities for people to reach their full potential. 3. Challenges and setbacks are temporary. Innovation and growth push society forward. 4. Optimism in the future is justified when backed by historical success. 5. Long-term is crucial. Short-term difficulties should not cloud future potential. There are 309 million people out there that are trying to improve their lot in life, and we've got a system that allows them to do it. Understanding and explanation. This quote emphasizes the vast number of people striving for a better life and highlights the existence of a system, likely referring to economic opportunities, free markets, or democratic structures that enables them to achieve their goals. It underscores the idea that ambition and hard work, when supported by the right environment, can lead to personal and financial growth. In simpler terms, it means many people want to improve their lives. There is a system in place, like capitalism, entrepreneurship, or education, that provides opportunities. If individuals take advantage of this system, they can achieve success. This aligns with the broader philosophy of progress and opportunity. People are not stuck in their circumstances. They have the tools to change them. Moral and key takeaways. 1. Opportunity exists. The world provides avenues for growth if one seeks them. 2. Effort is required. Simply having a system isn't enough. Individuals must take action. 3. Freedom to succeed. A system that enables progress ensures fairness and accessibility. 4. Personal growth is a choice. Everyone has the chance to improve, but it depends on their willingness to seize opportunities. 5. Supportive systems matter. Societies thrive when they create environments where people can grow and prosper. The gift of fortune, a family's path to purpose, a windfall beyond imagination. The morning light streamed through the windows as we sat around the kitchen table, sipping coffee, reflecting on the extraordinary turn our lives had taken. A financial windfall, bigger than we had ever dreamed, had come our way. For a brief moment, there was silence, then a question from my youngest, "What do we do now?" It wasn't about spending or luxury. It wasn't about guilt, either. It was about gratitude. A different measure of wealth. We took stock of our lives. We already had more than enough. A comfortable home, security for our children's education, access to good health care, and the ability to enjoy life's simple pleasures. Beyond that, more money wouldn't bring more happiness. But we knew something else. Beyond our doorstep, millions struggled for basic needs: food, medicine, education, opportunity. The difference our excess could make in their lives was enormous. That realization set our course. The 1% rule, enough for us, impact for others. Rather than indulging in extravagance, we made a family decision. We would keep only what we could reasonably need, less than 1% of our wealth. The remaining 99% would be directed toward causes that could uplift others, bringing tangible change where it was most needed. This wasn't charity. It was responsibility. It was an understanding that wealth is not just personal privilege, it's an opportunity to serve. The pledge, a commitment to society. With that clarity, we made a formal commitment, a pledge to give back, to use our fortune as a force for good. It wasn't about recognition or moral obligation. It was simply the best use of what we had been given. We had seen the truth. Money, beyond necessity, is only meaningful when it creates impact. Moral of the story: true wealth is not measured by what we keep, but by what we give. Gratitude, not guilt, should guide fortune. When we recognize that excess resources can dramatically improve the lives of others, giving becomes the most fulfilling path forward. Key takeaways. 1. Gratitude over guilt. Wealth should be seen as an opportunity, not a burden. 2. More doesn't equal happier. Once basic needs are met, extra money doesn't enhance well-being. 3. The power of 1 cent. Keeping only what you need allows the rest to make a life-changing difference for others. 4. Wealth as a tool. Money is most valuable when used to uplift society. 5. A legacy of impact. The greatest mark we leave isn't in what we accumulate, but in what we share. This is the path we chose, and it has given our family a greater sense of purpose than any material wealth ever could.
It is optimism that is the enemy of the rational buyer. Understanding and teaching explanation. This quote suggests that when someone is overly optimistic, they may lose their ability to make logical or well-thought-out buying decisions. Let's break it down in a simple and relatable way. A rational buyer is someone who makes decisions based on facts, research, and logic. They think about value, need, price, and long-term benefits. Optimism, in this context, means having a positive outlook that something will go well, sometimes without enough proof or evidence. When people become too optimistic, e.g., thinking an investment will surely succeed or a product will definitely change their life, they may ignore warning signs, skip research, or overpay. This quote warns that blind positivity can cloud judgment and lead to poor decisions, especially when money is involved. Think of it like this. Imagine someone buying a house in a booming market. A rational buyer would look at the price trends, interest rates, condition of the house, and resale value. But an overly optimistic buyer might ignore all that and say, the market will keep going up forever. That kind of thinking can lead to regret. Moral lessons. 1. Stay grounded in facts, not just feelings. 2. Don't let excitement or hope override research and logic. 3. Optimism is good, but too much can blind you to risks. 4. Wise decisions require a balance of hope and analysis. 5. In buying or investing, think with your head, not just your heart. But I think it is very easy to see what is likely to happen over the long term. Ben Graham told us why. Though the stock market functions as a voting machine in the short run, it acts as a weighing machine in the long run. Fear and greed play important roles when votes are being cast, but they don't register on the scale. Understanding and teaching explanation. This quote comes from the world of investing and is inspired by Benjamin Graham, a legendary value investor and mentor to Warren Buffett. Let's break it down step by step. Stock market functions as a voting machine in the short run. In the short term, stock prices can go up or down based on popular opinion, hype, emotions like fear and greed, news, trends, or rumors. It's like a popularity contest where many people are just reacting emotionally. Acts as a weighing machine in the long run. Over time, emotions settle, and what really matters is the true value of the company, its earnings, growth, fundamentals, and performance. That's what gets weighed. Fear and greed play important roles when votes are being cast. When people are scared during a crash or overly greedy during a boom, they make quick decisions, pushing prices up or down irrationally. But they don't register on the scale. These emotions don't affect the actual value of the company. In the long run, only real performance and intrinsic value count. In simple terms, the stock market can be chaotic in the short run because of emotions and trends. But in the long run, only a company's real value and performance will determine its worth. Moral key takeaways, point-wise. 1. Don't follow the crowd blindly. Popularity fades, but value remains. 2. Avoid making decisions based on fear or greed. They distort reality. 3. Invest with a long-term perspective, focusing on fundamentals. 4. Short-term market movements are noise. Long-term trends reflect truth. 5. Patience and rational thinking are powerful tools in investing. Today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Understanding and teaching explanation. This quote, likely from an investor like Warren Buffett, is a warning about the long-term downsides of holding too much cash or cash-like investments, like savings accounts, treasury bills, or money market funds. Breaking it down. 1. Today, people who hold cash equivalents feel comfortable. Many people think holding cash is safe because it's not risky like the stock market. It feels stable. 2. They shouldn't. The comfort is misleading. It may seem safe in the short term, but it's actually risky in the long term. 3. They have opted for a terrible long-term asset. Holding cash is a bad decision for the long term because it doesn't grow or earn much. 4. One that pays virtually nothing. Interest rates on cash are extremely low, so your money doesn't grow over time. 5. And is certain to depreciate in value. Inflation causes the value of money to drop, so over time your money loses buying power. Simple example. If you keep $10,000 in cash for 10 years with 0.5% interest but inflation is 3%, you're actually losing value every year. Your money may feel safe, but it's slowly shrinking in terms of what it can buy. Moral key takeaways, point-wise. 1. Cash feels safe, but it's not a good long-term investment. 2. Low interest rates mean your money doesn't grow. 3. Inflation slowly erodes the value of your cash. 4. For long-term goals, invest in assets that grow, like stocks, real estate, etc. 5. Comfort today can lead to regret tomorrow. Think beyond short-term safety. Munger made me focus on the merits of a great business with tremendously growing earning power, but only when you can be sure of it, not like Texas Instruments or Polaroid, where the earning power was hypothetical. Understanding and teaching way, explained simply. This quote refers to investment wisdom shared by Charlie Munger, Warren Buffett's longtime business partner. Munger taught the importance of investing in great businesses, companies that have the ability to consistently grow their earnings, profits, over time. But he added an important caution. Only invest in such companies if you're confident their growth is real and sustainable. He contrasts this with companies like Texas Instruments and Polaroid at certain times in history, companies that seemed promising, but whose future earnings were based on speculation or hope, not certainty. So the key message is, don't get distracted by hype or what might happen. Only invest when the business fundamentals clearly support long-term growth. Moral key lessons, point-wise. 1. Invest in businesses with strong, proven earning power. 2. Analyze deeply, make sure the growth is real, not just theoretical. Avoid investing in companies with unclear or speculative futures. 4. Follow rational analysis over hype or trend-based decisions. 5. Long-term value comes from reliable, consistent growth, not hopeful guesses. The definition of a great company is one that will be great for 25 or 30 years. Understanding and teaching explanation. This quote emphasizes long-term success over short-term popularity or profit. A company isn't considered truly great just because it's doing well right now. It's great if it can stay strong, valuable, and relevant for decades. Here's how to understand it better. Short-term success is easy. Any business can have a few good years. Long-term greatness is hard. It means the company consistently adapts, innovates, and stays true to its values. A great company builds a strong foundation, like a clear mission, loyal customers, great leadership, and ethical practices that lasts through challenges and changes in the market. Teaching example. Think of it like a tree. A small plant might grow fast in the sun, but only a strong tree with deep roots will survive storms and keep growing for 30 years. That's how a truly great company behaves, strong, steady, and built to last. Moral key learnings, point-wise. 1. True greatness is measured over time, not just in moments of success. 2. Sustainability and consistency are key traits of a great company. 3. Adaptability and long-term vision matter more than quick wins. 4. A company must evolve with changing times to remain relevant. 5. Leadership, culture, and values play a big role in lasting success. Success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people in trouble investing. Understanding and teaching way, explanation. This quote, often attributed to legendary investor Warren Buffett, highlights an important truth about investing. It doesn't matter how smart you are. Your IQ doesn't guarantee success. If you have basic intelligence, that's already enough. What really matters is your emotional discipline, your temperament. In investing, people often lose money not because they aren't smart, but because they let emotions like fear, greed, or impatience guide their decisions. Being able to stay calm during market highs and lows and stick to your plan is what sets successful investors apart from the rest. So, it's less about brain power, more about self-control and good judgment under pressure. Moral of the quote, point-wise. 1. Intelligence alone doesn't guarantee investment success. 2. Ordinary intelligence is sufficient for investing. Emotional control is more important than IQ. 4. Avoid impulsive decisions based on fear or greed. 5. Patience and discipline are key traits of successful investors. 6. Consistency beats brilliance in the long run. There seems to be some perverse human characteristic that likes to make easy things difficult. Warren Buffett. Understanding and teaching explanation. This quote by Warren Buffett highlights a curious trait in human behavior. Let's break it down. There seems to be. This suggests that it's a common observation, not necessarily a proven fact, but something seen often. Some perverse human characteristic. The word perverse here doesn't mean evil. It means contrary or irrational. It refers to a tendency people have that goes against logic or simplicity, that likes to make easy things difficult. This is the main idea. Instead of embracing simplicity, people often complicate things unnecessarily, whether out of habit, overthinking, ego, or trying to appear smarter. Teaching angle. Imagine you're solving a math problem that has a simple trick. Instead of spotting it, you start using complex formulas, not because it's needed, but because you assume it must be hard. That's what this quote is about, how we often overcomplicate what could be simple. It also applies to life decisions, work processes, communication, and relationships. Sometimes people prefer complexity because it feels more important, or they don't trust that the simple way could really work. Moral, point-wise. 1. Simplicity is powerful. Often, the simplest approach is the most effective. 2. Avoid overcomplicating. Don't make things harder than they need to be. 3. Trust the process. Sometimes easy solutions are the right ones. 4. Stay aware of your habits. Recognize when you're complicating things unnecessarily. 5. Value clarity over complexity, especially in communication and problem solving. Periodically, financial markets will become divorced from reality. Understanding and teaching explanation. Let's break this down in a simple and understandable way. Periodically means from time to time or occasionally. It doesn't happen all the time, but it does happen again and again. Financial markets refer to places or systems where people buy and sell financial assets like stocks, bonds, and commodities. Divorced from reality is a figurative way of saying that the prices or behaviors in the markets do not reflect the real-world economic conditions or true value of assets. In simple terms, sometimes the stock market or other financial markets behave in ways that don't match what's happening in the real economy. For example, stock prices may go way up even when companies are not making more money or when the economy is struggling. This can happen due to hype, speculation, or herd behavior, not because of actual value or performance. Moral lessons, point-wise. 1. Always research before investing. Don't blindly follow market trends. Understand the actual value of what you're investing in. 2. Markets can be irrational. Prices can rise or fall based on emotion, not logic. 3. Stay grounded in fundamentals. Long-term investing success comes from focusing on real economic data and company performance. 4. Be cautious of bubbles. Sudden rises in market prices without real support may indicate a bubble, which can burst. 5. Don't panic during disconnects. Just because markets behave oddly doesn't mean you need to react emotionally. Stick to your strategy. The uncertain tomorrow and the power of human potential. A story with a lesson for today and every day. Once upon a time in a bustling little town, nestled between vast fields and endless skies, there lived an old man named Walter. He was quiet and humble, known around town as the timekeeper, not because he dealt in clocks, but because he had lived long enough to see many chapters of history unfold before his eyes. Each evening, Walter would sit on a wooden bench outside his shop, sipping tea and talking to anyone who would listen. Children, travellers, and worried townsfolk would gather around him, especially when times felt heavy. One cool autumn evening, a young man named Ethan sat beside Walter with furrowed brows and a restless heart. "Walter," he sighed, "the world feels like it's falling apart. The news is full of crisis, division, war, and warnings about the future. How can anyone have hope when tomorrow feels so uncertain?" Walter looked at Ethan kindly and nodded. "Ah, yes," he said, "I've heard that song before, many times." He took a long sip of tea, gazing into the sunset. "You know, when I was your age, people said the same thing. They feared the future. They believed doom was near. But do you know what actually happened?" Ethan shook his head. Walter smiled. "Life got better. Much better. In fact, people today, yourself included, live 6 times better than when I was born. Despite all the fear, the world kept turning and we kept growing, not because problems disappeared, but because human potential never stopped rising. Ethan looked puzzled. But how, with so much uncertainty? Ah, said Walter, you see, the mistake people make is putting all their attention on what might go wrong. But the most powerful force in the world isn't fear, it's potential. The American system, with all its flaws and bumps, has given dreamers the chance to build, to create, to recover, even after wars and recessions. People underestimate how strong and resilient the human spirit is when it's given the freedom to thrive. He paused, letting the thought sink in. Tomorrow is always uncertain, Walter continued, but that's not a reason to be afraid. It's a reason to be curious, to be hopeful. We don't know what's coming, but we know what we're capable of. That's what matters most. Moral of the story, uncertainty is a constant, but so is human potential. Don't fear tomorrow. Believe in the ability of people to rise, adapt, and improve. Key takeaways. Fear is loud, but progress is often quiet and steady. Every era has had its doomsayers, yet humanity has repeatedly overcome obstacles. Our systems, though imperfect, still allow innovation, freedom, and resilience to flourish. Focusing on potential rather than panic opens the door to optimism and action. So the next time uncertainty comes knocking, remember Walter's words. There's more strength in hope than in fear. I tell everybody who works for our company to do only 2 things to be successful. They are 1, think like an owner, and 2, tell us bad news right away. There is no reason to worry about good news. Understanding and teaching explanation. This quote is a simple but powerful piece of advice for employees or team members. 1. Think like an owner. This means you should treat the company as if it were your own. Take responsibility, care about results, and think long-term. Don't just do your job to get it done. Do it with passion, creativity, and commitment, like someone who has a personal stake in the outcome. 2. Tell us bad news right away. If something is going wrong or there's a problem, share it immediately. Don't hide it or delay, because the sooner the problem is known, the faster it can be fixed. It shows honesty, courage, and team spirit. 3. There is no reason to worry about good news. Good news takes care of itself. Everyone loves hearing good news, but it's the bad news that needs quick action. Focusing on problems early helps prevent bigger issues later. Moral. 1. Take ownership of your work. Act like it's your own business. 2. Be responsible and proactive, not just reactive. 3. Don't be afraid to communicate problems early. It builds trust. 4. Open and honest communication helps teams grow stronger. 5. Growth and success come from responsibility, not just celebration. It's far better to own a portion of the hope diamond than 100% of a rhinestone. Explanation. Understanding teaching style. Let's break it down to make it clear. The hope diamond is a rare, incredibly valuable gemstone. Even owning a small piece of it means you have something precious. A rhinestone is a fake or imitation diamond. Even if you own all of it, it doesn't hold much real value. So what is this quote really saying? It means quality is more important than quantity. It's better to have a small share in something valuable, meaningful, or truly great than to fully own something that looks flashy but is ultimately cheap or meaningless. This applies to many areas in life: investments, friendships, projects, education, or even time. It's smarter to be part of something genuinely valuable than to hold on to something that only seems impressive on the surface. Moral. 1. Value quality over quantity. 2. It's wiser to have a small part in something valuable than full control of something worthless. 3. Don't be fooled by appearances. True worth lies in substance, not surface. Sometimes, collaborating or sharing in something great brings more benefits than going solo on something mediocre. 5. Be thoughtful about what you invest your time, energy, or money in. Choose value over volume. Do not take yearly results too seriously. Instead, focus on 4 or 5 year averages. Understanding and teaching explanation. This quote is about long-term thinking and consistency over time. Here's how to understand and explain it. Sometimes, our performance in 1 year might be better or worse than usual due to many factors: luck, circumstances, market conditions, or personal situations. But that 1 year does not define your true ability or value. What really matters is how you perform over a longer period, like 4 to 5 years, because this shows your real growth, effort, and stability. Whether it's in business, school, personal goals, or investing, don't judge yourself or others based on just one result. Focus on the trend over time. It teaches us to be patient, consistent, and not to be discouraged or overconfident from short-term results. Moral 1. Don't judge success or failure based on a single year's result. 2. Consistency over time is more valuable than one-time achievements. 3. Long-term thinking leads to better decisions and less stress. 4. True progress is seen through averages over several years, not temporary highs or lows. 5. Be patient with your journey. Growth takes time. We are not natively smarter than we were when our country was founded, nor do we work harder. But look around you and see a world beyond the dreams of any colonial citizen. Now, as in 1776, 1861, 1932, and 1941, America's best days lie ahead. Understanding and teaching explanation. This quote reminds us of a powerful truth about progress. The people today are not born smarter or inherently more capable than those who lived during the founding of America. We're also not working harder than they did. The early citizens worked tirelessly to build a nation from the ground up. Yet, despite this, look at how far we've come, technologically, socially, and economically. Our current world is filled with things that would have seemed like magic to someone from the 1700s. The quote highlights how human progress isn't just about individual intelligence or effort, but about building on each generation's knowledge and contribution. The mention of years like 1776, Declaration of Independence, 1861, Civil War, 1932, Great Depression, and 1941, World War II, shows how America has faced deep challenges before and each time emerged stronger. And just like those pivotal times, the quote expresses optimism that the future will continue to bring even better days. Moral 1. Progress is built over time, not just by intelligence but through perseverance and shared effort across generations. 2. Every generation builds on the past, making the impossible of yesterday possible today. 3. We don't need to be smarter to achieve more. We need to stay committed, creative, and united. 4. Hard times are not the end, but often turning points that lead to great achievements. 5. Hope and belief in a better future are essential for any nation or individual to thrive. Having first-rate people on the team is more important than designing hierarchies and clarifying who reports to whom. Understanding and teaching explanation. This quote emphasizes the value of talented individuals over complicated organizational structures. Here's how to understand it better. First-rate people means highly skilled, motivated, and capable team members, people who take responsibility, think creatively, and work well with others. Designing hierarchies and clarifying who reports to whom refers to building complex organizational charts, job titles, and reporting systems. The quote is saying that having excellent team members is much more valuable than spending time figuring out who's in charge of whom. Why? Because great people naturally collaborate and take initiative. They don't need constant supervision or detailed instructions. A strong team of capable people can solve problems, innovate, and adapt faster than a rigid structure can. So, instead of focusing too much on organizational structure, focus more on hiring and keeping the right people. Moral 1. Talent matters more than titles. Prioritize hiring skilled and motivated individuals over defining roles and chains of command. 2. Great teams self-organize. When the right people are in place, collaboration flows naturally without needing rigid rules. 3. People drive success. A strong team can achieve goals faster and more efficiently than a complex system of management. 4. Flexibility beats formality. Being too focused on structure can slow down progress, while great people adapt and get things done. 5. Leadership is about who, not how. The who you bring into the team matters more than how you organize them. We will continue to ignore political and economic forecasts, which are an expensive distraction for many investors and businessmen. 30 years ago, no one could have foreseen the huge expansion of the Vietnam War, wage and price controls, 2 oil shocks, the resignation of a president, the dissolution of the Soviet Union, a one-day drop in the Dow of 508 points, or Treasury bill yields fluctuating between 2.8% and 17.4%. Understanding and teaching explanation. This quote reminds us that trying to predict the future, especially in politics and economics, is extremely difficult and often misleading. It's from Warren Buffett, a legendary investor who emphasizes long-term thinking over reacting to short-term news. Let's break it down. We will continue to ignore political and economic forecasts. Buffett is saying that he and his team don't base their investment decisions on predictions about politics or the economy, because such predictions are unreliable and often wrong, which are an expensive distraction for many investors and businessmen. Trying to predict these things doesn't just waste time, it can cost a lot of money if you make decisions based on bad forecasts. Then he lists events from the past 30 years that were impossible to predict. The Vietnam War expanding, oil shocks, a president resigning, Nixon, the Soviet Union breaking up, major stock market crashes, wild changes in interest rates, etc. His point is, nobody saw these coming, and yet the economy and markets moved forward over time. Teaching point. Rather than guessing what will happen next in the world, Buffett teaches us to focus on the fundamentals, invest in strong businesses, stay patient, and think long-term. Trying to time the market or react to global events can lead to poor decisions and losses. Moral. 1. Avoid relying on political or economic predictions in decision-making. They are often wrong and can misguide your actions. 2. Unexpected events will always occur in history. Trying to guess them is a losing game. 3. Stay focused on long-term goals and strong fundamentals. This leads to better outcomes than reacting to short-term news. 4. Emotional or fear-based decisions hurt investments. Stick to your plan instead of panicking during uncertainty. 5. History proves that the market survives crises. Patience and discipline are your greatest tools. Like most training, it's driven by fundamentals. At some point, speculation takes over. What the wise man does in the beginning, the fool does in the end. Explanation, understanding, teaching way. This quote talks about how trends, especially in things like business, investing, fashion, or technology, usually start with solid reasons. These are called fundamentals. For example, a company grows because it has a good product, strong management, or solves a real problem. But as time goes on and more people notice the trend, it becomes popular. Then speculation begins. People jump in just because others are doing it, not because they understand it. They're driven by hype and fear of missing out, FOMO, not by logic or research. The wise person gets involved early, based on understanding and insight. The fool copies the actions of the wise person much later, when prices are high or the trend is about to end, and often faces losses or failure. Moral. 1. Understand the fundamentals before following any trend. 2. Act with knowledge, not with emotions or peer pressure. 3. Timing matters. What is smart early can be risky later. 4. Avoid blind imitation. Following others without understanding can lead to losses. 5. Be the wise one. Invest time in learning before acting. You do things when the opportunities come along. I've had periods in my life when I've had a bundle of ideas come along, and I've had long dry spells. If I get an idea next week, I'll do something. If not, I won't do a damn thing. Understanding and teaching, explained simply. This quote reflects a practical and honest view on how creativity and action often work. You do things when the opportunities come along. This means you act when the right chance presents itself. Not everything can be forced. Timing matters. I've had periods in my life when I've had a bundle of ideas come along. Sometimes inspiration flows easily and you get lots of ideas. These are the productive and creative phases in life. And I've had long dry spells. Other times there's nothing, no ideas, no motivation. That's okay too. It's part of the natural rhythm of life and creativity. If I get an idea next week, I'll do something. If not, I won't do a damn thing. He's saying he doesn't force creativity. If something naturally comes up, he acts. If not, he waits. He respects the process and doesn't stress about it. This quote teaches us to trust the flow of life and creativity, and to not feel pressured to always be producing or acting. Moral of the quote: 1. Act when opportunities arise. Don't force things. 2. It's normal to go through creative highs and lows. 3. Value patience and timing over constant activity. 4. Trust your process. Ideas will come when they're ready. 5. Don't stress during dry spells. They're temporary. 6. Stay open to inspiration, but don't chase it desperately. Speed versus Class, a tale of two handicappers and the wisdom of investing. Once upon a time, at a dusty racetrack on the edge of town, two seasoned handicappers stood watching the horses trot out onto the field. The sun was setting, casting long shadows over the track as they leaned on the rail, deep in thought. One of them, an older man with a notebook full of numbers and times, was known as the speed handicapper. He had spent years tracking how fast each horse could run on different days, in different weather, on different tracks. The secret, he'd always say, tapping his notes, is in the numbers. You figure out how fast a horse can run, and you'll know who wins. Beside him stood the class handicapper. He had fewer notes, but a keen eye for pedigree, condition, and reputation. To him, it wasn't just about how fast a horse ran, it was about who that horse was. You can clock them all you want, the class handicapper would say, but a $10,000 horse will beat a $6,000 horse any day of the week. It's about class. Their argument was friendly but firm. One trusted performance, the other trusted pedigree. One believed in raw speed, the other in proven quality. Now, in the world of investing, a similar debate plays out every day. Benjamin Graham, the legendary investor and teacher of Warren Buffett, once said, "Buy any stock cheap enough, and it will work." Graham was the speed handicapper of the market. He believed in numbers, in buying stocks below their intrinsic value, no matter the company, because eventually the price would catch up. Others, like those who followed Buffett's later style, believed in buying only the best companies, regardless of short-term price, because over time, great businesses outperform. That's the class handicapper's view. Who's right? The truth is, both approaches can work, but they require different mindsets and skills. Speed handicapping, value investing, requires deep analysis, patience, and the ability to buy when others are fearful. Class handicapping, quality investing, requires trust in the long-term vision and a strong understanding of what makes a company truly great. Moral of the story: in both horse racing and investing, there are different ways to bet, but every approach has its own rules and risks. Know what you're betting on and why. Important takeaways. Speed handicappers focus on undervalued opportunities. In investing, this means buying cheap stocks with potential. Class handicappers focus on quality and reputation. In investing, this means buying great companies even if they're not cheap. Benjamin Graham's philosophy is about finding value anywhere, even in humble places. Both strategies can win. What matters is discipline, understanding, and consistency in your approach. So whether you race with speed or class, or blend both, the key is to know your horse and trust your method. The Wise Investor and the Dancing Market. A story with a lesson in market volatility and opportunity. Once upon a time, in a small village nestled at the edge of a great forest, lived an old man named Arun. He was known not just for his silver hair and kind eyes, but for something much more remarkable: his uncanny ability to grow wealth through investing. People in the village often spoke in hushed awe of how Arun had turned modest earnings into a small fortune over the years. Many came to him asking, "How did you do it, Master Arun?" To every curious villager, Arun would only smile and say, "I learned to dance with the market's madness." One day a young man named Ravi, anxious and puzzled by the recent wild swings in the market, came to Arun with a worried expression. "Master," Ravi said, "the market is going crazy. Prices are swinging like leaves in a storm. I'm afraid to invest. Shouldn't we wait for it to calm down?" Arun chuckled softly and gestured for Ravi to sit beside him under the old mango tree. "My boy," he began, "do you see that river flowing nearby?" Ravi nodded. "Yes, it moves fast sometimes and calm at other times." "Exactly," Arun said, "and the fisherman who waits for only calm waters will never catch the big fish. Similarly, an investor who fears volatility misses out on the treasures hidden beneath the surface." He leaned closer and continued, "The true investor welcomes volatility, because when the market dances wildly, it sometimes drops diamonds in the dirt. Prices of strong, stable businesses may fall irrationally low, not because the business is bad, but because the crowd is panicking, and in those moments the wise investor quietly picks up those diamonds." "But what if I make a mistake?" Ravi asked. "What if the market falls further after I buy?" Arun smiled. "That's the beauty of being an investor, not a trader. You're not forced to act every time the market moves. You are free to ignore it when it's foolish and free to act when it gives you a gift. That freedom is your greatest strength." As the wind rustled through the mango leaves, Ravi sat in thoughtful silence. The market, he realized, wasn't something to be feared. It was something to be understood and used wisely. Moral of the story: volatility is not your enemy, it's your invitation. Important points. 1. Volatility creates opportunity. When prices fluctuate irrationally, it allows investors to buy solid businesses at discounted prices. 2. True investors think long-term. Short-term swings do not affect the long-term value of a good business. 3. You are not obligated to react. Unlike traders, investors can choose when to participate and when to watch. 4. The market's madness is not your madness. Use reason and patience to benefit from the market's folly. 5. Freedom is a tool, not a trap. The power to act or abstain is what protects and empowers the investor. Turnarounds seldom turn. Understanding and teaching explanation. This quote is short but powerful. Let's break it down to understand it clearly. Turnaround refers to a situation where something is expected to change for the better, often used in business or life when trying to recover from a bad situation. Seldom means rarely or not often. So turnarounds seldom turn means that attempts to fix or reverse a failing situation rarely succeed. Teaching perspective. Imagine a company is failing financially. The management brings in new plans, new leadership, or changes the strategy hoping to turn things around. But this quote says, most of the time these efforts don't actually work. Why? Because the problem is often too deep, the damage too far gone, or the change is not bold or real enough. This idea doesn't just apply to businesses, it applies to relationships, personal habits, even sports teams. Simply trying isn't enough. The efforts must be meaningful, timely, and sometimes radical. Moral key takeaways, point-wise. 1. Hope alone doesn't fix problems, action does. 2. Surface-level changes rarely lead to real improvements. 3. Delaying action can make a turnaround impossible. 4. Effective change requires deep understanding and bold moves. 5. Don't rely on wishful thinking. Measure real progress. A prediction about the direction of the stock market tells you nothing about where stocks are headed, but a whole lot about the person doing the predicting. Understanding and teaching explanation. This quote is a thoughtful reminder about stock market predictions and human behavior. Let's break it down. When someone makes a prediction about where the stock market is going, up or down, we shouldn't assume it's accurate or reliable. The quote emphasizes that such predictions don't reveal the future of the stock market, because the market is inherently unpredictable and influenced by countless factors. However, what a prediction does reveal is a lot about the person making the prediction, their confidence level or overconfidence, their beliefs, biases, or motivations, whether they're being genuine, persuasive, or self-interested, for example, trying to sell something or build a reputation. In simpler words, just because someone says the market will rise or fall doesn't mean it will, but it does tell you about their mindset, personality, or even hidden agendas. Moral lessons point-wise. 1. Don't blindly trust stock market predictions. 2. Focus on data, trends, and long-term strategies, not opinions. 3. Always consider the motive behind someone's prediction. 4. Understand that the market is uncertain and unpredictable. Judge predictions cautiously and evaluate the predictor even more. 6. Avoid making financial decisions based only on forecasts. We always live in an uncertain world. What is certain is that the United States will go forward over time. Understanding and teaching way. This quote acknowledges a basic truth about life. The future is never fully predictable. No matter how much we plan or prepare, uncertainties are always a part of our world. However, in the second part of the quote, there is a strong sense of confidence and belief in progress, specifically the progress of the United States. It means that despite facing challenges, crises, or changes, the nation will continue to grow, move ahead, and improve over time. This can be seen as a message of hope and resilience, encouraging people to stay strong even in difficult or unclear times. Moral, point-wise. 1. Uncertainty is a natural part of life. We can't always predict what will happen, but we can prepare ourselves to adapt. 2. Progress happens with time and effort. Even if times are tough, persistence leads to growth. 3. Believe in resilience and strength. Nations and people can overcome hardships if they stay united and determined. 4. Hope drives forward movement. Staying hopeful helps us keep going, even when the future is unclear. 5. Stay focused on long-term goals. Temporary setbacks don't stop long-term progress. What matters is the bigger picture. We have a wonderful system that eventually is self-cleansing and always moves forward. Understanding and teaching explanation. This quote means that our system, it could be referring to a society, nature, or a mechanism like democracy, economy, or even the universe, is designed in such a smart and natural way that over time, it fixes its own problems, self-cleansing. And it keeps improving or progressing, moves forward, even after facing challenges or setbacks. Imagine a river that may gather dirt or leaves, but eventually it clears itself and keeps flowing forward. Similarly, a strong system can correct its flaws over time and continue on a path of growth or development. This can be a reassuring thought. Even when things go wrong, the system is built to heal and improve. Moral in point-wise format. 1. Believe in the strength of the system. Good systems are designed to correct themselves. 2. Mistakes and problems are part of growth. They don't stop progress. They help shape better outcomes. 3. Progress is natural and ongoing. No matter the setbacks, we always keep moving ahead. 4. Patience and trust matter. Self-cleansing takes time, but it works. 5. We all play a role. A system works best when everyone contributes positively. 5 years from now, 10 years from now, the world everywhere will be doing better. Explanation in an understanding and teaching way. This quote expresses hope and optimism for the future. It means that even if things seem difficult or challenging right now, over time, positive change will happen. In 5 or 10 years, we will see improvements in many areas of life: technology, health, environment, education, and human progress in general. Let's break it down for better understanding. 5 years from now, 10 years from now. This refers to the future, not immediately but over time. It teaches us to have patience. The world everywhere. This includes all countries, all people, and all areas of life. We'll be doing better means there will be growth, healing, success, and improvement in different aspects of the world. Teaching note. This quote encourages us to think positively about the future and to believe that things will get better. It's a reminder to keep moving forward, make efforts, and stay hopeful even during tough times. Moral in point-wise format. 1. Have patience. Change and improvement take time. Be patient and stay focused. 2. Global progress is possible. No matter where we are, better days are ahead for everyone. 3. Stay hopeful. Even if things are tough now, believe in a brighter future. 4. Work toward a better future. Improvement happens when we all do our part. 5. Positivity shapes outcomes. A positive mindset can lead to positive actions and results. Our system unleashes people's potential, and we've got 312 million people that want to do better tomorrow than today. Over time, that works. This country goes forward, and it'll continue to go forward. The luckiest person in history on a probability basis is the baby being born in the United States today. Understanding and teaching explanation. This quote highlights the strength of the American system in fostering growth and opportunity. It emphasizes that the country's progress is driven by its people's desire for improvement. With millions of individuals striving for a better future, the collective effort ensures continuous development. The statement also suggests that being born in the US provides unparalleled opportunities, making it one of the most advantageous places to start life due to economic, social, and political factors. Moral lessons. 1. Growth comes from effort. Continuous progress is achieved when people aim to improve every day. 2. Opportunity matters. A system that encourages personal and professional growth leads to national success. 3. Collective strength. When a large number of people work toward betterment, the whole country benefits. 4. Fortune favors the prepared. Being in a place with resources and opportunities increases the likelihood of success. 5. Optimism fuels progress. A positive mindset about the future drives innovation and development. I am not a businessman, I am an artist. Understanding and teaching explanation. This quote reflects a powerful mindset. The speaker is trying to convey that their work is driven more by passion, creativity, and self-expression than by money or profit. A businessman is often seen as someone who focuses on profit, sales, and growth. On the other hand, an artist creates from the heart. They care about the beauty, originality, and emotional impact of their work. So, when someone says, "I am not a businessman, I am an artist," they are saying, "I don't just care about money. I want to create something meaningful. My work is my art, not just a product." This mindset often leads to more authentic, innovative, and inspiring creations, because the goal is to make something great, not just something that sells. Moral of the quote, point-wise. 1. Follow your passion, not just profit. 2. Create with purpose and heart. 3. Value originality and authenticity. 4. Let your work reflect who you truly are. 5. Success comes naturally when you love what you do. I am not. A number of smart people are involved in running hedge funds, but to a great extent their efforts are self-neutralizing, and their IQ will not overcome the costs they impose on investors. Investors on average and over time will do better with a low-cost index fund than with a group of funds. Understanding and teaching way, explanation. This quote is saying that while hedge funds are often managed by very intelligent and highly qualified professionals, their strategies tend to cancel each other out because they are all trying to outsmart the market in similar ways. In other words, if one fund wins, another might lose. And overall, their collective smartness doesn't necessarily produce better results for investors. Moreover, hedge funds usually charge high fees like management and performance fees, which reduce the actual profits investors get. So even if the fund performs well, a good portion of the earnings may go to the fund managers instead of the investors. On the other hand, a low-cost index fund simply tracks the performance of the overall market, like the S&P 500, and charges very low fees. It doesn't try to beat the market, it just tries to match it. Because of lower costs and the overall market growth over time, index funds often give better returns to the average investor compared to more expensive and complex hedge funds. Moral, in point-wise. 1. High intelligence does not guarantee higher returns in investing. 2. Complex strategies often cancel each other out in competitive markets. High fees can significantly eat into investors' profits. 4. Simple, low-cost investing like index funds is often more effective over time. 5. For most investors, patience and low costs lead to better long-term results than trying to beat the market. So if the government rate rises, the prices of all other investments must adjust downward to a level that brings their expected rates of return into line. Conversely, if government interest rates fall, the move pushes the prices of all other investments upward. Explanation in an understanding and teaching way. Let's break this down in a simple way. Government rate refers to the interest rate set by the government, often through a central bank, like the Federal Reserve in the US or RBI in India. When this interest rate increases, it means you can now get better returns just by keeping your money in safer investments like government bonds. Because of this, people will move their money away from riskier investments like stocks or real estate and into those safer options. As demand for these other investments goes down, their prices also fall. Why? Because the expected return from those other investments needs to become competitive again. Lower prices equals higher return potential. On the other hand, when the government lowers interest rates, safer investments give less return. So people start moving money into stocks, property, and other higher risk options to get better returns. This increases demand for those investments, and as a result, their prices rise. Think of it like a scale. If one side, government rate, goes up, the other side, investment prices, goes down, and vice versa. Moral key takeaways point-wise. 1. When government interest rates rise, other investment prices generally fall. 2. When government interest rates fall, other investment prices usually go up. 3. Investment markets are interconnected and adjust based on interest rate changes. 4. Understanding interest rate trends is key for smart investing decisions. 5. Smart investors watch government rate moves to predict market shifts. No business has ever failed with happy customers. You are selling happiness. Understanding and teaching explanation. This quote emphasizes the core essence of successful business, customer satisfaction. Let's break it down. 1. No business has ever failed with happy customers. When customers are happy, they become loyal. Happy customers talk positively about your business. This is free marketing, word of mouth. They return to buy again, and they bring others. If customers are consistently happy, your business will grow and sustain even in tough times. 2. You are selling happiness. You're not just selling a product or service, you're giving an experience. Whether you run a cafe, a clothing store, or a tech company, your ultimate goal is to make customers feel satisfied, valued, and happy. Focus on how your offering improves their lives or solves a problem in a pleasant way. Teaching tip. Ask yourself and your team, how can we make our customer smile today? If you build that into your daily process, your business is automatically heading towards success. Moral, key takeaways. Point-wise. 1. Customer satisfaction is the backbone of any business. 2. Happy customers become loyal advocates. 3. Word of mouth from satisfied clients is powerful and free marketing. 4. You're not just selling a product, you're creating a positive experience. 5. Focus on value and emotions, not just transactions. 6. A business that creates happiness will always have a place in the market. Most analysts feel they must choose between two approaches customarily thought to be in opposition: value and growth. In our opinion, the two approaches are joined at the hip. Growth is always a component in the calculation of value. Understanding and teaching explanation. This quote is talking about two major styles of investing: value investing and growth investing. Value investing is when investors look for stocks that are undervalued. That means their current market price is lower than what the company is really worth. Growth investing is when investors put money into companies that are expected to grow fast. Even if they're expensive now, they might become much bigger in the future. Traditionally, people think you have to pick one side. Either be a value investor or a growth investor. But the quote challenges this idea. It says that growth is actually part of value. When you're calculating how valuable a company is, you naturally have to think about how much it's going to grow in the future. So, they are not opposites. They work together. Imagine you're buying a business. Wouldn't you want to know not only how much it earns now, but also how much it might earn later as it grows? That's the point being made. Moral key takeaways, point-wise. 1. Value and growth are not enemies. They are connected. 2. Future growth is a key factor in deciding the real value of a company. 3. Smart investing involves understanding both the current worth and future potential. 4. Don't limit yourself to one style of thinking, see the bigger picture. 5. Blending both value and growth leads to better, more balanced decisions. We're not looking at the aspects of the stock, we're looking at the aspects of the business. Understanding and teaching explanation. This quote highlights a very important principle in value investing and long-term wealth building. Let's break it down step by step. 1. We're not looking at the aspects of the stock. This means we are not focusing on the stock price, market trends, or short-term movements of a company's shares. 2. We're looking at the aspects of the business. Instead, we are focusing on the company itself. How it earns money, its future potential, quality of its products or services, strength of management, financial health, profit, debt, growth, competitive advantage in the market. Teaching tip. When investing, don't get distracted by the ups and downs of the stock price. Think like a business owner, not a stock trader. Ask yourself, would I want to own this company if the stock market closed for 5 years? Does this company solve real problems or have real customers? Moral, key takeaways. 1. Focus on the business, not the stock price. 2. Long-term success comes from strong, well-run companies. 3. Invest with a business mindset, not a trading mindset. 4. Understand what the company does before investing. 5. Stock market noise can mislead. Stick to fundamentals. Post-mortems of acquisitions, in which reality is honestly compared to the original price projections, are rare in American boardrooms. They should be standard practice. Explanation in an understanding and teaching way. Let's break this quote down for better understanding. Post-mortems. This term is usually used in medicine to refer to an examination after death to find the cause. In business, a post-mortem means a deep review of an event, like a company acquisition, after it has happened, to see what went right, what went wrong, and what lessons can be learned. Acquisitions. When one company buys another. Original price projections. These are the expected costs and benefits, profits, growth, etc., estimated before the acquisition was made. Reality versus projection. This means comparing what was expected to happen with what actually happened. Rare in American boardrooms. The quote suggests that most companies don't actually do this honest comparison after acquisitions. They avoid checking if their expectations matched reality, maybe due to pride, fear of embarrassment, or to avoid blame. They should be standard practice. The speaker believes that every acquisition should be followed by a detailed review, so companies can learn and improve. In short, companies should regularly review and honestly evaluate the results of their acquisitions, comparing them to what was originally projected. But sadly, most don't. Moral lessons, point-wise. 1. Always review big decisions. After any major business move, especially acquisitions, conduct a thorough evaluation to learn from it. 2. Compare expectations with reality. This helps reveal mistakes, overestimations, or hidden opportunities. 3. Learn from failures and successes. Post-mortems aren't just for failures. Successes can also teach you what to repeat. 4. Avoid ego and denial. Don't skip reviews to protect pride. Honest evaluation is key to growth. Make reflection a habit. Post-mortems should be a standard process in any organization, not a rare event. Our stay-put behavior reflects our view that stock market serves as a relocation center at which money is moved from the active to the patient. Explanation in an understanding and teaching way. This quote, often attributed to Warren Buffett, conveys a deep investing principle in a simple way. Let's break it down. 1. Our stay-put behavior. This refers to the act of holding on to investments for a long time, rather than frequently buying and selling. It emphasizes patience and discipline. 2. Reflects our view. It shows that this patient behavior isn't random. It's based on a strong belief or philosophy about how the stock market works. 3. That stock market serves as a relocation center, a powerful metaphor. Think of the stock market like a place where money moves from one type of person to another, not randomly, but systematically. 4. At which money is moved from the active to the patient. People who are always active, buying, selling, reacting emotionally, often end up losing money or getting lower returns. Meanwhile, those who are calm, informed, and patient tend to gain wealth over time. In essence, the quote says, "In the long run, the impatient transfer their wealth to the patient." Moral of the quote, pointwise, patience pays off in investing. 2. Overactivity in the stock market can hurt your returns. Long-term thinking beats short-term emotional decisions. 4. Wealth in the market is often built by holding, not trading. 5. Successful investors stick to their plan with discipline. The Crystal Ball of Wall Street, a lesson from Buffett and Munger. Once upon a market. In a bustling town where Wall Street dreams ran wild, there lived two wise old investors, Warren and Charlie. They weren't flashy or loud, didn't chase fads or fortune tellers, and certainly didn't trust the people who claimed to predict the future of the stock market. Every morning, headlines screamed, "Dow to crash 20%. Tech stocks will soar by Friday. Buy now or regret forever." People ran around with charts, algorithms, and bold claims. They waved their hands like magicians, trying to summon tomorrow's prices. These were the stock forecasters, modern-day fortune tellers dressed in suits. But Warren and Charlie had seen this circus before. With a gentle smile and a knowing glance, Warren once said, "We have long felt that the only value of stock forecasters is to make fortune tellers look good." You see, years ago, they had learned a hard truth. No one can reliably predict short-term market moves. Not with certainty. Not even with fancy graphs. Not even if they sounded absolutely convincing. Charlie would often chuckle and add, "Short-term forecasts are poison. They should be locked up in a safe place, away from children and from grown-ups who behave like children in the market." They had watched intelligent people lose fortunes, not because they lacked knowledge, but because they believed in predictions instead of principles. A teaching moment. One day, a young investor approached them, starry-eyed and hopeful. "Mr. Buffett, Mr. Munger, which stock will go up next week?" he asked. Warren leaned in and said, "Let me ask you this. If you owned a farm, would you sell it just because the weatherman said it might rain next week?" The young investor shook his head. "Then why treat your investments like balloons in the wind?" Charlie added, "Good businesses, like good farms, grow over time. What matters is the soil, the seed, and your patience, not the weather next Tuesday." The young investor nodded, understanding that he had been asking the wrong question all along. Moral of the story: don't try to predict the market. Prepare for it. Important points to remember. 1. Short-term market forecasts are unreliable. Even experts get it wrong frequently. 2. Focus on long-term value. Invest in quality businesses and hold them like you own them. 3. Avoid emotional decisions. Predictions feed fear and greed, both enemies of smart investing. 4. Discipline beats drama. Steady, informed decisions win over sensational headlines. 5. Wisdom lies in patience. True wealth in investing is grown, not guessed. In stock markets, it's an auction market, and crazy things can happen. Understanding and teaching explanation. This quote means that the stock market works like an auction, where buyers and sellers place bids and offers for stocks, just like in a real-life auction where people shout prices for items. The price of a stock is decided by what people are willing to pay, demand, and what others are willing to sell for, supply. Since this system is based on people's emotions, opinions, and expectations, it can be unpredictable and sometimes irrational. News, rumors, fear, or hype can make stock prices go up or down quickly, sometimes without any real reason based on the company's actual performance. So when it says crazy things can happen, it's pointing to how emotions and herd behavior can make prices move in unexpected or extreme ways. Moral key takeaways. 1. Stock prices are driven by supply and demand, like an auction. 2. Emotions, fear, and greed can create wild price swings. 3. Be cautious. Don't assume the market is always rational. 4. Do your own research instead of blindly following the crowd. 5. Stay calm and focused during market ups and downs. When people get fearful, they get fearful en masse. Confidence comes back one at a time. When they get greedy en masse. Understanding and teaching explanation. This quote highlights human psychology in groups, especially in financial markets or during uncertain times. When fear strikes, like during a crisis, people react together, often in panic. It's like a crowd running from danger. Fear spreads quickly and widely. But when it comes to regaining confidence, it's a slow individual process. People don't trust again easily after getting hurt or seeing loss. Confidence must be rebuilt step by step. On the other hand, greed also spreads in groups. When people see others making money or succeeding, they tend to jump in all at once, thinking they'll miss out. This behavior is often seen in stock markets, trends, or even social behavior. Moral, point-wise. 1. Fear spreads quickly in groups. Be mindful before reacting to panic. 2. Regaining confidence is a personal journey. Take your time. 3. Greed also spreads in groups. Don't blindly follow the crowd. 4. Make decisions based on logic, not emotions or mass behavior. 5. Awareness of group psychology helps you stay calm and wise in tough times. You can't make a good deal with a bad person. Understanding and teaching explanation. This quote means that no matter how attractive or well-planned a deal seems, if the person you're dealing with is dishonest, selfish, or lacks integrity, the deal will likely go wrong. Let's understand this better. A good deal isn't just about money or profit. It also involves trust, fairness, and long-term peace of mind. A bad person here refers to someone who lies, cheats, manipulates, or has selfish motives. Even if you agree on clear terms, a bad person might break promises, twist facts, or look for loopholes to benefit only themselves. So in simpler terms, if the foundation, the person, is corrupt, then the structure, the deal, will eventually crumble. Think of it like planting a seed in toxic soil. You can't expect a healthy tree to grow from it. Moral lessons point-wise. 1. Trustworthiness matters more than the terms of a deal. 2. Avoid partnerships with people who have a bad reputation or questionable ethics. 3. Always look beyond the offer. Pay attention to who is offering it. 4. No profit is worth losing your peace or values over. 5. It's better to walk away from a bad person than to get stuck in a bad situation. We will have another bubble, but usually you don't get it the same way you got it before. Understanding and teaching explanation. This quote talks about economic or financial bubbles, like the housing bubble of 2008 or the dot-com bubble of the early 2000s. A bubble means a time when prices of something, like real estate, stocks, or crypto, rise quickly beyond their real value, often because of hype or speculation. Eventually, the bubble bursts and prices crash. The speaker is saying that bubbles happen again. They are part of human behavior and markets, but they don't repeat in the exact same way. For example, if the last bubble was in real estate, the next might be in tech, crypto, or some other sector. People often look for patterns from the past, but the next crisis or boom might have different reasons or take a new form. In a teaching way, imagine a child touches a hot stove and gets burned. Next time they may avoid the stove, but might still get hurt by something else hot, like boiling water. The lesson? The mistake may not repeat exactly, but risks remain if we're not careful and aware. Moral, point-wise. 1. History repeats, but not identically. Similar events may happen again, but the details and causes often change. 2. Learn from past mistakes. Don't just expect the same danger to return the same way. Be prepared for new forms. 3. Stay alert and informed. Just because one type of bubble burst doesn't mean another won't form differently. 4. Human behavior drives patterns. Greed, fear, and hype often fuel bubbles, regardless of the asset involved. 5. Adapt, don't assume. Expect change and be flexible in your thinking and strategies. The power of picking the right business, a story of Coca-Cola and timeless investment wisdom. A journey through time, Coca-Cola's unshaken legacy. Once upon a time, in the year 1919, a well-known company decided to go public. That company was Coca-Cola, and its stock was introduced to the public at $40 per share. Excitement buzzed in the air. Investors eagerly bought into the vision of a fizzy drink that was rapidly growing in popularity. But shortly after, reality struck. Just a year later, the price of Coca-Cola stock dropped to $19. The reason? A sharp fluctuation in sugar prices after World War I. Sugar was a core ingredient in Coca-Cola's product, and the instability in global markets sent shockwaves through many industries, including beverages. Imagine being one of those early investors. You bought at $40, and suddenly your investment was worth less than half. Fear would have crept in. People might have said, "See, that was a bad move." Some might have sold their shares in panic. But let's fast forward. Suppose one wise investor, rather than panicking, stayed the course. They didn't sell. Instead, they believed in the product. They knew that Coca-Cola wasn't just about sugar, it was about a brand, a habit, a culture. Over the decades, they reinvested every dividend they received back into the company. Now, more than 100 years later, that single $40 share would be worth about $1.8 million. Yes, $1.8 million. What this teaches us. The Coca-Cola story isn't just about a soda company. It's a timeless lesson about investing with vision rather than emotion. Too often, investors focus on the short-term noise, next week's economic report, next month's inflation numbers, next year's election. But the real question, the one that truly matters, is, are you in the right business to begin with? In other words, is the product or service strong enough to last through storms, wars, and market crashes? Coca-Cola's value didn't come from perfectly timed entries and exits in the stock market. It came from being in a business with enduring value, with a product that could weather every season. Moral of the story. It's far more important to invest in a great business than to try and time the market. If the foundation is strong, the storms can pass and the value will grow. Key takeaways. 1. Focus on the quality of the business, not just the stock price. 2. Short-term volatility is inevitable. Don't let it drive your decisions. 3. Reinvesting dividends and staying invested can create massive long-term wealth. 4. Think long-term. Ask, will this business still be relevant in 10, 20, or 50 years? 5. Panic selling can destroy value. Patience builds it. The rich invest in time. The poor invest in money. Understanding and teaching explanation. This quote highlights a powerful difference in mindset between wealthy and poor individuals, not just in terms of wealth, but in how they think and act. The rich invest in time. Wealthy people often focus on how to use their time wisely. They prioritize long-term planning, learning, and creating systems, like businesses or investments, that continue to grow even when they are not working. They know that time is more valuable than money, and if used well, it can bring in more money in the future. The poor invest in money. On the other hand, people with a poor mindset may focus only on quick gains or short-term spending. They often exchange their time for money, like working hourly jobs, and may not think about how to leverage time to build more wealth. They might also spend money instead of investing it in things that will grow over time, like education, skills, or assets. Think of it like this. A rich mindset asks, how can I make my time work for me? A poor mindset asks, how can I earn money right now? LAP moral in point-wise format. 1. Time is more valuable than money. Use it wisely. 2. Invest in learning and long-term growth, not just quick money. 3. Create systems, like businesses or investments, that earn for you even when you're not working. 4. Focus on building skills and assets that appreciate over time. 5. Adopt a mindset that values time as the real currency of success. There are some parts of the game that we don't understand, so we don't play with them. Explanation, understanding and teaching way. This quote can be interpreted both literally and metaphorically. Literally, in a game, if there are certain rules, strategies, or tools we don't fully understand, we tend to avoid using them. We stay in our comfort zone and only engage with the parts we know, even if the unexplored parts could be useful or fun. Metaphorically, this applies to life. Life is like a big game with many opportunities, skills, and experiences. But often, when we don't understand something, Like a new skill, an unknown situation, or a challenge, we avoid it. We hesitate, we hold back, and we miss out on growth simply because we're unfamiliar or unsure. This quote teaches us that fear of the unknown can limit our potential. It's okay not to understand something at first, but we should try to learn. Avoiding things just because we don't get them can lead to missed opportunities. Moral, point-wise. 1. Don't fear the unknown. Explore it. 2. Growth happens when we step out of our comfort zone. Learning is the key to participation. 4. Avoiding challenges won't help us improve. 5. Understanding brings confidence and new possibilities. On economic forecasts. Why spend time talking about something you don't know anything about? People do it all the time, but why do it? Understanding and teaching explanation. This quote points out the irony in how often people, especially in fields like economics, confidently speak about the future, even when they don't really know what will happen. It's a gentle criticism of pretending to be an expert on uncertain matters. Let's break it down. Why spend time talking about something you don't know anything about? The speaker is questioning the value of making predictions or statements on topics we're not truly informed about. People do it all the time, but why do it? It highlights a common habit. Many people make forecasts or give opinions just to appear knowledgeable or feel included, even without a strong understanding. In the context of economic forecasts, this means people often try to predict markets, inflation, or growth with great confidence, even though such things are inherently uncertain and complex. This quote encourages intellectual honesty, humility, and the wisdom of saying "I don't know" when appropriate. Moral point-wise. 1. Don't pretend to know what you don't. Like, it's okay to admit uncertainty or lack of knowledge. 2. Speak less, think more. Don't contribute to noise. Speak when you truly have value to add. 3. Value humility over hype. Being realistic and honest builds more credibility than guessing confidently. 4. Avoid blind forecasting. Especially in uncertain fields like economics, it's better to acknowledge limits than mislead. 5. Wise people speak with purpose, not just to be heard. The best thing that happens to us is when a great company gets into temporary trouble. We want to buy them when they're on the operating table. Understanding and teaching explanation. This quote is from legendary investor Warren Buffett, and it teaches a very powerful investment philosophy. What it means: Buffett is saying that some of the best investment opportunities come when strong, fundamentally sound companies face temporary problems, like a dip in earnings, a PR issue, or a market crash. These are not permanent issues, and the company has the potential to bounce back. On the operating table, this metaphor means the company is in a critical condition temporarily, like a patient in surgery. It's struggling, but with good care and time, it can recover and thrive again. Why investors like Buffett love this. When good companies are in trouble, their stock prices fall. That gives investors a chance to buy them at a bargain. And when the company recovers, the value of their investment increases significantly. Key takeaway: don't fear market drops or temporary setbacks. Instead, see them as chances to invest wisely, especially if you've done your homework and believe in the company's long-term strength. Moral in point-wise. 1. Look for long-term value, not short-term noise. 2. Temporary troubles can be golden opportunities. 3. Invest when others are fearful. Buy low, sell high. 4. Strong companies bounce back. Be patient and smart. 5. Do your research and stay calm in market storms. The wisdom of investing in productive assets. The story, a lesson from the orchard. Once upon a time, in a peaceful village nestled between rolling hills, lived an old wise farmer named Buskar. He wasn't flashy or loud like the traders in the city, but his land was always full of life. Orchards bursting with fruit, fields rich with grain, and a barn that smelled of fresh produce rather than dust. People often ask Buskar why he never invested in gold or chased the newest financial trends. He would smile, pick a ripe apple from his tree and say, "Because this apple feeds my family, earns me income, and grows again next season," without needing to plant a new tree every year. Bhaskar explained to his curious young nephew, Arav, that he believed in putting his hard-earned savings into productive assets, things that generate real value. Whether it was a well-run farm, a busy local shop, or a piece of land that produced rent, he looked for investments that had two powerful qualities. One, the ability to produce something valuable year after year, and two, the strength to keep their value even when prices rise all around, like during inflation. He pointed to his neighbor's dairy farm and said, "That farm gives milk every day. Inflation might raise the price of milk, but the cows still give it, and people still buy it. The farm doesn't need much new investment to keep going. It just keeps producing." Bhaskar then told Arav about businesses like See's Candy or big names like Coca-Cola and IBM, companies that, like his orchard, kept producing value without needing too much new money poured into them. These companies, he said, have strong roots, just like my trees, and when times get tough, their fruits still sell. Years passed. Arav grew up, and instead of getting swept up in the flashy trends of crypto coins and quick flips, he remembered his uncle's orchard and invested in real businesses, real farms, and real estate. While others panicked during tough economic times, Arav's investments continued to provide steady returns. He had learned the secret. Invest in things that work for you, not things you have to work for. Teaching. What are productive assets? Productive assets are investments that generate income or value on their own. These include businesses that sell products or services people want, farms that grow food or raise animals, real estate that generates rental income. What makes them especially valuable is when they can retain their purchasing power during inflation and keep generating returns without needing constant reinvestment. This means that while the cost of living may go up, these assets continue to produce outputs that rise in value, helping you preserve and grow your wealth. Key points to remember. Productive assets generate real, tangible value. The best ones require little new capital to continue producing. They're resilient during inflation because their output, like food, rent, or products, stays in demand and adjusts with prices. Businesses like Coca-Cola, IBM, and See's Candy are examples of this type of investment, strong brands with consistent demand and low capital needs. Moral of the story: wealth that grows steadily is wealth that lasts. Invest not in what shines today, but in what bears fruit every season. Most advisors are far better at generating high fees than they are at generating high returns. Understanding and teaching explanation. This quote highlights a common issue in the world of financial advising and investment management. Let's break it down simply. Advisors are professionals who give people advice on how to invest their money. High fees refer to the charges or commissions they earn from managing your money. High returns are the profits or gains you get from investing your money wisely. The quote suggests that many financial advisors are more skilled at earning money for themselves through fees than they are at earning money for their clients through good investment performance. In simple words, they may talk smart and charge a lot, but don't always deliver better profits for you. Teaching tip: when dealing with advisors, always look at the value they provide, not just how polished or convincing they sound. Ask, what are their actual track records? How much are they charging me? Is my money really growing, or are they just collecting fees? Moral key takeaways, point-wise. 1. Don't judge advisors by appearance or speech. Judge by performance. 2. Always check if the fees are worth the returns you're getting. 3. Be informed. Understand where your money is going and how it's being managed. Sometimes less flashy or low-cost investment options may give better results. 5. Financial literacy is your best defense against costly advice. I think the most important factor in getting out of the recession actually is just the regenerative capacity of American capitalism. Understanding and teaching explanation. Let's unpack this quote in a simple, teaching-friendly way. The speaker is talking about recession, which is a time when the economy is struggling, people are losing jobs, businesses are suffering, and money isn't flowing well. They believe the most important thing that helps the country recover isn't necessarily government aid or outside help. Instead, it's the regenerative capacity of American capitalism. That means the natural ability of the American economic system to bounce back, grow again, and create new opportunities. Capitalism, in this context, refers to the system where private individuals and businesses run the economy, not the government. It's based on innovation, competition, and investment. So this quote is appreciating how resilient and self-healing the American economic system can be when people are free to create, invest, and work hard. Morals, key takeaways. 1. Self-belief in the system. A strong economic system has the power to recover on its own. 2. Resilience is key. Like people, economies can also heal and grow after hard times. 3. Innovation drives recovery. New ideas and businesses can spark economic revival. 4. Support entrepreneurship. When individuals are free to create and invest, the whole economy benefits. 5. Crisis can lead to growth. Tough times can activate the strength and creativity within a system. The simple path to investment wisdom. Once upon a time in the bustling city of New Vale, nestled between corporate towers and financial schools, lived a curious young man named Arjun. He had just enrolled in one of the top business schools, dreaming of mastering the stock market and building wealth. Arjun's classes were packed with dense theories and complex equations: beta, efficient markets, modern portfolio theory, option pricing, and the intricate workings of emerging markets. His textbooks were thick, his notes even thicker. But the more he studied, the more confused he felt. "Why does investing feel so complicated?" he asked one day, staring blankly at a graph of stochastic models. One weekend, Arjun visited his grandfather, a calm, wise man who had built a modest fortune through investing without ever attending business school. Seeing Arjun's troubled face, the old man smiled. "You're learning a lot, but let me ask you this. Do you know how to value a business?" Arjun hesitated. "Well, not really. We touched on it, but mostly we've been looking at formulas and market theories." His grandfather nodded. "That's the issue. You see, to invest successfully, you don't need to understand all those complicated concepts. You need two things, and two things only: how to value a business and how to think clearly about market prices." He pulled out a notebook and sketched out a simple scenario. "Imagine you're buying a farm," he said. "You'd want to know how much income it can produce. That's valuing a business. Then you ask yourself, is the price fair for what you're getting? That's thinking about market prices. Everything else is noise." Arjun blinked. It was the simplest, clearest explanation he had heard. From that day forward, he focused less on abstract theories and more on understanding businesses. He studied balance sheets, talked to local entrepreneurs, and read about companies with curiosity and common sense. Over time, Arjun became a successful investor, not because he mastered the latest financial models, but because he understood the fundamentals deeply and thought clearly. Moral of the story: simplicity is powerful. In investing, understanding the basics, how to value a business and how to think about prices, is often more useful than mastering complex financial theories. Key lessons. 1. Focus on fundamentals. Learn how to evaluate a business's real worth by understanding its operations, cash flows, and sustainability. 2. Think rationally about prices. Market prices fluctuate, but they don't always reflect true value. Learn to spot the difference. 3. Ignore the noise. Complex theories can be useful for academic insight, but practical investing thrives on clarity, not complexity. 4. Don't overcomplicate. Great investors often use simple principles with discipline, not the most complicated formulas. 5. Education should empower, not confuse. Seek teachers and lessons that make things clearer, not more complicated. When proper temperament joins with proper intellectual framework, then you get rational behavior. Explanation in an understanding and teaching way. This quote highlights the two key elements needed for someone to consistently act in a rational or logical manner. 1. Proper temperament. This means having the right emotional attitude or personality traits, like being calm, patient, disciplined, and not overly reactive. Even if someone knows what's right, if they panic or get emotional, they may not act rationally. 2. Proper intellectual framework. This refers to having a well-structured way of thinking, being educated, thoughtful, and capable of analyzing situations logically. It involves having the mental tools to understand complex situations and make sound decisions. The quote tells us that both these elements are necessary. Just having the right temperament without understanding won't help. Similarly, just being smart but emotionally unstable can also lead to irrational choices. Only when calm emotions and clear thinking work together can a person behave rationally, making decisions that are well thought out and sensible. Moral-wise. 1. Balance emotions and intellect. Both are essential for wise decisions. 2. Build mental discipline. Strengthen your thinking habits and decision-making skills. 3. Develop emotional control. Stay calm under pressure and avoid impulsive actions. 4. Combine heart and mind. Rational behavior emerges when both align harmoniously. 5. Keep learning and self-reflecting. Improve both your understanding and your reactions. Overwhelmingly, for people that can invest over time, equities are the best place to put their money. Bonds might be the worst place to put their money. They are paying very, very little, and they're denominated in a currency that will decline in value. Understanding and teaching explanation. Let's break this down in a simple and educational way. 1. Overwhelmingly, for people that can invest over time. This means if you have time on your side, say you're planning to invest for many years, you have a big advantage. Long-term investors can ride out short-term ups and downs. 2. Equities are the best place to put their money. Equities means stocks or owning pieces of companies. Over a long period, stocks tend to grow much more than other types of investments, offering higher returns. Number 3. Bonds might be the worst place to put their money. Bonds are like loans you give to companies or the government, and they pay you interest. However, currently those interest payments are very low, which means they don't help your money grow much. 4. They are paying very, very little. The returns, interest you get from bonds are minimal nowadays. So your money isn't really growing if it's sitting in bonds. 5. They're denominated in a currency that will decline in value. This means the money you're getting from bonds is in a currency, like the US dollar, that is slowly losing value over time due to inflation. So even what you do earn will buy less in the future. Moral, key takeaways, point-wise. 1. Long-term investing favors equities. Stocks, they usually offer the best returns over time. 2. Bonds may give poor returns, especially when interest rates are low. 3. Inflation reduces purchasing power. If your returns don't beat inflation, you're actually losing value. 4. Be mindful of where you put your money. Safe options aren't always the smartest. 5. Time is your biggest asset in investing. Use it wisely by choosing growth-oriented investments. If principles can become dated, they're not principles. Understanding and teaching explanation. Let's break this down step by step. What are principles? Principles are fundamental truths or rules that guide our behavior and decisions. They are meant to be timeless and unchanging, like honesty, integrity, fairness, etc. What does dated mean? Dated means something that has become old-fashioned or no longer relevant in the present time. So, what does the quote mean? If something you call a principle can become outdated or irrelevant over time, then it was never really a true principle to begin with. Real principles stand the test of time. They don't expire or change just because trends or situations do. Example for clarity. If someone says respecting others is a principle, but they stop doing it because times have changed, then they weren't really following a principle. They were just following a preference or a habit. Moral in point-wise format. 1. True principles are timeless. They don't change with trends or society. 2. Principles guide behavior consistently, no matter the situation or era. 3. If a belief changes with time, it may be a trend, not a principle. 4. We must reflect on what we truly stand for and make sure it's based on solid values. 5. Following real principles builds character, trust, and integrity. If you feel that you can dance in and out of securities in a way that defeats the inflation tax, I would like to be your broker, but not your partner. Understanding and teaching explanation. This quote is often attributed to Warren Buffett, and it's packed with investment wisdom. Let's break it down in a simple, teaching-friendly way. Dance in and out of securities means frequently buying and selling investments like stocks or bonds. Defeats the inflation tax refers to the idea of trying to earn enough profits from investing to outpace inflation, which erodes the value of money over time. I would like to be your broker, but not your partner, is a clever way of saying, if you think you can consistently beat inflation by timing the market, I'd love to earn commissions from your trades as your broker. But I wouldn't risk my own money with you as your partner because I don't believe it will work long term. In essence, Buffett is skeptical of people who think they can outsmart the market through frequent trading. He knows that while it may look profitable in the short run, it's extremely hard to do consistently, especially after accounting for inflation, taxes, and transaction costs. Moral lessons. Point-wise. 1. Avoid overconfidence in market timing. It's extremely difficult to predict market movements consistently. 2. Frequent trading doesn't guarantee real gains. Even if you earn profits, inflation and taxes can reduce your actual returns. 3. Long-term investing is more reliable. Investing with a long-term mindset is generally safer and more rewarding. 4. Be cautious of flashy strategies. Just because someone trades actively doesn't mean they're making smart financial decisions. 5. Think like a partner, not just a player. Invest in things you'd be proud to own long-term, not just flip for quick gains. The fact that people will be full of greed, fear, or folly is predictable. The sequence is not predictable. Understanding and teaching explanation. This quote highlights a deep truth about human nature and behavior. Greed, fear, and folly are recurring patterns in how people act, especially in areas like investing, decision-making, or leadership. It is certain and predictable that these emotions or traits will show up because they're part of human nature. However, what is unpredictable is when and in what order they will appear. For example, sometimes people might act out of greed first, chasing quick success or profits. Other times, fear might take over, causing panic, hesitation, or poor decisions. Folly or irrational behavior can happen at any time, often without clear reason. So, while we can expect these emotions to influence people, we cannot predict the exact timing or sequence in which they will take control. This concept is especially useful in teaching about psychology, finance, or leadership, helping us stay alert and not be surprised when people act emotionally or irrationally. Now, moral in point-wise format. 1. Understand human nature. Emotions like greed, fear, and folly are natural and recurring. 2. Don't try to predict behavior patterns. The order in which people act emotionally is unpredictable. 3. Stay aware and cautious. Being mindful of these tendencies can help you make better decisions. 4. Control your own emotions. While others may fall to these patterns, you can strive to stay rational. 5. Be prepared, not surprised. Expect irrational behavior from time to time, but don't let it derail your focus. We enjoy the process far more than the proceeds. Understanding and teaching explanation. This quote means that the journey or the act of doing something can bring more happiness and satisfaction than the reward or outcome at the end. It highlights the importance of being present and finding joy in the efforts we make, rather than just focusing on what we'll get out of it. Let's break it down simply. Process means the steps, hard work, learning, and experiences you go through while doing something. Proceeds means the result, reward, or money you get after it's done. For example, if you're baking a cake, the fun might not just be in eating it, but in mixing, decorating, and sharing it with others. The doing is often more meaningful than the final thing. In teaching, encourage students to fall in love with learning itself, solving problems, asking questions, exploring ideas, not just getting good grades. Moral key takeaways, point-wise. 1. Focus on enjoying the journey, not just the destination. 2. True happiness often comes from the work, not the reward. 3. Appreciate effort, growth and learning over quick outcomes. 4. Passion and love for the process leads to long-term success. 5. Living in the moment brings deeper fulfillment. Charlie Munger and I never have an opinion on the market because it wouldn't be any good and it might interfere with the opinions we have that are good. Warren Buffett. Understanding and teaching explanation. This quote by Warren Buffett reflects a powerful mindset about investing and decision-making. Avoid distractions. Buffett and Munger choose not to predict the stock market's short-term movements. Why? Because such predictions are often unreliable, even for the most seasoned experts. Focus on what matters. Instead of wasting time trying to guess the market's ups and downs, they focus their energy on understanding specific businesses and making sound investment decisions based on long-term value. Preserve mental clarity. Having too many uncertain or speculative opinions can cloud your judgment. By avoiding baseless market forecasts, they prevent those weak opinions from affecting their strong, well-researched views. In essence, they're teaching us that quality of thought is more important than quantity. Not every topic deserves your opinion, especially if it's not grounded in solid understanding. Moral, key lessons, point-wise. 1. Don't waste time trying to predict what you can't control, like the stock market. 2. Focus on what you truly understand and have expertise in. 3. Avoid cluttering your mind with unhelpful or speculative thoughts. 4. Strong decisions come from clear thinking and deep knowledge. 5. Discipline in thought leads to better outcomes than guessing or reacting emotionally. The market is there only as a reference point to see if anybody is offering to do anything foolish. When we invest in stocks, we invest in businesses. Understanding and teaching explanation. This quote is often attributed to Warren Buffett, and it carries deep investing wisdom. Let's break it down step by step. 1. The market is there only as a reference point. The stock market goes up and down every day. Prices fluctuate based on fear, excitement, news and speculation. But these fluctuations don't always reflect the true value of a company. Think of the market like a thermometer. It gives you a temperature reading, but it doesn't control the weather. It just shows you what's happening. 2. To see if anybody is offering to do anything foolish. Sometimes people panic sell or buy irrationally, which leads to foolish pricing. For example, if a good business is being sold very cheap because the market is scared, that's a foolish move by the seller, and a great opportunity for a smart investor. Buffett is saying, use the market to spot opportunities, but don't let it control your emotions or decisions. 3. When we invest in stocks, we invest in businesses. This is the most important lesson. A stock isn't just a number or a ticker symbol, it represents ownership in a real business. So before buying a stock, ask yourself, would I buy this entire business at this price? Do I believe in its products, management and future? If yes, then ignore short-term market moves. Focus on the long-term value of the business. Moral point-wise. 1. Use the stock market as a tool, not a master. 2. Look for irrational behavior to find good investing opportunities. 3. Don't panic when prices fall. They might just be temporary noise. 4. Always remember you're buying a piece of a business, not just a stock. 5. Focus on the business fundamentals, not the daily stock price. 6. Be rational and patient. That's the key to long-term investing success. For some reason, people take their cues from price action rather than from values. What doesn't work is when you start doing things that you don't understand or because they worked last week for somebody else. The dumbest reason in the world to buy a stock is because it's going up. Understanding and teaching explanation. This quote is a deep insight into the world of investing and decision-making, especially in the stock market. Let's break it down. 1. People take their cues from price action rather than from values. Many investors focus only on what the stock price is doing, going up or down, instead of understanding the actual value or worth of the company. Price movements can be emotional or temporary, but the real strength lies in the company's fundamentals, like revenue, profit, growth potential, etc. 2. What doesn't work is when you start doing things that you don't understand. Jumping into investments or decisions without fully understanding them is risky. Blindly copying others without knowing why something works can lead to losses. 3. Or because they worked last week for somebody else. Just because a certain investment made money for someone recently doesn't mean it will work for you now. Markets change quickly. What worked yesterday might not work today. 4. The dumbest reason in the world to buy a stock is because it's going up. A rising price doesn't always mean a good investment. Buying just because it's going up is like chasing a trend without knowing the destination. It's not a strategy, it's speculation. Moral of the quote, point-wise. 1. Always focus on the true value of an investment, not just its price. 2. Avoid doing things you don't fully understand. Knowledge is key. 3. Don't blindly copy others' strategies. Do your own research. 4. Never invest based on hype or trends. Make informed decisions. 5. Patience, understanding, and analysis matter more than excitement. If past history was all there was to the game, the richest people would be librarians. Explanation. Understanding and teaching way. This quote, often attributed to investor Warren Buffett, carries a deep message about success, decision-making, and the importance of action over just information. Let's understand it in a simple way. Librarians have access to vast amounts of history, facts, and information. They are surrounded by books containing knowledge of the past. But simply having access to that information doesn't automatically make someone rich or successful. Why? Because success also depends on how you use that information. In other words, just knowing what happened in the past is not enough. What truly matters is how you analyze, apply, and make decisions based on that knowledge in the present and future. Imagine this. You can read 100 books on business, but unless you act on the knowledge, take risks, and learn from experience, success won't follow. Moral 1. Knowledge is important, but action is key. 2. Wisdom comes from applying what you know, not just knowing it. 3. Success requires decision-making, risk-taking, and adapting, not just studying the past. 4. Learning from history is useful, but creating your future is what counts. 5. Information is only powerful when combined with action and strategy. Anything can happen anytime in markets, and no advisor, economist, or TV commentator, and definitely not Charlie nor I, can tell you when chaos will occur. Market forecasters will fill your ear, but will never fill your wallet. Understanding and teaching, explained in a simple way. This quote, likely from Warren Buffett, carries a deep message about uncertainty in the stock market. 1. Anything can happen anytime in markets. The stock market is unpredictable. Prices can rise or fall unexpectedly due to many factors: news, politics, global events, or investor behavior. No one can fully anticipate what will happen next. 2. No advisor, economist, or TV commentator, and definitely not Charlie nor I, can tell you when chaos will occur. Even the most experienced and intelligent people, including Warren Buffett and Charlie Munger, admit that they cannot predict when a market crash or sudden change will happen. This is a humble acknowledgement that no one has a crystal ball. Market forecasters will fill your ear but will never fill your wallet. Many so-called experts will gold predictions on TV or social media. They may sound convincing, but blindly following them won't make you rich. Often their job is to talk, not to make money for you. Listening too much can be risky. Moral lessons. Point-wise. 1. Accept market uncertainty. Understand that surprises are normal in investing. 2. Avoid over-relying on predictions. No one, however smart, can time the market perfectly. 3. Be cautious with expert advice. Some advice is just noise. Always think critically. 4. Focus on fundamentals. Invest based on research and long-term value, not speculation. 5. Have a risk management plan. Prepare for the unexpected rather than trying to predict it. I only get into situations where I know the value. There are thousands of companies whose value I don't know, but I know the ones I know, and incidentally, you don't pinpoint things. If somebody walks in this door and they weigh between 300 and 350 pounds, I don't need to say they weigh 327 to say that they're fat. Understanding and teaching explanation. This quote emphasizes the importance of staying within your circle of competence, only involving yourself in areas where you truly understand the value instead of blindly trying to assess or invest in everything. Let's break it down. I only get into situations where I know the value. Focus only on opportunities you deeply understand. Don't gamble or guess. There are thousands of companies whose value I don't know. Shh! It's okay to admit you don't know everything. You don't need to understand every company or every opportunity to succeed. But I know the ones I know. It's better to deeply know a few good opportunities than to be vaguely aware of many. You don't pinpoint things. In many cases, you don't need extreme precision to make a sound judgment. If somebody walks in between 300 and 350 pounds, I don't need to say they weigh 327. You don't need to know the exact number to recognize the clear reality. Similarly, in investing or decision-making, an approximate understanding is often enough if the conclusion is obvious. Moral, point-wise. 1. Stick to what you know well. Don't venture into areas beyond your understanding. 2. Avoid unnecessary precision. Often, rough but clear insights are more practical than exact details. 3. Admit your limits. It's wise to know what you don't know. 4. Depth over breadth. Better to master a few areas than spread yourself thin across many. 5. Clarity is key. Make decisions based on clear signals, not confusing details. John Maynard Keynes essentially said, "Don't try to figure out what the market is doing. Figure out a business you understand and concentrate." Understanding and teaching explanation. This quote by John Maynard Keynes gives a powerful piece of investment advice. Let's break it down in a simple way. Don't try to figure out what the market is doing. The stock market is unpredictable. Trying to guess whether it will go up or down in the short term is often a waste of time and energy. Even experts can't always predict the market accurately. Figure out a business you understand. Instead of chasing trends or guessing market moves, focus on understanding businesses. Study how a company earns money, its strengths, weaknesses, and long-term potential. And concentrate. Once you've found a business you deeply understand and believe in, focus your efforts and investments there. Don't spread yourself too thin. Concentration in quality opportunities usually leads to better results than jumping from one thing to another. This advice is especially helpful for investors, students of finance, and even entrepreneurs. It promotes a mindset of deep understanding and focused effort rather than speculation. Moral of the quote, point-wise. 1. Avoid guessing the market's next move. It's highly uncertain. 2. Focus on businesses you truly understand. 3. Invest or work with deep knowledge, not just hype or trends. 4. Concentration is often more powerful than diversification without understanding. 5. Long-term success comes from clarity and focus, not confusion and chasing noise. I like to go for cinches. I like to shoot fish in a barrel, but I like to do it after the water has run out. Understanding and teaching explanation. This quote uses humor and metaphor to express a deeper idea about seeking easy wins, but only when the situation is even more in your favor. Let's break it down part by part. 1. I like to go for cinches. A cinch is something that's easy to do or guaranteed to succeed. This means the person prefers to go after tasks that are sure wins. 2. I like to shoot fish in a barrel. This is a saying that describes something so easy it's nearly impossible to fail, like shooting fish trapped in a small space. 3. But I like to do it after the water has run out. Here's where the wit kicks in. Even when the task is already easy, they want to wait until it's even easier. The water being gone means the fish can't even swim away. Teaching point. This quote speaks about strategic advantage. Some people may wait for the perfect moment, when the odds are entirely in their favor, before taking action. It also hints at a mindset of calculated patience and maximizing efficiency. However, it can also subtly suggest overcautiousness, or even a desire to only act when there's zero risk. Moral lessons, point-wise. 1. Choose battles wisely. Go for goals where success is highly probable. 2. Be patient. Sometimes waiting for the right moment increases your chances of winning. 3. Act smart, not hard. Efficiency can be more powerful than brute effort. 4. Strategic timing matters. Don't rush in. Wait until conditions are in your favor. 5. Don't avoid all challenges. While this mindset helps in strategy, always playing it too safe might limit growth. Overall, Berkshire and its long-term shareholders from a sinking stock market, much as a regular purchaser of food benefits from declining food prices. So when the market plummets, as it will from time to time, neither panic nor mourn. It's good news for Berkshire. Explanation in an understanding and teaching way. Imagine you're someone who buys groceries every week. If the prices of food go down, you're happy because you can buy more for less. Similarly, Berkshire Hathaway, which is Warren Buffett's company, and its long-term investors, actually like it when the stock market goes down sometimes. Why? Because when stock prices fall, it gives them a chance to buy great companies at cheaper prices. For long-term investors who are regularly buying into the market, a falling market is like a sale, a chance to pick up valuable assets at a discount. So Buffett is saying, don't be afraid or sad when the market crashes or drops. Don't panic. It's not bad news. It can actually be a great opportunity, especially for those who think long-term and keep investing over time. Moral key takeaways point-wise. 1. Market drops are not always bad. They can create valuable opportunities. 2. Falling prices benefit buyers. Just like lower grocery prices help shoppers, lower stock prices help investors. 3. Think long-term. Panic and emotional reactions hurt more than they help. 4. Buy quality when it's on sale. A smart investor uses downturns to buy more at better prices. 5. Stay calm during market turbulence. Patience and a steady mindset pay off. Currently liking neither stocks nor bonds, I find myself the polar opposite of Mae West, as she declared, I only like two kinds of men, foreign and domestic. Understanding and teaching explanation. This quote is a clever and humorous way to express disinterest in all available options. Here's how to understand it. The speaker is talking about not liking either stocks or bonds, which are the two major types of investments. Then they reference Mae West, a famous actress known for her bold and witty one-liners. Mae West once said, I only like two kinds of men, foreign and domestic, meaning she liked all kinds of men, no exceptions. The speaker contrasts this by saying they are the polar opposite of Mae West. So instead of liking both types like Mae West did with men, the speaker dislikes both types, stocks and bonds. In a teaching sense, it's a play on contrast and exaggeration to make a point. It mixes finance, stocks and bonds with humor, Mae West's famous quote, to keep the message engaging. The deeper idea is, sometimes none of the common options seem appealing. Moral lessons. Point-wise. 1. Don't be afraid to go against the norm. It's okay to not follow popular choices. 2. Use humor to express serious opinions. It makes the message more relatable and easier to digest. 3. Critical thinking is key. Always evaluate your choices, like stocks or bonds, rather than accepting them by default. 4. Clever comparisons can make communication powerful. Using familiar references can make your point stand out. 5. Be clear about your preferences. Knowing what you don't want is just as important as knowing what you do want. Berkshire buys when the lemmings are heading the other way. Understanding and teaching way, explanation. This quote comes from Warren Buffett, or one of his close associates at Berkshire Hathaway, the investment company he leads. Let's break it down. Berkshire refers to Berkshire Hathaway, which is known for value investing, buying strong companies at low prices. Lemmings are small animals that follow each other blindly, even to their own harm. In finance, lemmings represent the crowd or average investors who often follow market trends without thinking critically. Heading the other way means going in the opposite direction of the crowd. So, the full quote means, Berkshire Hathaway invests when everyone else is panicking and selling. Instead of following the crowd, they go the opposite way and look for opportunities. This reflects contrarian investing, making decisions based on logic, analysis, and value, not emotion or herd mentality. Moral, point-wise. 1. Think independently. Don't blindly follow the crowd. 2. Buy low, sell high. Look for opportunities when others are afraid. 3. Use logic over emotion. Investment decisions should be based on research, not fear or hype. 4. Be patient. Long-term thinking often leads to better outcomes. 5. Look for value. Great opportunities often come during market downturns. Writing a check separates a commitment from a conversation. Understanding and teaching way. This quote means that talking about doing something and actually committing to it are two very different things. When people talk, they may make promises, show interest, or say they'll help, but it's not always certain they will follow through. Writing a check is a tangible action. It turns words into something real, like giving money, signing a contract, or delivering on a promise. So, when someone writes a check, they are no longer just talking about support or help, they are actually doing it. Think of it like this. In a conversation, you might say, "I believe in your project." But when you write a check, you say, "I believe in your project so much that I'm willing to put money behind it." This applies to more than money too. It's about action over talk. Commitment means backing up your words with effort, time, resources, or whatever it takes. Moral. 1. Actions speak louder than words. Don't just say it, prove it. 2. True commitment requires effort or sacrifice. Whether it's money, time, or energy, real support shows up in action. 3. Talk is cheap. Real value comes with action. Promises mean little without follow-through. 4. Support should be measurable. If you believe in something or someone, show it in a way that makes a difference. 5. Make your intentions real. Move from intention to execution. It separates dreamers from doers. When you're associating with the people that you love, doing what you love, it doesn't get any better than that. Understanding and teaching explanation. This quote emphasizes the joy and fulfillment that comes from two powerful things. 1. Being with the people you truly care about, like family, friends, or mentors. 2. Doing the work or activities that make you happy and passionate, such as your dream job, hobbies, or purpose in life. When both of these elements, love for people and love for work, come together, it creates a deeply satisfying and meaningful life. It's a reminder that success isn't only about money or fame, it's about genuine connection and purpose. Teaching tip. Imagine you're on a team where everyone supports you and you're working on something you truly enjoy, like painting, coding, teaching, or playing sports. Every day feels energizing and exciting, not exhausting. That's the kind of life this quote encourages you to aim for. Moral of the quote, point-wise. 1. Value relationships. Surround yourself with people who bring joy, support, and inspiration into your life. 2. Pursue your passion. Do what you genuinely enjoy, not just what pays well or seems popular. 3. Balance is bliss. True happiness lies in combining meaningful work with meaningful relationships. 4. Define your own success. Success isn't just about wealth or status, but about love, passion, and fulfillment. 5. Live intentionally. Make choices that bring you closer to the life you truly want, both emotionally and professionally. In a bull market, one must avoid the error of the preening duck that quacks boastfully after a torrential rainstorm, thinking that its paddling skills have caused it to rise in the world. A right-thinking duck would instead compare its position after the downpour to that of the other ducks on the pond. Understanding and teaching explanation. This quote uses a metaphor to deliver a valuable lesson about investing and humility, especially during favorable times like a bull market, a market where prices are rising and everyone seems to be doing well. Imagine a duck floating on a pond during a heavy rainstorm. After the storm, the water level rises, and the duck is now higher than before. The naive duck thinks, "Wow, I'm so good at paddling. Look how high I've gotten." But in reality, all ducks on the pond have risen equally, not because of their paddling, but because of the external factor, the rain. In the stock market, a similar thing happens. During a bull market, prices go up and many investors make profits. But it's important to remember that rising prices may lift everyone's portfolio, not just because of individual skill, but due to the overall market conditions. The right-thinking duck, or a wise investor, doesn't get boastful. Instead, they compare their results to others. They check if their performance is better, worse, or the same as others, acknowledging the role of market conditions. Moral, point-wise. 1. External conditions, like market trends, often influence success more than we think. 2. Avoid pride or overconfidence based solely on favorable outcomes. 3. True performance should be measured relative to others or the market, not just by absolute gains. 4. Stay humble and self-aware, especially during good times. Skill is best judged during tough times, not just in rising markets. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. Understanding and teaching explanation. This quote is about investing wisely and not following the crowd blindly. When everyone is excited about a stock or the market, it usually means the price has already gone up a lot. People rush in out of fear of missing out, FOMO, often buying at high prices. But by then, the real profit opportunity is mostly gone. It's already popular, and the price reflects that. Smart investors look for undervalued or ignored stocks when nobody is talking about them. That's where the opportunity lies. Buy low, sell high, not the other way around. In essence, successful investing requires patience, discipline, and the courage to go against the crowd. Moral point-wise. 1. Don't follow the crowd blindly in investing. 2. Popularity often means the best opportunity has already passed. 3. Look for value where others are not looking. 4. True success comes from patience and independent thinking. 5. Invest when others are fearful, not greedy. You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Rationality is essential. Understanding and teaching explanation. This quote, often attributed to legendary investor Warren Buffett, delivers a powerful message about the nature of investing. Let's break it down. You don't need to be a rocket scientist. This means you don't have to be a genius or possess extremely high intelligence to succeed in investing. Complex mathematical skills or scientific knowledge aren't necessary. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. A high IQ, intelligence quotient, doesn't guarantee success in investing. Someone with a slightly lower IQ, 130, is still very smart. Can perform just as well, if not better, than someone with a higher IQ. Success doesn't depend on raw intelligence alone. Rationality is essential. The most important trait in investing is rational thinking. This means staying calm during market ups and downs, making decisions based on facts and logic, not emotions, having discipline and a long-term perspective. In other words, investing rewards clear thinking, patience, and emotional control more than brilliance. Moral, key takeaways, point-wise. 1. You don't need to be a genius to invest wisely. 2. Smart decisions matter more than a high IQ. 3. Rationality and emotional control are the real superpowers in investing. 4. Success in investing is about discipline, not complexity. 5. Stick to simple, logical strategies rather than flashy or risky moves. We like stocks that generate high returns on invested capital, where there is a strong likelihood that it will continue to do so. For example, the last time we bought Coca-Cola, it was selling at about 23 times earnings. Using our purchase price and today's earnings, that makes it about 5 times earnings. It's really the interaction of capital employed, the return on that capital and future capital generated versus the purchase price today. Understanding and teaching way. Let's break it down in simple, understandable terms. High returns on invested capital, ROIC. This means the company earns a lot of profit for every dollar it invests back into the business. Investors love this because it shows the company uses its money efficiently. Sustainability is key. It's not just about a company doing well today. it should have a strong likelihood of continuing to perform well in the future. Example of Coca-Cola. When they bought Coca-Cola stock, it looked expensive at the time. 23 times the company's earnings, a high PE ratio. But over time, as Coca-Cola's earnings grew, their original investment looked much cheaper, effectively just 5 times earnings. The core idea. What matters most is how much profit the company can generate using the money it has, capital employed, how much of that profit it reinvests, and how those future profits compare to the price paid today for the stock. Moral key takeaways, point-wise. 1. Invest in companies with consistently high returns on capital. These businesses use their resources wisely and make more profit with less input. 2. Think long-term and focus on future earnings, not just today's price. 3. Don't fear high PE ratios if the company can grow its earnings strongly. 4. Understand the relationship between capital invested, its return, and what you pay today. 5. Patience pays. Over time, a good business becomes a great investment. As long as we can make an annual 15% return on equity, I don't worry about one quarter's results. Understanding and teaching explanation. This quote is emphasizing a long-term investment mindset, especially in business and finance. Return on equity. This is a financial metric that measures a company's profitability in relation to shareholders' equity. An annual return of 15% means the company earns 15 cents for every dollar invested by shareholders over a year. One quarter's results. A quarter refers to 3 months of financial performance. Some investors or analysts focus too much on short-term results, quarterly earnings. The speaker is saying, if our overall yearly performance is strong, like a solid 15% ROE, then I'm not going to stress over short-term dips or fluctuations that may happen in just one quarter. This reflects the thinking of disciplined investors or business leaders who care about sustainable long-term growth rather than chasing short-term gains or reacting emotionally to short-term results. Moral lessons, point-wise. 1. Focus on long-term performance, not short-term fluctuations. 2. Consistent annual returns matter more than temporary ups and downs. 3. Patience and discipline are key traits in smart investing and business. 4. Sound fundamentals like ROE are better indicators than quarterly results. 5. Avoid emotional decisions based on short-term outcomes. The propensity to gamble is always increased by a large prize versus a small entry fee, no matter how poor the true odds may be. That's why Las Vegas casinos advertise big jackpots and why state lotteries headline big prizes. Understanding and teaching explanation. This quote highlights a psychological tendency in human behavior. People are more likely to take a chance or gamble when there is a big reward, large prize, chart at stake, and it only costs them a small amount, small entry fee, to participate, even if the actual chances of winning, true odds, are very low. For example, casinos in Las Vegas display huge jackpot amounts because they know that the possibility of winning a massive sum attracts more people, even if the chance of actually winning is tiny. Similarly, state lotteries advertise their biggest prizes to encourage ticket sales, knowing that people are more motivated by the dream of a life-changing win than by the reality of how unlikely that win is. This behavior comes from emotional decision-making rather than logical thinking. Instead of calculating the chances of winning, people often focus on what if I win and are tempted by the possibility rather than the probability. Moral, key takeaways, point-wise. 1. Big rewards can cloud judgment. People often overlook the low chances of winning when the prize is very attractive. 2. Low entry cost creates illusion of low risk. A small investment feels harmless even if it adds up over time. 3. Emotions can overpower logic. Desire and hope often drive gambling behavior more than mathematical thinking. 4. Marketing manipulates human psychology. Big jackpots are promoted to tap into our dreams and increase participation. 5. Be cautious with gambling. Understand the real odds and don't be misled by flashy prizes or low costs. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances, that cause the stock to be misappraised. Understanding and teaching way. This quote means that sometimes very good and strong companies go through tough times, not because they are bad companies, but because of unusual or temporary situations like economic downturns, scandals, or public panic. When this happens, the market may wrongly judge, misappraise the true value of the company's stock and price it much lower than it's actually worth. This creates a hidden gem opportunity for smart investors. They can buy the stock at a cheap price while the company is still fundamentally strong. Over time, as the situation clears, the stock returns to or even exceeds its true value, giving great returns to those who invested during the tough phase. Think of it like a diamond covered in mud. People might ignore it, but someone who recognizes the diamond underneath can get it for a bargain. Moral key takeaways. 1. Look beyond short-term problems. Good companies can face bad times, but that doesn't make them bad investments. 2. Opportunity hides in uncertainty. Unusual circumstances can create chances to invest at a discount. 3. Think independently. Don't always follow the crowd. The market can misjudge value. 4. Do your research. Know the real strength of a company before making decisions. 5. Patience pays off. Investing when others panic often leads to big rewards later.
I missed the play in cellular because cellular is outside of my circle of competence. Understanding and teaching way. Simple explanation. This quote means, I didn't take advantage of the opportunity in the cellular, mobile phone industry because I didn't understand it well enough. It wasn't something I had deep knowledge or experience in, so I stayed away from it. Let's break it down. Missed the play, missed the opportunity, or didn't invest, get involved. Cellular refers to the mobile or telecom industry. Outside of my circle of competence equals not an area the person knows well or is confident in. Teaching angle. The phrase circle of competence is a concept popularized by Warren Buffett. It means focusing only on what you know well. Everyone has a limited area where they have strong understanding and skill. Their circle. Venturing too far outside of it can lead to mistakes. So this quote is someone admitting, I didn't invest or take part in the cellular industry because I knew I didn't understand it deeply enough. That's a wise, humble approach to decision-making. Moral. 1. Know your limits. It's okay to not be good at everything. Focus on what you do know. 2. Stay in your circle of competence. Make decisions in areas where you have real knowledge. 3. Lifelong learning matters. If something is outside your circle but important, consider expanding your knowledge. 4. Admit what you don't know. There's wisdom in recognizing your own boundaries. 5. Don't chase every opportunity. Just because something looks profitable doesn't mean it's right for you. I can't be involved in 50 to 75 things. That's a Noah's Ark way of investing. You end up with a zoo that way. I like to put meaningful amounts of money in a few things. Explanation in an understanding and teaching way. This quote uses a metaphor to explain a principle of focused investing. Let's break it down. I can't be involved in 50 to 75 things. The speaker, likely a successful investor, is saying they don't like to spread their attention or money across too many investments or activities. That's a Noah's Ark way of investing. You end up with a zoo that way. This is a clever metaphor. In the biblical story, Noah took 2 of every kind of animal into the ark. If you apply that to investing, putting a little into everything, you end up with a messy, unorganized portfolio full of too many small investments. It's like trying to manage a zoo, chaotic and hard to control. I like to put meaningful amounts of money in a few things. Instead of investing in many things, the speaker prefers to focus on a few strong, well-understood opportunities and invest in them significantly. This approach allows for better management, higher confidence, and potentially better returns. Moral lessons. Point-wise. 1. Focus is powerful. Spreading yourself too thin leads to confusion and inefficiency. 2. Quality over quantity. A few strong investments are better than many weak ones. 3. Understand before you invest. Only invest where you have knowledge and confidence. 4. Avoid over-diversification. Too many different investments can hurt your performance rather than protect it. 5. Put your energy and resources where they matter most. Concentrate on what has the most potential. I read annual reports of the company I'm looking at, and I read the annual reports of the competitors. That is the main source of material. Explanation in an easy, understanding, and teaching way. This quote is about how serious investors, especially successful ones like Warren Buffett, who often says things like this, do their homework before investing in a company. What is an annual report? It's a detailed summary published once a year by a company. It includes financial results, business performance, strategies, risks, and plans. It's like a report card for a business. What is the quote saying? The speaker is saying that the main way they learn about a company is by reading these reports, not just from the company they're interested in, but also from its competitors. This helps them get a complete picture of the market and compare companies better. Why competitors' reports too? Because it helps you understand how the industry is performing, what one company is doing better or worse than another, trends, challenges, or opportunities in the field. It's like if you were trying to pick the best football team, you wouldn't just look at one team's performance, you'd compare it with others too. Lessons, point-wise. 1. Do your homework. Always research deeply before making decisions. 2. Use reliable sources. Annual reports are direct, factual, and trustworthy. 3. Compare options. Looking at competitors gives a clearer, more balanced view. 4. Understand the full picture. Don't just focus on one side, analyze the whole industry. 5. Good preparation leads to smart decisions. The more you read and know, the better your choices will be. The Castle, the Moat, and the Golden Heart, a story about great companies. Once upon a time, in the vast kingdom of commerce, there stood a collection of grand castles. These were no ordinary castles. They were majestic, powerful, and seemingly impenetrable. Travelers from all corners of the world admired them, not just for their size, but for their strength, stability, and the legends of the leaders within. Among these was a castle named Fort Evergold. It sat atop a hill, surrounded by a deep, dangerous moat filled with snapping crocodiles, hidden whirlpools, and watchful guards. No enemy could easily cross it. This moat wasn't built overnight. It had been carefully formed over years of innovation, strategy, and unmatched customer loyalty. Inside Fort Evergold lived a wise and humble leader named Sir Valorem. He was not just a genius in commerce, but also a man of great character. Sir Valorem didn't hoard the gold his castle generated. Instead, he reinvested much of it to strengthen the walls, widen the moat, and reward the people who made the castle thrive. Other rulers looked on, hoping to copy Fort Evergold's success. They tried to build similar castles, but they lacked the one thing Sir Valorem had mastered: permanence through genius and integrity. His strategies were not just clever, they were almost impossible to duplicate. Sir Valorem's moat wasn't just a barrier. It was a powerful symbol of his company's dominance. It protected the kingdom from competition, secured the future of those who lived within its walls, and gave peace of mind to those who invested in its success. And so, Fort Evergold stood tall year after year, weathering storms, outlasting rivals, and growing stronger with time. Teaching from the tale. This story is more than a fantasy. It's an allegory for what makes a great company. Legendary investor Warren Buffett often describes his favorite businesses in this very way. Castles are companies with strong, dependable operations. The moat represents a competitive advantage, something that protects the business from competition. This could be a strong brand, customer loyalty, patents, network effects, or scale. The leader inside, Sue, is the management, ideally someone who is smart, ethical, and thinks long-term. The gold is profit, but the best leaders use it wisely, sharing it with stakeholders or reinvesting it to make the company even better. Moral of the story: the best companies are like strong castles with wide moats, led by principled leaders who use genius and gold to create enduring value for all. Important points to remember. 1. Look for a wide moat. Great businesses have a lasting edge that protects them from competition. 2. Strong, ethical leadership matters. A wise and honest CEO can build something truly remarkable. 3. Sustainable advantage. The company should be difficult to copy and built to last. 4. Long-term thinking wins. Like a fortress, strength is built over time through reinvestment and integrity. 5. Invest where gold is shared. Companies that generate wealth and use it wisely are the real treasures. If they try to time their purchases, they will do very well for their broker and not very well for themselves. Understanding and teaching way. This quote is about investing in the stock market, and it gives an important lesson for individual investors. Timing the market means trying to guess the best times to buy low and sell high. Many people try to predict when stock prices will go up or down so they can buy or sell at the perfect time. However, this strategy rarely works for regular investors. When people frequently buy and sell, they often pay a lot in fees and commissions to their brokers or trading platforms. So, while the broker earns well from these transactions, the investor usually doesn't make much money, or may even lose money due to poor timing and extra costs. Moral key lessons, point-wise. 1. Don't try to time the market. It's extremely difficult, even for experts. 2. Frequent trading helps brokers, not you. 3. Long-term investing is often safer and more profitable. 4. Stay consistent with your investments instead of chasing quick gains. 5. Avoid emotional decisions like panic buying or selling. If you want to soar like an eagle in life, you can't be flocking with the turkeys. Understanding and teaching explanation. This quote uses birds as a metaphor to deliver a powerful life lesson. Eagles are known for flying high, being strong, focused, and independent. They symbolize ambition, vision, and success. Turkeys, on the other hand, stay on the ground, lack direction, and are often seen as less intelligent or purposeful. So this quote is saying, if you want to be successful, achieve great things, and rise above average, you need to surround yourself with people who are positive, driven, and goal-oriented, not those who waste time, discourage you, or hold you back. It's a reminder that your environment and the people you spend time with greatly influence your mindset, that growth, and future. Moral of the quote, point why. 1. Surround yourself with positive and ambitious people. Your company shapes your character and direction. 2. Let go of relationships that limit your growth. Avoid those who discourage or distract you from your goals. 3. Aim high like an eagle. Focus on your dreams, be bold, and think big. 4. Choose your environment wisely. Be in places that challenge you to be better, not comfortable, but stagnant. 5. Self-belief and strong vision lead to success. Like an eagle, trust your wings and soar above challenges. All there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. Understanding and teaching explanation. This quote gives a simple but powerful formula for successful investing. Let's break it down step by step. 1. Picking good stocks. This means choosing companies that are strong, profitable, well-managed, and have potential for growth. These are businesses you believe in because they offer good products or services and have solid fundamentals. 2. At good times, timing matters. You should aim to invest when the stock price is fair or undervalued, not overhyped or overpriced. That way, you buy more value for less money. 3. Staying with them. Once you've invested, don't panic with market ups and downs. Stay invested for the long term instead of chasing quick gains. 4. As long as they remain good companies, keep monitoring the company. If it continues to perform well, grow, and maintain its values, there's no reason to sell. But if it loses its strength or direction, it might be time to reconsider. Moral lessons, point-wise. 1. Choose quality over hype. Invest in companies with real value and solid foundations. 2. Be patient and think long-term. Great returns come to those who wait and trust the process. 3. Keep evaluating your investments. Stay informed about the company's performance. 4. Timing matters, but don't time the market. Buy when value aligns, not based on emotions or trends. 5. Don't panic during market fluctuations. Stick with your investments if the fundamentals are still strong. Talking at business schools, I always say students would be better off if, when they got out of school, they got a ticket with 20 punches on it. And every time they make an investment decision, it uses up a punch. You'll never use up all 20 punches if you save them for the great ideas. Understanding and teaching explanation. This quote is often attributed to Warren Buffett, one of the most successful investors of all time. He uses a metaphor to teach a powerful lesson about decision-making and investing. Imagine you only have 20 chances, punches on a ticket, to make investment decisions in your whole life. If you knew that you had only 20, you'd be extremely careful about each one, right? You'd spend more time researching, thinking deeply, and waiting for only the best opportunities. By doing this, you'll naturally avoid impulsive, emotional, or poorly thought-out investments. Buffett is saying, treat your decisions as if they are limited and precious, because in a way, they are. This mindset encourages quality over quantity, which often leads to much better outcomes in business and life. Moral key takeaways, point-wise. 1. Value quality over quantity. Don't chase every opportunity. Wait for the best ones. 2. Be patient and disciplined. Great ideas are rare, so be willing to wait for them. 3. Think long-term. Treat every decision as if it significantly impacts your future. 4. Avoid impulsiveness. Limited choices mean you must think carefully before acting. 5. Strategic thinking wins. Success often comes from fewer, smarter moves, not constant action. Chasing the Illusion, a tale of market myths and mathematical truths. Once upon a time, in the bustling world of finance, investors dreamed of riches just as children dream of candy. And why wouldn't they? After all, stock markets had soared in the past, an irresistible proof of promise. In the grand hall of 20th century history, the Dow Jones Industrial Average, a once humble index standing at just 66 points in the year 1900, climbed its way over the decades to an astonishing 11,497 by the end of 1999. That leap, majestic as it may seem, translates to an average market value gain of 5.3% annually. Modest? Perhaps. Powerful over time? Absolutely. Now, let's leap forward, as investors often do in their imagination, to the dawn of the next century, the year 2100. Suppose you wanted to match that same 5.3% gain over the next 100 years. Logic would demand a Dow not just at 30,000, 50,000, or even 100,000. No. To mirror that historical growth, the Dow would need to climb to nearly 2,000 and, yes, 2 million. Yet, financial advisors, ever optimistic, often speak casually about double-digit returns, as though they grow on trees in the backyard of Wall Street. If you dare to challenge this optimism with the above math, you might be met with a smile and a shrug. The advice givers will continue, undeterred, much like the queen in Alice in Wonderland, who proudly claimed, "Why, sometimes I've believed as many as 6 impossible things before breakfast." Moral of the story. Believing in magic is for fairy tales. Investing requires reality. Not every optimistic prediction deserves your trust. Exponential market returns aren't guaranteed, and compounding works both ways, for your gains and your expectations. Key takeaways. 1. Historical context matters. The Dow's rise from 66 to 11,497 was impressive, but it unfolded slowly over a century, not overnight. 2. Realistic returns win. A 5 to 6% annual return might sound small, but over time it's powerful and sustainable. 3. Question exaggerated optimism. If someone promises 10 to 15% annual returns every year, ask them to explain the math and the reality. 4. The magic of compounding is slow but steady. Patience, not fantasy, is the key to long-term wealth. 5. Skepticism is healthy. Trust but verify, especially when your financial future is on the line. Problems in a company are like cockroaches in the kitchen. You will never find just one. Understanding and teaching explanation. This quote uses a metaphor to describe the nature of problems in a company. Let's break it down. Cockroaches in the kitchen. If you see one, it usually means there are many more hidden somewhere. Problems in a company. Similarly, when you notice one issue, it's often a sign that there are deeper or more widespread problems lurking beneath the surface. Why this happens. Problems are often interconnected. A flaw in communication might also point to weak leadership or unclear processes. One issue can expose others. Fixing one thing might reveal other weaknesses that were hidden or overlooked. Organizational blind spots. Just like cockroaches hiding in the dark, problems often go unnoticed until something brings them to light. How to teach this idea. Encourage proactive problem solving. Don't stop at fixing the first issue. Investigate further. Teach systems thinking. Look at how different departments and processes are connected. Promote a culture of transparency and feedback. Employees should feel safe to report small issues before they grow into bigger ones. 1. One problem is rarely alone. Look deeper. 2. Solving surface issues is not enough. Address the root cause. 3. Ignoring small issues can lead to major crises later. 4. Encourage open communication to detect hidden problems early. 5. Adopt a holistic view. Every problem is part of a bigger picture. I'd rather have a $10 million business making 15% than a $100 million business making 5%. Understanding and teaching explanation. This quote is talking about the importance of profitability over size in business. Let's break it down. A $10 million business making 15% profit means it earns $1.5 million profit. $100 million business making 5% profit means it earns $5 million profit. Yes, $5 million is more than $1.5 million in pure numbers, but the quote is about more than just raw profit. Here's what it teaches. 1. Profit margin matters. A 15% profit margin means the business keeps more of every dollar it earns. It's healthier and more efficient. 2. Smaller can be better. A smaller company with better profit margins might be easier to manage, less risky, and more sustainable. 3. Bigger isn't always better. A large company with low margins might look impressive, but it can come with more stress, higher costs, and thinner safety nets. 4. Focus on quality, not just quantity. Smart business isn't just about growth in size, but also growth in quality and profitability. Moral key takeaways point-wise. 1. High profit margins are more valuable than high revenue. 2. Efficiency and smart management beat sheer scale. 3. A smaller, more profitable business can bring more peace and stability. 4. Don't chase size. Chase smart, sustainable growth. 5. In business, quality earnings matter more than quantity of sales. If you run across one good idea for a business in your lifetime, you're lucky. And fundamentally, Coca-Cola is the best large business in the world. It has got the most powerful brand in the world. It sells for an extremely moderate price. It's universally liked. The per capita consumption goes up almost every year in almost every country. There is no other product like it. Understanding and teaching explanation. This quote is emphasizing how rare and valuable it is to find a truly great business idea in your lifetime. The speaker uses Coca-Cola as an example of a perfect business model and explains why. Rare good idea. Truly successful business ideas don't come easily. If you find even one in your life, you are considered lucky. Coca-Cola as the best example. Coca-Cola is highlighted as the best large-scale business for several reasons. Brand power. Coca-Cola has built one of the most recognizable and trusted brands in the world. Affordable product. Its product is sold at a moderate price, making it accessible to everyone. Universal appeal. People all over the world enjoy Coca-Cola. In fact, the average amount consumed per person increases every year in many countries. No comparison. There is no other product that combines all these strengths in the same way Coca-Cola does. So this quote teaches us that building a timeless, universally loved, and affordable product is an extraordinary achievement. It also hints that simplicity and consistency, not just innovation, are keys to long-term success. Moral lessons, point-wise. 1. One great idea can define your lifetime success. 2. A powerful brand has global influence and lasting value. 3. Affordability helps in reaching a wide audience. 4. Creating a universally loved product leads to long-term growth. 5. Consistency and demand growth make a business truly exceptional. 6. Don't overlook simple ideas. They can become global giants. I always picture myself as owning the whole place. And if management is following the same policy that I would follow if I owned the whole place, that's a management I like. Understanding and teaching explanation. This quote encourages a mindset of ownership and responsibility. The speaker imagines that they own the entire organization or workplace. When someone sees themselves as the owner, they naturally care more, take initiative, and want everything to run well. They're saying that they respect and admire leadership, management, when it aligns with how they would manage the place if it were theirs, with fairness, vision, and commitment. It's about shared values between employee and management. This approach helps people stay motivated, feel involved, and perform their best because they aren't just doing a job, they feel like they're building something meaningful. Moral, point-wise. 1. Think like an owner. Take full responsibility for your work and environment. 2. Work with pride. When you act like it's your own, your efforts become sincere and impactful. 3. Respect values-based leadership. Appreciate management that shares your values and principles. 4. Promote alignment. Best results happen when employees and leaders think and act with a common vision. 5. Grow with responsibility. The ownership mindset leads to personal and professional growth. I am a huge bull on this country. We will not have a double-dip recession at all. I see our businesses coming back almost across the board. Understanding and teaching way. Let's break this quote down step by step. 1. I am a huge bull on this country. The speaker is saying they are very optimistic about the future of the country. In financial terms, being a bull means expecting growth and good economic performance. 2. We will not have a double-dip recession at all. A double-dip recession is when the economy starts to recover, but then falls back into a recession again. The speaker believes this won't happen. They think the recovery will continue without another downturn. 3. I see our businesses coming back almost across the board. This means that many industries or sectors are showing signs of strong recovery. Across the board suggests that it's not just one area improving, it's widespread. In short, the speaker has a strong belief that the country's economy is on the rise. There won't be another recession soon, and many businesses are recovering well. Moral or lessons, point-wise. 1. Stay positive. Confidence in the future can inspire growth and progress. 2. Believe in recovery. Even after tough times, economies and businesses can bounce back. 3. Look at the bigger picture. A broad view shows that recovery is happening in many places, not just a few. 4. Optimism fuels action. Belief in success often leads people and businesses to take steps that make it happen. 5. Support local growth. Encouraging local businesses helps strengthen the whole economy. Buy a business, don't rent stocks. Understanding and teaching explanation. This quote is a powerful piece of investment advice, especially popular among long-term value investors like Warren Buffett. Let's break it down. Buy a business means when you invest in a stock, think of it as buying ownership in a real company, not just a piece of paper or a ticker symbol. Understand the business model, its products, services, management, financial health, and long-term potential. Don't rent stocks. Warns against short-term trading or speculation. Buying and selling stocks frequently just to make a quick profit. This is like renting something temporarily without commitment. So, instead of trading stocks like they're poker chips, treat your investment as if you're becoming a part owner of the company. Think long-term. Study the company as if you were going to own it forever. Moral, point-wise summary. 1. Think like an owner, not a trader. Invest with the mindset of owning a piece of a business. 2. Focus on long-term value. Choose companies you believe will grow and succeed over time. 3. Avoid emotional or impulsive trading. Don't jump in and out of stocks based on short-term market moves. 4. Do your research. Understand the company thoroughly before investing. 5. Be patient. True wealth from investing often comes over years, not days. The Business Lens, a story about ignoring the noise. The tale of two investors. In a bustling city filled with skyscrapers and opportunity, there lived two investors. Elliot, a data-obsessed strategist who read every economic forecast he could find, and Clara, a calm thinker who believed in simplicity and clarity. Elliot would start every morning by reading thick reports from economists, scanning predictions about interest rates, inflation, GDP growth, and unemployment trends. His desk was cluttered with charts, colored graphs, and newspapers with headlines shouting about Congress or global trade. Clara, on the other hand, had a different habit. She spent her mornings reading annual reports, not of countries or governments, but of businesses. While Elliot was worried about the Fed's next move, Clara was curious about whether the CEO of a packaging company in the Midwest had a long-term vision and solid customer retention. One day, both of them stumbled upon a small tech company called BrightNest. The business made simple yet innovative organizational tools and had a loyal customer base, strong leadership, and consistent profits. Elliot hesitated. "But what if inflation goes up?" he muttered, scanning yet another forecast about interest rates. "And what about the next election? What if Congress changes policy again?" Clara smiled. "I like this company," she said. "It makes something useful. The people running it are smart, and the price is fair. The rest is just noise." Years passed. BrightNest grew. The stock multiplied. Clara's decision to invest based on what she understood paid off. Meanwhile, Elliot was still waiting for the perfect macro environment, which never really arrived. The teaching. What this story tells us. Investing often seems complicated because of all the noise around us, economic forecasts, political predictions, and endless charts. But in truth, the best investors look past the noise and focus on what truly matters, the business itself. They don't worry about what the economy might do. They know that economies rise and fall, but a great business with smart leadership and a fair price will often do well regardless. If someone handed them a report filled with predictions by the world's top economist, they would politely smile and toss it aside. Why? Because they know the future is uncertain, and trying to predict it doesn't improve your odds. Moral of the story: don't try to predict the waves, learn to sail the ship. The market will always move up and down, but if you find a good company, at a good price, run by good people, you're already ahead. Key points to remember. Focus on individual businesses, not the overall market or economy. Understand the company, what it does, how it makes money, and who runs it. Ignore political headlines and macro forecasts. They often distract more than help. Don't wait for perfect conditions. Instead, look for clear opportunities. Long-term success in investing comes from clear thinking, not complicated predictions. The best CEOs love operating their companies and don't prefer going to business roundtable meetings or playing golf at Augusta National. This quote means that the most successful and dedicated CEOs are deeply involved in the day-to-day work of running their companies. They are passionate about building, managing, and improving their business operations. Instead of spending time on luxurious hobbies or high-profile social gatherings, like exclusive golf clubs or elite business conferences, they focus on what truly matters, their company's success. In simpler words, they enjoy the hard work of running their business. They are hands-on leaders, not just figureheads. They prioritize real work over appearances or status. Moral, point-wise. 1. Passion for your work is more valuable than status or luxury. 2. Great leaders stay involved in the core of their business. 3. Focus on meaningful work instead of distractions. 4. True success comes from dedication, not just networking. 5. Leadership is about action, not just position. I like a business that, when it's not managed at all, still makes lots of money. That's my kind of business. Understanding and teaching explanation. This quote is talking about a type of business that works on its own without needing constant attention or supervision and still earns a good profit. Let's break it down. When it's not managed at all. This means the business doesn't need someone always watching or running it daily. It's systemized and possibly automated. Still makes lots of money. Even without hands-on control, the business keeps generating good income. That's my kind of business. The speaker prefers businesses that give financial returns with minimum effort and time, which is also a smart and efficient business model. In simpler terms, the best kind of business is one that works for you even when you're not working on it. Think of businesses like digital products, ebooks, online courses, rental income, real estate, automated e-commerce stores, apps or software that solve ongoing problems. These are often called passive income businesses. Moral lessons, point-wise. 1. Work smarter, not harder. Build systems that work even when you're not actively managing them. 2. Focus on passive income. Aim to create income streams that run automatically. 3. Think long-term. Design businesses that grow and operate independently over time. 4. Automation and delegation are key. A great business doesn't rely on constant personal effort. 5. Sustainability wins. The more self-sustaining your business is, the more freedom you'll have. If you have mediocrity and you have a bunch of friends on the board, it's certainly not the kind of test you put a football team through. If the coach of a football team puts 11 lousy guys out on the field, he loses his job. The board never loses their job because they've got a mediocre CEO. So you've got none of that self-cleansing type of operation that works with all other jobs. Understanding and teaching explanation. This quote draws a comparison between how performance is judged in sports versus how it's judged in corporate governance. In football, if a coach selects poor-performing players, the team loses. Everyone can see the failure clearly, and the coach gets fired. There's accountability. In business, especially with boards of directors, things are different. If a CEO is underperforming but still has friendly connections or loyalty from board members, they often stay in power. The board doesn't face consequences either. This means there's no natural correction system like in sports or other performance-based jobs. Mediocrity can survive in corporate structures due to favoritism, lack of transparency, or politics. The speaker is criticizing how corporate boards often protect poor leadership rather than replacing it, unlike in fields where results are directly visible and failure brings immediate consequences. Moral key takeaways, point-wise. 1. Accountability is crucial in leadership. 2. Favoritism in decision-making leads to mediocrity. 3. Unlike sports, many corporate systems lack performance-based consequences. 4. Effective systems need self-correcting mechanisms. 5. Boards should act in the company's best interest, not based on personal loyalty. 6. Leadership should be earned through results, not relationships. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Understanding and teaching explanation. This quote comes from Warren Buffett, one of the most successful investors of all time. Let's break it down part by part to make it easy to understand. Part 1. Diversification is a protection against ignorance. What it means. If you don't have deep knowledge about the companies or investments you're choosing, spreading your money across many options, diversification, helps reduce risk. In simple terms, if you're not sure which investment will do well, you spread your bets, just like not putting all your eggs in one basket. Why it matters. For beginners or casual investors, diversification helps avoid big losses if one investment fails. Part 2. It makes very little sense for those who know what they're doing. What it means. If you truly understand what you're investing in and have done your research, you don't need to spread your investments too wide. In simple terms, experts or informed investors can focus their money on a few strong opportunities rather than playing it safe with many. Why it matters. Concentrating investments can bring higher returns, but only if the investor is confident and knowledgeable. Moral key takeaways, point-wise. 1. Diversification is a safety net for those who lack deep investment knowledge. 2. The more you understand an investment, the less you may need to diversify. 3. Confidence must be backed by knowledge. Otherwise, concentration is risky. 4. Beginners should focus on protecting their money. Experts can focus on growing it. 5. This quote teaches the importance of self-awareness in investing. Know your limits. A lot of great fortunes in the world have been made by owning a single wonderful business. If you understand the business, you don't need to own very many of them. Understanding and teaching explanation. This quote emphasizes the power of focus and deep understanding in the business world. Let's break it down. A lot of great fortunes in the world have been made by owning a single wonderful business. Many of the wealthiest people didn't become rich by owning many businesses. They found one great business, poured their time and energy into it, and built their fortune from it. Think of examples like Steve Jobs with Apple, Jeff Bezos with Amazon, or Mark Zuckerberg with Facebook. They each focused on one powerful idea and built it into something huge. If you understand the business, you don't need to own very many of them. You don't need to run multiple businesses to succeed. If you truly understand one business, how it works, its market, its strengths, and you manage it well, that can be more than enough to make you successful. It's about quality over quantity. One well-run, well-understood business is often better than many poorly managed ones. This quote teaches us the value of specialization, focus, and deep knowledge, instead of spreading ourselves too thin. Moral lessons, point-wise. 1. Focus brings fortune. You don't need to chase many things. One great idea can change your life. 2. Deep understanding beats shallow diversity. Mastering one business is more powerful than half knowing many. 3. Quality over quantity. Success often comes from doing one thing really well. 4. Simplicity is powerful. One well-built, well-managed business can create more wealth than several average ones. 5. Patience and dedication matter. Great things come when you stick with one thing and grow it with care. If you have a harem of 40 women, you never get to know any of them very well. Understanding and teaching explanation. This quote uses a metaphor to talk about quantity versus quality in relationships, and not just romantic ones. Here's how to break it down. A harem of 40 women symbolizes having many relationships, connections, or interests at once. The idea is that with too many people or commitments, you can't truly connect, understand, or go deep with any one of them. It's not just about women or relationships, it's a life lesson. This could apply to friends, hobbies, goals, clients, or even tasks. The more you spread yourself thin, the less meaningful or effective each connection becomes. Think of it like this. If you try to read 40 books at once, how well will you understand any single one? Moral, in point-wise form. 1. Quality is more important than quantity in relationships and commitments. 2. Focus creates depth. You connect more deeply when your attention isn't divided. 3. Too many distractions weaken genuine connections. 4. Meaningful bonds need time, effort, and exclusivity. 5. Simplifying your life can lead to stronger, more fulfilling experiences. I am quite serious when I say that I do not believe there are, on the whole earth besides, so many intensified bores as in these United States. No man can form an adequate idea of the real meaning of the word without coming here. Explanation in an understanding and teaching way. This quote is making a sharp, almost humorous criticism of how boring or dull people can be in the United States, according to the speaker. Let's break it down step by step. I am quite serious when I say, the speaker wants us to know that they're not joking. This is a genuine opinion. I do not believe there are on the whole earth besides so many intensified bores. The speaker believes that no other place on earth has as many extremely boring people as the United States. As in these United States. This is just another way of referring to the U.S., often used in older or more formal English. No man can form an adequate idea of the real meaning of the word without coming here. The speaker thinks that unless someone visits the U.S., they cannot fully understand what it means to be bored or meet truly boring people. So, in a nutshell, the speaker is criticizing American society, or at least a certain part of it, claiming that it's filled with people who are very dull and that to truly understand boredom, one must visit the U.S. Moral message and point wise. 1. Observe society with a critical lens. It's okay to reflect and critique cultural traits, but it should be done thoughtfully. 2. Not everything popular is exciting. Sometimes things that are widely accepted may still feel dull or repetitive. 3. Boredom can come from uniformity. When people or culture lack diversity in thought and expression, it can feel lifeless. 4. Travel gives perspective. You truly understand a place or a word, like bore, when you experience different parts of the world. 5. Be aware of your environment. It's important to notice the emotional and intellectual impact your surroundings have on you.
Stocks are simple. All you do is buy shares in a great business for less than the business is intrinsically worth, with managers of the highest integrity and ability. Then you own those shares forever. Understanding and teaching explanation. This quote simplifies the concept of value investing in the stock market. Let's break it down. 1. Stocks are simple. Investing in stocks doesn't have to be complicated. The core idea is straightforward if you stick to the basics. 2. All you do is buy shares in a great business. Look for companies that are strong, stable, and have long-term potential. These are businesses with good products, loyal customers, and consistent performance. 3. For less than the business is intrinsically worth. Intrinsic worth means the real value of a company, based on its future earnings, assets, and overall strength. You're aiming to buy the stock at a discount to this value. This is called buying with a margin of safety. 4. With managers of the highest integrity and ability. Trustworthy and skilled management is crucial. You want people running the company who are honest, capable, and make decisions that benefit shareholders. 5. Then you own those shares forever. Long-term holding is key. Instead of constantly buying and selling, you keep the investment as long as the company remains great, letting your wealth grow over time through compound returns. Moral, key takeaways, point-wise. 1. Invest in quality businesses, not just trending stocks. 2. Buy undervalued stocks. Pay less than what the company is truly worth. 3. Trust, good management, integrity and ability matter. 4. Think long-term. Hold great companies for years, even decades. 5. Simplicity works best. No need to overcomplicate investing. The Farmer's Orchard, a lesson in long-term investing. The story. Once upon a time, in a quiet countryside, there lived a wise old farmer named Hari. Hari wasn't flashy or loud, and he didn't chase every trend that swept through the village. Instead, he spent his days tending to a modest orchard he had started many years ago. Unlike other villagers who jumped from one crop to another every season, hoping for quick profits, Hari had a different approach. He chose to plant apple trees. The thing about apple trees is, they take years before they bear fruit. While others mocked him and sold fast-growing vegetables, Hari quietly nurtured his trees through storms, dry spells and all. Year after year, the villagers measured their success by how much they earned that day at the market. "Look at my radishes," one would shout. "Cabbages sold out in an hour," said another. They'd laugh at Hari, who carried no baskets to the market, only watering cans and pruning tools. But Hari didn't mind. He knew something they didn't. 10 years passed, and then Hari's orchard came alive. His apple trees, now tall and strong, bore thousands of sweet, shiny apples. And every year after that, they produced more and more. Villagers who once laughed were now lining up outside his orchard to buy apples, seeking advice, or asking if he would sell them even one tree. One young farmer asked, "Uncle Hari, why didn't you just grow what was hot in the market?" Hari smiled and replied, "Because I wasn't growing for today's price. I was growing for a lifetime of harvests." The teaching. In the world of investing, most of our large stock positions are like Hari's apple trees. They're planted not for instant gratification but for long-term growth. The true scorecard of a wise investment is the business results over many years, not the stock prices on any single day. Just as it would be unwise to judge an entire company's worth by how it's performing this month, it's equally short-sighted to focus only on a stock's short-term earnings. Stocks represent pieces of real businesses, and good businesses, like good trees, take time to show their full value. The moral. Don't watch the clock, watch the orchard. Important points to remember. Invest with patience. Real value unfolds over time. Ignore short-term noise. Daily stock prices can distract from long-term potential. Think like a business owner. When you buy a stock, you're buying a piece of a real business, not just a ticker symbol. Business performance matters more than market hype. Let compounding work for you. Just like apples grow year after year, returns multiply when left undisturbed. Investors making purchases in an overheated market need to recognize that it may often take an extended period for the value of even an outstanding company to catch up with the price they paid. Understanding and teaching explanation. This quote gives a valuable lesson about investing, especially during times when the stock market is overheated, which means prices of stocks are higher than their actual worth due to hype, speculation, or excessive optimism. Let's break it down simply. Overheated market refers to a situation where prices are going up too fast, often beyond what the company's real value justifies. Outstanding company means a company with solid performance, good leadership, and strong financials. Even if the company is genuinely great, if an investor buys its stock when it's overpriced, the company's value may not rise fast enough to match what the investor paid. This means the investor could wait a long time just to break even, or might see little to no return for years. So, timing and price matter a lot in investing. It's not just about buying good companies, it's also about buying them at the right price. Moral key takeaways, point-wise. 1. Don't let hype drive your investment decisions. 2. Avoid buying stocks at inflated prices, even if the company is excellent. 3. Be patient and think long-term. Returns take time, especially if you overpay. Do your research to understand a company's true value before investing. 5. A great company is not always a great investment if the price is too high. I'll make more acquisition mistakes in the future. You can bet on that. A line from Bobby Bear's country song explains what too often happens with acquisitions. I never gone to bed with an ugly woman, but I've sure woke up with a few. Understanding and teaching way. This quote humorously and honestly reflects the nature of business acquisitions, especially in investing or corporate takeovers. I'll make more acquisition mistakes in the future. You can bet on that. The speaker, likely an investor or business leader, admits they are not perfect and will continue to make mistakes when buying other companies. Acquisitions. They're being upfront. Mistakes are part of the learning and growth process. I never gone to bed with an ugly woman, but I've sure woke up with a few. This line, originally from a country song, uses a metaphor. It means that when making a decision, like entering an acquisition, everything might look good and attractive at first. But after some time passes, reality kicks in, and the deal or company might not be as good as it initially appeared. In simple words, people often go into business deals thinking they've found something great, only to realize later that it wasn't what it seemed. Moral. 1. Not all good-looking deals are truly good. Initial appearances can be deceiving. 2. Admit and learn from your mistakes. Accepting future errors shows wisdom and growth. 3. Be cautious before committing. Whether in business or life, analyze deeply before making big decisions. 4. Even experienced people make mistakes. Expertise doesn't guarantee perfection. 5. Time reveals the truth. What looks good today might not hold up tomorrow. Though marginal businesses purchased at cheap prices may be attractive as short-term investments, they are the wrong foundation on which to build a large and enduring enterprise. Selecting a marriage partner clearly requires more demanding criteria than does dating. Explanation in an understanding and teaching way. Let's break it down into 2 key parts and understand it with real-life relevance. Part 1. Business perspective. The quote begins by talking about marginal businesses. These are companies that may not have strong fundamentals, like consistent profits, good leadership, or a competitive edge. Buying such businesses at low prices might seem like a good short-term strategy to make quick gains. However, these are not reliable for building a long-lasting, successful business. You can't expect a weak foundation to support a large structure forever. It's like building a house on sand. It might stand for a while, but it won't endure storms. Part 2. Personal life analogy. Marriage versus dating. The quote cleverly compares business investment to relationships. Just like you might date someone casually without deep evaluation, but when choosing a life partner, marriage, the criteria must be much more thoughtful and demanding. Similarly, in business, short-term ventures like dating may not require deep evaluation, but long-term investments like marriage need thorough thinking and solid reasoning. Moral lessons, point-wise. 1. Don't get tempted by short-term gains. Think long-term. 2. A weak business bought cheap is still a weak business. 3. Strong foundations are essential for lasting success. 4. Use higher standards when making big, life-altering decisions. 5. Whether in business or life, short-term thrill should not replace long-term wisdom. The most common cause of low prices is pessimism, sometimes pervasive, sometimes specific to a company or industry. We want to do business in such an environment, not because we like pessimism, but because we like the prices it produces. Explanation. Understanding and teaching way. This quote is often attributed to Warren Buffett, and it reflects a key principle in value investing. Let's break it down. Low prices often come from fear or negativity, pessimism, in the market. This could be fear about the entire economy, broad pessimism, or fear about a specific industry or company. When investors are scared, they tend to sell their shares, which pushes the prices down, often more than is justified by the actual situation. Smart investors look for opportunities in these times. They don't get scared off by pessimism. They use it to their advantage. The idea is not to love the negativity, but to appreciate that such negativity creates chances to buy quality businesses at bargain prices. In simpler terms, when everyone is afraid and selling, prices drop. That's often the best time to buy if you know what you're doing. Moral key takeaways, point-wise. 1. Fear in the market creates opportunities. Learn to recognize them. 2. Pessimism often leads to undervaluation. Prices fall below true worth. 3. Don't follow the crowd blindly. Think independently and look deeper. 4. A wise investor seeks value, not just good news. 5. Embrace temporary fear, not as a threat, but as a tool for smart investing. Don't pass up something that's attractive today because you think you will find something more attractive tomorrow. Understanding and teaching explanation. This quote advises us not to ignore or reject good opportunities that are available to us right now, just because we hope or assume something better might come later. In life, many people delay decisions or hesitate to commit because they keep waiting for something perfect or better to come. But the truth is, the future is uncertain. That better thing may never appear, and in the process, we might lose what was already great. It's like being offered a delicious meal today, but you refuse it thinking tomorrow's dinner might taste better, and then tomorrow comes and there's nothing at all. This doesn't mean we shouldn't aim high or wait when it makes sense. It simply reminds us to appreciate and value what we have now, especially when it's already good. Moral life lessons, point-wise. 1. Value what you have today. Don't ignore good opportunities just because you're chasing something uncertain. 2. Don't always wait for perfect. Perfection is often an illusion. What you have now might be more than enough. 3. Timing matters. Some chances come only once. Delaying might mean losing them forever. 4. Balance hope with reality. It's good to dream, but also be practical and wise about current options. 5. Gratitude leads to wisdom. Recognizing the value in what's in front of you builds better decision-making habits. Losing some money is an inevitable part of investing, and there is nothing you can do to prevent it. Understanding and teaching explanation. This quote highlights a fundamental truth about investing. Losses are unavoidable. No matter how skilled or careful an investor is, the nature of markets means that some investments will not perform well, and may even result in losses. It's important to accept this reality instead of fearing it. Think of it like playing a long game. Sometimes you win, sometimes you lose. But over time, smart decisions, patience, and consistency tend to lead to growth. Here's how to understand it better. Markets fluctuate. Prices of stocks, mutual funds, and other assets go up and down. You can't always predict what will happen. No one has a perfect record. Even the best investors, like Warren Buffett, have made losing investments. Risk is part of the process. Without some risk, there's no reward. Trying to avoid all losses often means avoiding potential gains too. Focus on long-term growth. Instead of stressing over small losses, focus on your overall progress over years. Moral lessons, point-wise. 1. Accept losses as part of the journey. They are natural and unavoidable in investing. 2. Stay focused on the bigger picture. Don't let short-term losses distract you from long-term goals. 3. Don't panic during downturns. Making emotional decisions can lead to more harm than good. 4. Keep learning and improving. Every loss teaches a lesson that can help you grow. 5. Diversify your investments. Don't put all your money in one place to reduce risk. 6. Be patient. Investing is a marathon, not a sprint. Losing some money is a... Hold steady when storms rage. A lesson from the 2008 financial panic. In the chilling autumn of 2008, fear was thick in the air. The global economy trembled. News channels broadcast endless stories of collapsing banks, plunging stock markets, and deepening unemployment. Panic was not just palpable, it was contagious. But amidst the turmoil, one man sat still. He owned a farm and real estate in New York, both solid, tangible assets. As the headlines screamed economic doom, he didn't once consider selling them. They were valuable, they produced income, they had long-term worth. The recession, however deep, would eventually pass. Now imagine this same man owned shares, small pieces of excellent businesses. Not just any businesses, but those with strong leadership, proven models, and long-term potential. Should he panic and sell them simply because the market was tanking? No, that would have been foolish. Just like he wouldn't sell his farm or property in a storm, why should he sell parts of great businesses during a financial hurricane? Sure, one or two might not perform as expected, but as a group, these businesses represented the productive spirit of a nation. Of America itself, brimming with talent, resources, and relentless drive. To sell in fear would have been to bet against the resilience of people, the power of innovation, and a tale of investment versus speculation. The enchanted ballroom of easy money. Once upon a time, in the bustling kingdom of Marketland, people gathered in a grand ballroom. It was no ordinary hall. It shimmered with wealth, glittered with opportunity, and echoed with the laughter of recent triumphs. The guests were investors and traders, all riding the high of gains they had made with seemingly little effort. The music of the market was sweet. The champagne of success flowed endlessly, and in that euphoric atmosphere, something peculiar began to happen. People forgot where they were, or rather what they were doing. What had started as investing, carefully choosing companies with solid fundamentals and bright, realistic futures, was slowly turning into speculation. The line that once separated the two had faded under the glow of profits. The Cinderella syndrome. Among the dancers was a young man named Elliot, a prudent investor by nature. He had built his modest fortune through years of discipline, patience, and research. But tonight he found himself caught up in the magic. Everyone around him was making money, fast, easy, and in outrageous amounts. Stocks with sky-high valuations soared even higher, not because they were creating value, but because everyone else believed they would continue to rise. Elliot knew deep down this was unsustainable. It reminded him of the tale of Cinderella. She knew the magic would end at midnight, yet she danced with joy until the very last second. So did the revelers here. They planned to leave just before the clock struck disaster, cashing out before reality hit. But there was a twist in this tale. The ballroom had no clocks. The room without time. As Elliot looked around, he realized the danger. Without clocks, no one could say when midnight would come. Everyone was guessing. Some thought they still had hours. Others believed it was already past 12, but no one could be sure. And so they danced on. People who were once rational and cautious had become intoxicated by the promise of effortless wealth. Like Cinderella's carriage that would turn into a pumpkin, their investments, glowing now, could vanish into thin air with the first stroke of bad news, a change in market sentiment, or a sudden economic shift. Elliot quietly stepped aside from the dance floor. He had remembered something more valuable than all the sparkling stocks: discipline. Moral of the story: know when you're dancing. The line between investment and speculation is often thin, and when markets are booming, That line becomes almost invisible. Easy money dulls the senses and clouds judgment, making even the wisest feel invincible. But just like Cinderella's ball, all market euphoria ends. And if you're trying to leave just before midnight, you might discover that in this ballroom there are no clocks to warn you when it's time to go. Important points to remember: investment versus speculation. Investment is grounded in fundamentals. Speculation relies on hoping someone will pay more than you did. Euphoria is dangerous. Large, quick gains can lead to overconfidence and reckless behavior. Discipline over desire. Staying grounded in sound investment principles is crucial, even when others are dancing with risk. There's no perfect exit time. Timing the top of the market is nearly impossible. It's better to be early and safe than late and sorry. Don't forget the pumpkins. Eventually, valuations must be justified by real earnings and cash flow. Never risk what you have and need for what you don't have and don't need. Understanding and teaching explanation. This quote is a powerful reminder about priorities and decision-making. Let's break it down step by step for better understanding. 1. Never risk what you have and need. This part tells us that we should not put our essential things, like health, relationships, job, peace of mind, etc., in danger. These are the things we already possess and truly need in life. 2. For what you don't have and don't need. This refers to unnecessary desires or wants, things we don't own and don't actually require for a happy or meaningful life, like excessive luxury, status symbols, or risky pleasures. In simple words, don't gamble your important things for the sake of unimportant things. Many people make this mistake when they chase after more money, fame, or pleasure and end up losing what really matters. Moral life lessons. Point-wise. 1. Value what you already have. Appreciate the things that are truly important in your life. 2. Think before you act. Make wise decisions, especially when something important is at risk. 3. Don't chase unnecessary desires. Not everything that looks attractive is worth pursuing. 4. Protect your essentials. Health, relationships, peace, and stability should always come first. 5. Avoid greed. Greed can blind you and lead to losing even what you truly need. Our approach is very much profiting from lack of change rather than from change. With Wrigley chewing gum, it's the lack of change that appeals to me. I don't think it is going to be hurt by the internet. That's the kind of business I like. Understanding and teaching way. This quote emphasizes the value of stability and consistency in business. Here's what it means in simpler terms. The speaker is saying their investment or business approach benefits more from things staying the same rather than constantly changing. They give an example: Wrigley's chewing gum. It's a simple, timeless product that doesn't need to change with trends or technology, and it still remains successful. Even with the rise of the internet and digital innovations, chewing gum is unaffected. People will still chew it, no matter what. The speaker prefers businesses that are not easily disrupted by external changes, especially technological ones. So this quote teaches us that sometimes the best investments are in businesses that are steady, reliable, and not dependent on changing trends. Moral key takeaways, point-wise. 1. Stability can be more profitable than constant change. 2. Simple and timeless products often have lasting value. 3. Not all businesses are affected by technological disruption. 4. Investing in consistent, reliable industries can be a wise strategy. 5. Long-term success often comes from products that fulfill basic, unchanging needs. We never stretch for yield. Understanding and teaching explanation. This quote is often used in the context of investing, but its meaning can be applied to many areas of life. Let's break it down. Stretch for yield means taking excessive risks just to get higher returns or benefits. We never stretch implies a disciplined, cautious, and smart approach. It means sticking to your principles and not compromising safety or values for short-term gains. Teaching in simple terms. Imagine you have some money and you're looking for a place to invest it. You see a company offering very high returns, much higher than others. Sounds tempting, right? But someone wise tells you, We never stretch for yield. Why? Because high returns often come with high risks. That company might be unstable or even fraudulent, so it's better to earn less but safely than to chase big returns and lose everything. This applies not just in money matters, but in life too. Don't take unnecessary risks just to get ahead fast. Moral lessons. 1. Avoid unnecessary risks in pursuit of gains. 2. Stay disciplined and follow your principles. 3. Short-term temptations can lead to long-term losses. 4. Better safe and steady than risky and regretful. 5. Wisdom lies in choosing sustainability over speed. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Benjamin Graham. Understanding and teaching explanation. This quote means that truth and correctness are not determined by popularity or majority opinion. Just because many people disagree with you doesn't automatically make you wrong, and just because many agree doesn't mean you're right. What truly matters is the quality of your data, facts, evidence, and the strength of your reasoning, logical thinking, and sound judgment. In simpler terms, imagine you're in a class and everyone believes the answer to a question is 5, but you say it's 10. If you've done the math correctly and your method is solid, you're still right, even if you're the only one who thinks so. Popular opinion can be wrong. What counts is being correct based on facts and logic, not following the crowd. This teaches us to think critically and be confident in our well-thought-out ideas, even when others disagree. Moral key takeaways. 1. Truth is based on facts, not opinions. 2. Use data and logic to form your beliefs. 3. Don't be afraid to stand alone if you're right. 4. Popularity doesn't equal correctness. 5. Stick to your principles, not the crowd's noise. Unless you can watch your stock holding decline by 50% without becoming panic-stricken, you should not invest in the stock market. Understanding and teaching explanation. This quote is a piece of investment wisdom often attributed to Warren Buffett or other seasoned investors. Here's how to understand it. Stock market is volatile. The stock market often goes up and down. It's normal for stock prices to fall, even by large amounts, especially in the short term. Emotional control is key. If you panic when your investment drops in value, you might sell at the worst possible time, locking in losses. This behavior is driven by fear, not logic. Long-term mindset needed. Successful investing requires patience, emotional resilience, and trust in your long-term strategy. You need to be okay with temporary losses to gain long-term rewards. Risk tolerance. If you're someone who cannot handle seeing big drops in your portfolio without stress or fear, then the stock market might not be the right place for you, or you might need a safer investment approach. So, this quote teaches that mental strength is as important as financial knowledge when it comes to investing. Moral in point-wise format. 1. Be mentally prepared for market ups and downs. 2. Do not let emotions control financial decisions. 3. Have a long-term vision when investing. 4. Understand your risk tolerance before entering the market. 5. Patience and discipline are crucial for investment success. Stop trying to predict the direction of the stock market, the economy, interest rates, or elections. Understanding and teaching way. This quote advises us not to waste our energy or time trying to predict things that are naturally unpredictable, like the stock market, which can rise or fall due to thousands of factors. The economy, which is influenced by global events, policies, and consumer behavior. Interest rates, which change based on inflation, central bank decisions, and economic health. Elections, which depend on people's choices, media influence, and social trends. Trying to guess the future of these complex systems often leads to anxiety, wrong decisions, or missed opportunities. Instead of predicting, focus on things you can control, like learning how markets work, investing for the long term, managing your money wisely, staying calm and consistent. Think of it like sailing. You can't control the wind, but you can adjust your sails. Moral in point-wise format. 1. Focus on what you can control, not what you can't. 2. Avoid making decisions based on predictions and guesses. 3. Educate yourself instead of trying to time the market. 4. Practice long-term thinking and patience. 5. Let go of the need to control the future. Respond wisely instead. Remember, the stock market is manic-depressive. Understanding and teaching explanation. This quote is a metaphor that compares the stock market to a person with manic-depressive disorder, now more commonly called bipolar disorder. Here's what it means in simple terms. The stock market goes through extreme mood swings. Sometimes it's overly optimistic, like in a manic phase, and other times it's overly pessimistic, like in a depressive phase. In the manic phase, prices may rise very high, quickly and irrationally. People get excited and everyone wants to buy. In the depressive phase, prices drop sharply and fear takes over. People panic and start selling. This behavior isn't always based on logic or the actual value of companies. It's often driven by emotions, speculation, and herd mentality. As an investor or learner, it's important to stay calm and not get swept away by the market's mood swings. Stick to your strategy, stay informed, and think long-term. Moral, point-wise. 1. Don't let emotions control your investments. 2. Be patient and think long-term, not short-term. 3. Recognize the market's mood swings and don't follow the crowd blindly. 4. Stay informed and make decisions based on facts, not fear or hype. Consistency and discipline are more powerful than reacting emotionally. The greatest investment reward comes to those who by good luck or good sense find the occasional company that over the years can grow in sales and profits far more than industry as a whole. Explanation, understanding, teaching way. This quote is about smart investing and how real success comes from spotting rare, exceptional companies. Let's break it down. The greatest investment reward. This means the biggest gains or highest returns from investing. Comes to those who by good luck or good sense. Sometimes people find great companies by luck, but often it's because of wisdom, research, and insight. Find the occasional company. These are rare companies that don't come along often. That over the years can grow in sales and profits far more than industry as a whole. These are businesses that grow much faster and outperform others in the same industry. Think of companies like Apple, Amazon, or Tesla that didn't just grow, they exploded in growth over time. So, in simple words, big investment success happens when you find rare companies that grow faster than most others, and either you get lucky or you recognize their potential before everyone else. Moral, key learnings, point-wise. 1. Look for exceptional companies, not just average ones. 2. Patience is powerful. True growth happens over years. 3. Study and research. Good sense often beats good luck. 4. Big wins are rare, but one great investment can change everything. 5. Outperforming the market is possible if you focus on long-term value. I believe in getting things done through other people. Understanding and teaching explanation. This quote emphasizes the importance of teamwork, delegation, and leadership. It reflects a mindset where success doesn't come from doing everything alone, but from empowering others to contribute their strengths. In a teaching context, this means leadership over micromanagement. A good leader knows how to trust and guide others instead of doing every task themselves. Smart delegation. Delegating work to capable people not only makes things efficient, but also helps in developing their skills and confidence. Building a team. When you collaborate with others, you create a support system where everyone's abilities are valued and utilized. Focus on results, not ego. It's not about who does the work, but about getting it done well. Leaders who embrace this idea achieve more in less time. Think of it like a coach of a sports team. The coach doesn't play the game, but guides and motivates the players to perform their best. Moral, key takeaways, point-wise. 1. Teamwork leads to greater success than solo efforts. 2. Effective delegation is a key leadership skill. 3. Empowering others increases overall productivity and morale. Working smart means using the strengths of people around you. 5. True leadership is about guiding, not doing everything yourself. If you are not happy being in the top 1/10 of 1% wealthiest people on Earth, being in the top 100 of 1% isn't going to do anything for you. Understanding and teaching way. This quote emphasizes a powerful truth about happiness and fulfillment. It doesn't necessarily increase with more wealth. Let's break it down simply. The top 1/10 of 1% refers to people who are already extremely rich. They're richer than 99.9% of the world's population. The top 1/100 of 1% are even richer, a tiny group of people with extreme wealth. The quote says, if you're not happy even after reaching such a high level of success and wealth, then having even more will not suddenly bring you happiness. This teaches us that happiness isn't just about how much money or success we have. Even if we keep climbing higher and higher in wealth or achievements, we might still feel empty if we don't find joy within or have deeper meaning and satisfaction in life. So, the chase for more never ends unless we stop and appreciate what we already have. Moral in Pointwise. 1. True happiness comes from within, not just from wealth or status. 2. Chasing more success or money endlessly won't fill emotional or spiritual gaps. 3. Gratitude and contentment are key to lasting happiness. 4. Personal fulfillment should not be measured by comparing with others. 5. Learn to enjoy the present instead of always reaching for the next level. Ted Williams in The Science of Hitting talks about waiting for the right pitch, and that's what investing is. In batting, if you have 2 strikes, you have to swing at the next strike. In investing, you just wait for the next pitch. Understanding and teaching explanation. Let's break it down into simple terms. Ted Williams was a legendary baseball player, and in his book, The Science of Hitting, he explained that a batter should wait for the right pitch, one that's in their sweet spot, instead of swinging at every pitch. In baseball, if a batter already has 2 strikes, they're forced to swing at the next strike, even if it's not ideal. They don't have the luxury to keep waiting. But in investing, you don't have that pressure. You can afford to wait patiently for the right opportunity, the perfect pitch. You don't have to act unless you see something that truly fits your criteria. Think of investing like standing at the plate in baseball with no strikes. You can wait and wait until the best possible pitch comes your way. Moral, Pointwise. 1. Patience pays off. Great investors don't rush, they wait for the perfect opportunity. 2. Avoid unnecessary risks. Don't invest just for the sake of doing something. Only act when the odds are in your favor. 3. Discipline is key. Like a good batter, you need discipline to avoid swinging at every pitch, i.e., every opportunity. 4. You don't have to act all the time. In investing, not making a move can sometimes be the smartest move. 5. Timing matters. Knowing when to act is just as important as knowing how to act. I have pledged to you, the rating agencies, and myself to always run Berkshire with more than ample cash. We never want to count on the kindness of strangers in order to meet tomorrow's obligations. When forced to choose, I will not trade even a night's sleep for the chance of extra profits. Understanding and teaching explanation. This quote comes from Warren Buffett, one of the most respected investors and business leaders. Here's what he's saying in simpler teaching terms. I have pledged to you, the rating agencies, and myself. He made a promise not just to his stakeholders, investors, partners, etc., but also to financial institutions and even to himself personally. To always run Berkshire with more than ample cash. His company, Berkshire Hathaway, will always keep a lot of cash in hand. Not just enough, but more than enough. This gives them security and flexibility. We never want to count on the kindness of strangers in order to meet tomorrow's obligations. They don't want to rely on outside help or hope someone will bail them out when bills are due. They prefer to be self-sufficient and ready for any financial need. When forced to choose, I will not trade even a night's sleep for the chance of extra profits. Peace of mind is more valuable to him than risky profits. He won't take risks that could cause stress or jeopardize the company's stability, even if it means missing out on potential extra income. Moral lessons. Point 1. Always maintain a strong financial cushion. Having more than enough resources can protect you from unexpected problems. 2. Self-reliance is strength. Don't depend on others to fulfill your responsibilities. 3. Peace of mind is priceless. No profit is worth losing sleep or putting yourself under avoidable stress. 4. Long-term security is better than short-term gain. Making safe and wise choices leads to sustainable success. 5. Leadership involves responsibility and discipline. True leaders keep their promises and prioritize stability for those they serve. Risk is a part of God's game, alike for men and nations. Understanding and teaching explanation. This quote means that risk is an unavoidable and natural part of life, whether you're an individual, a man, or a whole country, a nation. Think of life as a game designed by God, and in this game, no one is exempt from taking risks. It's part of how progress, challenges, and growth happen. Whether it's a personal decision, a business choice, or a political move by a nation, everyone has to face uncertainty and step into the unknown at some point. Key teachings. Equality in risk. Just like gravity pulls on everyone the same way, risk affects all, rich or poor, strong or weak, individual or collective. No growth without risk. Achievements, innovation, and success often require people to step out of their comfort zones. Part of a divine plan. The mention of God's game suggests that these challenges and uncertainties are not random. They have purpose and value in shaping us. Moral of the quote, point-wise. 1. Risk is universal. No one can escape it. 2. Taking risks is necessary for personal and national growth. 3. Life's uncertainties are part of a greater divine plan. 4. Courage in the face of risk leads to strength and progress. 5. We should accept challenges as natural steps in life's journey. I have no views as to where gold will be, but the one thing I can tell you is it won't do anything between now and then except look at you. Whereas, as you know, Coca-Cola will be making money, and I think Wells Fargo will be making a lot of money, and there will be a lot. And it's a lot. It's a lot better to have a goose that keeps laying eggs than a goose that just sits there and eats insurance and storage and a few things like that. Explanation in an and teaching way. This quote, famously said by Warren Buffett, teaches a fundamental principle of smart investing. He starts by talking about gold. He says he doesn't know how the price of gold will change in the future. But one thing is sure. Gold, as an asset, doesn't produce anything. It just sits there. You buy it, and it just stays with you. It doesn't grow, earn, or generate income. In contrast, he talks about companies like Coca-Cola and Wells Fargo. These are businesses that generate income regularly. They sell products or services, make profits, pay dividends, and grow over time. Then, he uses a simple analogy. It's a lot better to have a goose that keeps laying eggs than a goose that just sits there. This means it's smarter to invest in something that gives you continuous returns, like eggs from a goose, rather than something that just sits there and costs you money, like gold that needs storage and insurance. So in simpler terms, invest in businesses or assets that grow and generate income, not in things that just sit idle. Moral lesson point-wise. 1. Productive assets are better than idle ones. Choose investments that generate income over time. 2. Gold has value but not productivity. It doesn't create wealth on its own. 3. Businesses create value. Companies like Coca-Cola generate profits by providing real goods and services. 4. Go for egg-laying geese. Prefer assets that give continuous returns over those that just sit and consume resources. 5. Think long-term and logically. Don't chase shiny things. Look for value and productivity in investments. The world will seek low-cost production as long as the quality is there. Understanding and teaching way. Simple explanation. This quote means that people, companies, and countries prefer products or services that are cheap, low cost. However, they don't want to compromise on quality. So, if someone can produce something cheaply but still with good quality, the world will naturally choose that option. It's about value for money, not just being cheap, but being worth it. Example: If two companies make the same phone, and one sells it for $500 and the other for $300, but both phones are of similar quality, then most people will go for the $300 one. That's what the quote is all about. Moral, point-wise: 1. Quality must never be compromised, even when aiming to reduce costs. 2. Efficiency and innovation are key to staying competitive in global markets. 3. Global demand favors affordability with reliability. 4. Skilled production with cost control is a powerful business strategy. 5. Lower prices alone won't win. Quality is the deciding factor. If you are in a poker game and after 20 minutes you don't know who the patsy is, then you're the patsy. Understanding and teaching explanation. This quote uses the game of poker as a metaphor for life, business, or any competitive situation. In a poker game, a patsy is the least skilled player, the one others target to win money from. The quote means, if you're in a group or situation where people are competing and you can't tell who is at a disadvantage, then you might be the one being outplayed. It teaches us about awareness, self-assessment, and critical thinking. If you're unaware of who is weak or being manipulated, you might actually be the one being taken advantage of. It's a reminder to pay attention, read the room, and understand the dynamics of the situation you're in. Moral of the quote, point-wise: 1. Always stay aware of your surroundings and people's intentions. 2. Assess situations quickly and critically, don't be naive. 3. In any competitive setting, if you're not ahead or observant, you might be falling behind. 4. Understand the game you're in, whether it's life, business, or relationships. 5. If you can't spot the problem, you might be the problem. It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. Explanation, understanding's teaching way. This quote by Warren Buffett emphasizes how fragile a good reputation is. Imagine spending years working hard, being honest, responsible, and reliable. All of that effort builds trust and respect from others. That's your reputation. But then, if you make one poor decision, act unethically, lie, or do something wrong, it can destroy all that trust instantly. The line, "if you think about that, you'll do things differently," is a reminder. If you're aware how easily your reputation can be damaged, you'll start to be more careful with your actions, choices, and behavior, especially when no one's watching. So, it's a call to always act with integrity, because protecting your reputation is easier than repairing it once it's broken. Moral key takeaways, point-wise. 1. A good reputation takes time and effort to build. 2. It can be destroyed in a moment by a single wrong action. 3. Think before you act, especially in tough situations. 4. Protect your integrity as it's your most valuable asset. 5. Consistency in good behavior builds trust and respect. We believe that according the name investors to institutions that trade actively is like calling someone who repeatedly engages in one-night stands a romantic. Understanding and teaching explanation. This quote comes from legendary investor Warren Buffett, and it uses a powerful analogy to distinguish true investing from speculative trading. Let's break it down. According the name investors to institutions that trade actively, this means calling organizations or people who frequently buy and sell stocks investors. Is like calling someone who repeatedly engages in one-night stands a romantic. A romantic is someone who believes in long-term emotional connection, not just quick flings. So this is sarcasm. It highlights the contradiction. What Buffett is saying, just like someone who jumps from one short relationship to another isn't truly romantic, someone who constantly trades stocks isn't truly an investor. Real investors focus on the long-term value and growth of their investments, not just short-term profits. Moral, point-wise. 1. True investing is about long-term commitment, not quick profits. 2. Active trading is speculation, not genuine investment. 3. Labels matter. Calling traders investors creates confusion. 4. Patience and understanding are key traits of real investors. 5. Short-term gains may be flashy, but long-term growth builds real wealth. Can you really explain to a fish what it's like to walk on land? One day on land is worth 1,000 years of talking about it, and one day running a business has exactly the same kind of value. Explanation in an understanding and teaching way. This quote uses a powerful metaphor to highlight the difference between theory and experience. Imagine trying to explain to a fish what it's like to walk on land. The fish has never been out of water, never used legs, and cannot imagine the feeling or experience of walking. You could talk for years, give examples, use diagrams, but the fish still wouldn't truly understand. Now compare this to running a business. You can read hundreds of books, attend seminars, watch YouTube videos, or talk to successful entrepreneurs, but nothing compares to the real experience of actually starting and running a business. The lessons you learn in one single day of doing it yourself, facing real problems, making real decisions, and experiencing real outcomes are far more valuable than years of theory. Moral, key takeaways, point-wise. 1. Experience is the greatest teacher. Real learning happens when you actually do something, not just read or talk about it. 2. Theory has limits. While preparation is important, it can't replace hands-on experience. 3. Take action. Don't wait forever trying to be ready. Start doing, and you'll learn along the way. 4. Value of practice. One day of real-world involvement teaches more than years of passive learning. 5. Step out of the comfort zone. Like the fish, you'll never fully understand something until you experience it yourself. Derivatives are financial weapons of mass destruction. Understanding and teaching explanation. This quote comes from Warren Buffett, one of the most successful investors of all time. He used this strong phrase to warn people about the dangers of derivatives in the financial markets. What are derivatives? A derivative is a financial contract whose value depends on or is derived from the value of another asset, like stocks, bonds, commodities, interest rates, or currencies. Common types of derivatives: futures, options, swaps, and forwards. Why did he call them weapons of mass destruction? Because 1. High risk. Derivatives can involve huge risks if not understood or managed properly. 2. Complexity. Many investors and even institutions don't fully understand how derivatives work. 3. Leverage. They allow people to control large amounts of money with little initial investment, leading to big gains or massive losses. 4. Systemic impact. If something goes wrong with big players using derivatives, like in the 2008 financial crisis, the entire financial system can be affected, just like a chain reaction. Teaching tip: think of derivatives like powerful tools, like a chainsaw. In skilled hands, it's useful, but if misused or handled carelessly, it can be extremely dangerous. Moral lessons, point-wise. 1. Understand what you're investing in. Never invest blindly. 2. Powerful tools require responsibility and knowledge. 3. Short-term gains should never outweigh long-term safety. 4. Risk management is as important as profit-making. 5. Financial education is crucial before using complex instruments. 6. One person's mistake with derivatives can impact many. Be cautious. 7. Even experts warn against misuse. Listen and learn from them. Sound investing can make you very wealthy if you're not in too big a hurry. Understanding and teaching explanation. This quote emphasizes the importance of patience and discipline in investing. Sound investing refers to smart, well-thought-out investment strategies. This could mean investing in strong companies, diversified portfolios, or following long-term investment principles. Can make you very wealthy suggests that if you stick to these smart strategies, your wealth can grow significantly over time. If you're not in too big a hurry, warns against rushing. Wanting fast results can lead to risky decisions like chasing trends or reacting emotionally to market ups and downs. In simple words, investing works best when you're patient. Trying to get rich quickly usually backfires, while steady, smart investing builds real wealth over time. Moral key takeaways, point-wise. 1. Patience is key to successful investing. 2. Avoid chasing quick profits. Focus on long-term growth. 3. Sound strategies beat emotional decisions. 4. Wealth builds slowly but surely through consistency. 5. Time in the market is more important than timing the market. A very rich person should leave his kids enough to do anything, but not enough to do nothing. Understanding and teaching explanation. This quote emphasizes a balanced approach to wealth inheritance. Here's how to understand and explain it. When someone is very wealthy, it's natural to want to pass on their wealth to their children. However, giving children too much money can be harmful. They may lose motivation, not learn hard work, or lack purpose in life. On the other hand, giving them too little may limit their potential and make life unnecessarily hard. So, the wise approach is to leave them with enough resources so they can follow their dreams, build something meaningful and take risks, but not so much that they never feel the need to work, grow, or contribute. This quote is often linked to responsible parenting and the value of teaching children self-reliance, discipline, and ambition. Moral lessons, point-wise. 1. Wealth should empower, not enable laziness. 2. Children should be taught the value of hard work and responsibility. 3. Too much comfort can lead to a lack of motivation. 4. True success comes from effort, not just inheritance. 5. Parents should prepare their kids for life, not just fund it. Take me as an example. I happen to have a talent for allocating capital, but my ability to use that talent is completely dependent on the society I was born into. If I'd been born into a tribe of hunters, this talent of mine would be pretty worthless. I can't run very fast. I'm not particularly strong. I'd probably end up as some wild animal's dinner. Understanding and teaching explanation. This quote is a humble reflection on the role of environment and society in shaping success. The speaker admits that although they have a special talent, the ability to manage money and investments, allocating capital, that talent only has value because of the modern society they live in. In a different world, say a primitive hunting tribe, their financial skills would be useless, because survival in that world depends on physical strength and speed, not financial intelligence. So the speaker is saying, I may be talented, but my success depends heavily on circumstances beyond my control, like where, when, and to whom I was born. This is a powerful lesson in humility, and it helps us recognize that privilege and context play a big role in what we achieve. Moral life lessons, point-wise. 1. Talent alone isn't enough. Environment matters. A skill is only valuable when the society or setting supports and values it. 2. Be humble about your success. Much of it may be due to circumstances you didn't choose, like your birthplace or era. 3. Recognize the role of privilege. Not everyone gets the same opportunity to use their talents. 4. Value different kinds of strengths. What seems useless in one context could be life-saving in another. 5. Use your advantages wisely and responsibly. If society has given you the chance to use your skills, use them not just for yourself, but to help others too. 400 of us pay a lower part of our income in taxes than our receptionists do, or our cleaning ladies for that matter. If you are the luckiest 1% of humanity, you owe it to the rest of humanity to think about the other 99%. Explanation in an understanding and teaching way. This quote was made by Warren Buffett, one of the richest people in the world. He's pointing out something unfair in society. There are about 400 very rich people, like him, who pay a smaller percentage of their income in taxes than the people who work for them, such as receptionists or cleaning staff. This is because of tax laws that often benefit the rich. They may earn money through investments, which are taxed at lower rates instead of regular salaries. He's not just stating a fact. He's calling for fairness. Buffett says, if you're extremely rich, the top 1%, then you have a moral responsibility to think about and help the remaining 99% of people who are not as fortunate. He's encouraging empathy, responsibility, and fairness, especially from those who have more than enough. Moral point-wise. 1. Wealth comes with responsibility. The richer you are, the more you should think about those who are not as fortunate. 2. Be aware of inequality. Sometimes systems can favor the wealthy unfairly. It's important to recognize this and seek fairness. 3. Support fairness in taxation. Everyone should contribute their fair share to society, especially the wealthy. 4. Think beyond yourself. Being successful doesn't mean ignoring the struggles of others. 5. Give back to society. True success includes using your position to uplift others. If you invested in a very low-cost index fund, where you don't put the money in at one time, but average in over 10 years, you'll do better than 90% of people who start investing at the same time. Understanding and teaching explanation. Let's break it down step by step in a simple teaching-friendly way. 1. Very low-cost index fund. This means you're investing in a fund that tracks a market index, like the S&P 500, and charges very low fees. These funds don't try to beat the market, they match it, and they are simple, safe, and smart for long-term investing. 2. Don't put the money in at one time. Instead of investing a big amount all at once, which can be risky if the market drops right after, you invest smaller amounts over time. 3. Average in over 10 years. Also called dollar cost averaging. You invest regularly, like monthly or yearly, spreading out your risk. Over 10 years, this helps balance out the market's ups and downs. 4. You'll do better than 90% of people who start investing at the same time. Most investors try to time the market or pick individual stocks, which usually doesn't work out. This quote says that by simply and consistently investing in a low-cost index fund, you'll outperform most of them. Moral key takeaways, point-wise. 1. Consistency is powerful. Invest regularly over time instead of trying to guess the perfect moment. 2. Low risk, low cost wins. Index funds with low fees are safer and often more profitable in the long run. 3. Think long term. Wealth builds with patience and discipline, not shortcuts or quick wins. 4. You don't have to be an expert. A simple strategy can beat complex ones when done right. 5. Use dollar cost averaging. It protects you from market ups and downs and builds wealth steadily. The unconventional but inescapable conclusion to be drawn from the past 50 years is that it has been far safer to invest in a collection of American businesses than to invest in securities, treasures, for example, whose value have been tied to American currency. Explanation in an understanding and teaching way. This quote is saying something very important about investing and where money has been safest over time. Let's break it down step by step. Unconventional but inescapable conclusion. This means it's not what most people might expect or believe, but it's a fact you can't ignore. Past 50 years, we're looking at the long-term performance of investments over the last half-century. Safer to invest in a diversified collection of American businesses. Instead of putting all your money into one thing, spreading it across different strong, stable companies, like buying shares in companies through the stock market, has turned out to be more secure and profitable than to invest in securities tied to American currency. This refers to things like US Treasury bonds, generally seen as safe, but their value is linked directly to the value of the dollar, which can decrease due to inflation. In simpler words, over the last 50 years, it was actually safer and smarter to invest in a mix of good American companies than to just keep your money in government bonds or savings that depend on the dollar's value. Even though bonds feel safe, they lose value over time due to inflation, while businesses can grow and earn more. Key takeaways, point-wise. 1. Think long-term. Over decades, investing in businesses has proven safer than it seems. 2. Diversification reduces risk. Don't put all your money in one place, spread it across good businesses. 3. Don't rely only on currency-based investments. The value of money drops over time, inflation, but businesses can grow. 4. True safety comes from growth. Assets that grow over time, like stocks, can be safer than those that just sit and lose value slowly. 5. Challenge common beliefs. What seems safe, like government bonds, may not be the safest choice in the long run. Smile when you read a headline that says investors lose as market falls. Edit it in your mind to disinvestors lose as market falls, but investors gain. Though writers often forget this truism, there is a buyer for every seller, and what hurts one necessarily helps the other. Understanding and teaching explanation. When the stock market goes down, the media often says, investors lose. But that's only part of the picture. This quote teaches us to look deeper into what's really happening. Let's break it down. When someone sells in panic during a market drop, they lock in a loss. These are the disinvestors. On the other hand, someone else is buying those same shares at lower prices. These are the true investors who often gain in the long run. The market works like a seesaw. Every time one person sells, another buys. So, losses for one side may mean opportunities for the other. In simple terms, don't panic when the market drops. If you're a wise investor who thinks long term, that drop might actually be a good thing. Moral key lessons. 1. Market drops aren't always bad. They can be opportunities in disguise. 2. Panic selling leads to real losses. Patience pays off. 3. Every seller has a buyer. What's bad for one can be good for another. 4. Think rationally, not emotionally. Smart investors stay calm in chaos. 5. Long-term mindset wins. Don't react, plan and hold. We don't get paid for activity, just for being right. As to how long we'll wait indefinitely. Understanding and teaching explanation. This quote emphasizes the value of accuracy over busyness and the importance of patience in achieving success. Let's break it down in a teaching-friendly way. We don't get paid for activity means that just doing a lot of work, being busy, or constantly taking action doesn't automatically lead to results or rewards. Just for being right means you get rewarded only when your decisions or actions are correct, effective, or make a real impact. As to how long we'll wait indefinitely, shows a mindset of patience and discipline. It means being willing to wait as long as it takes for the right opportunity, instead of rushing into things just to stay active. Example for better clarity. Imagine you're investing in the stock market. Just buying and selling stocks every day activity won't guarantee profit, but choosing the right stock at the right time, being right, even if you wait months or years to make that decision, can bring big rewards. Moral key lessons, point-wise. 1. Quality matters more than quantity. 2. Smart decisions are more valuable than busy actions. 3. Patience is a powerful trait. Wait for the right moment. 4. Success comes from being accurate, not just active. 5. Avoid rushing. Doing the wrong thing quickly is worse than doing the right thing slowly. The Man with a Million Claim Checks. The story. In a peaceful town lived a quiet man who, though rarely seen on the covers of magazines or speaking in front of crowds, held great wealth. To most people, he was simply Mr. Harold. The older gentleman who wore the same simple clothes, lived in the same modest house, and smiled kindly when passing by. But Harold was no ordinary man. He was a man who had, over a lifetime of wise decisions and careful investments, amassed a fortune that could sway economies. His bank account was filled with what he called claim checks on society. To Harold, money wasn't just shiny things or bigger houses, it was potential. He saw every dollar as a claim on someone's time, talent, or energy. If he wanted, he could pay thousands of people to sing songs about him, sculpt statues in his honor, or create luxury goods just for his amusement. But he didn't. One day, a curious young journalist named Lily came to interview him. "Don't you feel guilty about having so much money when others have so little?" she asked gently. Harold chuckled. "No, I don't feel guilt, but I do feel responsibility," he replied. He pointed to a painting on the wall, not a masterpiece, but a picture drawn by a child from an orphanage he supported. "You see, Lily, money is like these little pieces of paper, each one a pass to use someone's time. I could use them all for myself, but what's the point of hiring 10,000 people to paint my face every day? Sure, the economy might say productivity is up, but what real good would come of it?" He paused and then said, "Those people could be researching cures, teaching kids, or caring for the sick. So I live simply. I only use what I need, and when my wife and I pass on, nearly all of it will go to causes matter." Lily was silent for a moment, moved by his words. She realized that while Harold had more than most, it was his understanding of value, not just money, that truly made him rich. Moral of the story: wealth is not wrong, but waste is. True wisdom lies not in how much you have, but in how meaningfully you use it. Important points to reflect on. Money is power, not in the dominating sense, but in the sense that it represents the ability to influence the world. Every dollar is a choice. Spending money is choosing what gets created or supported in society. Minimalism with meaning. Living simply doesn't mean living without. It means living with intention. Legacy over luxury. The greatest impact comes not from what we accumulate, but what we enable in others. Guilt versus responsibility. Feeling guilty about wealth changes nothing. Taking responsibility can change everything. Over the years, Charlie Munger and I have observed many accounting-based frauds of staggering size. Few of the perpetrators have been punished. Many have not even been censured. It has been far safer to steal large sums with pen than small sums with a gun. Understanding and teaching explanation. This quote by Warren Buffett, referring to his longtime business partner Charlie Munger, reflects a deep observation about corporate misconduct and the justice system's response to it. Let's break it down step by step. 1. Over the years, Charlie and I have observed many accounting-based frauds of staggering size. Warren and Charlie have seen numerous cases where companies manipulated their financial records, i.e., accounting fraud, to deceive investors, inflate profits, or hide losses. These aren't small mistakes, they are massive, carefully planned deceptions. 2. Few of the perpetrators have been punished. Many have not even been censured. Despite the scale of these frauds, the people responsible, executives, accountants, CEOs, often face little to no consequences. Censured means formally criticized or reprimanded, so many of these people don't even get that. 3. It has been far safer to steal large sums with pen than small sums with a gun. This is the powerful part. He compares stealing with a pen, white-collar crime like fraud, to stealing with a gun, robbery. Ironically, someone who robs a small amount with a weapon is often punished harshly, while someone who commits large-scale corporate fraud may escape accountability. It highlights the unfairness in how society and the justice system treat different types of crime. Moral lessons, point-wise. 1. White-collar crime can cause massive damage but is often overlooked. 2. Our justice system sometimes fails to hold powerful people accountable. 3. Financial integrity is as important as legal compliance. 4. Ethics in business must go beyond avoiding legal trouble. It must be about doing what's right. 5. Society must not ignore crimes just because they're committed with a suit and a pen instead of a weapon. 6. Power and money should never place someone above accountability. Our future rates of gain will fall far short of those achieved in the past. Berkshire's capital base is now simply too large to allow us to earn truly outsized returns. If you believe otherwise, you should consider a career in sales, but avoid one in mathematics, bearing in mind that there are really only 3 kinds of people in the world: those who can count and those who can't. Understanding and teaching explanation. This quote is from Warren Buffett, and here's what he's really saying in simpler and more teachable terms. 1. Our future rates of gain will fall far short of those achieved in the past. Berkshire Hathaway has made huge returns in the past, but those high growth rates won't continue in the future. Why? Because things have changed. 2. Berkshire's capital base is now simply too large to allow us to earn truly outsized returns. The company now has a massive amount of money, capital. When a company becomes so big, it's harder to grow at the same fast pace it once did. It's easier to double $1 million than to double $500 billion. 3. If you believe otherwise, you should consider a career in sales but avoid one in mathematics. If someone thinks Berkshire can still deliver extraordinary gains like before, they may be overly optimistic or unrealistic, like a good salesperson but not someone good with numbers. 4. Bearing in mind that there are really only 3 kinds of people in the world: those who can count and those who can't. This is a clever joke. It seems like he's going to say 3 kinds but only mentions 2. That's the punchline. A bit of humour showing that not everyone understands the math behind investing logic. Moral lessons, point-wise. 1. Growth becomes harder as size increases. Bigger companies can't grow as quickly as smaller ones due to scale limits. 2. Be realistic, not blindly optimistic. Past success doesn't guarantee future results, especially when circumstances have changed. 3. Understand the math in investing. Good investing requires logical and mathematical thinking, not just hope or persuasion. 4. Humor can teach too. Buffett uses humor to make a serious point more memorable and relatable. Don't fall for illusions of consistent outsized returns. Always assess whether expectations are mathematically and practically realistic. I always knew I was going to be rich. I don't think I ever doubted it for a minute. Warren Buffett. Understanding and teaching explanation. This quote reflects strong self-belief and unwavering confidence. Warren Buffett is one of the most successful investors in the world, and here he's emphasizing that even before achieving success, he had no doubt in his mind that he would become rich. Let's break it down in a teaching style. I always knew I was going to be rich. This shows a clear vision or goal. It means he had a dream, a target, and a firm belief in himself from the very beginning. I don't think I ever doubted it for a minute. This reveals his mindset. Even in tough times or uncertainty, he never questioned his potential or future success. He maintained a rock-solid belief in his goal. Lesson: success begins with your mindset. If you believe in yourself with complete certainty, you start to act, think, and make decisions that align with that belief, and that's a powerful force. Moral in points. 1. Believe in yourself fully. True success starts with self-confidence. Doubts can weaken your progress. 2. Have a clear vision. Knowing what you want gives your life direction and purpose. 3. Stay consistent and committed. Confidence without effort doesn't work. Keep working toward your vision. 4. Mindset shapes reality. What you believe deeply influences your actions and ultimately your results. 5. Success grows from inner belief. Before others believe in you, you must believe in yourself. Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. The calculation of intrinsic value, though, is not so simple. As our definition suggests, intrinsic value is an estimate rather than a precise figure, and it is additionally an estimate that must be changed if interest rates move or forecasts of future cash flows are revised. Understanding and teaching way, simplified explanation. What is intrinsic value? Intrinsic value is the true worth of a business, based on how much money, cash, it can generate in the future. This future cash is not just added up directly, it is discounted, meaning we reduce its value to reflect today's money, since money today is worth more than money in the future. The business will not live forever, so we only consider cash it can generate during its remaining lifespan. Why is it hard to calculate? While the idea is simple, the calculation isn't, because we are making estimates about future cash flow. We also need to guess what interest rates will be in the future. If either of these guesses, cash or interest, changes, the value changes. So, intrinsic value is not a fixed number. It's an informed guess that can vary depending on new information or changing conditions. Moral, key takeaways, point-wise. 1. Intrinsic value reflects the real worth of a business based on future cash generation. 2. Future cash must be discounted to understand its value in today's terms. 3. It's an estimate, not an exact number. It depends on assumptions. 4. Changes in interest rates or cash flow forecasts can shift intrinsic value. 5. Investors must use judgment and critical thinking, not just formulas. We will reject interesting opportunities rather than over-leverage our balance sheet. Understanding and teaching explanation. This quote is about financial discipline and smart decision-making in business. Let's break it down. We will reject interesting opportunities. This means the company or individual is willing to say no to exciting or potentially profitable chances, even if they seem promising. Rather than over-leverage our balance sheet. A balance sheet shows a company's financial position, what it owns, assets, and owes, liabilities. To over-leverage means taking on too much debt or financial risk. So in simple terms, The speaker is saying, we prefer to stay financially stable and avoid too much debt, even if that means passing on some great-sounding deals. Teaching angle. This quote teaches a powerful lesson in financial prudence. Not every shiny opportunity is worth the risk if it threatens your long-term stability. It's about being smart and responsible, not just ambitious. Moral lessons, point-wise. 1. Prioritize financial stability over short-term gains. 2. Think long-term. Even exciting opportunities can be risky. 3. Avoid over-leveraging. Don't take on more debt than you can handle. 4. Saying no is sometimes the wisest business move. 5. Build a solid foundation before chasing growth. Big opportunities come infrequently. When it's raining gold, reach for a bucket, not a thimble. Understanding and teaching explanation. This quote is from Warren Buffett, one of the most successful investors in the world. Let's break it down. 1. Big opportunities come infrequently. Life doesn't always offer big chances or golden moments. Truly valuable opportunities are rare. Whether it's in your career, investment, relationships, or personal growth, those breakthrough chances don't happen every day. 2. When it's raining gold. This means when those rare golden opportunities do show up, it's like wealth or success is pouring down from the sky. It's your time to win big. 3. Reach for a bucket, not a thimble. A bucket holds a lot. A thimble holds just a tiny bit. In other words, when a big chance comes your way, go all in. Take bold action, think big, and don't play small or hesitate. Teaching takeaway. When luck, opportunity, or success knocks at your door, don't be timid. Be prepared to act boldly and make the most of it. Playing small out of fear or hesitation can cost you what could have been a life-changing moment. Moral of the quote, point-wise. 1. Rare opportunities deserve bold action. 2. Don't underestimate what you can achieve. Think big. 3. Be prepared for success and ready to act fast. 4. Fear or hesitation can lead to missed chances. 5. When life gives you a big break, make the most of it. A pin lies in wait for every bubble, and when the two eventually meet, a new wave of investors learns some very old lessons. Understanding and teaching explanation. This quote is about the financial market, especially speculative bubbles. When asset prices rise far above their actual value due to hype, overconfidence, or herd mentality, a pin lies in wait for every bubble. Think of a bubble as an inflated asset price, like tech stocks, real estate, or crypto during a hype cycle. The pin is the event or realization that causes the bubble to burst, like a market crash, interest rate hike, bad news, or just the end of irrational excitement. And when the two eventually meet, sooner or later the pin, reality, meets the bubble, overhyped value, and the asset crashes. It's not a matter of if, but when. A new wave of investors learns some very old lessons. New or inexperienced investors often get caught up in the excitement thinking, this time is different. But when the crash happens, they're reminded of the same old truths about risk, value, and market cycles that seasoned investors have seen before. This is a classic warning that markets are cyclical, and overconfidence often leads to painful losses. Moral lessons. Point-wise. 1. What goes up too fast often comes down hard. Unsustainable price rises usually end in crashes. 2. Do your research, not just follow the hype. Avoid investing based on emotion or popular trends. 3. History often repeats itself in the markets. Learn from past bubbles like the dot-com crash or 2008. 4. Beware of the herd mentality. Just because everyone's doing it doesn't mean it's safe. 5. Risk is real, even if it's hidden by excitement. Smart investing means knowing when to step back. Honesty is a very expensive gift. Don't expect it from cheap people. Understanding and teaching way. This quote, often attributed to Warren Buffett, carries a powerful life lesson. Let's break it down simply. Honesty is a very expensive gift. This means honesty is rare, valuable, and not everyone possesses it. Just like a costly gift, it's something that comes with great character and integrity. Don't expect it from cheap people. Here, cheap doesn't mean people without money, but rather those who lack morals, values, or principles. Such people are unlikely to give you something as valuable as honesty because it's not in their nature or character. So, it teaches us not to be disappointed when we don't get honesty from everyone. We must learn to recognize who is genuine and who is not, and to set our expectations accordingly. Moral in point-wise. Slaw 1. Value honesty. It is a rare and precious quality. 2. Don't expect integrity from unprincipled people. It saves you from disappointment. 3. Be wise in judging character. Learn who deserves your trust. 4. Surround yourself with honest people. They bring value and stability to your life. 5. Be honest yourself. Be the kind of person others can respect and trust. A hyperactive stock market is the pickpocket of enterprise. Understanding and teaching explanation. Let's break this quote into simple parts. Hyperactive stock market means a market that is constantly moving, too fast, too emotional, too focused on short-term changes. Pickpocket is someone who steals quietly and sneakily. Enterprise refers to businesses and long-term productive efforts. So, what is the quote really saying? When the stock market is too active and erratic, it can distract or harm real businesses. Instead of focusing on building solid products, creating jobs, and making long-term improvements, companies and investors may get too caught up in short-term stock prices and speculation. This steals attention and resources away from true enterprise and productivity, just like a pickpocket quietly stealing from your pocket. It's a critique of short-term thinking in financial markets, suggesting that too much focus on daily stock movements can hurt real economic growth. Moral lessons in point form. 1. Focus on long-term value, not short-term gains. 2. Real success in business comes from productivity, not stock price swings. 3. Don't let distractions steal your core purpose. Healthy markets support enterprise. Hyperactive ones can harm it. 5. Avoid being driven by speculation. Stay grounded in real work. The most important thing to do if you find yourself in a hole is to stop digging. Understanding and teaching explanation. This quote is a metaphorical piece of advice. Imagine you're stuck in a hole in the ground. If you keep digging, you'll only go deeper, making it harder to get out. The same applies in life. In simple terms, it means, when you're in a bad situation, don't keep doing the things that made it worse. First, recognize you're in trouble. Then, stop repeating the same mistakes that got you there. Only after stopping the damage can you begin to find a solution and recover. This is often used in situations like financial problems, arguments, bad habits, or poor decisions. If you keep doing the same thing expecting different results, you'll just sink deeper. Moral? Lessons, point-wise. 1. Acknowledge your mistakes. You must be aware you're in a bad situation before you can fix it. 2. Stop making it worse. Don't continue actions that are harming you. 3. Change your approach. Find a smarter or different way to deal with the problem. 4. Learn from experience. Use the situation as a learning opportunity for future choices. 5. Seek help if needed. Sometimes you need guidance or support to get out of a tough spot. Think, don't follow. A story of real investing wisdom. Once upon a time in the bustling city of Marketville, there lived two friends, Harry the herd follower and Connie the contrarian. Both were passionate about investing and often debated over lunch at their favorite cafe. Harry always followed the crowd. If a stock was popular, he'd buy it without question. If everyone's doing it, it must be right, he'd say confidently. Connie, on the other hand, prided herself on being different. If a stock was not popular, if people were avoiding it, she'd jump in eagerly. The best opportunities are hidden where no one dares to look, she'd often claim. But time revealed an uncomfortable truth. Both friends, despite their opposite strategies, kept making poor choices. Harry invested in hype. He bought into companies with soaring prices and zero substance. When the crowd moved on, so did the value of his investments. Connie wasn't much better. She bought stocks just because they were unpopular, assuming unpopularity meant undervaluation. But many of these companies were unpopular for a reason: poor management, weak financials, or failing products. After one particularly bad market year, the friends met an old, wise investor named Mr. Graham. They poured out their frustrations. Mr. Graham listened, then smiled gently and said, "You see, both of you are trying to follow patterns, just opposite ones. One follows the crowd, the other avoids it. But neither of you is thinking, and that's the root of the problem." He handed them a note with a quote by Bertrand Russell. "Most men would rather die than think. Many do." "That applies to investing more than you'd believe," he said. "Being a contrarian isn't enough, and being popular isn't safe. What matters is reason, analysis, independent thought. That's how you find intelligent investments, not by asking what others are doing, but by understanding what you are doing." Moral of the story: don't follow the crowd, and don't rebel against it either. Just think for yourself. Important lessons to remember. 1. Popularity doesn't equal value. Just because everyone's buying doesn't make something a good investment. 2. Unpopularity isn't a golden ticket. Being contrarian for its own sake can be just as reckless. 3. Reason over reaction. True investing requires thinking, analysis, and understanding, not emotion or imitation. 4. Independent thought is rare and valuable. Most people would rather avoid the hard work of thinking, but those who embrace it stand apart. Bertrand Russell was right. In finance and in life, thinking is harder and rarer than it should be. If you like spending 6 to 8 hours per week on investments, do it. If you don't, then dollar cost average into index funds. This accomplishes diversification across assets and time, two very important things. Understanding and teaching explanation. This quote is offering simple, practical advice for people who want to grow their wealth through investing. If you enjoy investing and can dedicate 6 to 8 hours a week to researching companies, analyzing trends, and making informed decisions, then go ahead and actively manage your investments. But if you don't have the time, interest, or knowledge, don't worry. You can still invest wisely by using a passive approach. Use a method called dollar cost averaging, DCA, which means investing a fixed amount of money at regular intervals, like monthly, regardless of the market's ups and downs. Put that money into index funds, which are bundles of many different companies' stocks, like owning a slice of the whole market. Why is this smart? Because you're spreading your risk across many assets, diversification. And you're also spreading your investments over time, which helps reduce the risk of bad timing, like buying everything right before a market crash. So either become a knowledgeable active investor or take the smart, low-effort passive path. Both are valid. Just be consistent and diversified. Moral key takeaways. 1. Investing requires either time or a smart system. 2. If you can't commit time, follow a disciplined passive strategy. 3. Dollar cost averaging helps reduce risk over time. 4. Index funds provide broad diversification and steady growth. 5. Consistency and diversification are more important than timing the market. 6. Choose the investing method that fits your lifestyle and mindset. Never depend on a single income. Make investments to create a second source. Understanding and teaching explanation. Let's break it down step by step in a simple and teaching-friendly way. 1. Never depend on a single income. This part is advising us not to rely on just one source of money, like a single job or salary. Life is unpredictable. Your job might not last forever, or emergencies can happen. If you only have one income, you're at higher risk if something goes wrong. Number 2. Make investments to create a second source. This means you should put your money into things that can generate extra income over time. Examples include investing in stocks or mutual funds, starting a small business, buying property to rent out, learning skills that allow freelance or side work. These investments help build a second or even multiple income streams, so if one fails, the others can still support you. Moral lessons, point-wise. 1. Don't rely on just one source of income. 2. Start investing early to build financial security. 3. Explore side hustles or passive income options. 4. Multiple income streams protect you from financial instability. 5. Keep learning about financial planning and money management. The one thing I will tell you is the worst investment you can have is cash. Everybody is talking about cash being king and all that sort of thing. Cash is going to become worth less over time, but good businesses are going to become worth more over time. Understanding and teaching explanation. Let's break it down in a simple and teaching-friendly way. The speaker is saying, holding on to cash is not a smart long-term investment. While people often say cash is king, that's usually only true in the short term, like during a crisis when people need liquidity. Over time, inflation reduces the purchasing power of money, meaning the same amount of cash buys less in the future than it does today. On the other hand, good businesses, companies with strong fundamentals, growth and value, tend to grow in value. So instead of keeping all your money in cash, it's smarter to invest in productive assets, especially businesses that grow and create value. This quote encourages people to think long-term and be smart with their investments. Moral key takeaways, point-wise. 1. Cash loses value over time due to inflation. 2. Saving only in cash can hurt your wealth in the long run. 3. Good businesses grow in value and can increase your wealth over time. 4. Investing wisely is smarter than just saving money. 5. Think long-term with your finances, not just what's comfortable now. I think the worst mistake you can make in stocks is to buy or sell based on current headlines. Understanding and teaching way. This quote means that making decisions in the stock market purely based on the latest news headlines can be a big mistake. Headlines are often sensational or emotional, and they don't always reflect the true, long-term value of a company or the overall market. When people react quickly to headlines, whether it's panic during a crisis or excitement during a boom, they may end up buying high or selling low, which is the opposite of what smart investors do. Instead of reacting emotionally to the news, good investors focus on solid research, company fundamentals, long-term goals, and patience. Moral in point-wise. 1. Avoid emotional decisions. Don't let fear or hype in the news control your investment actions. 2. Think long-term. Focus on the bigger picture rather than short-term media noise. 3. Do your own research. Understand a company's real value instead of relying on headlines. 4. Stay calm in volatility. Markets move up and down. Reacting to every headline increases risk. 5. Discipline is key. Successful investing needs a plan, not impulse based on news. Charlie Munger and I have always considered a bet on ever-rising US prosperity to be very close to a sure thing. Indeed, who has ever benefited during the past 237 years by betting against America? If you compare our country's present condition to that existing in 1776, you have to rub your eyes in wonder. And the dynamism embedded in our market economy will continue to work its magic. America's best days lie ahead. Understanding and teaching explanation. This quote comes from Warren Buffett, one of the greatest investors of all time, reflecting his strong belief in the long-term success of the American economy. Let's break it down in simple terms. 1. Charlie Munger and I have always considered a bet on ever-rising US prosperity to be very close to a sure thing. Warren and his business partner Charlie Munger believe that investing in America's future is almost guaranteed to bring positive results. They have faith in the country's economic growth. 2. Indeed, who has ever benefited during the past 237 years by betting against America? He's making a powerful point. In American history, those who doubted the country's growth and progress didn't come out ahead. The US has consistently risen above challenges. 3. If you compare our country's present condition to that existing in 1776, you have to rub your eyes in wonder. He highlights how far America has come since its founding. From a young, developing country to a global powerhouse, it's a stunning transformation. 4. And the dynamism embedded in our market economy will continue to work its magic. America's free market system is full of innovation, creativity, and growth. That energy will keep driving the country forward. 5. America's best days lie ahead. Despite any problems we face today, he believes the future of America is bright, full of potential. Moral lessons, point-wise. 1. Believe in long-term progress. Betting on growth, innovation and resilience tends to pay off over time. 2. Have faith in opportunity. America's system provides ongoing chances for success if you invest wisely and think long-term. 3. Learn from history. Over centuries, the US has overcome wars, depressions and crises and still come out stronger. 4. Trust in the market system. A free and dynamic economy encourages advancement and reward for effort. 5. Stay optimistic about the future. Even when challenges arise, believing in a brighter future keeps people, investors, and nations moving forward. On his farm and New York commercial real estate property, with my 2 small investments, I thought only of what the properties would produce and cared not at all about their daily valuations. Games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. If you can enjoy Saturdays and Sundays without looking at stock prices, give it a try on weekdays. Explanation in an understanding and teaching way. This quote, likely from Warren Buffett, uses a simple analogy to teach a very deep investing lesson. Let's break it down in a way that makes it easy to understand. Part 1. With my 2 small investments, cared not at all about their daily valuations. Buffett is saying that when he invested in a farm and real estate, he wasn't checking their prices every day. Instead, he focused on what they produced, the crops from the farm and the rent from the property. Lesson. The real value of an investment lies in what it generates over time, not what someone is willing to pay for it today. Part 2. Games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. This is a metaphor. In investing, the playing field is your actual strategy, research, patience and discipline. The scoreboard is the market price, constantly changing, sometimes wildly. Lesson. If you keep watching stock prices all day, you might panic or make bad decisions. Winners focus on long-term performance, not short-term noise. Part 3. If you can enjoy Saturdays and Sundays without looking at stock prices, give it a try on weekdays. Most stock markets are closed on weekends, and people usually don't worry about them. Buffett suggests trying the same mindset during the week. Relax, trust your investments, and don't obsess over prices. Lesson. Less emotional involvement with daily price changes can make you a better, calmer investor. Moral, point-wise. 1. Focus on long-term value, not short-term market movements. 2. Good investors concentrate on performance, not price fluctuations. 3. Daily stock prices are just noise, they don't define true worth. 4. Productivity and income from investments matter more than market quotes. Detach emotionally from price volatility to make better decisions. 6. Trust your process and stop reacting to every small change. Forming macro opinions or listening to the macro or market predictions of others is a waste of time. Indeed, it is dangerous because it may blur your vision of the facts that are truly important. When I hear TV commentators glibly opine on what the market will do next, I am reminded of Mickey Mantle's scathing comment. You don't know how easy this game is until you get into that broadcasting booth. Understanding and teaching explanation. This quote is a caution against paying too much attention to broad market forecasts and predictions, especially those made by so-called experts on TV or in the media. Let's break it down. Forming macro opinions or listening to market predictions. This means trying to guess or believe in big-picture economic trends, like predicting the next market crash or boom, is a waste of time. Indeed, it is dangerous. The author emphasizes that doing so not only wastes your energy, but can also lead to poor decisions because your focus gets shifted from what really matters. It may blur your vision of the facts that are truly important. Listening to market noise can distract you from actual facts and fundamentals like company performance, long-term growth, and sound investment strategy. The Mickey Mantle reference. Mickey Mantle was a legendary baseball player. His quote pokes fun at how easy the game looks from the sidelines, especially when you're not the one actually playing. The comparison here is, people on TV can talk confidently about markets, but they aren't in the real trenches making tough decisions. Just like a sports commentator, they're not feeling the real risks. In teaching terms, don't let the loud voices of others distract you from doing your own thinking, especially when it comes to money and investments. Focus on what you can control and what actually matters. Moral in point-wise format. 1. Avoid chasing market predictions. Most forecasts are just guesses and often misleading. 2. Focus on facts, not noise. Stick to actual data and fundamental analysis. 3. Think independently. Don't outsource your thinking to commentators or media. 4. Stay grounded in reality. Understand that real experience is different from theoretical talk. 5. Protect your clarity. Don't let opinions blur your vision or distract your strategy. The market, like the Lord, helps those who help themselves. But unlike the Lord, the market does not forgive those who know not what they do. Explanation in an understanding and teaching way. This quote draws a powerful comparison between faith, the Lord, and economics, the market, to help us understand how the market operates. 1. The market, like the Lord, helps those who help themselves. Just as spiritual beliefs often teach that God supports those who put in effort and take initiative, the market rewards people who are proactive, hard-working, and make smart choices. If you educate yourself, work hard, take calculated risks, and make informed decisions, the market can provide you with opportunities and success. 2. But unlike the Lord, the market does not forgive those who know not what they do. In spiritual or religious beliefs, mistakes might be forgiven if you are unaware or ignorant. But the market is strict and unforgiving. If you make decisions without proper knowledge, you may suffer losses, and the market won't care whether your mistake was intentional or not. So, ignorance is punished in the marketplace, and even well-meaning but uneducated decisions can lead to failure. Moral in point-wise format. 1. Take initiative. Success in life and business requires your own effort. Don't wait for help. Act. 2. Be informed. Never make decisions blindly. Educate yourself before entering the market or making financial choices. 3. Avoid ignorance. The market does not care about intentions. Only results matter. 4. Learn continuously. The best way to protect yourself in any competitive environment is through constant learning and awareness. 5. No free passes. Unlike spiritual grace, the market doesn't offer forgiveness. It's results-driven and punishes mistakes harshly. The story of the frenzied farmers, a lesson in investing. Once upon a time, in a fertile valley nestled between gentle hills, there lived a community of farmers. The land was rich, the rains were kind, and the sun generous. Each farmer owned a piece of farmland, and year after year they planted crops, tended their fields, and harvested bountifully. Life was simple, the work was hard, and the rewards were steady. But one day, something curious began to happen. A man in a crisp suit, carrying a stack of papers and a confident smile, arrived in the valley. He spoke of profits, strategies, and something called portfolio optimization. He wasn't interested in growing crops. No, he was interested in buying and selling farmland. Not to farm it, mind you, but to trade it like a game. The man told the farmers, "You're sitting on a gold mine. If you trade your land at the right time, you can make a fortune without ever getting your hands dirty." Some farmers were intrigued. They started selling their plots and buying others, hoping to ride the waves of land values. The quiet valley turned noisy, phone calls, paperwork, hurried decisions. Every week land changed hands, new land advisors moved in, charging fees to help farmers strategize. But something odd began to happen. The crops didn't grow any faster. The harvests didn't become more plentiful. The prices of the crops didn't rise. In fact, the farmers who traded the most began to see less profit. Why? Because every transaction had a cost. A fee here, a tax there, time lost, stress gained. And worst of all, they were spending more time swapping land than growing food. Meanwhile, a few old-timers stayed put. They ignored the buzz, kept their land, and focused on farming. Their costs were low, their yields consistent, and their sleep peaceful. One day a young farmer asked one of the old-timers, "Why don't you trade like the others? Aren't you missing out?" The old man smiled and said, Son, if I keep switching farms, I spend more time moving than growing. I treat my land like a business, not a bet. And crops don't care who owns the land. They grow when they're well tended. Moral of the story: invest like a farmer, not a gambler. Just as trading farmland won't improve your crops, frantic buying and selling of stocks won't increase your returns. It only raises costs and distractions. Important lessons. 1. Value lies in production, not in trading. Just like farmland produces crops, stocks represent companies that produce real value. 2. Every transaction comes at a cost. Advisory fees, taxes, spreads, they quietly eat into your earnings. 3. Noise benefits the middlemen. Those who urge you to trade often profit from the activity, not from your success. 4. Long-term focus wins. Like good farmers, good investors are patient, disciplined, and focused on growth, not hype. 5. Ignore the chatter. Market news, trends, and tips may sound urgent, but they rarely help your long-term returns. We intend to continue our practice of working only with people whom we like and admire. This policy not only maximizes our chances for good results, it also ensures us an extraordinary good time. Understanding and teaching explanation. This quote emphasizes a simple but powerful principle for both personal and professional life. Choose your company wisely. The speaker is saying that they prefer to work only with people they like, personally connect with, and admire, respect, and look up to. Why? Because when you're around such people, you're more likely to have a positive, motivating environment. Collaboration becomes enjoyable and smooth. It boosts productivity and creativity, leading to better results. And most importantly, it makes the journey fun, not just the outcome. This is a reminder that success is not just about working hard, it's also about working happily with the right people. Moral key learnings point-wise. 1. Surround yourself with people you like and respect. It makes both work and life better. 2. Positive relationships boost performance. Good vibes often lead to great results. 3. Enjoyment matters. Success feels more fulfilling when the process is joyful. 4. Admiration fuels growth. Working with people you admire can inspire you to improve. 5. Like-minded teams create harmony, less conflict, more creativity, and smoother teamwork. I buy expensive suits. They just look cheap on me. Understanding and teaching explanation. This quote may sound simple or even humorous on the surface, but it carries a deeper meaning when looked at thoughtfully. The speaker is pointing out a mismatch between the external appearance, the expensive suits, and the internal or personal quality, how they carry or present themselves. Even though the suits are expensive and luxurious, they don't look that way on the speaker. Why? Because the person feels like they don't fit the image the suit is supposed to represent. This can be understood in two main ways. 1. Lack of confidence or self-worth. The speaker may feel that no matter how expensive or fancy something is, it doesn't work on them because they don't feel worthy or confident inside. It's like putting a shiny cover on a book that still feels unreadable or unfinished inside. Number 2. True style or value isn't bought. This suggests that just buying expensive things doesn't automatically bring style, grace, or value. If you don't own it mentally or emotionally, it won't reflect outwardly, no matter the price tag. In teaching terms, think of this like someone buying the best tools but not knowing how to use them. They won't be effective. Or like a student copying answers but not understanding the subject, it won't help in the long run. The outer tools are only useful when the inner person is ready. Moral in point form. 1. Confidence comes from within, not from price tags. 2. External things can't replace inner worth or self-belief. 3. True value is in how you carry yourself, not what you wear. 4. Work on your inner self, skills, mindset, and confidence to make anything you wear or do look truly valuable. 5. Style and grace aren't bought, they're lived. The legacy of simple wisdom, a lesson in investing. Once upon a time, in a quiet study filled with books and charts, an old man sat by his desk writing what would become one of the most important documents of his life, his will. He wasn't just passing on his wealth, he was passing on his wisdom. This man had spent decades studying markets, watching fortunes rise and fall like tides. He had seen people dazzled by clever fund managers, seduced by promises of outsized returns, only to end up disappointed or broke. He had learned, through trial and triumph, that complexity often leads to confusion and unnecessary cost. So, as he penned the instructions for the trust that would care for his loved ones long after he was gone, he kept it beautifully simple. "Put 10% of the cash in short-term government bonds," he wrote, "and put the remaining 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's." He smiled, knowing that this wasn't just a note in a will. This was a philosophy he had lived by, a quiet promise he had made to himself, to put his money where his mouth was. He had often shared this advice with others, friends, family, even strangers seeking guidance. Now it was immortalized in writing, a message to the future that echoed out a lifetime of disciplined investing. He didn't need complex models, high-fee advisors, or secret formulas. He trusted the power of the market, the resilience of the economy, and the simple magic of compounding over time. And he believed, deep in his heart, that this approach, boring to some, brilliant to others, would beat the flashy strategies of most pension funds, institutions, or individuals weighed down by fees and overconfidence. Moral of the story: sometimes the wisest path is the simplest one. Complexity is not a sign of intelligence in investing. Patience, discipline, and low costs are. Key takeaways: put your money where your mouth is. Practice what you preach, especially with something as important as investing. Keep it simple. A low-cost index fund strategy can outperform the majority of actively managed funds. Minimize fees. High fees can erode returns over time. Choosing cost-efficient options is crucial. Trust the long term. Time and compound interest are your most powerful allies. Make it clear for the next generation. Leave not just money, but wisdom behind. Storytime wisdom. The right time to invest. Understanding the when in the world of investing. Once upon a time in a quiet town, nestled between green hills and busy cities, lived a man named Ravi. Ravi was a school teacher who had just started exploring the world of investing. Every day he read news about the stock market soaring. Headlines screamed, record highs, and everyone's getting rich. His friends, even those who knew little about finance, bragged about how much money they made last month. Ravi, excited and afraid of missing out, quickly put his savings into the market without much thought. The excitement around him made it feel like the perfect time. How can this go wrong, he thought. But just a few weeks later, the market dipped. News turned gloomy. Recession fears rising, they now warned. Stocks that had gone up quickly began to fall. Ravi panicked. "I knew this wasn't for me," he sighed, and sold everything at a loss. That night he remembered something an old investor once said: "A bull market is like sex. It feels best just before it ends." It was the late Barton Biggs's way of saying that when everyone is most excited, the end is often near. Enter Mr. Sharma, the patient investor. Ravi decided to learn more. That's when he met Mr. Sharma, a retired professor and seasoned investor. Mr. Sharma smiled as Ravi shared his story. "You're not alone," Mr. Sharma said. "Many people jump in at the top because it feels safe and exciting, but markets go up and down. The trick isn't timing the market, it's time in the market." He continued, "I've been investing for 30 years. Every month I buy a few shares, no matter the headlines. Sometimes the market is high, sometimes it crashes, but I never sell in panic. I diversify, keep my costs low, and let time do the heavy lifting." Ravi listened closely. "So, you don't try to predict the best time to invest?" Mr. Sharma shook his head. "Trying to guess the perfect time is like chasing clouds. Instead, build the habit. Invest regularly, stay calm when news is scary, and let compounding work its magic." Moral of the story: the best time to invest is regularly, not reactively. Avoid jumping in during extreme excitement, and never sell in fear. Stay the course, diversify, keep costs low, and your patience will reward you. Key takeaways. 1. Timing the market is a trap. Emotional investing often leads to buying high and selling low. 2. Consistency wins. Accumulate shares over time, rain or shine. 3. Don't panic during downturns. Markets recover, and paper losses are not real losses unless you sell. 4. Diversify and keep costs minimal. These are the quiet heroes of successful long-term investing. 5. Patience beats prediction. The know-nothing investor who follows these rules often outperforms the overconfident trader. The lower prices go, as long as you know the company you're investing in, the better it is for a buyer. Down days always make me feel good. Understanding and teaching explanation. This quote is about investing in the stock market, and it emphasizes the mindset of a smart investor. When stock prices fall, most people panic. But if you're an informed investor who has done your research and you truly understand the company, falling prices should actually excite you, not scare you. Think of it like shopping. If your favorite product goes on sale, you'd be happy to buy more at a lower price. It's the same with stocks. If you believe in the long-term value of the company, lower prices mean you're getting a good deal. Down days. Refer to those days when the stock market goes down. While others may feel anxious, the speaker feels good because it presents a buying opportunity. Moral key takeaways. Point 1. Understand what you invest in. Only invest in companies you know and trust. 2. Don't fear market drops. Price dips can be opportunities, not threats. 3. Think long-term. Focus on the value of the business, not short-term market swings. 4. Buy the dip. Falling prices can be a chance to buy quality stocks at a discount. 5. Stay calm and confident. A smart investor stays positive even on down days.
I learned most of the thoughts in this investment discussion from Ben Graham's book, The Intelligent Investor, which I bought in 1949. My financial life changed with that purchase. For me, the key points were laid out in what later editions labeled chapters 8 and 20. The original 1949 edition numbered its chapters differently. These points guide my investing decisions today. Of all the investments I ever made, buying Ben's book was the best, except for my purchase of 2 marriage licenses. Understanding and teaching explanation. This quote is by Warren Buffett, one of the greatest investors of all time. He's talking about how reading a single book, The Intelligent Investor by Benjamin Graham, changed his entire financial life. Let's break it down. I learned most of the thoughts. Buffett is saying that many of his investment ideas and strategies come directly from Graham's book, which I bought in 1949. He bought the book at a young age, showing how early knowledge can have a lifelong impact. My financial life changed. The lessons he learned weren't just useful, they transformed the way he handled money and investments. Key points were laid out in chapters 8 and 20. These chapters teach 2 important concepts. Chapter 8. The concept of Mr. Market, an imaginary person who offers to buy or sell stocks daily at different prices. It teaches investors to stay rational and not be swayed by market moods. Chapter 20. The margin of safety principle. Only invest when there's a good cushion between price and value to reduce risk. These points guide my investing decisions today. Even decades later, he still follows these principles. Buying Ben's book was the best investment. He calls it the best investment he ever made, better than stocks, real estate, or even business, except for the humorous mention of his 2 marriage licenses, a sweet nod to his personal life. Moral lessons to learn. Point-wise. 1. The right knowledge can change your life. 2. Books can be life-changing investments. 3. Learn from the wisdom of experts and mentors. 4. Stick to proven principles over trends and emotions. 5. Start learning early. It pays off in the long run. 6. Humor and humility make success even more admirable. Personal growth and strong relationships are as valuable as financial success. An irresistible footnote. In 1971, pension fund managers invested a record 122% of net funds available in equities. At full prices, they couldn't buy enough of them. In 1974, after the bottom had fallen out, they committed a then record low of 21% to stocks. Understanding and teaching way. Simplified explanation. Let's make this easier to understand with a step-by-step breakdown. 1. In 1971, the stock market was doing really well and prices were high, expensive. Even though stocks were pricey, pension fund managers, people who manage retirement money, were buying a lot of them, so much that they invested 122% of the money they had. This likely includes borrowed money. This means they were extremely confident or excited about the market going even higher. 2. In 1974, the market had crashed and prices were very low, a great time to buy from a value perspective. But this time, the same pension fund managers only invested 21% of their money in stocks. They were scared and hesitant, even though it was actually a better time to buy because stocks were cheaper. What's the irony? They bought the most when prices were high and bought the least when prices were low, which is the opposite of what smart investing suggests. Buy low, sell high. Moral lessons. Point 1. Avoid emotional investing. Don't let fear or greed drive your investment decisions. 2. Buy low, sell high. The best time to buy is often when the market is down and everyone else is afraid. 3. Be contrarian when needed. Sometimes, going against the crowd can lead to better opportunities. 4. Stick to a strategy. Have a consistent investment plan rather than reacting to short-term market movements. 5. Market timing is hard. Even professionals get it wrong. Focus on long-term value instead of chasing trends. It's simply to say that managers and investors alike must understand that accounting numbers are the beginning, not the end, of business valuation. Understanding and teaching explanation. This quote emphasizes an important concept in finance and business decision-making. Accounting numbers like profits, revenue, and assets are important tools for evaluating a company, but they are just the starting point. Business valuation means finding out how much a company is really worth, not just based on current performance, but also considering future potential, risks, market position, and other qualitative factors. For example, two companies may show the same profit on paper, but one might have better growth opportunities or a stronger brand, making it more valuable. So, managers should not rely solely on accounting figures to make strategic decisions. Similarly, investors must look beyond the financial statements and dig deeper into the business model, competition, leadership quality, and market trends. Think of accounting numbers as the tip of the iceberg. What's visible? The true value of a business often lies beneath the surface. Moral in point-wise form. 1. Don't judge a business only by its financial statements. 2. Dig deeper to understand the full picture of a company's value. 3. Consider future potential, not just past performance. 4. Use accounting as a tool, not the final decision maker. 5. Managers and investors must apply critical thinking beyond numbers. The worst sort of business is one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Think airlines. Here, a durable competitive advantage has proven elusive ever since the days of the Wright brothers. Indeed, if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down. Explanation, understanding, teaching way. Let's go step by step. 1. The worst sort of business is one that grows rapidly. This means some businesses might look successful from the outside because they are expanding fast. However, growth alone isn't always a good sign. 2. Requires significant capital to engender the growth. These businesses need a lot of money to keep growing, buying equipment, infrastructure, hiring people, etc. They burn a lot of cash just to stay in the race. 3. And then earns little or no money. Despite all that growth and investment, the profits are minimal or even zero, so the returns for investors or owners are disappointing. 4. Think airlines. The airline industry is used as an example. Planes are expensive, operations cost a lot, and yet airlines often struggle to stay profitable. 5. Here, a durable competitive advantage has proven elusive. In simple terms, airlines find it hard to stand out in a long-lasting way. There's too much competition, and it's hard to keep an edge over rivals. 6. If a far-sighted capitalist had been present at Kitty Hawk. Kitty Hawk is where the Wright brothers first flew their airplane. The author jokingly says that if a smart investor had seen the future back then, they might have stopped the invention, because it led to an industry full of financial struggles. Moral lessons in point form. 1. Rapid growth doesn't always mean a good business. 2. If a business needs constant and heavy investment, it can become a money pit. 3. Low or no profit despite growth is a red flag for investors. 4. An industry with no lasting competitive advantage is risky and unstable. 5. Not all revolutionary inventions lead to profitable businesses. 6. Wise investors look beyond hype. They evaluate long-term profitability and sustainability. I've reluctantly discarded the notion of my continuing to manage the portfolio after my death, abandoning my hope to give new meaning to the term thinking outside the box. Understanding and teaching explanation. This quote is a humorous and clever way of addressing the idea of letting go of control, even beyond death. Let's break it down. I've reluctantly discarded the notion. The speaker is saying they have given up an idea, though they didn't want to, of my continuing to manage the portfolio after my death. They had once jokingly imagined that they could still manage their investments even after they're gone, which is, of course, impossible. Abandoning my hope to give new meaning to the term thinking outside the box. This is the punchline. Thinking outside the box usually means being creative or unconventional, but here the speaker plays with the phrase literally, trying to think while being outside the box, meaning the coffin. So they're adding a dark but witty twist to the idiom. In simple teaching terms, this quote uses dark humor to show even smart people have to accept their limits. We cannot control things after we're gone. It's a reminder to plan ahead, train successors, or trust others to carry the work forward. Moral of the quote, point-wise. 1. Accept your limitations. No one can control everything forever. 2. Plan for the future. Prepare others to continue your work. 3. Let go when needed. Sometimes, stepping back is wiser than holding on. 4. Use humor to face serious truths. It makes heavy ideas easier to accept. 5. Legacy matters more than control. Focus on what you leave behind, not what you can hold on to. The single most important decision in evaluating a business is pricing power. If you have the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 1/10 of a cent, then you've got a terrible business. Explanation. Let's break it down in a simple and clear way. 1. What is pricing power? Pricing power means a business's ability to increase the prices of its products or services without losing customers. 2. Why is it important? If a company can raise prices and still keep its customers, it shows that the product is valued. Customers have loyalty. There's low competition, or the brand is strong. 3. Good versus bad business. In simple terms, good business can increase prices confidently. Profits grow, business becomes stronger. Bad business, even a small price hike feels risky. Fear of losing customers, weak position in the market. 4. Imagine this like a restaurant. A famous restaurant can raise prices and still have long queues. A struggling one fears even a 1 increase because customers might leave. Moral, key learnings, point-wise. 1. Pricing power reflects business strength. 2. A strong brand or product can command higher prices. 3. Customer loyalty and uniqueness reduce fear of competition. 4. Businesses that fear raising prices are often replaceable or weak. 5. While evaluating a business, focus on its control over pricing. 6. Sustainable profit comes from value, not just cost cutting. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. Understanding and teaching explanation. This quote is a powerful investment insight often associated with Warren Buffett, one of the most successful investors of all time. Let's break it down. 1. The key to investing. This sets the stage, what's truly important when you're putting money into a business or the stock market. 2. Is not assessing how much an industry is going to affect society or how much it will grow. Many people think that just because an industry is exciting, like AI, electric vehicles, or biotech, it's automatically a good investment. But just because an industry grows doesn't mean all the companies in it will be profitable or successful. 3. But rather determining the competitive advantage of any given company. Instead of looking at the whole industry, you should focus on individual companies and what makes them better than their competitors. A competitive advantage can be a strong brand, exclusive technology, low production cost, or customer loyalty. 4. And, above all, the durability of that advantage. The most important thing is how long a company can keep that advantage. A company with a strong but short-lived edge is less valuable than one with a sustainable lead over time. In short, don't just follow the hype of a booming industry. Instead, study specific companies and ask, what makes this company better than others? Can it stay better for a long time? Moral key takeaways, point-wise. 1. Focus on companies, not just industries. A growing sector doesn't guarantee every company within it will succeed. 2. Identify competitive advantages. Look for what makes a company stand out, like innovation, cost efficiency, or branding. 3. Check for long-term sustainability. A great business keeps its edge for years, not just temporarily. 4. Avoid getting distracted by hype. Popular or trending industries can still produce poor investments if the companies aren't strong. 5. Think like a business owner, not a speculator. Invest in companies with solid foundations that can last the test of time. Investors should be skeptical of history-based models constructed by a nerdy-sounding priesthood using esoteric terms such as beta, gamma, sigma, and the like. These models tend to look impressive. Too often, though, investors forget to examine the assumptions behind the models. Beware of geeks bearing formulas. Understanding and teaching explanation. This quote is a cautionary statement directed at investors, highlighting the risks of blindly trusting financial models. Let's break it down simply. 1. Investors should be skeptical of history-based models. Just because a model worked in the past doesn't mean it will work in the future. The world changes, and past data doesn't guarantee future outcomes. 2. Constructed by a nerdy-sounding priesthood using esoteric terms such as beta, gamma, sigma, and the like. Financial experts often use complex mathematical jargon. While it may sound impressive, it can also confuse or mislead those who don't fully understand the underlying concepts. 3. These models tend to look impressive. With charts, formulas, and fancy presentations, models can appear very reliable or scientific, which makes people more likely to trust them. 4. Too often, though, investors forget to examine the assumptions behind the models. The key danger is that these models are built on certain assumptions, e.g. that markets behave rationally or that volatility is stable. If those assumptions are wrong, the model can fail. 5. Beware of geeks bearing formulas. This is a clever warning. Like, beware of Greeks bearing gifts from mythology. It means, don't blindly trust experts just because they have fancy formulas. Be critical and ask questions. Moral key lessons, point-wise. 1. Don't blindly trust complex financial models. 2. Understand the assumptions behind any investment strategy. 3. Just because something looks scientific doesn't mean it's accurate. 4. Past performance is not a reliable predictor of future results. 5. Always use critical thinking even when dealing with experts. 6. Simplicity and common sense often outperform overly complex systems. Crossing the bridge. The hidden wisdom in margin of safety. Once upon a time in a bustling town nestled beside a wide canyon, there lived an old trader named Elliot. Known for his sharp mind and love for storytelling, Elliot often shared life lessons through tales from his travels and trading days. One sunny afternoon, a group of eager young investors gathered around him in the village square. "Tell us something about investing, wise Elliot," they urged. Elliot smiled, leaned on his cane, and began. The Tale of Two Bridges. "Imagine," he said, "you are driving a big delivery truck. It's packed with precious goods and weighs exactly 9,800 pounds. As you drive, you approach a bridge with a sign. Maximum weight, 10,000 pounds. Now, you have two options. The first bridge is over a shallow ditch, barely 6 inches deep. The second bridge, it stretches over the vast, gaping Grand Canyon. Which bridge would you feel safer crossing?" Elliot asked with a glint in his eye. The crowd murmured. Some chuckled. One bold lad said, "The one over the ditch, of course." Elliot nodded. Exactly. The risk is the same in terms of weight, just 200 pounds shy of the limit. But the consequences if something goes wrong are very different. Over the ditch, a mistake might be inconvenient. Over the canyon, it could be fatal. He paused and let the lesson settle. The business lesson hidden in the bridge. You see, Elliot continued, this is how investing works too. When you understand a business perfectly and you are confident in its future, you don't need as much of a margin of safety. It's like crossing the bridge over the ditch. You're close to the edge, but it's a manageable risk. But when a business is vulnerable, perhaps it's in a changing industry, or faces strong competition, or has unpredictable earnings, it's like that second bridge. You'd want a larger margin of safety, even if the numbers seem to check out. Moral of the story. It's not just about how close you are to the limit. It's about what lies beneath if things go wrong. Important points to remember. 1. Understanding reduces risk. The more thoroughly you understand a business and its future, the less cushion or margin of safety you might need. 2. Vulnerability requires caution. When dealing with uncertain or risky businesses, increase your margin of safety, just like you'd want more clearance when crossing a dangerous bridge. 3. Consequences matter. Always consider not just the likelihood of something going wrong, but also the consequences if it does. 4. Margin of safety, peace of mind. In both bridges and investing, a good margin of safety helps you sleep at night. Elliot looked around at the young investors, their eyes wide with new understanding. Always know what kind of bridge you're on, he said with a wink, and never underestimate the value of a good margin. And with that, the old trader wandered off, leaving behind a lesson that would stick with them for life. Your premium brand had better be delivering something special, or it's not going to get the business. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, is about value, quality, and expectations in business. Here's what it means in simple and teaching terms. If you call your product or service a premium brand, meaning high-end, expensive, or luxury, then you must offer something truly valuable and unique. Customers are smart. They won't pay extra just for the name, unless the product actually delivers better quality, experience, or results. In other words, premium pricing must be backed by premium performance. If not, customers will take their money elsewhere. Example to teach. Imagine 2 smartphones. One is priced high and branded as luxury, but it doesn't offer anything better than a cheaper phone. People won't buy it. But if it offers a great camera, fast performance, long battery, and elegant design, then people will feel it's worth the price. Moral lessons, point-wise. 1. High price must come with high value. 2. Customers expect something special from premium brands. 3. Reputation alone is not enough. Quality must back it. 4. In business, delivering excellence is key to gaining trust and profit. 5. Don't just say you're the best. Prove it with what you offer. You know, people talk about this being an uncertain time. You know, all time is uncertain. I mean, it was uncertain back in 2007. We just didn't know it was uncertain. It was uncertain on September 10th, 2001. It was uncertain on October 18th, 1987. You just didn't know it. Understanding and teaching explanation. This quote reminds us of a powerful truth. We often think that only the present moment is uncertain or risky, especially during crises or difficult times. But in reality, life has always been uncertain. We just realize it more clearly during challenging events. Let's break it down. In 2007, before the financial crisis of 2008, life seemed normal, but uncertainty was still there. On September 10th, 2001, everything felt regular. No one knew that the tragic events of 9/11 would unfold the next day. On October 18th, 1987, everything seemed fine until the stock market crashed the next day on what became known as Black Monday. So uncertainty is not new. It's not something unique to today. It's always been part of life. The only difference is that sometimes we see it and sometimes we don't notice it. This quote teaches us that uncertainty is the default setting of life, not the exception. The key is not to fear it, but to accept it and prepare wisely, mentally, emotionally, and practically. Moral key takeaways, point-wise. 1. Uncertainty is a constant in life, not just during crises. 2. Awareness of uncertainty helps us stay grounded and prepared. 3. The world may seem stable at times, but hidden risks always exist. 4. Wise people don't panic at uncertainty. They plan and adapt. 5. Accepting uncertainty reduces fear and builds emotional strength. 6. History shows that the calm before any event was just an illusion. 7. Live with readiness, not fear, because certainty is never guaranteed. I insist on a lot of time being spent, almost every day, to just sit and think. That is very uncommon in American business. I read and think. So I do more reading and thinking and make less impulse decisions than most people in business. I do it because I like this kind of life. Warren Buffett. Understanding and teaching explanation. This quote is from Warren Buffett, one of the most successful investors in the world. Here's what he means, in simple and teachable terms. He values thinking time. Almost every single day, he spends time just sitting quietly and thinking deeply. In modern business, especially in fast-paced cultures like in America, this habit is rare. Most people are always rushing, reacting quickly, and constantly working without pausing to think things through. He combines reading and thinking to make better decisions. Because he spends time absorbing knowledge and reflecting on it, he avoids making quick, emotional decisions. It's not just a strategy. He genuinely enjoys this lifestyle of thoughtful living and learning. So, Buffett is teaching us that slowing down to think is not a weakness. It's actually a powerful advantage in life and business. Moral key lessons, point-wise. 1. Take time daily to think. Don't rush into decisions. Thinking clearly leads to better outcomes. 2. Read regularly. It feeds your mind and gives you tools to make smart choices. 3. Avoid impulsive decisions. Thoughtful actions are usually more effective and sustainable. 4. Thinking is rare but valuable. In a fast world, deep thinking gives you a real edge. 5. Do what suits your nature. Buffett thinks and reads because he enjoys it, not just for success. Successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, uses a humorous yet powerful analogy to explain a deep truth about investing and life in general. Successful investing takes time, discipline, and patience. This means you can't expect to get rich overnight. Real wealth grows gradually. Like planting a tree, you must nurture it over time to see it grow and bear fruit. Rushing or trying shortcuts often leads to failure. No matter how great the talent or effort, even if you're incredibly smart or hardworking, some processes can't be accelerated. They follow a natural course and require time to unfold. You can't produce a baby in 1 month by getting 9 women pregnant. This is the central analogy. It humorously but wisely shows that some results simply can't be rushed. Just like pregnancy takes 9 months no matter what, success in investing, or any long-term goal, follows its own timeline. Moral or key lessons, point-wise. 1. Patience is essential for long-term success. 2. Discipline and consistency matter more than speed. 3. You can't rush natural processes. Some things just need time. 4. Talent and effort are important, but not everything can be fast-tracked. 5. Trying to force quick results often leads to failure or disappointment. I could end the deficit in 5 minutes. You just pass a law that says that anytime there is a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. Understanding and teaching explanation. This quote suggests a bold and simple solution to a very complex problem, the budget deficit of a country. Let's break it down to understand better. 1. Deficit. This is when the government spends more money than it earns, leading to borrowing. 2. GDP, gross domestic product. This is the total value of goods and services produced in a country, basically how much the whole economy is worth. 3. More than 3% of GDP. This means the government is borrowing too much money, more than is considered healthy or sustainable. 4. Sitting members of Congress. These are the people currently holding office and making laws. 5. Ineligible for re-election. If the deficit is too high, those in Congress cannot run for their position again. The person is saying, if we make it a law that politicians lose their jobs, if the budget deficit is too high, they will work harder to manage the budget responsibly. It's like saying, if students failed a class and weren't allowed to come back to school unless they improved, they'd be more motivated to study harder. This is a powerful way to force accountability. If their jobs depended on the economy doing well, politicians might stop wasting money or passing irresponsible budgets. Moral, point-wise. 1. Accountability drives action. People are more responsible when their actions have direct consequences. 2. Incentives matter. When leaders are motivated by the right reasons, serving the public, not just re-election, better results follow. 3. Good governance requires discipline. A stable economy needs careful spending and wise decision-making. 4. Reform can be simple but powerful. Sometimes bold, simple laws can fix deeply rooted problems. 5. Leadership must have skin in the game. If leaders face consequences for bad governance, they're more likely to act in the public's best interest. Never ask a barber if you need a haircut. Understanding and teaching explanation. This quote is a clever and humorous way of saying, don't ask someone who has a personal or financial interest in your decision for advice about that decision. Why? Because their answer will likely be biased. Let's break it down. A barber earns money by cutting hair. If you ask a barber, do I need a haircut? They're very likely to say yes, even if you don't really need one, because it's in their best interest. So in life, when you're making a decision, especially one that involves spending money, taking risks, or trusting someone else's judgment, be aware of their motives. Example, imagine you're buying a car, and you ask the salesperson if the expensive model is worth it. Of course, they'll say yes. It helps them make a sale. So, this quote is a reminder to think critically, know who you're asking, consider their personal interest. Moral, point-wise. 1. Don't seek advice from someone who benefits from your decision. 2. Always consider the other person's interest before trusting their suggestion. 3. Use your own judgment and do independent thinking. 4. Be aware of biases, especially in business or money-related matters. 5. Ask neutral or experienced people for honest advice. When you combine ignorance and leverage, you get some pretty interesting results. Warren Buffett. Understanding and teaching explanation. Let's break it down into simple parts. Ignorance means lack of knowledge or understanding. Leverage usually means using borrowed resources like money, tools, or influence to increase potential results, either gains or losses. So what Warren Buffett is saying is, when someone who doesn't really know what they're doing, ignorant, starts using powerful tools or borrowed resources, leverage, the outcome can be dramatic, and often in a negative way. Example to understand. Imagine a person who doesn't know how to drive trying to race a sports car at high speed. The car, leverage, is powerful, but their lack of skill, ignorance, makes it dangerous. The results might be interesting, but not in a good way. In finance or business, if someone borrows a lot of money to invest in something they don't understand, they could lose everything. Moral lessons, point-wise. 1. Never use power or tools you don't fully understand. 2. Learn first, act later. Knowledge reduces risk. 3. Leverage is not bad but dangerous in the wrong hands. 4. Ignorance with power can lead to disaster. 5. Combine knowledge with responsibility for smart decisions. You keep doing the same things and you keep getting the same result over and over again. Understanding and teaching explanation. This quote is about repeating the same actions but expecting different outcomes. Let's break it down simply. Imagine you're trying to improve your grades, but you're still studying the same way, not changing your method or routine. Or you're trying to be healthier, but you keep eating junk food and avoiding exercise. In both cases, you're hoping for a new result, but you're doing the same old thing. So this quote teaches us that if we want a different or better result, we must be ready to change our approach or behavior. It's like a cycle. Doing the same thing will always lead to the same place. If you want to go somewhere else, you need to take a new path. Moral of the quote, point-wise. 1. Change is necessary for progress. 2. Repeating the same actions gives the same outcomes. 3. To see different results, try a different approach. 4. Growth comes from learning and adjusting. 5. Break the cycle to break free from failure or stagnation. Public opinion poll is no substitute for thought. Understanding and teaching explanation. This quote by Warren Buffett emphasizes a very important idea. Just because many people believe something or vote a certain way in a poll doesn't mean it's the right answer or the most thoughtful conclusion. Let's break it down. Public opinion poll. This is a survey that tells us what a group of people thinks about a particular topic. Substitute for thought. This means replacing thinking or deep reasoning with something else. So, the quote warns us not to blindly follow popular opinion. Just because the majority believes something doesn't mean it's based on logic, truth, or deep thinking. We should use our own minds, ask questions, and analyze facts rather than simply going along with what most people think. Example for better understanding. If a poll says 80% of people believe a certain food is unhealthy, but scientific research proves otherwise, should you just go with the poll? No, you should trust thoughtful analysis, not just majority opinion. Moral lesson. Point-wise. 1. Always think for yourself. Don't blindly follow the crowd. 2. Popular opinion is not always correct. 3. Make decisions based on logic, facts, and understanding. 4. Use critical thinking rather than relying on what others believe. 5. Question everything, even widely accepted beliefs. The difference between successful people and very successful people is that very successful people say no to almost everything. Understanding and teaching explanation. This quote by Warren Buffett emphasizes the power of focus and boundaries. Successful people often say yes to many opportunities, projects, meetings, and tasks. They are driven and open to new ideas. Very successful people, on the other hand, protect their time and energy fiercely. They understand that doing too many things dilutes their efforts. So they say no to most things, not because those things aren't good, but because they aren't great or aligned with their core goals. This teaches us that to rise from being merely successful to truly exceptional, we must learn to prioritize wisely, avoid distractions, say no without guilt. It's not about doing more. It's about doing what matters most. Moral in points. 1. Focus is key to greatness. 2. Learn to say no to things that don't align with your goals. 3. Don't confuse being busy with being productive. 4. Stay committed to your top priorities. 5. Selective action leads to extraordinary results. Intensity is the price of excellence. Understanding and teaching explanation. This quote is short but powerful. Here's how to understand and teach it. Intensity means focus, passion, dedication, and full effort. Excellence means achieving the best results, reaching greatness, or performing at the highest level. So, the quote means, if you want to be truly excellent at something, you must give your all, your energy, focus, and commitment. Think of it like this. A top athlete trains harder than anyone else. That's intensity. A brilliant student studies deeply and consistently. That's intensity. A great artist, entrepreneur, or leader always gives their best. They live with intensity. Teaching tip. Tell learners that nothing great comes easy. You can't casually aim for excellence. It requires intensity, just like fire needs fuel. Moral life lessons, point-wise. 1. Greatness demands full effort. You can't reach the top without putting your heart into it. 2. Passion fuels success. The more intense your focus, the better your results. 3. Discipline and consistency matter. Excellence comes from persistent, high-effort work. 4. Stay committed, even when it's hard. Challenges will test you, but intensity keeps you going. Number 5. Don't fear hard work, embrace it. Hard work is the price you pay for something truly worthwhile. A horse that can count to 10 is a remarkable horse, not a remarkable mathematician. Understanding and teaching explanation. This quote is a clever way to highlight the importance of context and expectations when judging someone's abilities. Imagine a horse that can count to 10. That would be very impressive, right? Because we don't expect animals, especially horses, to understand numbers at all. But if a human could only count to 10, we wouldn't say they're a brilliant mathematician. We might be concerned they haven't learned enough. So, the same skill, counting to 10, is amazing for a horse, but very basic for a mathematician. What's the lesson? The value of a skill or action depends on who is doing it and what is expected of them. It's a reminder to not confuse novelty or surprise with true expertise. Moral of the quote. 1. Judge achievements in the right context. A skill may be impressive for one being, but basic for another. 2. Don't confuse novelty with expertise. Just because something is surprising doesn't mean it's advanced. 3. Set expectations based on roles and potential. We should evaluate abilities based on what's reasonable or expected from a person or creature. 4. Appreciate effort, but understand depth. Recognize hard work, but don't overestimate the level of mastery. Those people who can sit quietly for decades when they own a farm or apartment house too often become frantic when they are exposed to a stream of stock quotations and accompanying commentators delivering an implied message of, "Don't just sit there, do something." For these investors, liquidity is transformed from the unqualified benefit it should be to a curse. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, highlights a psychological difference in how people perceive different types of investments. When someone owns a farm or an apartment building, they're usually content to hold on to it for years, letting it generate income through crops or rent. They don't constantly check its price or worry about its day-to-day fluctuations. However, when the same people invest in the stock market, they are constantly bombarded with news, price changes, and expert opinions. This overwhelming flow of information creates a sense of urgency and fear of missing out. FOMO. Stocks are very liquid, meaning they can be bought or sold easily and quickly. While this seems like a good thing, it often causes investors to overreact. They panic when prices drop or chase trends when prices rise, leading to poor decisions. The quote warns that liquidity, while a useful feature, can become a curse if it tempts investors into making emotional, short-sighted choices instead of thinking long-term. Moral, point-wise. 1. Patience is key. Long-term thinking often leads to better investment outcomes. 2. Ignore the noise. Constant media updates and market commentary can cloud your judgment. 3. Liquidity is a double-edged sword. Just because you can trade often doesn't mean you should. 4. Stay calm and focused. Treat stock investments like real businesses, not just fluctuating numbers. 5. Discipline beats reaction. Avoid impulsive moves. Stick to a well-thought-out plan.
Buy into a company because you want to own it, not because you want the stock to go up. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, is a powerful piece of investment wisdom. Let's break it down in a simple and teachable way. Buy into a company. This means investing your money in a business by purchasing its stock, because you want to own it. The focus here is on long-term ownership. You should believe in the company, its business model, products, leadership, and future potential, just like you'd feel confident owning and running it yourself. Not because you want the TOS, you want the stock to go up. This warns against short-term thinking. If your only reason to invest is hoping the stock price will rise quickly, you're treating the market like a gamble. That's not wise or sustainable investing. In short, invest like a business owner, not like a gambler. Moral key lessons, point-wise. 1. Think long-term, not short-term gains. 2. Invest in companies you understand and believe in. 3. Treat stock buying as owning part of a real business. 4. Avoid emotional or hype-based investing decisions. 5. Patience and conviction are the keys to smart investing. Love is the greatest advantage a parent can give. Understanding and teaching explanation. This quote emphasizes the power of love in parenting. It means that out of all the things a parent can provide, education, money, opportunities, or material comforts, love stands above them all. When children are raised with genuine love, they feel secure and valued. They grow up with confidence and emotional strength. They learn how to love others, be kind, and form healthy relationships. Love becomes the foundation for everything else in life. Even in difficult times, a child who feels loved is more likely to overcome challenges and succeed. So teaching this to parents or future parents means helping them understand that no matter their financial status or lifestyle, giving love is the most powerful gift they can offer. Moral life lessons point-wise. 1. Love creates emotional security and strength. 2. A loving environment helps children grow with confidence. 3. More than wealth or success, love builds character. 4. Children who feel loved tend to be more empathetic and kind. 5. Every parent can give love. It's priceless but powerful. 6. Love is the true legacy parents leave behind. It's like choosing the 2020 Olympic team by picking the children of all the winners at the 2000 Games. Understanding and teaching explanation. This quote is a metaphor that highlights the flaw in making decisions based solely on legacy, inheritance, or past achievements of others, rather than current merit or ability. Imagine this. Instead of selecting athletes for the 2020 Olympics based on their own performance, talent, and hard work, you simply pick the children of those who won in 2000, assuming they will be just as good because of their parents. That wouldn't make sense, right? Every generation is different. Skill isn't automatically passed down, and success needs to be earned, not inherited. This can relate to real-life situations such as nepotism in jobs or leadership roles, giving opportunities to someone just because of their family background, not their capabilities, judging someone by their surname rather than their personal skills or effort. So this quote criticizes unfair selection systems that ignore current talent and rely on outdated or unrelated criteria. Moral lesson in point-wise format. 1. Merit should matter more than legacy. 2. Opportunities should be based on ability, not ancestry. 3. Hard work and current performance are what truly count. 4. Every individual deserves a fair and equal chance. 5. Inherited privilege shouldn't overshadow genuine talent. People will always try to stop you doing the right thing if it is unconventional. Understanding and teaching. Explanation. This quote means that when you try to do something good or morally right, but in a way that's different from what most people expect or accept, others might discourage you or try to stop you. Why? Because people are often afraid of change or anything that challenges the norm. Let's break it down. Doing the right thing. This means making a choice that is honest, kind, fair, or morally correct. Unconventional. This means something that is not usual, traditional, or what most people are used to. When these two come together, it means you're doing something good, but in a new or different way, and that makes some people uncomfortable. Example for better understanding. Imagine someone wants to help poor children by starting a free school in a place where no one has done that before. Some people might say, that won't work, or why are you doing that? Even though the idea is good, just because it's new or different. 1. Always stand firm when you're doing the right thing, even if others doubt you. 2. Don't be discouraged by criticism that comes just because your method is different. 3. Unconventional paths often lead to big change and positive impact. 4. Society may resist change at first, but that doesn't mean the change is wrong. 5. Doing good may not always be easy or accepted, but it is always worth it. Do not save what is left after spending, but what is left after saving. Explanation in an understanding and teaching way. This quote is about smart financial habits. Let's understand it step by step. Most people follow this pattern. 1. Earn money. 2. Spend on their needs and wants. 3. Whatever is left, they try to save, if any. But Warren Buffett suggests a wiser approach. 1. First, decide how much you want to save. treat saving like a bill you must pay. 2. Then spend what is left after saving. This flips the usual habit. It builds discipline and ensures you're always saving, no matter how much you earn. It's about prioritizing your future over short-term pleasures. Even small regular savings can grow over time if done consistently. Moral of the quote, point-wise. 1. Make saving a priority, not an afterthought. 2. Be intentional with your spending. Plan ahead. 3. Financial discipline leads to long-term stability. 4. Save first, enjoy later, not the other way around. 5. Even small savings today can build big security tomorrow. I wouldn't mind going to jail if I had 3 cellmates who played bridge. Understanding and teaching explanation. This quote is humorous but also insightful. Here's what it really means. Literal meaning. The speaker is saying that they wouldn't mind being in jail as long as they have 3 other people to play the card game bridge with. Deeper meaning. It's not actually about jail or crime. The quote emphasizes the importance of companionship, hobbies, and shared interests. Even in a tough or undesirable situation like jail, the presence of people you enjoy spending time with, doing something you love, can make it bearable, even enjoyable. Teaching angle. This quote teaches us that difficult circumstances become easier when you have the right company. Passion, in this case, for bridge, can bring joy even in bad situations. Life is less about where you are and more about who you're with and what you're doing. Moral. Point-wise. 1. Good company can make any situation better. 2. Shared interests create strong bonds. 3. Hobbies and passions bring comfort and joy. 4. Your environment matters less than the people around you. 5. Happiness is often found in simple pleasures with good friends. My successor will need one other particular strength, the ability to fight off the ABCs of business decay, which are arrogance, bureaucracy, and complacency. Explanation in an understanding and teaching way. This quote emphasizes a crucial piece of wisdom for anyone in a leadership role, especially someone taking over a successful business. Let's break it down. My successor will need one other particular strength. This means that besides all the usual skills needed to run a company, like decision-making, communication, vision, etc., there's one special skill that's absolutely essential. The ability to fight off the ABCs of business decay. This refers to defending the company against 3 hidden enemies that can slowly destroy it from the inside. What are these ABCs? 1. Arrogance. When leaders or employees start to believe they're too good to fail, they stop learning and growing. 2. Bureaucracy. When rules, procedures, and red tape become more important than results or innovation. 3. Complacency. When people get too comfortable with past success and stop pushing for improvement or change. These 3, arrogance, bureaucracy, and complacency, are silent killers of businesses. They don't usually show up in profits right away, but over time, they weaken the company's ability to stay competitive and relevant. So the quote is saying that the next leader must have the strength to recognize and resist these tendencies, no matter how successful the business becomes. Moral key takeaways, point-wise. 1. Stay humble. Success should never lead to arrogance. Always keep learning and listening. 2. Simplify. Don't suffocate. Keep systems and processes efficient, not overly complicated. 3. Keep the fire alive. Never let comfort replace the drive to grow, innovate, and improve. 4. Guard against decay. Great leaders protect the culture and spirit of a company, not just its profits. 5. Success is not a finish line. It's a journey that demands constant vigilance and adaptability. Gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. Understanding and teaching explanation. This quote by Warren Buffett humorously highlights the irrational behavior of humans when it comes to gold. Let's break it down step by step. Gold mining. First, we spend a lot of money and effort to dig gold out of the ground, often in places like Africa. Processing and storing. Then, after melting and refining it, we bury it again, this time in vaults, underground bunkers, or safes. Security costs. To make sure it stays safe, we even pay guards and install advanced security systems to protect it. Question of utility. Buffett questions its actual usefulness. Utility. Unlike food, water, or medicine, gold doesn't nourish, heal, or shelter us. Its value mostly comes from perception, tradition, and investment. Martian's perspective. From an outsider's view, like a Martian watching us, this whole process would look absurd. Why go through all this effort for something that, practically speaking, we don't use? He's not saying gold is worthless, just that the way we treat it is a bit ironic and symbolic of human behavior driven more by belief than logic. Moral key takeaways, point-wise. 1. Think critically about value. Not everything that is considered valuable has practical use. 2. Humans often follow tradition blindly. We sometimes do things just because they've always been done that way. 3. Perceived value can be misleading. Society often gives importance to things based on perception rather than function. 4. Question economic behavior. It's important to reflect on whether our financial systems make real-world sense. External perspectives can reveal absurdities. Looking at our actions from an outsider's point of view can help us see things more clearly. Some material things make my life more enjoyable. Many, however, would not. I like having an expensive private plane, but owning a half-dozen homes would be a burden. Too often, a vast collection of possessions ends up possessing its owner. The asset I most value, aside from health, is interesting, diverse, and long-standing friends. Understanding and teaching way explanation. This quote teaches us about the balance between enjoying material comforts and understanding their limits. The speaker acknowledges that some luxury items, like a private plane, do bring convenience or joy. However, having too many things, like multiple homes, can become more of a responsibility than a pleasure. It points out a common truth. When people accumulate too many possessions, those things can start to control them. They require maintenance, attention, and often cause stress rather than happiness. At the core, the speaker highlights what truly matters: health and meaningful friendships. These are the real treasures of life, things that bring lasting happiness, growth, and emotional support. Moral in point-wise. 1. Not all material things bring happiness. Some can become burdens. 2. Having too many possessions can control your life instead of improving it. 3. True wealth lies in good health and meaningful, long-term friendships. 4. Enjoy comforts, but don't let them define your life. 5. Focus on what brings genuine joy and lasting value, not just surface-level satisfaction. A story of wealth, luck, and perspective. Once upon a birth, the ovarian lottery. There once lived a man who became one of the wealthiest people on earth. But when asked the secret of his success, he didn't begin with intelligence, hard work, or ambition. Instead, he said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." From the very start, he knew he had drawn a winning ticket in what he called the ovarian lottery. He was born in 1930, not just anywhere, but in the United States of America. The odds of that alone were 30-1 against him. He was also born male and white, circumstances that at the time spared him from the crushing barriers faced by many others. These weren't choices, they were strokes of luck. A lucky place, a lucky time. As the years rolled by, the man found himself in a unique and powerful system, a capitalist market economy. While far from perfect, it rewarded innovation, risk-taking, and financial insight. He didn't invent a cure or teach in a classroom. Instead, he had a knack for spotting undervalued companies and making smart investments. And in this system, the ability to recognize mispriced securities could generate billions, while saving lives in war earned medals, and shaping young minds brought heartfelt thank you notes. He found it strange, even unfair, but true. The caprice of fate. He reflected on how arbitrary life could be, how being born in one country versus another, in one era versus another, with one skin color or gender versus another, could determine the entire trajectory of a person's life. He saw that fate doesn't distribute its gifts fairly. Some are born with all the advantages, and others must climb mountains just to reach level ground. And so he lived his life not just accumulating wealth, but remembering where it began, with luck, timing, and a system that rewarded his particular talents. Moral of the story: gratitude with humility. This story teaches us that while hard work, discipline, and skill are essential, they are only part of the equation. Much of success, especially vast wealth, can trace its roots back to circumstances beyond our control. Important points to remember. 1. The ovarian lottery. Where and how you're born greatly shapes your future. Recognize the privilege of a fortunate start. 2. Systems matter. Economic and social structures determine how different talents and efforts are rewarded. 3. Unequal rewards. Our society often rewards financial acumen far more than equally or more important contributions like teaching or heroism. 4. Humility in success. Acknowledging luck fosters empathy for those with less and encourages responsible stewardship of wealth. 5. Use wealth wisely. Those who benefit most from the system have the power and perhaps the duty to help fix its imbalances. It's a mistake paying attention to the day-to-day fluctuations of a stock. It makes no difference. Understanding and teaching way. This quote is advising investors not to obsess over the daily ups and downs of stock prices. Stocks naturally fluctuate every day due to market sentiment, news, and many small factors. However, these short-term changes are mostly noise and don't reflect the true value or long-term potential of a company. When people constantly watch stock prices go up and down, they may feel anxious or emotional, leading to bad decisions like panic selling. Lose focus on long-term goals and investment strategy. React to short-term events instead of trusting the fundamentals of their investment. In teaching terms, it's like trying to judge a student's intelligence by checking their performance every single hour. It makes more sense to evaluate them over a semester or a year, right? Similarly, you judge a stock's performance over months or years, not days. Moral, point-wise. 1. Focus on the long-term growth, not daily price swings. 2. Stay calm and patient. Daily movements are natural and often meaningless. 3. Don't let emotions drive investment decisions. 4. Trust the fundamentals of the companies you invest in. 5. Investing is a marathon, not a sprint. Keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Understanding and teaching explanation. This quote gives practical advice, especially useful in life, business, and investing. 1. Keep things simple. Don't overcomplicate your plans or strategies. The more straightforward your approach, the easier it is to manage, understand, and succeed. Complexity often leads to confusion and mistakes. 2. Don't swing for the fences. This is a baseball metaphor. It means don't always go for huge, risky wins, like trying to hit a home run. Instead, aim for consistent, small successes. High-risk moves can lead to big losses. 3. When promised quick profits, respond with a quick no. If someone offers you fast and easy money, be skeptical. Most of the time, these are scams or risky deals. Financial success takes time, patience, and discipline. Saying no quickly protects you from regret later. Moral lessons, point-wise. 1. Simplicity is powerful. A clear and simple approach often wins over complex strategies. 2. Be consistent, not reckless. Small, smart steps are better than big, risky moves. 3. Avoid get-rich-quick traps. If it sounds too good to be true, it usually is. 4. Practice patience and discipline. Real success builds over time, not overnight. 5. Protect yourself with skepticism. Trust your gut and say no to shady or rushed opportunities. My idea of a group decision is to look in the mirror. Understanding and teaching way. This quote is a powerful and slightly humorous way of expressing individual responsibility and leadership. When someone says, "My idea of a group decision is to look in the mirror," they are implying that they make decisions independently, without needing to consult others. They trust their own judgment above all. In simple terms, imagine someone is in charge of making a decision for a team or group. Instead of discussing or debating with everyone, they just look in the mirror. meaning they ask themselves, trust their own experience, and then go ahead with what they believe is right. This quote is often used by leaders, entrepreneurs, or strong-willed individuals who are confident in taking responsibility without relying too much on group consensus. Moral in point-wise. 1. Believe in yourself. Trust your judgment when making important choices. 2. Take responsibility. Own your decisions without shifting blame. 3. Leadership needs confidence. Sometimes leaders must act decisively without waiting for group approval. 4. Balance is key. While independence is good, wise leaders also know when to seek advice. 5. Self-reflection is power. Looking in the mirror reminds us that the answers often lie within us. Managements that say or imply during a public offering that their stock is undervalued are usually being economical with the truth or uneconomical with their existing shareholders' money. Understanding and teaching explanation. Let's break this down in a simple and clear way. When a company goes public or offers new shares to the public, its management may sometimes say, "Our stock is undervalued." They're suggesting that investors are getting a bargain by buying it, but the quote warns us to be careful here. Being economical with the truth means they might not be telling the whole truth, or might be twisting it slightly. Uneconomical with their existing shareholders' money means they could be hurting the current shareholders by selling shares at a price lower than what the company is truly worth. So, if the stock were really undervalued, then issuing new shares at that low price would dilute the value for existing shareholders. That wouldn't be a smart move if management had their current investors' best interest in mind. In essence, this quote is calling out a contradiction. Either the management is not being honest about the stock being undervalued, or they are not acting wisely by selling something valuable at a cheap price, which harms current shareholders.
Moral
lessons, point-wise. 1. Be skeptical of undervaluation claims during public offerings. 2. Management should protect existing shareholders' value. 3. Honesty and financial wisdom must go hand in hand. 4. True undervaluation is rarely a reason to sell more shares, it's a reason to hold. 5. Investors should question the motives behind public statements in stock offerings. Long ago, Sir Isaac Newton gave us 3 laws of motion, which were the work of genius. But Sir Isaac's talents didn't extend to investing. He lost a bundle in the South Sea bubble, explaining later, "I can calculate the movement of the stars, but not the madness of men." If he had not been traumatized by this loss, Sir Isaac might well have gone on to discover the 4th law of motion. For investors as a whole, returns decrease as motion increases. Understanding and teaching explanation. This quote cleverly combines science, history, and financial wisdom. 1. Newton's genius in science. Sir Isaac Newton was a brilliant physicist who introduced the 3 famous laws of motion, which form the foundation of classical mechanics. He could predict how objects moved with precision, even the planets and stars. But 2. Newton's struggle in investing. Despite his brilliance in science, Newton failed as an investor. He got caught up in the South Sea bubble, a financial mania in the 1700s where investors poured money into a company whose stock price rose dramatically and then crashed. Newton lost a significant amount of money in the crash. 3. The famous quote. Newton himself admitted that while he could predict celestial movement, he couldn't understand or predict the irrational behavior of human beings, especially during a financial frenzy. Number 4. The imaginary 4th law of motion. The author jokingly suggests that if Newton had kept investing, he might have discovered another rule, a financial one. For investors as a whole, returns decrease as motion increases. This means the more frequently investors buy and sell, i.e. move, the lower their overall returns tend to be. Constant activity often leads to poor decisions, high transaction costs, and emotional investing. Her moral lessons, point-wise. 1. Intelligence doesn't guarantee investing success. Even the smartest minds can fall victim to emotional investing and market hype. 2. Human behavior is unpredictable. Markets are driven not just by numbers but by the psychology of people, fear, greed, and herd mentality. 3. Less activity often leads to better returns. Patience and long-term thinking usually outperform constant trading and chasing trends. 4. Learn from the past. History offers lessons. Even geniuses like Newton made mistakes. Wise investors study those mistakes to avoid repeating them. 5. Don't underestimate emotional control in investing. Discipline and calm decision-making often beat intelligence in financial success. Getting fired can produce a particularly bountiful payday for a CEO. Indeed, he can earn more in that single day while cleaning out his desk than an American worker earns in a lifetime of cleaning toilets. Forget the old maxim about nothing succeeding like success. Today, in the executive suite, the all-too-prevalent rule is that nothing succeeds like failure. Explanation in an understanding and teaching way. This quote points out the unfair contrast between high-level corporate executives, like CEOs, and everyday workers. Here's the breakdown. When a CEO is fired, they often receive a huge severance package, sometimes in the millions of dollars, even though they may have failed at their job. This severance can be so large it exceeds what a regular worker, like a janitor or toilet cleaner, might earn over their entire lifetime of hard work. Traditionally, the saying goes, nothing succeeds like success, which means if you're successful, more success follows. But now, especially in corporate culture, the opposite seems true. Even failing at a top job can bring huge rewards, especially for executives. In simple terms, CEOs can fail and still get rich, while hard-working people at the bottom often struggle just to survive. Moral, key learnings, point-wise. 1. Corporate systems can reward failure at the top more than hard work at the bottom. 2. Financial justice and fairness are not always present in the workplace. 3. Society needs to re-evaluate what kind of work is truly valued and rewarded. 4. We should question systems where effort and outcome are so disconnected. 5. Success should be based on contribution and responsibility, not just position. Charlie Munger and I love newspapers. We each read 5 a day. Understanding and teaching way explanation. This quote is from Warren Buffett, referring to himself and his longtime business partner, Charlie Munger. Here's how to understand it. Love newspapers. This shows how much they value staying informed. Newspapers offer a wide range of information: business, politics, world news, trends, etc. Each read 5 a day. This tells us how serious they are about learning. Reading 5 newspapers every single day requires discipline, curiosity, and a strong thirst for knowledge. Buffett and Munger are known for being lifelong learners. This habit of consuming a lot of diverse and high-quality information daily helped them make smarter decisions in investing and business. Teaching tip: if you want to grow smarter or make better decisions in life, career, or money, regularly consuming thoughtful and reliable information is one of the best habits to develop. Moral, point-wise. 1. Lifelong learning leads to long-term success. 2. Stay informed to make better decisions. 3. Discipline in habits builds a sharp and intelligent mind. Quality information is a powerful tool. Use it wisely. 5. If billionaires read 5 newspapers daily, there's something to learn from that habit. You can't precisely know what a stock is worth, so leave yourself a margin of safety. Only go into things where you could be wrong to some extent and come out okay. Understanding and teaching explanation. This quote is a valuable lesson in investing wisely and managing risk. Let's break it down in a simple and teaching-friendly way. 1. You can't precisely know what a stock is worth. This means no matter how smart or experienced you are, it's impossible to perfectly calculate the exact value of a stock or investment. There are too many unknowns: market conditions, company performance, global events, etc. But 2. So leave yourself a margin of safety. Since you can't be 100% sure, you should buy stocks or make decisions with a built-in cushion. For example, if you think a stock is worth $100, don't buy it at $100. Try to buy it at $70 or $80, so even if you're a little wrong, you're still safe. 3. Only go into things where you could be wrong to some extent and come out okay. Choose investments or make decisions where, even if you're not completely right, the outcome won't be a disaster. In simple terms, Avoid high-risk, all-or-nothing decisions. Play it smart and leave space for error. Moral 1. Accept uncertainty. No one can predict the exact value of anything perfectly. 2. Always create a margin of safety. Give yourself room for error in any decision. 3. Be conservative, not overconfident. Better to underestimate than overestimate. 4. Avoid risky bets. Don't go all in on something unless you can afford to be a little wrong. 5. Think long-term and wisely. Smart investing is about protecting your downside as much as aiming for upside. Borrowed money is the most common way that smart guys go broke. Understanding and teaching explanation. This quote means that even intelligent
Borrowed
or
money
successful
is the most
people
common
can
way
face
that
financial
smart guys
ruin
go
when they
broke.
misuse or over-rely on borrowed
Understanding
money,
and teaching
like
explanation.
loans, credit, or
This
debt.
quote means that even
It's not just
intelligent
about
or
borrowing.
successful people
It's about
can
how
face
borrowing
financial
can give a
ruin when they
false
misuse
sense of
or
power or
over-rely on borrowed
security.
money, like loans,
People may take
credit,
risks they
or
wouldn't
debt.
normally take if
It's
it
not
were their
just
own
about
money.
borrowing.
They
It's
might
about how
overinvest,
borrowing can give a
overspend,
false sense
or
of
assume
power
they'll
or
always
security.
win. But when
People
things
may
go
take risks
wrong,
they wouldn't
as they
normally
often
take
can
if it
in
were their
business
own
or
money.
investments,
They're
they're left
overinvest,
not only with losses but
overspend,
also with
or
debt they
assume
still
they'll
have to
always
repay.
win.
So,
But when
even
things
if
go
you're smart or
wrong,
capable,
as they often
debt can
in
be
business or
dangerous if not
investments,
handled wisely.
they're left not only with losses,
It can wipe
but
out
also
all your
with debt
progress
they
and
still
leave you
have to
worse off than
repay.
before.
So, even if you're smart
Moral
or capable,
lessons, point-wise.
debt can be
1.
dangerous if not
Use
handled
borrowed money
wisely.
with caution.
It can wipe out
2.
all your progress
Being
and
smart
leave you worse
doesn't
off than
guarantee
before.
immunity from financial mistakes.
Moral lessons,
3.
point-wise.
Debt increases
1.
risk.
Use
Even
borrowed
for the
money
best
with
planners.
caution.
4.
2.
Don't
Being
let
smart
confidence
doesn't
blind you to the
guarantee
danger of
immunity
borrowing.
from financial mistakes.
5. Always
3.
have a backup
Debt
plan when
increases
using other
risk,
people's
even
money.
for the best planners.
6. Success
4.
built on
Don't
debt
let
is
confidence
fragile.
blind you to the danger of borrowing. 5. Always have a backup plan when using other people's money. 6. Success built on debt is fragile. The happiest people do not necessarily have the best things, they simply appreciate the things they have. Understanding and teaching explanation. This quote teaches us a powerful life lesson about gratitude and contentment. Happiness isn't about owning the most expensive car, living in the biggest house, or wearing designer clothes. Some people may have everything money can buy but still feel empty or dissatisfied. On the other hand, truly happy people might not have the best or most luxurious things, but they feel rich because they value and cherish what they already have. It's not what you own that brings happiness. It's how you see and appreciate what you have. So if you can look at your life and find joy in small things like family, health, peace, or even a simple meal, you're already one of the happiest people. Moral of the quote, point-wise. 1. Gratitude brings happiness more than possessions. 2. Appreciating what you have leads to inner peace. 3. True joy comes from within, not from material things. 4. Contentment is the key to lasting happiness. 5. You don't need the best of everything to live a good life. There comes a time when you ought to start doing what you want. Take a job that you love. You will jump out of bed in the morning. I think you are out of your mind if you keep taking jobs that you don't like because you think it will look good on your resume. Isn't that a little like saving up sex for your old age? Understanding and teaching explanation. This quote is a powerful message about following your passion rather than blindly chasing what's practical or impressive on paper. There comes a time when you ought to start doing what you want. At some point in life, you must stop living for others' expectations and start pursuing what truly matters to you. Take a job that you love. You will jump out of bed in the morning. When you love what you do, work doesn't feel like a burden. You're excited, energized, and motivated every single day. I think you are out of your mind if you keep taking jobs that you don't like because you think it will look good on your resume. It's foolish to keep choosing jobs just for appearances or future opportunities if those jobs make you unhappy in the present. Isn't that a little like saving up sex for your old age? This humorous metaphor points out the absurdity of postponing joy and fulfillment. Life is happening now. Enjoy it while you can, rather than waiting for some right time that may never come. Moral life lessons, point-wise. 1. Follow your passion.
Life is too short to do work that doesn't fulfill you. 2. Choose a career that excites you. Enjoying your job boosts both happiness and productivity. 3. Don't live for your resume. Chasing prestige without purpose can lead to burnout and regret. 4. Live in the present. Don't delay joy or keep sacrificing today for a future that's uncertain. 5. Balance practicality with passion. It's smart to plan for the future, but never at the cost of your present well-being. In order not to make too many stupid things, it's enough to make a few very important things. Understanding and teaching explanation. This quote carries a deep and practical life lesson. Let's simplify and explain it in a way that's easy to understand. Life is full of choices and actions. Every day we do many small or big things. Sometimes we waste our time or energy on things that don't matter, and those can turn out to be stupid or unwise decisions. But the quote says, you don't need to try avoiding every small mistake. Instead, just focus on doing a few really important things well, things that actually matter. If you prioritize the right actions, the meaningful, thoughtful ones, they will guide your life in the right direction and reduce the chance of messing up too much. In short, doing a few key, meaningful things can protect you from doing many foolish or useless things. Example for students or learners: if you focus on truly understanding core concepts instead of trying to memorize everything, you'll do better overall and avoid making silly mistakes during exams or in real life. Example for daily life: instead of trying to do everything, focus on managing your time, health, and values. Just a few good habits, like saving money, eating healthy, and being kind, can prevent a lot of bad outcomes. Moral, point-wise: 1. Focus on what truly matters in life. 2. Doing a few important things right can reduce mistakes overall. 3. Quality is more valuable than quantity in our actions. 4. Wise choices lead to fewer regrets. 5. Don't try to do everything. Do the right things with care. If you hit a hole in every hole, you wouldn't play golf very long. Understanding and teaching explanation. This quote uses golf as a metaphor for life. In golf, a hole-in-one is a rare and perfect shot where the ball goes directly into the hole from the tee. It's exciting and special because it's difficult. Now imagine if every shot you made was a perfect hole-in-one. At first it might seem amazing, but soon it would become boring. There would be no challenge, no growth, no thrill of improving. Just like in life, if everything came easy, if there were no struggles, mistakes, or learning curves, life would feel empty and unfulfilling. We appreciate success more when we work for it, fail sometimes, and keep improving. So the quote teaches us that challenges and difficulties give life meaning. Failure is not a bad thing, it's part of the journey. The joy lies in the process, not just the result. Moral of the quote, point-wise: 1. Struggles make success meaningful. 2. Perfection without effort becomes boring. 3. Failures are essential for growth and excitement. 4. Enjoy the journey, not just the destination. 5. True satisfaction comes from overcoming challenges. Lethargy bordering on sloth should remain the cornerstone of investment style. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, may sound a bit humorous or ironic at first, but it carries a deep and important message about how to approach investing. Let's break it down in a simple and teaching way. Lethargy means a lack of energy or eagerness. Sloth is one of the 7 deadly sins and basically means laziness. Cornerstone means the most important foundation or principle. So the quote is saying, being extremely passive, almost lazy, should be the main strategy when it comes to investing. But why would laziness be a good thing in investing? Because this kind of laziness refers to patience and discipline, not carelessness. It means don't try to constantly buy and sell stocks. Don't chase quick profits or jump from one hot trend to another. Instead, invest in good companies and hold them for the long term. This approach avoids emotional decisions and reduces mistakes, taxes, and transaction costs. Think of it like planting a tree. You don't dig it up every week to see if it's growing. You plant it, water it, and let time do its magic. That's what this quote is all about. Moral, key takeaways point-wise. 1. Patience is powerful in investing. Great results come over time. 2. Avoid overtrading. Frequent buying and selling often hurts more than it helps. 3. Stick to a long-term strategy. Don't get distracted by market noise. 4. Do your homework once and trust your choices. If you've chosen well, let them grow. 5. Simplicity and discipline beat complexity and hype. Life is like a snowball. The important thing is finding wet snow and a really long hill. Understanding and teaching explanation. Imagine you're rolling a snowball at the top of a snowy hill. If the snow is too dry or powdery, it won't stick together. But if it's wet and sticky, the snowball grows bigger as it rolls. And if the hill is long, it has more time to grow and pick up speed. Warren Buffett uses this image to explain how success, especially in life or investing, builds over time. The wet snow means the right resources, people, or opportunities. The long hill represents time and consistency. When you combine the right foundation with long-term effort, your progress compounds and grows bigger, just like a snowball rolling downhill. This is especially true in learning, investing, personal growth, or building good habits. Start small, keep at it, and let momentum work in your favor. Moral, in point-wise format. 1. Start small, but start early. Even a small snowball can grow huge with time and momentum. 2. Choose the right foundation. Like wet snow, success needs the right ingredients: smart choices, good habits, or supportive people. 3. Be consistent and patient. The longer you stick with something good, the more it grows. 4. Let time and momentum work for you. Progress compounds over time. Stay steady and trust the process. 5. Avoid shortcuts. Just like a short hill won't grow the snowball much, rushing through life won't give you lasting growth. Never test the depth of the river with both feet. Understanding and teaching way. This quote is a metaphorical piece of wisdom. Let's break it down for better understanding. Imagine you are standing in front of a river and you don't know how deep it is. If you jump in with both feet, you risk drowning if the water is too deep. Instead, the wise way would be to test with one foot first, check how deep and safe it is, and then decide whether to proceed. So, in real life, the quote advises, don't take big risks all at once, especially when you are unsure of the situation. Test or explore things carefully and gradually before fully committing. Whether it's business, relationships, or new experiences, avoid jumping in blindly without preparation. Moral and points. 1. Think before you act. Don't rush into uncertain situations. 2. Take small calculated steps before making big decisions. 3. Avoid unnecessary risks when the outcome is unknown. 4. Be cautious and plan ahead to stay safe and successful. 5. Wisdom lies in testing the waters first, not in diving in head first. The stock doesn't know you own it. You have feelings about it, but it has no feelings about you. The stock doesn't know what you paid. People shouldn't get emotionally involved with their stocks. Understanding and teaching explanation. This quote teaches a valuable lesson about emotional discipline in investing. Let's break it down step by step. The stock doesn't know you own it. A stock is just a piece of ownership in a company. It doesn't care who owns it. Whether you're a billionaire or a beginner investor, the stock behaves the same way. You have feelings about it, but it has no feelings about you. Investors often develop emotional attachments to their stocks. You might feel excited when the price goes up or frustrated when it goes down. But the stock isn't aware of your feelings. It just reacts to market forces. The stock doesn't know what you paid. Whether you bought the stock at a high price or got it on a discount, the market doesn't care. The stock moves based on broader factors, not your personal purchase price. People shouldn't get emotionally involved with their stocks. Emotions like fear, hope, and greed can cloud judgment. Smart investing requires rational thinking. Decisions should be based on analysis and facts, not emotional attachment or panic. Moral of the quote, point-wise. 1. Stay emotionally detached from your investments. 2. Make decisions based on logic, not feelings. 3. Don't take market movements personally. 4. Focus on facts, research, and long-term goals. 5. Accept that the market is indifferent to your personal situation. The Era of Thoughtless Investing, a tale from the 1970s. Once upon a time, in the bustling financial world of the early 1970s, a strange spell was cast upon the minds of many of the most powerful players in the stock market: institutional investors. These were the giants: pension funds, mutual funds, insurance companies, the kind of investors whose moves could sway markets. But despite their size and influence, they began to follow a new and curious doctrine that was spreading like wildfire from the ivy-covered halls of the world's most prestigious business schools. At these schools, a new theory was being taught with great confidence and enthusiasm. Professors and scholars, who had never managed a single portfolio, stood before packed lecture halls and proclaimed, "The stock market is totally efficient." According to this theory, every stock price already reflected all known information. Therefore, it was futile to analyze businesses, study their operations, or calculate their intrinsic value. The only thing that mattered was the market price. Thinking, analyzing, and understanding were considered old-fashioned and even unnecessary. Many institutional investors, dazzled by the academic credentials and sophisticated formulas, eagerly adopted this new way of thinking. They began buying and selling stocks without much regard to what the businesses behind them were actually worth. They were no longer investors, they were speculators, treating the market as a casino where prices, not value, were the only cards that mattered. But not everyone fell for the spell. A small group of thoughtful investors, people like Warren Buffett, watched in amazement as their opponents abandoned common sense in favor of academic theory. To them, the idea that stock prices always reflected true value was laughable. After all, if no one was doing the hard work of valuing businesses, how could prices possibly be right? Buffett and others like him quietly continued to study companies, analyze balance sheets, and assess long-term value. And in the intellectual contest of investing, they found themselves with a huge advantage. As Buffett once wryly put it, what could be more advantageous in an intellectual contest, whether it be bridge, chess, or stock selection, than to have opponents who have been taught that thinking is a waste of energy? Moral of the story: never abandon your ability to think critically, even when the crowd and the experts say otherwise. Important points to remember. 1. The efficient market hypothesis, EMH, became popular in the 1970s, leading many to believe that stock prices always reflect true value. 2. Institutional investors largely embraced this idea, reducing the role of business analysis in investing decisions. 3. This created an environment where rational, value-based investors had a distinct advantage. 4. Critical thinking, patience, and fundamental analysis are timeless tools in investing. 5. Just because an idea is widely accepted doesn't make it right, especially when it encourages laziness in thinking. I bought a company in the mid-90s called Dexter Shoe and paid $400 million for it. And it went to zero, and I gave about $400 million worth of Berkshire stock, which is probably now worth $400 billion. But I've made lots of dumb decisions. That's part of the game. Understanding and teaching explanation. This quote is from Warren Buffett, one of the most successful investors of all time. Here's what he means, broken down simply. I bought a company, Dexter Shoe. In the 1990s, Buffett acquired a shoe company named Dexter Shoe, believing it would be a great investment. Paid $400 million, and it went to zero. He paid a huge amount, $400 million for it, but the business failed and became worthless over time. Gave about $400 million worth of Berkshire stock. Instead of paying in cash, he used Berkshire Hathaway stock, his company's shares, to make the purchase. Now worth $400 billion. The value of the stock he gave away would have grown massively if he had kept it, likely to $400 billion today. I've made lots of dumb decisions. Part of the game. Even though he's a legendary investor, he admits he makes mistakes. Losses and bad decisions are a natural part of learning and growing in any field, including investing. Moral lessons point-wise. 1. Everyone makes mistakes, even the best. No one is perfect. Even successful people make bad decisions. 2. Learn from failure. Mistakes are not the end, they are lessons for future growth. 3. Don't fear risk, but be wise. Taking risks is part of success, but evaluating them carefully is crucial. 4. Own your decisions. Buffett openly admits his error. Taking responsibility shows true leadership. 5. Long-term thinking matters. The value of patience and long-term planning, like holding on to valuable stock, can be massive. 6. Stay humble. Even billionaires have regrets. Humility is a sign of wisdom. A fool and his money are soon invited everywhere. Understanding and teaching explanation. This quote is a witty twist on the more well-known proverb, "A fool and his money are soon parted." But here it says, invited everywhere. And that's intentional and ironic. Explanation. A person who has money but lacks wisdom, a fool, often becomes popular, not because of who they are, but because people want access to their money. Such people get invited to parties, gatherings, and social events, not out of genuine affection or respect, but because others hope to benefit from their wealth. It's a cautionary quote. Money can attract fake friends and opportunists. Teaching way. Simple terms. Imagine someone who won the lottery but doesn't know how to manage money. Suddenly, everyone wants to be their friend, take them out, or invite them to expensive places. Why? Because they think the person will pay. But once the money is gone, those friends disappear too. So it teaches us that being wise is more important than just being rich. Moral, point-wise. 1. Wealth without wisdom attracts the wrong crowd. 2. Being smart with money is more important than simply having it. 3. People may pretend to like you for what you have, not who you are. 4. Beware of fake friendships based on personal gain. 5. True friends value you, not your wallet. The rich are always going to say that, just give us more money and we'll go out and spend more, and then it will trickle down to the rest of you. But that has not worked the last 10 years, and I hope the American public is catching on. Understanding and teaching way. Simple explanation. This quote is criticizing a common economic idea known as trickle-down economics. This theory suggests that if wealthy people or big businesses are given more money through tax cuts or financial benefits, they will invest or spend more. The hope is that this spending will eventually benefit everyone in society, including the middle class and poor. But what the speaker is saying is this: rich people always support this idea because they benefit directly from it. They claim that their spending will eventually help others. However, in reality, this strategy hasn't helped the general public much over the past 10 years. The speaker is warning and hoping that regular people, especially Americans, are starting to understand that this approach doesn't really work. So, it's a call to question this economic belief and to realize that giving more money to the rich doesn't automatically mean a better life for everyone else. Moral key takeaways, point-wise. 1. Question popular economic theories, especially if they seem to benefit only the wealthy. 2. Trickle-down economics doesn't always help the majority. 3. Wealthy people may push policies that serve their own interests. 4. Economic growth should be inclusive, not just top-heavy. 5. Citizens should stay informed and critically think about what truly benefits society. History and results matter more than promises. Observe the actual impact. Diversification may preserve wealth, but concentration builds wealth. Understanding and teaching. This quote speaks about two common strategies in investing and wealth creation. 1. Diversification, safety net. Diversification means spreading your investments across various assets, like stocks, real estate, gold, etc. This approach helps preserve wealth because if one investment performs poorly, others may balance out the loss. It's like not putting all your eggs in one basket. 2. Concentration equals focused growth. Concentration means putting a significant portion of your investment in one area you believe in, like a specific business or stock. This strategy can build wealth faster, but it's also riskier. If your concentrated bet is right, you could earn a lot more. This is how many successful entrepreneurs and investors, like Warren Buffett or Elon Musk, built massive fortunes. Simple analogy, diversification is like a buffet. You try many dishes and you won't go hungry if one isn't great. Concentration is like betting on one dish. You could either have the best meal or be very disappointed. Moral key takeaways, point-wise. 1. Diversify to protect your existing wealth from big losses. 2. Concentrate if you want to grow your wealth significantly, but only when you have deep knowledge and confidence. 3. Balance is key. Start with concentration to build, then diversify to protect. 4. Understand your risk tolerance before choosing between the two strategies. 5. Wealth building requires strategy, discipline, and sometimes bold, focused decisions. The best business returns are usually achieved by companies that are doing something quite similar today to what they were doing 5 or 10 years ago. Understanding and teaching explanation. This quote emphasizes consistency and focus in business. Let's break it down in a simple and teaching-friendly way. Companies that succeed in the long run often stick to their core strengths. They don't constantly jump into new trends or try to reinvent themselves completely. Instead, they refine, improve, and evolve the business they were already good at 5 or 10 years ago. This doesn't mean no innovation. It means innovation happens within a clear and steady direction, not by constantly changing paths. Example to understand. Think of a restaurant that's been making great pizza for 10 years. They might improve their recipe, offer delivery, or redesign their place, but they're still focused on pizza. That focus builds trust, quality, and loyalty, which brings good returns over time. Moral key takeaways, point-wise. 1. Consistency builds trust and long-term value. 2. Sticking to core strengths often leads to steady and strong returns. 3. Gradual improvement is better than constant drastic change. 4. Successful businesses evolve with purpose, not by chasing every new trend. 5. A clear and focused vision helps in building brand identity and customer loyalty. Money, to some extent, sometimes lets you be in more interesting environments, but it can't change how many people love you or how healthy you are. Understanding and teaching explanation. This quote means that money has its limits. It can help you experience new places, better living conditions, or exciting opportunities, like traveling, attending events, or working in creative spaces. However, it cannot buy true love or genuine relationships. You can't pay people to truly care for you. Also, money can't guarantee good health. While it can buy access to healthcare, it can't prevent illness or give you a strong body and mind automatically. So, while money has its usefulness, it's not the key to everything that truly matters in life. Moral, point-wise. 1. Money is useful but limited. It can improve lifestyle but not everything. 2. Love and relationships are earned, not bought. 3. Health is maintained through habits, not wealth. 4. True happiness comes from emotional and physical well-being, not just financial success. 5. Focus on what money can't buy: love, time, and health. The Tale of Liquor and Leverage, a lesson in self-destruction and self-reliance. There once was a young man named Arjun who had all the signs of becoming very successful. He was bright, driven, and had a sharp eye for business. After graduating from a top university, he landed a job at a promising investment firm. There he quickly rose through the ranks, earning respect and admiration. But success, as they say, is a double-edged sword. It can build you up, and if you're not careful, it can also blind you. Arjun enjoyed celebrating. What started as a weekly drink with friends soon turned into a nightly ritual. The stress of work gave him an excuse, and the praise he received made him feel invincible. He could handle it, or so he thought. "I'm just blowing off steam," he'd say, chuckling as he poured another glass. At the same time, Arjun grew impatient. While his peers were growing slowly and steadily, he wanted more, faster. So he began using borrowed money to invest in bigger and riskier ventures. "Why not use leverage?" he told himself. "It's what the big guys do. I'll multiply my profits." For a while it worked. The borrowed money helped him secure big deals, and his confidence soared. But the cracks beneath the surface began to widen. His drinking started affecting his judgment. He missed details in deals, made impulsive decisions, started chasing losses. Then came the downturn. The market shifted. One highly leveraged investment fell apart, then another. The banks came calling. Arjun wasn't just losing his own money, he was losing money he didn't even have. With no safety net, his empire crumbled overnight. He sat alone in his now empty apartment, the clink of an empty bottle echoing around the room. The lesson hit him hard. Liquor clouded his mind, and leverage cut his feet from beneath him. Moral of the story: strength lies not in how fast you grow, but in how solidly you build. You don't need liquor to feel bold or leverage to feel rich. If you're truly smart, you can build wealth patiently, without risking what you can't afford to lose. Important points to remember. Liquor dulls judgment. Even the smartest minds can make foolish decisions under its influence. Leverage, borrowed money, is a double-edged sword. It magnifies gains, but it also magnifies losses. When things go wrong, debt can destroy everything. You don't need leverage to succeed. Many great investors and entrepreneurs have built their fortunes steadily, using discipline, knowledge, and patience, not debt. Stay humble during success. Overconfidence can lead to risky behavior. Wisdom is knowing your limits. Predicting rain doesn't count. Building arcs does. Understanding and teaching explanation. This quote uses the biblical story of Noah to make a powerful point about action over mere prediction. Predicting rain represents awareness, talking about problems, or understanding what's coming, like noticing a risk, trend, or potential danger. Building arcs, on the other hand, symbolizes taking action, preparing, and doing the work to protect yourself or others from that danger. In other words, just knowing or talking about a problem is not enough. What truly matters is how you respond and what steps you take to solve or prepare for it. Imagine someone saying, "There might be an exam soon," but they don't study. That's like predicting rain and not building an ark. The wise person studies. That's building the ark. Moral key takeaways, point-wise. 1. Action matters more than awareness. 2. Preparation is the key to survival and success. 3. Don't just talk about problems, solve them. 4. It's better to act early than regret later. 5. Wisdom is in doing, not just knowing. Of the billionaires I have known, money just brings out the basic traits in them. If they were jerks before they had money, they are simply jerks with $1 billion. Explanation, understanding, and teaching way. This quote means that money does not fundamentally change a person's true nature or character. Instead, it acts like a magnifying glass, amplifying who they already are. If someone was kind, humble, or generous before they became rich, those traits will likely show more when they have wealth. But if they were rude, arrogant, or selfish before, their money will only make those qualities more visible and powerful. Think of money as a tool or a mirror. It doesn't transform someone into a new person. It simply gives them the freedom and power to express their real self more openly. Moral in point-wise. 1. Money reveals, not changes, a person's true character. 2. Wealth amplifies who you already are, good or bad. 3. Personal values and behavior matter more than financial status. 4. True richness comes from character, not cash. 5. Cultivate kindness and humility before seeking wealth. We have learned to turn out lots of goods and services, but we haven't learned as well how to have everybody share in the bounty. The obligation of a society as prosperous as ours is to figure out how nobody gets left too far behind. Understanding and teaching explanation. This quote highlights a powerful idea about progress and fairness in society. Here's how to understand it clearly. We have learned to turn out lots of goods and services. This means that modern society has become very good at producing things: food, technology, clothing, homes, and more. Our economies are strong and capable of creating great wealth. But we haven't learned as well how to have everybody share in the bounty. Despite all the wealth and progress, not everyone benefits equally. Some people still live in poverty, don't have access to quality healthcare, education, or housing. The obligation of a society as prosperous as ours. In a wealthy society like ours, we have a responsibility, a moral duty, to take care of each other, is to figure out how nobody gets left too far behind. The goal should be to create a fair system where everyone, no matter their background or situation, has a chance to succeed and live a good life. No one should be left struggling while others thrive. Moral of the quote, point-wise. 1. Economic progress should be matched with social fairness. 2. A strong society helps uplift everyone, not just a few. 3. Compassion and responsibility are key in a prosperous world. 4. We must not only focus on growth but also on equal opportunity. 5. A truly advanced society is one where no one is left behind. If you cannot control your emotions, you cannot control your money. Understanding and teaching explanation. This quote means that emotions play a huge role in how we make financial decisions. If we let feelings like fear, greed, anger, or excitement control us, we might make poor money choices, like overspending, panic selling, or gambling on risky investments. For example, if you get too excited, you might buy things you don't need. If you're afraid, you might sell investments too early and miss long-term gains. If you're angry or stressed, you might make impulsive financial decisions as a form of emotional relief. In short, emotional discipline is essential in managing money wisely. Just like you wouldn't drive a car recklessly based on how you feel, you shouldn't handle money that way either. Moral. Lessons, point-wise. 1. Stay calm and think before spending or investing. 2. Avoid making financial decisions when emotionally charged. 3. Emotional control leads to better money management. 4. Discipline and patience are key to financial success. 5. Smart money habits require a stable and thoughtful mindset. If you don't find a way to make money while you sleep, you will work until you die. Understanding and teaching explanation. This quote by Warren Buffett is a powerful lesson about financial independence and smart investing. Understanding. The quote means that if your only source of income is the work you do during the day, you'll always have to keep working. As long as you exchange your time for money, a job, for example, your income stops when you stop working. To become truly financially free, you need to create sources of passive income, money that comes in even when you're not actively working. Teaching way, simple explanation. Imagine you're planting seeds. If you plant them and take care of them well, they will grow into trees and give you fruit every season, even if you're not out there every day working on them. The same goes for money. If you invest your time and money wisely now, like starting a business, investing in stocks, real estate, or creating digital products, it will start earning for you while you sleep. So instead of working your whole life to earn money, your money will start working for you. Moral lessons in point form. 1. The big question about how people behave is whether they've got an inner scorecard or an outer scorecard. It helps if you can be satisfied with an inner scorecard. Explanation in an understanding and teaching way. This quote, often attributed to Warren Buffett, talks about how we evaluate ourselves and our actions in life. Inner scorecard. This means you judge yourself based on your own values, beliefs, and what you think is right or wrong. It's internal. You do things that align with your principles, even if others don't notice or praise you for it. Outer scorecard. This means you judge yourself based on what others think of you, how they view your success, your image, and your decisions. It's all about external validation. The quote suggests that it's better and healthier if you can be satisfied with an inner scorecard. That way, your happiness and self-worth don't depend on what others say or think. You stay true to yourself, even in a world full of outside opinions and judgments. Think of it like this. Are you doing something because you believe it's right, or because you want others to approve of it? This question helps guide our behavior, choices, and the way we live our lives. Moral life lessons, point-wise. 1. Be true to yourself. Don't compromise your values just to please others. 2. Judge your actions by your own standards, not by public opinion. 3. Don't chase approval. It's impossible to satisfy everyone, so focus on satisfying yourself. 4. Build inner confidence. When you follow your own moral compass, you become mentally stronger. 5. Personal growth comes from within, not from outside praise or criticism. I am not in the business of predicting general stock market or business fluctuations. If you think I can do this or think it is essential to an investment program, you should not be in the partnership. Explanation, understanding and teaching way. This quote emphasizes a key principle in investing, not relying on market predictions. The speaker is making it clear that they do not try to forecast whether the overall stock market or economy will go up or down in the short term. They're saying, I don't claim to know where the market is heading. I don't base my investment decisions on short-term ups and downs. If you expect that kind of foresight from me, or think it's necessary to invest wisely, then this investment strategy or partnership is not right for you. It's a reminder that successful investing is more about long-term thinking, choosing solid companies, and not reacting emotionally to market noise. Moral lessons, point-wise. Avoid trying to predict market movements. 2. Successful investing doesn't rely on short-term forecasts. 3. Long-term thinking and discipline are key to investment success. 4. Don't expect anyone to consistently predict the market, because it's nearly impossible. 5. Choose an investment strategy that aligns with realistic expectations. Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless. Understanding and teaching explanation. This quote emphasizes how important reputation is in business, even more than money. It was famously said by Warren Buffett, one of the most successful investors of all time. Here's a breakdown to understand it better. Lose money for the firm, and I will be understanding. Mistakes happen, especially in business. Losing money might come from taking risks or bad luck. The speaker is saying, it's okay to make financial mistakes. We can learn from them. Lose a shred of reputation for the firm, and I will be ruthless. But if your actions damage the company's reputation, its trust, integrity, and image, then that's unacceptable. Even a small stain on character can cause long-term harm that money can't fix. That's why the speaker says they will not tolerate it at all. In simple terms, money can be regained. Reputation once lost is almost impossible to rebuild. Moral lessons, point-wise. 1. Integrity matters more than profits. Your honesty and trustworthiness define your long-term success. 2. Mistakes are okay if you learn from them. Financial losses can be recovered. They're part of learning and growth. 3. Don't compromise on ethics. Even one bad decision can destroy years of hard-earned respect. 4. Guard your reputation like a treasure. It's your most valuable asset, personally and professionally. 5. Character builds lasting business relationships. People invest in those they trust, not just in those who profit. Dive in early, the tale of a young investor. Chapter 1. A curious boy and a mountain of books. In the heart of Omaha, there lived a boy who was different from the others his age. While most kids chased baseballs or traded marbles, this boy chased ideas. He wasn't after toys or treasures, he was after knowledge. By the age of 10, he had done something remarkable. He had read every single book about investing in the Omaha Public Library, some of them not once, but twice. He wasn't just flipping pages. He was trying to understand how money worked, how businesses grew, and how wealth was built. His mind, though young, was filled with the voices of different authors, each offering their version of the investing world. Fill your mind with various competing thoughts, he would later say, and decide which makes sense. Chapter 2. From pages to practice. Books gave him knowledge, but he knew they weren't the final step. Learning about investing without ever investing, he realized, was like reading a romance novel and thinking you understood love. There was theory, and then there was real life. So, with a few dollars he had saved, birthday money, nickels from chores, he made his first investment. It wasn't a lot, but it was his. That small step into the market taught him more in weeks than books had in months. He watched prices move, he felt excitement, he felt doubt, but most importantly, he felt engaged. He was no longer a reader, he was a participant. Chapter 3: The Power of Early Steps. Many adults wait. They say they'll invest when they're older, when they have more money, when they feel ready. But the boy from Omaha knew better. He knew that time was the most powerful force in investing, more powerful than picking the perfect stock or timing the market just right. The earlier you start, the more time your money has to grow, and the more you learn from experience. And so, with every tiny investment, he grew. Not just his bank balance, but his wisdom. Moral of the story: books build the foundation, but action builds the understanding. Start small, start early, and let time and experience be your greatest teachers. Important points to remember: read broadly. Don't stick to one opinion. Explore multiple viewpoints and form your own understanding. Think critically. Not every idea will make sense. Learn to filter what's useful from what's noise. Take action. Knowledge without action is like a map never used. Start small and learn by doing. Experience matters. Real-world investing teaches lessons that no book can fully prepare you for. Start early. Time is your biggest ally. The sooner you begin, the more powerful your growth. Buy a stock the way you would buy a house. Understand and like it such that you'll be content to own it in the absence of any market. Understanding and teaching explanation. This quote is about investing with wisdom and patience, especially in the stock market. Let's break it down. Buy a stock the way you would buy a house. When people buy a house, they don't do it randomly. They research, visit the location, check the condition, neighborhood, future value, and whether they would enjoy living in it. Similarly, you should approach buying a stock with the same level of care and thought. Don't just jump in because someone else said it's good. Understand and like it. Know what the company does, how it earns money, its strengths, weaknesses, and potential. You should personally feel good about owning it, not just rely on others' opinions, such that you'll be content to own it in the absence of any market. Imagine there's no stock market to sell the stock tomorrow, or even for years. Would you still be happy holding that company just because you believe in it? If yes, that's a wise investment. If no, maybe you're just gambling, not investing. Moral key lessons, point-wise. 1. Do deep research before investing, like buying a home. 2. Invest in businesses you understand and believe in. 3. Don't depend on daily price movements or trends. 4. Have the patience to hold your investment long-term. 5. Buy with confidence, not just for quick profit. 6. If a company is truly great, market ups and downs won't shake your trust in it. What we do is not beyond anyone else's competence. I feel the same way about managing that I do about investing. It's just not necessary to do extraordinary things to get extraordinary results. Understanding and teaching explanation. This quote, often attributed to legendary investor Warren Buffett, carries a powerful yet humble message. Let's break it down part by part. 1. What we do is not beyond anyone else's competence. This means that the work we are doing isn't some kind of secret magic or genius-level task. Anyone with the right mindset and discipline can learn and do it. 2. I feel the same way about managing that I do about investing. The speaker treats managing people or businesses with the same philosophy he applies to investing. Simple principles, applied consistently and patiently. 3. It's just not necessary to do extraordinary things to get extraordinary results. This is the core idea. Success doesn't require big, flashy actions. Instead, consistent, smart, and disciplined efforts often lead to amazing outcomes. You don't have to be a genius, just do the basics really well, repeatedly. Moral key lessons, point-wise. 1. Simplicity works. Great results often come from doing simple things consistently, not from complex or risky actions. 2. Discipline beats genius. You don't need to be exceptionally talented. You just need to be disciplined and focused. 3. Learnable skills. Anyone can achieve success by learning and applying core principles effectively. 4. Consistency is key. It's not about doing one big thing, but doing small things right every day. 5. Stay humble. True mastery comes with humility and the understanding that greatness is accessible to all who are willing to learn and grow. There is nothing wrong with a know-nothing investor who realizes it. The problem is when you're a know-nothing investor, but you think you know something. Understanding and teaching explanation. This quote is about self-awareness and humility in investing. A know-nothing investor is someone who doesn't have much knowledge or experience in investing. There's no shame in being this kind of investor, as long as you recognize your limits. The real danger comes when someone doesn't know much, but they believe they do. This can lead to overconfidence, risky decisions, and big losses. Think of it like this. If you know you can't swim well, you'll stay near the shallow end or wear a life jacket. But if you think you're a pro swimmer when you're not, and you jump into the deep ocean, you're in real trouble. In investing, recognizing that you're a beginner allows you to ask for help, stick to safer choices, like index funds, avoid emotional or irrational decisions. But if you falsely believe you're an expert, you might take unnecessary risks, ignore warnings or advice, lose your money by following gut feelings or trends blindly. Moral, key takeaways, point-wise. 1. Know your limits. It's okay to not know everything, but be honest about it. 2. Avoid overconfidence. Thinking you know more than you do can be dangerous. 3. Stay humble and keep learning. Good investors grow through curiosity and experience. 4. Make decisions wisely. Base your choices on facts and understanding, not assumptions. 5. Play it safe when unsure. If you're not confident, go for low risk or professional guidance. 6. Seek help when needed. It's smart to rely on expert advice when you're still learning. Investing is forgoing consumption now in order to have the ability to consume more at a later date. Understanding and teaching explanation. This quote means that when you invest, you are choosing not to spend your money today so that it can grow and give you more financial benefits in the future. Imagine you have 100. You could use it now to buy something you want, like snacks or a small gift. But if you invest that 100 in something that grows in value, like a savings plan, mutual fund, or stock, it might become 150 or 200 in the future. Then you can buy more than you could have today. It's a little like planting a seed instead of eating it. You wait, take care of it, and later you can enjoy the fruit from a tree instead of just one seed. So investing is about delayed gratification, sacrificing a little today for a lot more tomorrow. Moral key takeaways. 1. Think long term. Small sacrifices today can bring big rewards later. 2. Practice patience. Good things take time to grow. 3. Be financially wise. Don't spend everything you have now. Let some of it work for your future. 4. Invest in growth. Your money can grow if you give it the chance. 5. Value the future. What you do today impacts your tomorrow. When trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. Understanding and teaching explanation. This quote, often attributed to legendary investor Warren Buffett, offers a sharp critique of the financial industry, especially big investment firms on Wall Street. Here's a simplified breakdown. When trillions of dollars are managed, this means that an enormous amount of money belonging to individuals, companies, and institutions is invested through professional firms by Wall Streeters charging high fees. These firms or managers take a significant percentage as fees for managing that money, regardless of how well or poorly the investment performs. It will usually be the managers who reap outsized profits, not the clients. Even if the investors, clients, don't earn much or even lose money, the managers still earn large profits from the fees they charge. So, the people running the show make money either way, while the actual investors might not. In essence, the quote warns that high management fees can erode clients' returns, and the real beneficiaries of these investments may be the managers, not the investors. Moral, in point-wise form. 1. Be cautious of high fees when choosing investment managers or funds. 2. Understand how your money is being managed. Transparency is crucial. 3. Always check if the fee structure aligns with your goals, not just theirs. 4. Smart investing isn't just about returns, it's also about costs. 5. Long-term wealth is built by reducing unnecessary expenses, including hefty management fees. 6. Don't blindly trust big firms. Do your homework before investing. The illusion of safety. A long-term investor's tale. Once upon a time in Marketville. In a quiet town called Marketville lived 3 friends who were wise and forward-thinking. Penny, Dean, and Grace. All 3 had big dreams for the future. Penny wanted to retire peacefully, Dean managed a college endowment, and Grace was in charge of a large pension fund. They each had decades to go before they needed to use the money they were managing. One day, a smooth-talking investment advisor visited the town. "Friends," he said confidently, "if you want to be safe, fill your portfolios with bonds. Stocks are risky. The more bonds you have, the safer your investments will be." The idea sounded logical. After all, bonds didn't bounce up and down in value like stocks did, so Penny shifted half her savings to bonds. Dean adjusted the college's endowment to 70% bonds. Grace moved the pension fund to a conservative mix heavy in fixed income. Years passed. Stock markets surged. Though there were some scary dips, the overall trend was upward, driven by innovation, productivity, and growth. Bonds, meanwhile, crept up at a turtle's pace, sometimes even losing purchasing power due to inflation. One day, the trio met again. "I feel safe," Penny said, "but my portfolio barely grew." Dean frowned. "The college fund isn't keeping up with tuition increases. We might have to cut scholarships." Grace looked worried. "Our pension liabilities are growing faster than our investments. How will we pay everyone?" Then came a visit from a seasoned investor named Warren, who had seen many market cycles. He chuckled kindly and said, "You made a mistake, one many make. You measured risk by your portfolio's bond-to-stock ratio. But for long-term goals, that's not the true risk." The lesson. What is true investment risk? Warren explained, "Real risk isn't short-term volatility, it's failing to meet your long-term goals. Stocks may fluctuate, but over the long run they tend to outpace inflation and grow wealth. Bonds, while stable, often offer returns too low to build lasting value. If you don't grow your assets enough to meet future needs, that's the real danger." He added, "For long-term investors like you 3, it's not about avoiding ups and downs. It's about compounding growth over time." Moral of the story. Measuring investment risk by the ratio of bonds to stocks is a terrible mistake for long-term investors. True risk is not market fluctuation, but the failure to grow wealth over time. Important points to remember. 1. Volatility risk. Short-term price swings are not the same as long-term risk. 2. Long-term horizon equals growth assets. The longer your horizon, the more stocks should play a role. 3. Bonds provide stability, not growth. Great for short-term needs or stability, but not for building long-term wealth. 4. Inflation is a silent threat. Fixed income investments can lose value in real terms over decades. 5. Goals first, asset mix second. Choose your portfolio based on your future needs, not your comfort with fluctuations. Charlie Munger and I view the marketable common stocks that Berkshire owns as interests in businesses, not as ticker symbols to be bought and sold based on their chart patterns, the target prices of analysts, or the opinions of media pundits. Understanding and teaching explanation. This quote is by Warren Buffett, referring to how he and Charlie Munger, his longtime business partner, think about investing in stocks. Let's break it down in a simple way. Marketable common stocks means the shares of companies that anyone can buy or sell in the stock market. Interests in businesses means they don't just see these shares as numbers or prices going up and down, they see them as partial ownership of real companies. They don't follow the crowd by making decisions based on chart patterns, technical analysis or trends, target prices set by analysts who predict stock prices, media opinions, TV experts or online influencers. Instead, they focus on the actual value and performance of the business itself, its profits, leadership, future potential, and more. This is the heart of value investing. Buy good companies and hold them for the long term, rather than trying to predict short-term price moves. Moral lessons in point-wise format. 1. Invest in businesses, not just stocks. Always look at what the company does, not just its stock price. 2. Think long term. Good businesses grow with time. Don't chase quick profits. 3. Avoid noise. Don't blindly follow charts, analyst targets, or media hype. 4. Do your own research. Understand the business before investing. 5. Ownership mindset. When you buy a stock, act like you own part of the company. The smartest side to take in a bidding war is the losing side. Understanding and teaching explanation. Imagine two people are fighting over something they both want. Maybe a house, a car, or even an idea. They keep increasing their bids, trying to outdo each other. This is what we call a bidding war. Now, at first glance, it seems like the winner, the one who finally gets the item, is the smart one. But this quote flips that idea. It says the smartest move is to be on the losing side. Why? Because in bidding wars, especially emotional or high-stakes ones, people often overpay or invest too much energy or money just to win. They get caught in the competition and forget to ask, is this even worth it? So the person who steps back and says, no, it's not worth that much to me, is actually thinking long-term, avoiding regret and saving resources. That's the truly smart move. Moral, point-wise. 1. Don't let ego drive your decisions. Winning isn't always worth the cost. 2. Know when to walk away. Saying no at the right time shows strength and wisdom. 3. Value over pride. Just because you can win doesn't mean it's the best choice. 4. Avoid emotional overspending. Think logically, not emotionally, especially in competitive situations. 5. Long-term thinking wins. Short-term victories can lead to long-term regrets. I call investing the greatest business in the world because you never have to swing. You stand at the plate. The pitcher throws you General Motors at 47, US Steel at 39, and nobody calls a strike on you. There's no penalty except opportunity lost. All day you wait for the pitch you like. Then when the fielders are asleep, you step up and hit it. Explanation, in an easy-to-understand teaching way. This quote uses a baseball analogy to explain the mindset of a smart investor. Here's what it means, part by part. I call investing the greatest business in the world. Investing is seen as a great opportunity because it's unique compared to other businesses, because you never have to swing. In investing, you're not forced to make a decision or take a risk right away. You can wait as long as you want. You stand at the plate. This is like standing in position, ready, observing opportunities that come your way. The pitcher throws you General Motors at 47, US Steel at 39. These are examples of stock prices, i.e. investment opportunities being presented to you. The market throws many different options at you every day, and nobody calls a strike on you. Unlike baseball, where not swinging could get you a strike, in investing there's no penalty for not acting. There's no penalty except opportunity lost. The only thing you risk by waiting is missing out on a good chance, but that's still better than rushing into a bad one. All day you wait for the pitch you like. You should be patient and wait for the right opportunity that truly fits your goals or comfort level. Then, when the fielders are asleep, you step up and hit it. When the perfect moment comes and no one else is paying attention, that's when you strike and potentially win big. Moral, key takeaways, point-wise. 1. Be patient. You don't have to rush into every opportunity. 2. Wait for the right moment. Only act when you find something that truly suits your strategy. 3. There's no pressure to act. Unlike other areas of life, investing allows you to wait without penalty. 4. Avoid fear of missing out, FOMO. Skipping a few pitches is okay. The right one will come. 5. Strike when it matters. When a rare, high-quality opportunity appears, go for it confidently. 6. Discipline beats action. Sometimes doing nothing is wiser than making the wrong move. Fund consultants like to require style boxes such as long-short, macro, international equities. At Berkshire, our only style box is SMART, Warren Buffett. Understanding and teaching the quote. This quote is from Warren Buffett, one of the most respected investors of all time, and it critiques how many investment professionals categorize funds into specific style boxes. Let's break it down. Style boxes are a common tool used by financial consultants to classify investment strategies. Examples include long-short, investing in stocks expected to go up, long, and against those expected to go down, short. Macro, based on global economic trends and events. International equities, focused on non-domestic foreign stocks. These boxes help categorize investment approaches, but they can also limit creativity or flexibility in investing. Buffett's response. He says that at Berkshire Hathaway, his investment company, they don't care about fitting into those labels or boxes. Instead, they follow only one guiding principle: smart. This means they invest in what makes sense. They focus on logic, value, and long-term success. They don't follow trends or rigid categories. They focus on intelligent decision-making. Moral lessons from the quote point-wise. 1. Think smart, not just by labels. Don't get boxed in by trends or titles. Use intelligence and judgment in decision-making. 2. Flexibility leads to better choices. Being open-minded allows for more opportunities than rigid categories. 3. Simplicity is powerful. Rather than overcomplicating things with jargon, focus on what truly matters. Smart, thoughtful action. 4. Follow value over fashion. Go after what makes sense logically, not what's popular at the moment. 5. True success is principle-driven. Labels may come and go, but smart decisions based on solid principles stand the test of time. Mr. Market is kind of a drunken psycho. Some days he gets very enthused, some days he gets very depressed. And when he gets really enthused, you sell to him. And if he gets depressed, you buy from him. There's no moral taint attached to that. Charlie Munger, Berkshire. Understanding and teaching way, simple explanation. Imagine the stock market as a person named Mr. Market, who comes to you every day offering to buy or sell shares at different prices. But he's not emotionally stable. Some days he's overly excited and willing to pay a high price. Other days he's very sad and offers very low prices. When Mr. Market is excited, enthused, he overvalues everything and offers to buy shares at high prices. That's the best time to sell. When he is depressed, he undervalues everything and wants to sell at very low prices. That's the best time to buy. This quote teaches us that we should not follow Mr. Market's mood swings, but rather take advantage of them rationally. We shouldn't feel guilty for doing so. It's not unethical. It's just being smart. Moral key takeaways. 1. Don't get emotional with the market. It's often irrational. 2. Buy low, sell high. Take advantage of market overreactions. 3. Stay rational. Use logic and analysis, not feelings. 4. Volatility is an opportunity, not a threat. 5. There's nothing wrong with making smart moves during emotional market phases. The trick is, when there is nothing to do, do nothing. Understanding and teaching way. This quote is simple, yet deeply wise. Let's break it down. The trick is. This implies there is a secret, a smart way to handle something. When there is nothing to do, sometimes in life situations arise where action isn't possible or necessary. Maybe things are out of your control, or it's just not the right time to act. Do nothing. Instead of forcing action or reacting impulsively, it's okay, and even wise, to just wait, observe, and allow things to unfold. In short, not every moment demands action. Trying to fix or control everything can lead to more stress or mistakes. Learning to be still and patient is often the smartest move. It's like when you're waiting for a cake to bake. If you keep opening the oven, you'll ruin it. Some things just need time. Moral in point wise. 1. Patience is a powerful action. Sometimes doing nothing is actually doing something, like allowing time to work its magic. 2. Don't force progress. Trying to push when it's not the right time can make things worse. 3. Wisdom lies in timing. Knowing when to act and when to pause is key. 4. Silence and stillness can bring clarity. When you pause, you often see things more clearly. 5. Trust the process. Life unfolds naturally. Trying to rush it can block the good that's coming your way. And so the important thing we do with managers generally is to find the 400 hitters and then not tell them how to swing. Understanding and teaching explanation. This quote uses a baseball metaphor to teach an important lesson about leadership and management. In baseball, a .400 hitter is someone with an exceptionally high batting average. They're the top performers. So in the workplace, these are your high-performing employees. Talented, skilled, and experienced individuals. The message here is, great managers recognize talent, hire or promote top performers, and then trust them to do their job. Instead of micromanaging or interfering with how they work, telling them how to swing, you let them use their own methods and creativity because that's what made them successful in the first place. It's about empowering people, not controlling them. Moral lessons point-wise. 1. Recognize and recruit top talent. 2. Trust skilled individuals to do their job. 3. Avoid micromanagement. Give people freedom to perform. 4. Good leadership is about support, not control. 5. Respect different working styles that lead to success. 6. Empower others by giving them ownership and confidence. Cash, though, is to a business as oxygen is to an individual. Never thought about when it is present, the only thing in mind when it is absent. When bills come due, only cash is legal tender. Don't leave home without it. Explanation in an understanding and teaching way. This quote compares cash in a business to oxygen in human life. Let's break it down. 1. Cash, though, is to a business as oxygen is to an individual. Just like people need oxygen to survive, a business needs cash to operate. It's a basic and essential need. 2. Never thought about when it is present, the only thing in mind when it is absent. When we have oxygen, we don't even notice it. We breathe without thinking. But when we don't have it, it becomes the only thing we care about. Similarly, when a business has enough cash, no one worries. But when it runs out, it becomes a crisis. 3. When bills come due, only cash is legal tender. When it's time to pay suppliers, salaries, rent, or loans, you can't pay with promises or assets. You need real cash. It's the only acceptable form of payment. 4. Don't leave home without it. This is a reminder. Always ensure your business has enough cash available. Running a business without cash is like going on a journey without your essentials. It's risky. Moral key lessons point-wise. 1. Cash is the lifeblood of any business. 2. Never take cash flow for granted, even in good times. 3. Lack of cash can shut down a business, no matter how profitable it looks on paper. 4. Always plan for upcoming payments and keep reserves. 5. Success is not just about sales or profits. It's about having enough cash to keep moving. 6. Be financially disciplined. Monitor, manage, and protect your cash flow. Keep all your eggs in one basket, but watch that basket closely. Understanding and teaching explanation. This quote may sound a bit risky at first, but it carries a powerful message when understood correctly. Literal meaning, if you put all your eggs in one basket and that basket falls, all your eggs will break. That's why people usually say, don't put all your eggs in one basket. Meaning, don't risk everything on one plan or investment. But this quote flips that idea. It says, yes, go ahead and put all your eggs in one basket, but then give that basket your full attention. What it really means, if you choose one goal, one plan, or one investment, focus on it completely. Monitor it, take care of it, and manage it wisely. If you are truly dedicated and careful, it can bring great success. Teaching point, don't fear committing to one thing, as long as you are committed to giving it your full focus, energy, and responsibility. It's not about playing safe, but about playing smart. Moral-wise. 1. Focus leads to mastery. When you concentrate on one goal, you become better and more efficient. 2. Pay close attention. Success comes not just from doing one thing, but by doing it carefully and watching over it. 3. Risk management is key. Taking a risk is okay if you're prepared and attentive. 4. Commitment matters. Choosing one path and sticking with it shows strength and responsibility. 5. Success favors the focused. Divided efforts often produce average results, but focused efforts can lead to excellence. If returns are 7 or 8% and you're paying 1% for fees, that makes an enormous difference in how much money you're going to have in retirement. Understanding and teaching explanation. This quote is about investing and the long-term impact of fees on your retirement savings. Let's break it down in simple terms. Suppose your investments are earning a 7% or 8% return per year, but you're also paying a 1% fee to a financial advisor or fund manager. At first glance, 1% might seem small, but over many years, that 1% is not just subtracted once, it's taken every year. And because your investments grow over time, that 1% fee eats into your profits more and more. Over decades, the compound effect means you could lose tens or even hundreds of thousands of dollars just because of that small fee. Imagine you're saving for retirement for 30 or 40 years. Even a 1% fee can reduce your final amount by 20 to 30% or more just due to the compounding loss. Moral key takeaways, point-wise. 1. Small fees make a big difference over time. Always consider the impact of fees on long-term returns. 3. Understand what you're paying for in investment services. 4. Compounding works both ways, on gains and on costs. 5. Look for low-fee investment options, like index funds or ETFs. Be an informed investor to maximize retirement savings. Today, with much of finance, media, government and tech located in coastal areas, it's easy to overlook the many miracles in Middle America. Understanding and teaching explanation. This quote is highlighting a modern societal imbalance. Let's break it down step by step. Today, with much of finance, media, government and tech located in coastal areas, this means that the major industries like Wall Street, finance, Hollywood, media, Washington, D.C., government, and Silicon Valley, tech, are mainly found in cities along the east and west coasts of the U.S. It's easy to overlook the many miracles in Middle America. Because of the spotlight on the coasts, people often forget or ignore the valuable contributions, innovations, and strong communities in the central part of the country, also known as Middle America. This includes small towns, farms, factories, and heartland cities that are essential to the country's economy and culture. In teaching terms, imagine you're only paying attention to the bright lights on the edges of a picture and forgetting to notice the rich, beautiful details in the center. The quote is a reminder to look beyond the obvious and appreciate what might not be in the spotlight. Moral, life lessons point-wise. 1. Don't judge value based on visibility. Just because something isn't in the spotlight doesn't mean it's not important. 2. Appreciate the unnoticed. Middle America contributes quietly but significantly through agriculture, manufacturing, community, and values. 3. Avoid narrow perspectives. Concentrating attention only on big cities or popular regions limits understanding of a country's full story. 4. Every region has its own miracles. Contributions and greatness can come from anywhere, not just where power or media is concentrated. 5. Balance is key. National growth and progress require recognizing and supporting all parts of the country, not just the coasts. I like thinking big. I always have. To me, it's very simple. If you're going to be thinking anyway, you might as well think big. Understanding and teaching explanation. This quote encourages bold and ambitious thinking. Let's break it down in a way that's easy to understand. I like thinking big. I always have. The speaker naturally tends to dream big and aim high. It's a part of their mindset and personality. To me, it's very simple. The idea is not complicated. It's common sense from the speaker's point of view. If you're going to be thinking anyway, you might as well think big. Since we already spend time and energy thinking about life, plans, or goals, why not think big instead of limiting ourselves with small ideas? Thinking big doesn't cost more than thinking small, but it can lead to far greater outcomes. Moral, lessons in point-wise form. 1. Don't be afraid to dream big. Small or big, both require thought, so choose the bigger vision. 2. Your mindset shapes your future. Big thinkers often create big opportunities. 3. Effort is the same, so aim higher. Since you're already investing time thinking, aim for greatness. 4. Confidence starts with bold thoughts. Thinking big can boost self-belief and motivation. 5. Limits exist mostly in our minds. Free yourself from self-imposed boundaries and think beyond the usual. The power of writing, a simple habit to make smarter stock decisions. The story of Daniel the Eager Investor. Once upon a time, in a small town, there lived a young man named Daniel. He had recently discovered the world of investing and was eager to grow his savings. With a few $100s in his account and a handful of stock tips from social media, he was ready to dive in. One morning, Daniel saw that Microsoft stock was buzzing online. "Buy now before it goes to the moon," a popular influencer tweeted. Without much thought, Daniel bought shares of Microsoft, telling himself, "It's Microsoft. How bad could it be?" Days passed and the price dipped. Daniel began to worry. Did I make a mistake? He wondered. He couldn't remember why he had even bought the stock. He had no clear reason, no plan, just a vague sense of excitement. Then one day, an old family friend and experienced investor named Mr. Lewis visited. Daniel shared his confusion and losses. Mr. Lewis smiled gently and said, "Let me share a small secret that helped me for decades. Always write down why you're buying a stock before you buy it." Daniel looked puzzled. "Just write it down?" "Yes," Mr. Lewis said. "Before you hit that buy button, write something like, 'I am buying Microsoft at $300 billion because I believe its cloud business is growing rapidly and I expect earnings to rise significantly in the next 5 years.' If you can't clearly explain it, don't buy it. This small habit sharpens your thinking and builds discipline." Daniel decided to give it a try. From then on, every time he considered a stock, he wrote down the reason, the valuation, and what he expected. Some stocks he ended up skipping after realizing his reasoning was weak. Others he held with confidence because his thesis was clear. Over time, Daniel made fewer impulsive decisions and became a thoughtful, confident investor. The lesson. When investing, emotions like fear and excitement can cloud your judgment. Writing down your reasons forces you to slow down, think clearly, and commit to a rationale. It's like having a conversation with your future self. Moral of the story: clarity comes from writing. Discipline grows from reflection. Important takeaways. Before buying a stock, write down your reason. For example, I am buying Microsoft at $300 billion because I believe its cloud services will continue to dominate and expand revenue. If you can't clearly explain the reason, don't invest yet. Confusion is a red flag. Writing builds discipline. It protects you from emotional or impulsive decisions. Keep a journal of your investments. Review it over time to learn from your thinking, both right and wrong. Charlie Munger and I would follow a buy and hold policy even if we ran a tax-exempt institution. Warren Buffett. Understanding and teaching the quote. This quote is from Warren Buffett, referring to his longtime business partner, Charlie Munger. Here's a simple breakdown. Buy and hold policy means purchasing good investments, like stocks of strong companies, and holding on to them for a long time, instead of frequently buying and selling. Tax-exempt institution means an organization that doesn't have to pay taxes, like certain charities or retirement funds. Often, people sell investments just to avoid paying high taxes on profits, called capital gains taxes. But if you're tax-exempt, you wouldn't have to worry about those taxes. What Buffett is saying is, even if we didn't have to pay any taxes at all, we would still follow the buy and hold approach. Why? Because it's not just about avoiding taxes, it's about trusting in the long-term growth of high-quality investments. It shows discipline, patience, and belief in the power of compounding. Moral key takeaways point-wise. 1. Long-term investing creates lasting wealth. 2. Buy quality, trust it, and let time do the work. 3. Avoid unnecessary trading. It invites risk and costs. 4. Patience in investing often leads to greater rewards. 5. Stick to principles even when circumstances change. 6. Investment success isn't just about tax strategy, it's about mindset and discipline. Success stories abound throughout America. Since our country's birth, individuals with an idea, ambition, and often just a pittance of capital have succeeded beyond their dreams by creating something new or by improving the customer's experience with something old. Understanding and teaching explanation. This quote highlights how America has always been a land of opportunity. From the very beginning, many people have found great success here, not because they were rich, but because they had ideas, determination, and creativity. Even if they started with very little money, they achieved more than they ever imagined. How? By either inventing something new that people needed or enjoyed, or making something better that already existed, especially in ways that made customers happier. This teaches us that success doesn't require a fortune. What truly matters is the will to act on an idea and the effort to make it better or more useful to others. Moral, point-wise. 1. Success comes from ideas, not just money. 2. Ambition and hard work can turn dreams into reality. 3. Innovation leads to progress. Create something new or improve the old. Focus on customer satisfaction for lasting success. 5. Even small beginnings can lead to great achievements. If calculus or algebra were required to be a great investor, I'd have to go back to delivering newspapers. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, highlights a powerful message. You don't need complex mathematics or be a genius in subjects like calculus or algebra to succeed as an investor. Buffett is humorously saying that if investing required deep mathematical knowledge, he'd have failed, and ended up doing a basic job like delivering newspapers. He's not actually putting down newspaper delivery, but rather emphasizing that successful investing is more about common sense, patience, and good decision-making, not solving complicated equations. In simpler terms, you don't need to be a math wizard to be a smart investor. Understanding businesses, being disciplined, and staying calm during market ups and downs are far more important. Moral, lessons point-wise. 1. Simplicity is powerful. You don't need complex tools to succeed. Simple thinking often wins. 2. Investing is about behavior, not equations. Discipline, patience, and logic matter more than advanced math. 3. Everyone can learn to invest. You don't have to be a genius. Investing is accessible to ordinary people. 4. Overthinking can be dangerous. Trying to overanalyze with formulas may lead to confusion or poor decisions. 5. Success lies in wisdom, not IQ. Smart decision-making and emotional control beat intelligence alone. The way to wealth is as plain as the road to the supermarket. It depends on 2 words, industry and frugality. Explanation, understanding and teaching way. This quote compares gaining wealth to a simple and familiar task, going to the supermarket. It means becoming wealthy isn't a mystery. It's as clear and straightforward as following a known road. It all comes down to 2 key habits. 1. Industry. This means hard work, being active and consistently putting in effort. 2. Frugality. This means being wise with money, avoiding unnecessary expenses and saving wherever possible. Just like you know the exact steps to reach the supermarket, success and wealth also have a clear path. You just need to work hard and spend wisely. Moral, point-wise. 1. Hard work is the foundation of success. 2. Saving and wise spending lead to financial growth. 3. The path to wealth is clear. Stay focused and consistent. 4. Discipline in work and money habits pays off in the long run. 5. Avoid laziness and wasteful spending to stay on the right track. An investor should ordinarily hold a small piece of an outstanding business with the same tenacity that an owner would exhibit if he owned all of that business. Understanding and teaching explanation. This quote emphasizes the mindset an investor should have when buying shares of a company. Here's a step on the ideal business, something that costs a penny, sells for $1, and is habit-forming. Understanding and teaching explanation. This quote is about what makes a perfect or ideal business from a financial and strategic point of view. Let's break it down. Costs a penny. This means the product or service should be very cheap to produce. Low cost means higher profit margins. Sells for $1, it's being sold at a much higher price than it costs to make. This means the business earns a high profit on each sale. Habit forming. This is the key part. It means the product should be something people want to use again and again, like coffee, social media, or addictive games. When something becomes a habit, customers keep coming back, so the business keeps earning. In simple terms, an ideal business makes something cheap, sells it for a lot more, and people can't stop buying it. Moral, key takeaways point-wise. 1. Keep production costs low to maximize profit. 2. Sell with a good profit margin. Your pricing should reflect value. 3. Build habit-forming products so customers come back regularly. 4. Focus not just on sales, but on customer behavior and loyalty. 5. A smart business model is scalable, repeatable, and profitable. The Golden Cube and the Power of True Value. Once upon a time, in a land not too far from our own, there lived a wise old teacher named Elian. People from all walks of life came to him, hoping to unlock the secrets of wealth and wisdom. One crisp autumn morning, a curious young man named Aaron visited Elian with a burning question. "Master Elian," he asked, "what is true value? Is it in gold, land, or something else entirely?" Elian smiled and pointed toward a clearing behind his cottage. There stood a large wooden cube, roughly 67 feet in every direction. "Imagine," Elian began, "this cube is made entirely of gold, all the gold that has ever been mined in the history of mankind. Every ounce ever discovered melted into this one shimmering block. Now, let's say you could have this cube. At today's gold prices, it's worth trillions of dollars." Aaron's eyes sparkled. "That's incredible." "But wait," Elian said, raising a finger. "With that same amount of money, you could choose something else instead. You could buy every acre of farmland in the United States, millions of fertile acres producing food, fiber, and fuel, year after year. That's not all. You could also buy 10 ExxonMobils, one of the most profitable and powerful energy companies in the world. And after all that, you'd still have $1 trillion left just to play with." Aaron's jaw dropped. "All of that, or a big shiny cube of gold?" "Yes," Elian replied. "Now ask yourself, what creates real value over time? The cube of gold just sits there. It does nothing. It produces nothing. It sparkles, yes, but it doesn't feed people. It doesn't fuel cars. It doesn't innovate. It doesn't grow. Meanwhile, farmland feeds the world. Companies like ExxonMobil employ thousands, build infrastructure, and produce energy. They adapt, evolve, and expand." Aaron paused, pondering the comparison. Elian leaned in, his eyes kind. "True value doesn't lie in what merely looks precious. It lies in what produces, what serves, and what grows. Gold has its place, yes, but don't mistake it for productivity or progress. Wealth that sits still is not the same as wealth that works." Moral of the story: choose assets that produce, serve, and grow over time, not just those that sparkle and sit. Key takeaways. 1. Gold is finite and static. All the gold ever mined fits in a 67-foot cube. 2. At current value, that gold could buy all US farmland, 10 ExxonMobils, and still leave you with $1 trillion in cash. 3. Gold doesn't produce anything. It doesn't yield crops, create energy, or employ workers. 4. Productive assets like land and businesses generate ongoing value and help build long-term wealth. 5. True wealth lies in what creates more wealth.
If a statue is ever erected to honor the person who has done the most for American investors, the hands-down choice should be Vanguard founder Jack Bogle. For decades, Jack has urged investors to invest in ultra-low-cost index funds. In his crusade, he amassed only a tiny percentage of the wealth that has typically flowed to managers who have promised their investors large rewards while delivering them nothing, or, as in our bet, less than nothing of added value. Explanation in an understanding and teaching way. This quote is a powerful tribute to Jack Bogle, the founder of Vanguard and a strong advocate for index fund investing. The speaker says that if there were ever a statue built to honor someone who helped American investors the most, it should be Jack Bogle. Why? Because Bogle championed the idea of investing in low-cost index funds. These are simple, affordable investments that aim to match the market instead of trying to beat it. Unlike other investment managers who made big promises of high returns, but often failed, Bogle focused on helping investors keep more of their money by avoiding high fees and risky bets. Despite changing millions of lives financially, Bogle didn't chase wealth for himself. He earned far less than typical fund managers, showing that he was truly mission-driven, not motivated by greed. In short, Bogle put investors first, and that's what made him a hero in the financial world. Moral key takeaways, point-wise. 1. Simplicity and low cost often beat complexity and high promises in the long run. 2. True leadership is about helping others, not enriching oneself. 3. Ethics and integrity in finance matter more than flashy results. 4. Consistent, long-term investing in index funds is a smart and safe strategy. 5. Real impact isn't always rewarded with wealth, but it earns lasting respect. Cash combined with courage in a time of crisis is priceless. Understanding and teaching explanation. This quote means that during difficult or uncertain times, such as an economic downturn, war, personal loss, or any kind of crisis, having money, cash, is very important. But it becomes truly powerful when it's paired with courage. Just having money is not enough. You also need the bravery and confidence to use it wisely, make bold decisions, or take risks when others are afraid. For example, during a financial crash, someone who has both cash and the courage to invest when prices are low may end up with great rewards once the situation improves. It teaches us that resources alone don't create success. They need to be used with courage, wisdom, and timing. Moral point 1. Resources are valuable, but not enough alone. Cash gives you opportunities, but it's only one part of the equation. 2. Courage unlocks potential. Without the courage to act, even great resources can go unused. 3. Crisis reveals true character. Tough times test our ability to act with bravery and wisdom. 4. Right action at the right time is powerful. Success often comes to those who are prepared and bold enough to act. 5. Balance practicality with bravery. Combine smart planning with fearless decision-making to turn crisis into opportunity. Instead, we try to apply Aesop's 2,600-year-old equation to opportunities in which we have reasonable confidence as to how many birds are in the bush and when they will emerge. A formulation that my grandsons would probably update to, a girl in a convertible is worth 5 in the phone book. Understanding and teaching explanation. This quote cleverly blends ancient wisdom with modern humor to explain how smart decisions are made based on measured confidence and timing. 1. Reference to Aesop's fable, Aesop's old proverb, "A bird in the hand is worth 2 in the bush," means that it's better to hold on to something certain than risk it for something that might be better, but uncertain. The speaker, Warren Buffett in this case, is saying that instead of blindly following this advice, they make decisions only when they have a clear and confident estimate of what's in the bush, i.e. the future opportunity, and when they can benefit from it. 2. Modern twist. The humorous line, "A girl in a convertible is worth 5 in the phone book," is a playful modern update. It means a real engaging opportunity, a girl in a convertible, is more valuable than many theoretical or distant options, girls listed in a phone book. It's a metaphor to highlight the difference between actual, accessible value and potential, but unreachable value. 3. Lesson in investing in life. The speaker advises that it's okay to bet on future rewards, but only if you have a clear idea of the value and a good sense of timing. This blends both caution and courage. Don't ignore future potential, but don't chase it blindly either. Moral key takeaways, point-wise. 1. Don't settle for less if you clearly understand the greater reward ahead. 2. Smart decisions involve calculating risk and timing, not just avoiding them. 3. Future opportunities are worth pursuing only when you're confident in their outcome. 4. Balance practical wisdom with strategic vision. Combine old lessons with modern thinking. 5. Use humor and creativity to stay sharp and relatable, even when making serious choices. Don't get caught up with what other people are doing. Being a contrarian isn't the key, but being a crowd follower isn't either. You need to detach yourself emotionally. Understanding and teaching explanation. This quote is offering valuable advice on how to approach decision-making and mindset, especially in situations involving trends, opinions, or pressure from others. 1. Don't get caught up with what other people are doing. This means don't blindly follow others just because they're doing something. Whether it's a trend, a business move, or a lifestyle choice, always think independently. 2. Being a contrarian isn't the key, but being a crowd follower isn't either. You don't have to go against everyone just to be different. That's being a contrarian. And you don't have to follow everyone just to fit in. That's being a crowd follower. The message here is about balance. Choose your path based on logic and clarity, not emotions or social pressure. 3. You need to detach yourself emotionally. Decisions made with too much emotion can cloud judgment. Detachment doesn't mean not caring. It means staying calm, objective, and thoughtful, especially in intense or overwhelming situations. Moral in point-wise format. 1. Think for yourself. Don't blindly copy others. Use your own mind and judgment. 2. Avoid extremes. You don't have to always agree or always disagree. Find a wise middle path. 3. Stay emotionally balanced. Keep your emotions in check while making important decisions. 4. Be mindful of influence. Don't let trends or peer pressure dictate your choices. 5. Act with clarity. Let your actions be guided by understanding, not reactions. There are 3 kinds of people: innovators, 2. imitators, 3. idiots. Understanding and teaching explanation. This quote categorizes people into 3 broad types based on how they think and act. 1. Innovators. These are the people who think outside the box. They come up with new ideas, create original things, and take the first steps into new territories. Innovators are leaders in thought and action. They take risks and often shape the future. 2. Imitators. These people don't create original ideas, but follow what innovators have already done. They might not be the first to do something, but they are smart enough to recognize a good idea and follow it. Imitators can still be successful by learning from others. 3. Idiots. This group blindly follows trends without understanding them. They neither create nor thoughtfully follow. They often jump on bandwagons without thinking critically or understanding the consequences. Their decisions are impulsive or ignorant. Teaching tip. This quote encourages us to reflect on which kind of person we want to be. While not everyone can be a revolutionary innovator, we can all strive to avoid being in the 3rd category, those who follow blindly without thought. Moral-wise. 1. Think for yourself. Don't just follow the crowd. 2. Be original whenever possible, or at least be wise in choosing whom to follow. 3. Avoid blind imitation. It leads to poor decisions and failure. 4. Learn from innovators instead of copying without understanding. 5. Your mindset determines your path. Choose to be a thinker, not a follower without purpose. I'm no genius, but I am smart in spots, and I stay around those spots. Understanding and teaching explanation. This quote emphasizes self-awareness and strategic thinking. The speaker humbly admits that they're not a genius, meaning they don't know everything or excel at everything, but they recognize that they do have strengths in certain areas, those spots where they are smart. Instead of trying to be good at everything, they focus their energy and time on the areas where they are naturally good or have developed skills. By doing this, they maximize their effectiveness and success. In a teaching context, it encourages knowing what you're good at, not feeling discouraged for not being good at everything, focusing and improving your strong areas, letting others help in areas you're weak in, teamwork. Moral in point-wise form. 1. Know your strengths and weaknesses. Be honest with yourself. 2. Focus on your strengths. Put time and energy into what you're good at. 3. Don't compare with others. You don't need to be a genius to succeed. 4. Stay in your zone. Staying close to your strengths brings confidence and results. 5. Work smart, not just hard. Success often comes from smart choices, not just effort. After 25 years of buying and supervising a great variety of businesses, Charlie Munger and I have not learned how to solve difficult business problems. What we have learned is to avoid them. Warren Buffett. Understanding and teaching explanation. Warren Buffett, one of the most successful investors in the world, is making a very important point here. He says that even after decades of experience, working closely with Charlie Munger and managing many businesses, they haven't figured out a perfect way to fix or solve difficult business problems. Instead of spending energy trying to fix what's broken or overly complicated, they've learned a much smarter approach. Avoid getting into those messy situations in the first place. This is a wise strategy that can apply beyond business too. If a business or decision looks too complex, problematic, or full of red flags from the beginning, it's better to stay away than try to jump in and fix it later. In other words, prevention is better than cure, especially in business. Moral key lessons, point-wise. 1. Experience doesn't always lead to solving all problems, and that's okay. 2. The smartest solution to some problems is simply to avoid them. 3. Good judgment often means saying no to trouble before it starts. 4. Avoiding bad decisions is just as powerful as making great ones. 5. Don't chase complexity. Seek clarity and simplicity in business and life. Rockefeller certainly had power and fame. He could not, however, live as well as my neighbors now. Understanding the quote. This quote highlights a powerful contrast between past wealth and modern living standards. Here's a breakdown in a simple and teaching way. John D. Rockefeller was one of the richest men in history, known for his immense wealth, power, and influence in the oil industry. Despite his power and riches, he lacked many of the comforts and conveniences that ordinary people have today. Things like modern medicine, air conditioning, the internet, smartphones, safe cars, fast travel, or even simple daily comforts were not available to him. The quote is emphasizing that even average people today may live more comfortably than the richest person from the past, thanks to technological and societal advancements. It teaches us to appreciate what we have, because comfort and quality of life aren't just about money. They're also about time, progress, and access to everyday things. Moral lessons, point-wise. 1. Appreciate modern conveniences. The small things we take for granted today were once unimaginable luxuries. 2. Wealth isn't everything. Quality of life is shaped by access, health, technology, and comfort, not just money. 3. Progress benefits everyone. Technological and social progress lifts the standard of living for even ordinary people. 4. Gratitude matters. Recognizing how far we've come helps us stay grounded and thankful. 5. Perspective changes value. Comparing across time shows that what seems ordinary now was once priceless. They say the chains of habit are too light to be felt until they are too heavy to be broken. The chains you put around yourself now have enormous consequences as you go through life. Understanding and teaching explanation. This quote uses the metaphor of chains of habit to describe how small, repeated actions or routines, whether good or bad, slowly become stronger over time. Too light to be felt means that at first our habits seem harmless or insignificant. We don't even notice them forming. Too heavy to be broken means that over time, those small actions become so ingrained in us that it's very difficult to change or break free from them. The chains you put around yourself now refers to the habits you're forming today. These habits, whether productive or destructive, will shape your future and have enormous consequences throughout your life. This quote teaches that habits build gradually, but once they're solid, they can either empower you or trap you. So it's important to pay attention to what you're doing regularly, even if it seems minor. Moral point-wise. 1. Small actions matter. Even tiny habits can grow into powerful forces in your life. 2. Habits form silently. You often don't notice them until they control you. 3. Be mindful of your routines, because today's habits shape tomorrow's future. 4. Good habits empower you. They become your strengths over time. 5. Bad habits enslave you. The longer they continue, the harder they are to change. 6. Build wisely, early. It's easier to form good habits than to break bad ones later. Things that you like to do should be a hobby of yours, but things the world like to do should be a business of yours. Explanation. Understanding teaching way. This quote carries a powerful message about passion and smart work. Let's break it down. Things that you like to do should be a hobby of yours. This part means that your personal interests, things that make you happy, relaxed, and fulfilled, should be pursued as hobbies. Whether it's painting, music, gardening, or reading, do it because you enjoy it, not because it needs to earn you money or fame. But things the world like to do should be a business of yours. This second part talks about creating value. If you want to start a business, focus not just on what you like, but on what others want. If a large number of people enjoy something or have a common need, that creates a market. By turning that into a business, you solve a problem or provide something people desire. This is the heart of entrepreneurship. In simple words, do what you love for your soul, but if you want to make money or build a business, do what people love and are willing to pay for. Moral life lessons, point-wise. 1. Follow your passion for personal happiness. Don't ignore your hobbies. They keep your mind healthy and soul satisfied. 2. Build a business based on what people want. Understand the needs and interests of the world around you to create value. 3. Separate emotions from economics. Your hobbies are for joy. Your business is for solving problems or fulfilling desires in the market. 4. Grow both personally and professionally. Balance between self-fulfillment and financial success is key to a well-rounded life. 5. Smart work is identifying opportunities outside your comfort zone. Your business should cater to others, not just your own interests. The Seeds of Success, a story about investing in yourself. The Boy Who Planted Knowledge. In a quiet village surrounded by fields and forests lived a young boy named Aaron. Every morning, while other children played in the meadows, Aaron sat under the old banyan tree with a book in his hands and a sparkle in his eyes. His friends would laugh and call him the little teacher, but Aaron didn't mind. He had a dream, to build a life where he wouldn't have to worry about food, shelter, or the changing winds of fortune. One day, his grandfather, a wise farmer, asked him, "Why do you study so much when others are out enjoying their time?" Aaron looked up and said, "Grandpa, I want to grow something that no storm can destroy, knowledge. I believe that if I learn well now, I can build a strong future." The old man smiled, placing a hand on Aaron's shoulder. "You're planting seeds in your mind, my boy, and just like in the fields, those seeds will one day feed you, protect you, and help others too." Years passed. The village faced many hardships. Crops failed, prices rose, and jobs became scarce. Many struggled, including Aaron's childhood friends who hadn't thought much about the future. But Aaron had become a skilled engineer, working in a nearby city, and had saved wisely. He returned to the village not only to support his family, but also to open a small learning center for the village children. He shared his story with them and said, "The world changes quickly, but what you carry in your mind will carry you through anything. I'm here today not because of luck, but because I invested in my education." Moral of the story: your best investment is in yourself. Education is the key that opens doors when the world closes others. Important points to remember. 1. Start early. The younger you begin learning, the more time you have to grow your knowledge and skills. 2. Long-term thinking. Education is not just about grades, it's about preparing for the future. 3. Security through skill. In uncertain economies, your abilities are your safety net. 4. Give back. True success is when you use what you've learned to help others rise too. Speculation is most dangerous when it looks easiest. Explanation. Understanding teaching way. Let's break this down to truly understand it. Speculation refers to making risky guesses or investments, especially in areas like the stock market, real estate, or business, where the outcome is uncertain. Most dangerous means it carries the highest risk of loss or harm. When it looks easiest, suggests that the danger is greatest when speculation seems simple or effortless, like when everyone seems to be making money quickly and easily. In simple terms, the quote warns that the time you feel most tempted to take risks, because it seems like everyone is winning easily, is exactly when you're most likely to lose. Why? Because you're not seeing the full picture, and you might be acting based on hype or emotions rather than careful thinking. Teaching point. Imagine a time when everyone is investing in something, like cryptocurrency or a popular stock, and it's going up every day. It might feel like a sure thing, but that's the trap. When something seems too easy, you stop being cautious. And that's when things can crash. Moral lessons. Point 1. Be cautious when something seems too easy. Easy wins can hide big risks. 2. Don't follow the crowd blindly. Do your own research. 3. Avoid making decisions based on emotions or hype. 4. Understand what you're investing in before jumping in. 5. The greatest risk often comes when you feel the most confident. I am a better investor because I am a businessman, and a better businessman because I am an investor. Understanding and Teaching Explanate, often attributed to Warren Buffett, beautifully highlights the deep connection between business and investing. Let's break it down in simple terms. When someone runs a business, they understand how companies work from the inside, how they make money, handle expenses, grow, and survive competition. This real-world business experience helps them make smarter investment decisions because they can judge which companies are strong and which are not just by looking at financial reports, strategies, and leadership. On the flip side, when someone is an investor, they learn how to analyze businesses from the outside by looking at value, risk, long-term potential, and market behavior. This mindset helps them run their own business more wisely by focusing on long-term growth, sustainability, and making solid, data-driven decisions. So, both roles feed into each other. The businessman sharpens the investor. The investor sharpens the businessman. Moral life lessons, point-wise. 1. Real-world experience boosts judgment. Being involved in business helps you understand investments better. 2. Analytical thinking improves decision-making. Learning to invest makes you more strategic as a business owner. 3. Cross skills make you stronger. Skills in one field can greatly enhance performance in another. 4. Practical plus strategic equals success. Combining hands-on business with smart investing creates a powerful edge. 5. Never stop learning. Growth happens when you allow different areas of knowledge to inform each other. If Fed Chairman Alan Greenspan were to whisper to me what his monetary policy was going to be over the next 2 years, it wouldn't change one thing I do. Understanding and Teaching Explanation. This quote is from Warren Buffett, one of the world's most successful investors. Let's break it down. Fed Chairman Alan Greenspan refers to the head of the Federal Reserve, who plays a major role in shaping U.S. monetary policy, including interest rates and money supply. Whisper to me what his monetary policy was going to be means even if Buffett had secret insider knowledge about upcoming economic policies, it wouldn't change one thing I do. Indicates that this information wouldn't influence or change his investment decisions at all. What Buffett is teaching here is that long-term investing success doesn't depend on predicting short-term economic changes like interest rates, inflation, or government policy. Instead, he focuses on buying strong businesses with solid fundamentals and holding them for the long run. He's basically saying, don't get caught up in macroeconomic predictions. Stick to your investing principles. Focus on what you can control, like understanding businesses. Moral key learnings, point-wise. 1. Stick to your strategy. Don't let outside noise distract you from your core plan. 2. Focus on fundamentals. Invest in what you understand and what has lasting value. 3. Avoid relying on predictions. Even expert forecasts can be unreliable. 4. Think long-term. Good businesses succeed regardless of short-term economic changes. 5. Confidence in your approach. A strong investment philosophy removes the need for constant market speculation. We select our marketable securities in much the same way we would evaluate a business for acquisition in its entirety. We want the business to be one, A, that we understand, B, with favorable long-term prospects, C, operated by honest and competent people, and D, available at a very attractive price. Understanding and Teaching Explanation. This quote is about how to wisely choose investments, especially when buying stocks, also called marketable securities. It suggests that instead of looking at stocks as just numbers or trends, we should think of them as real businesses. Here's a breakdown. We select our marketable securities when choosing what stocks to buy, as if we are buying the whole business. Treat it like you're buying the entire company, not just a small piece. That we understand. Don't invest in things you don't get. Know how the business works. B. With favorable long-term prospects. Choose businesses that are likely to do well in the future. C. Operated by honest and competent people. Make sure the people running the company are trustworthy and skilled. D. Available at a very attractive price. Don't overpay. Even a great company is a bad investment if the price is too high. So the idea is, treat investing seriously. Think long-term, do your homework, and don't chase trends blindly. Moral key takeaways, point-wise. 1. Invest in what you truly understand. 2. Focus on businesses with strong long-term potential. 3. Trust matters. Choose companies with honest, skilled leaders. 4. Buy only when the price is fair or a bargain. 5. Think like a business owner, not a stock trader. If you can't communicate and talk to other people and get your ideas across, you're giving up your potential. Learn how to communicate well. Understanding and teaching explanation. This quote emphasizes the importance of communication in achieving your full potential. Let's break it down step by step for better understanding. 1. If you can't communicate and talk to other people. This means if you're not able to express your thoughts clearly to others, whether it's through speaking, writing, or even body language, you're limiting your growth. 2. And get your ideas across. Simply talking isn't enough. You need to make sure others understand what you're saying. The goal is clarity and connection, not just speaking. 3. You're giving up your potential. And no matter how smart, talented, or creative you are, if you can't express your thoughts, your abilities go unnoticed or unused. 4. Learn how to communicate well. Communication is a skill, and like any skill, you can learn and improve it. Practice, feedback, and learning from others can help you become a powerful communicator, unlocking your full potential. In simple terms, even the best ideas are wasted if no one understands them. Good communication turns ideas into action. Moral lessons, point-wise. 1. Communication is key to success in any field of life, personal, academic, or professional. 2. Ideas are powerful, but only when they're shared clearly. 3. Good communication is a learnable skill, not just a natural talent. 4. Without communication, your true potential remains hidden. 5. Developing communication skills can open doors to more opportunities, respect, and influence. 6. Listening well is also part of communicating effectively. 7. Start practicing early. It improves confidence and builds stronger relationships. Equities will do well over time. You just have to avoid getting excited when other people are getting excited. Explanation, understanding, and teaching way. This quote is a valuable piece of investment wisdom, often shared by experienced investors like Warren Buffett. Here's what it means in simple terms. Equities will do well over time. This means that stocks, equities, tend to grow in value over the long term. Historically, the stock market has gone up despite short-term ups and downs. You just have to avoid getting excited when other people are getting excited. This part warns against emotional investing. When everyone around you is hyped up about a particular stock or market rally, it's easy to feel like you're missing out and jump in without thinking. But following the crowd during a market bubble can lead to bad investment decisions, like buying overpriced stocks. Smart investors stay calm and stick to their strategies, even when others are acting irrationally. So the quote is encouraging patience, discipline, and emotional control in investing. 1. Long-term investment in equities is generally rewarding. 2. Don't let emotions drive your financial decisions. 3. Avoid herd mentality. Just because everyone is investing doesn't mean it's the right time. 4. True success comes from discipline and sticking to your strategy. 5. Patience in investing often leads to greater returns than chasing trends. Not doing what we love in the name of greed is the very poor management of our lives. Understanding and teaching explanation. This quote emphasizes the importance of staying true to our passions and not sacrificing our happiness just for money or material success. Let's break it down. Not doing what we love means ignoring our true interests, talents, or passions. In the name of greed refers to chasing money, status, or power excessively. Is the very poor management of our lives suggests that making life choices based solely on greed instead of joy or purpose leads to an unfulfilled and mismanaged life. It teaches us that life should be balanced. Money is important, but not at the cost of our mental peace, joy, or inner satisfaction. If we keep chasing wealth and ignore our calling, we might end up with regret, stress, or emptiness despite material success. Moral of the quote, point-wise. 1. Follow your passion. Life is more meaningful when we do what we love. 2. Don't let greed control your decisions. Chasing only money can lead to emptiness. 3. Balance is key. Earn, but also enjoy what you do. 4. True success includes happiness. Not just wealth, but peace of mind too. 5. Manage life with purpose, not pressure. Align your goals with your values. Investors should remember that excitement and expenses are their enemies. Understanding and teaching explanation. This quote, often attributed to Warren Buffett, offers a simple but powerful lesson for anyone investing in the stock market or any other financial venture. Excitement refers to the emotional highs investors may feel during market booms or when they hear hot tips. This can lead to irrational decisions, buying when prices are high or selling out of fear when they drop. In investing, being too emotional can cloud your judgment. Staying calm and sticking to a strategy is usually more effective. Expenses means the fees, commissions, and taxes associated with frequent trading or expensive investment products. Over time, high expenses eat into your returns, even if your investments perform well. Keeping costs low is a big part of smart investing. In essence, successful investors stay calm, think long-term, and minimize costs. Moral of the quote, point-wise. 1. Stay calm. Don't let emotions drive investment decisions. 2. Avoid unnecessary expenses and fees in your investment strategy. 3. Focus on long-term growth, not short-term excitement. 4. Patience and discipline often beat fast, emotional decisions. 5. A simple and steady approach is often safer and more rewarding. Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. Understanding and teaching explanation. This quote by Warren Buffett uses a metaphor to describe how economic downturns or crises, the dark clouds, can actually present rare and valuable opportunities, rain gold, for those who are prepared and wise. Let's break it down. Every decade or so, economic troubles are a regular occurrence, not a one-time event. Roughly every 10 years, the world faces some kind of financial crisis, recession, or panic. Dark clouds will fill the economic skies. This symbolizes economic fear, uncertainty, and crisis. Just like stormy clouds signal bad weather, economic dark clouds signal financial trouble like crashes, inflation, or mass layoffs. They will briefly rain gold. Here's the twist. Opportunity hides within crisis. For those who stay calm and think clearly, these moments offer chances to buy valuable things at a low price, like good businesses, stocks, or real estate. In simple terms, when most people are scared and running away, a smart investor sees an opportunity to get something valuable at a bargain. Moral lessons, point-wise. 1. Crisis is temporary, but opportunity during it is rare and precious. 2. Be prepared. Economic downturns are part of the cycle, not an exception. 3. Stay calm and think long-term while others panic. 4. Great fortunes are often built by acting wisely during difficult times. I don't measure my life by the money I've made. Other people might, but I certainly don't. Understanding and teaching explanation. This quote emphasizes personal values over material wealth. The speaker is saying that their sense of fulfillment or success in life is not based on how much money they've earned. They recognize that some people do judge success by financial gain, but they personally choose not to. In simpler terms, money isn't everything. Life's true worth comes from things like love, experiences, growth, and making a difference. Everyone has different ways of measuring success, And that's okay. What's important is staying true to your own values. This teaches us that we don't have to follow society's standards of success. We can choose our own path and decide what really matters most to us. Moral of the quote, point-wise. 1. Success is personal. Define it your own way. 2. Money is a tool, not a measure of self-worth. 3. Stay true to your values, even if others think differently. 4. Live a life that feels meaningful to you, not just impressive to others. 5. Don't let society pressure you into chasing things that don't matter to your soul.
The Tale of Mr. Longview and the Two Treasures. The Tale of Mr. Longview and the Two Treasures. Once upon a time, in a quiet town named Econville, lived a wise old investor known to all as Mr. Longview. He wasn't the richest, nor the flashiest, but when it came to building wealth slowly and surely, no one could rival his wisdom. One fine morning, he gathered the younger folks of the town under the grand oak tree in the village square. In his hand, he held two treasures, a golden scroll labelled equities and a silver one marked fixed-rate bonds. Both of these, he began, have the power to grow your wealth, but they behave very differently over time. The crowd leaned in. Mr. Longview unfurled the silver scroll first. "This," he said, "is a bond, a promise to pay you a steady income. It's calm, predictable, and often feels safe, but it rarely changes. If today's rates stay the same, this silver path will only take you so far over the decades." He then opened the golden scroll. "Now this," he smiled, "is equity, ownership in businesses that thrive in this wonderful American economy. Over time, businesses grow, innovate, and generate more profits. This scroll may shake in the wind, dip and rise, even fall by half at times, but when you hold it steady for years, its shine only grows brighter." The townspeople murmured with curiosity. "But beware," he warned. "Many have grabbed the golden scroll in excitement, only to run away screaming when a storm hits. Equities can be wild in the short run. Stock prices may tumble, sometimes drastically. If your heart isn't calm or you borrow money to buy too much, the golden scroll can burn your hands." A young boy raised his hand. "So what should we do?" Mr. Longview chuckled. "Stay steady. Don't borrow to invest. Don't let fear or greed decide for you. The American tailwind, our nation's spirit of innovation and productivity, will push those businesses forward. Add the magic of compounding, where your earnings make more earnings, and the golden scroll becomes your best long-term companion." Moral of the story: patience and emotional control are the keys to unlocking the long-term rewards of investing in equities. Important points. Equities stocks, over decades, almost always outperform long-term fixed-rate bonds, especially if interest and tax rates remain low. Stock prices can drop dramatically, even by 50% or more, but they tend to recover and grow over time. The American tailwind, the nation's strength in innovation and growth, boosts the long-term potential of equities. Compounding is a powerful force. Reinvesting gains leads to exponential growth over time. Avoid borrowing to invest and maintain emotional discipline to truly benefit from stock market investments. Keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Understanding and teaching explanation. This quote gives practical advice, especially useful in life, business, and investing. 1. Keep things simple. Don't overcomplicate your plans or strategies. The more straightforward your approach, the easier it is to manage, understand, and succeed. Complexity often leads to confusion and mistakes. 2. Don't swing for the fences. This is a baseball metaphor. It means don't always go for huge, risky wins, like trying to hit a home run. Instead, aim for consistent, small successes. High-risk moves can lead to big losses. 3. When promised quick profits, respond with a quick no. If someone offers you fast and easy money, be skeptical. Most of the time, these are scams or risky deals. Financial success takes time, patience, and discipline. Saying no quickly protects you from regret later. Moral lessons, point-wise. 1. Simplicity is powerful. A clear and simple approach often wins over complex strategies. 2. Be consistent, not reckless. Small, smart steps are better than big, risky moves. 3. Avoid get-rich-quick traps. If it sounds too good to be true, it usually is. 4. Practice patience and discipline. Real success builds over time, not overnight. 5. Protect yourself with skepticism. Trust your gut and say no to shady or rushed opportunities. I have a house that I bought 55 years ago. It's warm in the winter, it's cool in the summer. It has everything I wanted, plus it has all kinds of good memories. Like my kids, I have good thoughts about that. I can't imagine living any better. Explanation, understanding and teaching way. This quote is spoken by someone reflecting on a home they bought 55 years ago. It highlights a deep sense of satisfaction, comfort, and emotional connection with the house. The speaker appreciates the physical qualities of the house, how it stays warm in winter and cool in summer, showing that it serves its purpose well. But even more important than comfort are the memories made there. The house isn't just a building, it's a place filled with love, experiences, and cherished moments, just like the feelings one has for their children. The speaker ends by saying, "I can't imagine living any better," which tells us they feel complete and content. They don't desire anything more, not a bigger house, not a newer one, because what they have is deeply meaningful to them. Moral, point-wise. 1. True happiness comes from contentment, not luxury. 2. Emotional value is more meaningful than material upgrades. 3. A home is more than bricks and walls. It holds memories and love. 4. Cherish what you have. It may already be the best you could ask for. 5. Gratitude brings peace and lifelong satisfaction. I am doing what I enjoy the most. I tap dance to work every morning. I love what I am doing. There is really nothing about my job that I would trade in any way. It's the perfect job. If it wasn't, I would be doing something else. Understanding and teaching explanation. This quote beautifully expresses the joy and fulfillment someone feels when they are truly passionate about their work. Let's break it down in a simple and teaching-friendly way. I am doing what I enjoy the most. The speaker is saying that their work is not just a duty or responsibility, but something they truly love and enjoy deeply. I tap dance to work every morning. This is a metaphor. It means they are so happy and excited about going to work that it feels like dancing. It doesn't feel like a burden or a chore. I love what I am doing. They are emotionally connected to their work and it brings them happiness and satisfaction. There is really nothing about my job that I would trade in any way. They find their job so perfect and fulfilling that they wouldn't want to change any part of it. It's the perfect job. If it wasn't, I would be doing something else. They believe life is too short to do something you don't enjoy. If the job wasn't this great, they wouldn't hesitate to leave it and pursue something better. Moral of the quote, point-wise. 1. Choose a career that excites you every day. When you love what you do, work becomes joyful and effortless. 2. Happiness in work leads to personal fulfillment. Loving your job can improve your mood, health, and overall life satisfaction. 3. Don't settle for less. If your current path doesn't make you happy, have the courage to change it. 4. Passion fuels success. Being passionate makes you more creative, committed, and driven. 5. Work should feel meaningful, not forced. When your job aligns with your interests, it no longer feels like work. You have to think for yourself. It always amazes me how high IQ people mindlessly imitate. I never got good ideas talking to other people. Understanding and teaching explanation. This quote emphasizes the importance of independent thinking. Let's break it down part by part. 1. You have to think for yourself. This is a call for self-reliance in thought. Instead of blindly following others, develop your own ideas, beliefs, and solutions. Independent thinking leads to innovation and personal growth. 2. It always amazes me how high IQ people mindlessly imitate. The speaker is surprised that even highly intelligent people often copy others without question. Intelligence alone doesn't guarantee original thinking. Many fall into the trap of conforming to what others say or do, simply because it's easier or safer. 3. I never got good ideas talking to other people. This line doesn't mean we should isolate ourselves, but highlights that the best ideas often come from deep personal reflection, not from simply repeating others' thoughts. Great ideas usually arise when we give ourselves space to think freely. Moral point-wise: 1. Think independently, don't blindly follow others. 2. Intelligence is valuable, but originality is powerful. 3. Self-reflection often leads to the best ideas. Question norms, even if they come from smart or popular sources. 5. Your own voice can create something no one else has. What we learn from history is people don't learn from history. Understanding and teaching explanation. This quote may sound confusing at first, but it's actually very powerful. It means that even though we have so many lessons recorded in history, wars, mistakes, injustices, economic crashes, and more, humans keep repeating the same errors. We could avoid problems by studying history and learning from it, but often we don't. People forget the past or ignore its warnings. For example, we've seen how hatred and division can lead to violence, yet similar conflicts keep happening. Economic crashes have happened due to greed or lack of regulation, yet similar financial behaviors return. Climate warnings have existed for decades, but meaningful action is often delayed. So, the quote is a criticism of human behavior. Despite having so many historical examples to guide us, we don't always use them to improve the future. Moral lessons point-wise. 1. Learn from past mistakes to avoid repeating them. 2. Study history not just as facts, but as guidance for better decision-making. 3. Awareness of history builds wisdom and responsibility. 4. Ignoring history can lead to unnecessary suffering. 5. Personal and societal growth depends on reflection and change. When people tell me they've learned from experience, I tell them the trick is to learn from other people's experience. Understanding and teaching explanation. This quote highlights a smarter way of learning in life. Most people believe that personal experience is the best teacher. They go through things themselves, make mistakes, face consequences, and learn from them. While that works, it can also be slow, painful, or even risky. The quote suggests a wiser approach. Instead of waiting to make mistakes yourself, observe and learn from what others have already gone through. People all around us, family, friends, mentors, even historical figures, have experienced things and made both good and bad choices. If we pay attention to their stories, decisions, and outcomes, we can gain valuable lessons without having to suffer or fail ourselves. It's like reading the map before going on a journey, rather than wandering and getting lost to figure it out. Moral points. 1. Learn smart, not hard. It's better to learn from others than to wait for life to teach you the hard way. 2. Observe and absorb. Pay attention to the experiences of those around you. 3. Avoid repeat mistakes. Don't make the same errors others already made and regretted. 4. Gain wisdom early. Learning from others helps you grow faster and make wiser choices sooner. 5. Respect mentors and elders. They have lessons to offer from the roads they've already walked. 6. Be open-minded. You don't have to experience everything yourself to understand its value. The Orchard of Patience, a story of the wise investor. Once upon a time, in a small village nestled by rolling hills, lived a humble man named Kiran. Kiran wasn't a wealthy man, but he was curious, observant, and patient. More than anything, he loved to learn how things grew: trees, ideas, and even money. One day, while visiting the town square, Kiran overheard a conversation between two merchants arguing about which fruit was better to plant: fast-growing but tasteless berries, or slow-growing mango trees that bore sweet fruit for generations. An old sage sitting nearby chuckled and said, "Plant what you understand, nurture it with care, and be willing to wait for the harvest. That's the secret to wealth." These words echoed in Kiran's mind for days. Later he met a traveller who told him about something new: investing. The traveller explained that buying shares in a business was like planting a tree. You weren't just tossing seeds, you were choosing a tree whose fruit you'd harvest for years to come. Kiran took this wisdom to heart. Instead of chasing every business he heard about, he began studying companies like he would study trees. He asked, "Do I understand what this company does? Is it planted in good soil, strong fundamentals? Will it still be growing fruit 10 or 20 years from now? Can I buy it for a reasonable price?" Over time, Kiran only invested in a handful of businesses, but they were strong, reliable, and easy to understand. Some people laughed at his boring choices and slow-growing garden, but he ignored the noise. Years passed, and while others ran from one fad to another, Kiran's small portfolio grew steadily. Like his orchard, it wasn't flashy, but it was fruitful. Each year, it gave more than the year before, and with every passing season, his patience was rewarded. When people asked Kiran for his secret, he simply said, "I only buy what I'd be happy to hold for 10 years. If it won't feed me tomorrow, I don't pluck it today." Moral of the story: investing is not about speed, but about strength, simplicity, and staying power. Important teaching points. 1. Understand the business. Only invest in companies you truly understand. Complexity invites risk. 2. Think long-term. Ask yourself, will this company earn more in 10 or 20 years? If yes, it may be worth owning. 3. Buy at a rational price. Don't overpay, even for great businesses. Value matters. 4. Hold with conviction. If you aren't comfortable owning it for a decade, don't buy it for a day. 5. Be selective. You'll only find a few truly great opportunities. When you do, invest meaningfully. 6. Focus on earnings growth. As a company's earnings grow, so will the value of your portfolio. Follow the earnings, not the noise.